operation in the capital of Venezuela. Overwhelming American military power, air, land, and sea, was used to launch a spectacular assault. And it was an assault like people have not seen since World War II. All Venezuelan military capacities were rendered powerless as the men and women of our military, working with U.S. law enforcement, successfully captured Maduro in the dead of night. We're going to run the country until such time as we can do a safe, proper, and judicious transition.
Now, Maduro and First Lady Celia Flores are charged with narco-terrorism conspiracy, cocaine importation conspiracy, and weapons offences. Now, the Venezuelan leader is scheduled to make his first court appearance in New York City later today. Take a look at this detailed report.
Venezuela's toppled leader, Nicolas Maduro, was in a New York detention center on Sunday, awaiting drug charges. That's after President Donald Trump ordered an audacious raid to capture him, saying the U.S. would take control of the oil-producing nation. The image of the 63-year-old Maduro blindfolded and handcuffed en route to the U.S. has stunned Venezuelans. It was Washington's most controversial intervention in Latin America since the invasion of Panama 37 years ago. Maduro is due to appear in a Manhattan court on Monday.
Good night. Happy New Year.
While many Western nations oppose Maduro and say he stole the 2024 election, there were many calls for the U.S. to respect international law and resolve the crisis diplomatically. There were also questions over the legality of seizing a foreign head of state. Democrats say they were misled at recent Congress briefings and demanded a plan for what is to follow. At home, Maduro allies were still in charge and have denounced what they call kidnapping as part of an imperialist oil grab. The UN Security Council plans to meet on Monday to discuss the U.S. move, which Secretary General Antonio Guterres described as a dangerous precedent. Russia and China, both major backers of Venezuela, criticized the U.S. Pope Leo said he was following events with a soul full of concern and called for Venezuela to stay independent and respectful of rights.
In Venezuela.
Well, it won't cost us anything.
Trump said the U.S. would, for now, manage the South American nation, plus its oil reserves. It is unclear just how Trump plans to oversee Venezuela. Trump's focus on foreign affairs fuels Democrats' criticism and also runs the risk of alienating some supporters who have backed his America First agenda and oppose foreign interventions.
Let's also now listen into U.S. Secretary of State Marco Rubio defending the recent U.S. operation in Venezuela that led to the arrest of the country's longtime leader, Nicolas Maduro, saying that congressional authorization was not required for the same. Listen in.
This is not an invasion. We didn't occupy a country. This was an arrest operation. This was a law enforcement operation. He was arrested on the ground in Venezuela by FBI agents, read his rights, and removed from the country. I encourage everyone, I know it's Sunday, people are busy, but the indictments have now been unsealed. People should read this indictment. They should read this indictment. They should read what this man did for the last 15 years of his life against the United States, him and his wife. He was arrested. Obviously, this was not a friendly territory. So in order to arrest him, we had to ask the Department of War to become involved in this operation. The Department of War went in, they hit anything that was a threat to the agents that were going in to arrest him, and they hit anything that was a threat on the way out.
That was all the developments that have taken place over the weekend in Venezuela. But how will all of this impact our own markets, or will there be any impact? Our research team is here to tell you just that with the trade setup, stocks that are likely to be in the news, and of course the setup on the F&O side of things as well. First up, Gaurav is here to tell us all the market cues we need to watch out for. Gaurav, good morning.
Good morning. If you look at Nifty, we have already seen Nifty actually breached its 52-week high and all-time high level, and currently it ended at around 26,330. So what's next is that if you look at open interest data, it suggests that there is some support building up in the put side of Nifty. In fact, 26,200 is the level that we should be watching out for. In fact, in case if there is any downside, and at the same time on the upside, 26,500 is something can be act as resistance. Apart from that, if you look at sector-wise performance, all the sector ended in green except for FMCG. within FMCG also, if you look at ITC, that was down, and that was one of the key reason why FMCG index was down. Apart from that, Nifty Energy, if you look at that index, it was up more than 2%. So let's see if any gist is left in this index. Weekly, if you look at the performance, Nifty Metals and Nifty PSU banks actually led the rally in the last week. So let's also watch out for all the stocks in Nifty Metals and Nifty PSU banks. Remember, results are also coming in. So let's see if it is going to have any grip on the indices. Other than that, if you look at the specific stocks, watch out for IDBI Bank. It was up more than 10%. And remember, on the weekend, we also saw quarterly updates coming up from the bank, which was healthy. Other than that, ITC, Sapphire Foods, both were down almost by 4% in the last trading session. And let's see if there is any action which can be seen in these stocks. TFCI, if you look at this stock, this was down almost by 20%, and now we have got to know that Ekta Halvasia, the investor, has bought around 3.7 lakh shares in the company at 55.14 rupees a piece. So let's see what happens in this stock. Lastly, on the results front, we have Axita Cotton, CGD Petrochem, and KSH International. All these companies will come up with their quarterly results today. And if you look at the global events, we've already seen some events happening in the US and Venezuela. So let's see if it has any grip on the Indian market today.
Oh, there is a lot to track today. Gaurav, thank you for that update. And to tell us what all the stocks that should be on your radar, Ria is here with that very, very long list. Ria, morning.
Well, good morning, Homer. A very long list indeed, and starting off with the Q3 updates. First up is Bank of India. The deposits as well as the gross advances in the domestic business have seen growth of roughly 13% and 15% on a year-on-year basis. For PNB, the domestic business has gone up by roughly 3% sequentially and 9% on a year-on-year basis. For Avenue Supermarts as well, healthy growth seen in the standalone revenue coming in at roughly 17,600 crores in this quarter. For Union Bank, the advances have seen an increase of roughly 7.5%, while the domestic deposits have gone up by roughly 3.5% compared on a year-on-year basis. For Hindustan Zinc, the mined metal production has come in at roughly 276 kilotons, going up by roughly 4% on a year-on-year basis. For IDBI Bank, the total business has declined by 2% on a sequential basis, but up 12% on a year-on-year basis. For Vedanta Zinc, the aluminum production has seen an increase of roughly 1% compared to Q3 of last year. And for Bajaj Finance, the AUM growth has been in line with the company's guidance given last quarter, that was 22 to 23%. Moving away from the Q3 updates, Adani Enterprises has approved a fundraise of 1,000 crores with a green shoe option of 500 crores. For Coal India, its arm Bharat Coking Coal has filed for an IPO, so this stock could also be in focus on the back of that. Trident's Group CFO Rahul Rungta has resigned with effect from the 2nd of January. For Kiri Industries, this company has received roughly $689 million from Dystar stake sale after a legal battle. And remember, the stock has also been in focus over the last couple of weeks, so watch out for this one in today's trading session as well. And the last stock is Nibe Limited, backing an order worth roughly 293 crores from the Indian Army for the manufacture and supply of ground equipment for universal rocket launcher systems.
Ria, thank you for that update there. Lastly, Sudarshan joins in with cues from the FNO space. Sudarshan, good morning. It's a record high. What is the FNO data pointing towards?
So good morning, Hormaz, and it's the first full week of 2026 and Nifty firmly holding the levels above 26,000, and now it has formed the base in the range of 26,000 to 26,100, and the support majorly is coming from Nifty Bank, especially from the PSU bank side. All the PSU banks have been moving higher over the last few days, and if you take a look of the FI's action, mostly their action has been on the long side. In the index futures, they have done buying. Also, they have added long positions of more than 2,500 contracts, reduced short positions of more than 11,000 contracts, and now their long exposure has increased to 11% from the earlier level of 9%. Now, in the options data on the call side, 26,200 has seen shedding, while the maximum addition was seen in 26,500, and on the put side, 26,300 and 26,250, both these strike rates have seen the addition, but at the same time, premium for both these options has moved lower. So I've just taken the support for Nifty 26,000, that's the 50-day moving average. Resistance 26,500 would be the first resistance. That's the most active option for Nifty. And as far as Nifty banking is concerned, support would be around 59,700 Friday's intraday low. One stock is in the band, that is SAIL, and two stocks that have been seeing fresh strong, SBI and Angel One.
Sudarshan, thank you for that update there. 90 points higher now is where the implied open currently is. Take a short break, continue our coverage on the US attacks on Venezuela on the other side. Stay tuned. Welcome back. And all the weekend developments that took place in Venezuela. Here are some expert views on the implications of this development.
What often happens in the United States before a major military operation, there is at least the modest effort to explain to the American people what exactly is at stake. And if you listen carefully to President Trump and Secretary Rubio and other key figures at the top of the administration, they've been a little bit vague about what exactly is at stake here. Is it illegal drugs? Is it illegal persons coming over the border? Is it oil, as your excellent guests have been speculating about? It hasn't been completely clear. And remember, Martin, the most important element that President Trump ran on when he was vying for his second term is no more endless wars, no more reaching out and engaging in military operations that have nothing to do with making America great again. So I think he's going to have some explaining to do to his very base that is wary about some of these international engagements.
I think a lot of people are basically thinking about, what's going on in Venezuela, right? Especially, given all these political turmoil. But very importantly is that this is something that is not really completely new, right? So of course there's military action, but at the same time, you look at like half a year ago, there's already U.S. fleet around the coast of Venezuela, right? So basically, a lot of those oil prices, even though that will give some oil price volatility going forward, but at the same time, a lot of things we think have priced in the oil price already. So that's number one.
And now this Venezuela conflict also puts companies like ONGC and Reliance Industries in the spotlight. Why so, and what are the implications? Sonal is joining us to explain just that. Sonal, good morning.
Good morning, Hormuz. Well, a lot has been happening. Now, do remember in April 2025, Donald Trump had put sanctions on Venezuelan oil, and that's something that would change now, that would reverse now with American companies or US companies entering the market. That would mean there could be some pressure on oil prices because more supply would come by. Now, let's talk about company-specific data. For ONGC, they have investments in Venezuela. San Cristobal project, where ONGC Videsh, that holds 40% participating interest in that field. OVL, Indian Oil Corporation, and Oil India also hold via JV 11% stake in Carabobo 1 field. So these are some investments that ONGC has. Now, remember, because of all the sanctions that had come by, the company could not go ahead and execute the exploration that they were having and that particular field, because there was blockage to access to rigs, equipments and services needed to sustain the output. Also, Venezuela failed to pay dividends worth $536 million to ONGC since 2014. Now there's a possibility that this money could come back to ONGC, so that definitely is a big positive for them. In fact, there's a PTI report which suggests that once sanctions are eased, or ONGC Videsh could move rigs and other equipments from India to Venezuela, and this could increase their output that had plummeted to as low as 5,000 to 10,000 barrels per day to now 80,000 to 1 lakh barrels per day. So the output could increase, and that is something which will be positive, along with the dividend that ONGC will now receive. For Reliance Industries, there was a long-standing pact that they had for Venezuelan oil. It was a 15-year-old pact, but of course the sanctions impacted that. Analysts are suggesting that this could start now. There could be some discount that Reliance Industries could get that on that as well, and that is something which will improve margins for them. So yes, some positive news would be expected because of these updates.
Yes, we'll keep an eye out on both of these names as well. Sonal, thank you for explaining that to us. Now, in a separate development, Donald Trump, replying to a question on India and its purchases of Russian oil, had this to say. Listen in.
If you want to end this conflict, then put pressure on Putin's customers. He sanctioned the 2 largest oil companies in Russia, which is the biggest pressure anybody's put on Putin since the war started. But we have 85 co-sponsors to give this president...
It's hurting Russia very bad, the sanctions.
Oh, yeah. So this bill would allow...
And India also is both.
Yes, sir. So he put a 25% tariff on India for buying Russian oil. I was at the Indian ambassador's house about a month ago, and all he wanted to talk about is how they're buying less Russian oil. Would you tell the president to relieve the tariff? This stuff works. So I'm hoping we'll bring the bill up, and it's from 0 to 500. He picks the number, Nobody else does. But if you're buying cheap Russian oil, keeping Putin's war machine going, we're trying to give the president the ability to make that a hard choice by tariffs. I really do believe that what he did with India is the chief reason India is now buying substantially less Russian oil. So I hope we pass this bill soon. And after this...
They wanted to make me happy, basically. He wanted to... Modi's a very good man.
Yes.
He's a good guy. He knew I was not happy. And it was important to make me happy. They do trade.
Yeah.
And we can raise tariffs on them very quickly, and it would be
People are
very
afraid
bad
of that.
for them.
We'll take a short break. Cues from the commodities market on the other side. Stay tuned. Welcome back, and as promised, Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. The whole host of developments over the weekend, and the oil prices are seeing a negative reaction to it.
Oh, well, yeah, absolutely, because the markets are reading it in various ways. To begin with, Hormuz, it always was the case that, one, Venezuela is not such a big of a producer. It does less than 1 million barrels per day, and we're looking at an excess of 2.5 million barrels per day for the year 2026. The other thing is that the U.S. strike on Venezuela has inflicted no damage on the country's oil production and refining industry. So all we are looking at is perhaps more investments coming into the country, reviving of the oil there. So what we are looking at perhaps in 2 to 3 years is more oil coming in from Venezuela. So no damage, and the fact that 1 million barrels per day of a loss is not too much, given the fact that much of that was going to China, and China perhaps could be buying it from other countries, is what seems to be relieving the markets right now. But what has led to a reaction in the international market clearly has been for the precious metal prices. We did see gold prices surge above $4,400 an ounce. Silver has gained 4% in the Asian markets right now. Copper is up 2% as well. So the money moving into tangible commodities continues to be quite strong. This also is on the back of the fact that while, of course, Venezuela is a simmering factor right now, but the U.S.-Iran issues could lead to higher prices also. And then the U.S. president saying that he could be looking at Colombia, Mexico, Cuba in terms of some action as well, is what has led to geopolitical premium building up in many of these commodities.
Manisha, thank you for that update there. Oil prices in an oversupplied market too, seeing a negative reaction. HDFC Bank's business updates on your screen. Gross advances up 11.9% from last year for the December quarter. So more updates coming in as we speak. So we'll be reacting to that. Average advances under management also up 9% from last year to 28.6 lakh crore. We'll talk more about this on the other side. Take your leave on this edition of Power Breakfast. From me and the team, thank you for watching. Bazaar Morning Call on the other side.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Starting a new week, we're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Nigel, both back from breaks. Short and one slightly longer, but not long. Guys, Happy New Year. Welcome back.
Happy New Year, guys.
Happy New Year. Recharged, reset, and ready for 2026. So to new beginnings.
Well, that's right. It was a good break for me. Happy to be back as well. Rested it up and going to miss the kids among everything that I did. But that's the way of life. Let's get cracking with the markets.
Absolutely. And, if you thought 25 was wild, 26, how do you describe it?
It already started off.
It is wild and how. And events over the weekend, you can use all kinds of adjectives, but I'll just lay the news out for you because I don't think I need to do it. So over the weekend, the US carried out large-scale strikes against Venezuela. Remember, over the last many months, they'd been building up naval presence. There was almost a blockade around Venezuela, trying to sort of, cut sea lanes and sort of, they were, of course, also attacking boats which perhaps were carrying drugs into the US out of Venezuela. So all kinds of action. And, of course, it's now culminated into these strikes over the weekend. Now, US has captured President Maduro and his wife and flown them back to the US and indicted them on charges of narco-terrorism, et cetera, a bunch of other things as well. I mean, brief few hours worth of operation, apparently no casualties on the US side, and the president of Venezuela in the US custody in New York, about to face charges. So it's just quite absolutely incredible. Now, Trump essentially is saying that US will run Venezuela until a leadership transition could be organized. And this is why Venezuela is important. Much has been said about this. They've got the world's largest proven oil reserves. Of course, this is their own claim. Some $300 billion worth of plus of oil under Venezuelan land. That's about 1/5 of global reserves. And of course, this certainly means near term anything can happen. But I would imagine that over a medium to longer term, this is negative for oil prices. Essentially, it means more oil into global markets from Venezuela. Remember, at the peak back in early 2000s, exports out of Venezuela, oil exports out of Venezuela were some 3 million barrels per day. Recent reports suggest that it's not even 1 million barrels per day. Actually far lesser than that with US sanctions, blockade, etc. So, the trajectory of exports, the quantum of oil which goes out of Venezuela is higher. We can quibble about whether infrastructure is there, people are there, and it'll take time, lots of investment because it's been neglected, and et cetera, But over a period of time, that less than 1 million barrels per day of exports will go higher. And that essentially is what I'm talking about, the fact that this is negative for oil prices in the long run. That's that. Now, Trump, of course, is saying that there is a second wave of American attacks, which perhaps will come if cooperation from the remaining Venezuelan leaders of the government, the current government, is not forthcoming. So, for example, you have the vice president in Venezuela essentially saying that, well, this is illegal, this is terrorism, et cetera. Rubio has come out and said, well, they need to cooperate with, of course, the current U.S. administration. We'll see how it goes, but Trump already saying, well, we're prepared to go in again if the cooperation is not forthcoming. UN Security Council will hold an emergency meeting on Monday. I suspect not very much will come out of it, though. OPEC Plus has agreed to keep production steady, and this was widely expected. The meeting was over the weekend till the end of March. But importantly, they said that and remember, Venezuela is one of the founding members of OPEC, along with other Middle Eastern countries. They said, OPEC Plus delegates said that they did not discuss Venezuela and what has happened there over the 10-minute video conference. So that's a big global story. And think about it, right? It's not just about Venezuela. It's not just about Venezuelan oil as well. This will send what U.S. has done in Venezuela with the capture of Venezuelan president. It's going to send a chilling impact, a chilling effect across countries around the world. Latin America, of course, the Western Hemisphere is one. But even countries far-flung, Africa. Marco Rubio, for example, is on one of the networks in the U.S. essentially saying he was asked specifically whether this is about Venezuelan oil. He said, no, we've got enough oil under our own land. We don't need Venezuelan oil. This is about fortifying U.S.'s supremacy in our region, which is our hemisphere, which is Latin America, even Canada, et cetera. So I would expect that with this kind of action, countries will fall in line. I would say even countries like Russia, countries like, who knows, China, of course, is a holdout. We'll have to see what they do. But the action shows that Trump and the US are not just talking. I mean, they're ready to act if necessary. So right, wrong is a separate matter. But I think this will send a very, very clear message that, they're up for anything, basically. I'll just leave you with levels here. So markets, the Nifty Bank, etc., hit all-time highs last Friday. We've been creeping higher, and finally we kind of took out those previous highs. And this is the pivot level, right? I mean, we, by the way, had a test of the 40-day. Actually, we broke the 40-day moving average, but those supports held. And now we're above the 20-day. So those are the levels, 25,540. You can look at extensions on the higher side. But for now, I'll just put out the 20 days. 25,540 on the Nifty, 59,277 on the Nifty Bank as well. So a lot of focus around, of course, what's happening with geopolitics right at the beginning of the year and implications for single stocks. We'll talk about all of that in our top 10 segment. But Nigel has walked across with what the positioning is like as far as the F&O market is concerned. Nigel, over to you.
Well, before I went into the break, I said before I come back, I won't be surprised if we are at fresh all-time highs. And on Friday, in fact, we had both the Nifty and the Nifty Bank go ahead and visit those levels. Well, in terms of participation, the DIs and the FIs, both of them were buyers. But keep in mind, the FI participation is very low. As the course of the week does pick up, in fact, you'll see participation as well pick up from the FIs. But clearly, there were signs of short covering on the Nifty itself. Nifty went up, the Nifty open interest was down, and there were signs of long build-up that we saw on the Nifty Bank. And that perfectly reflects with what the FI activity showed, because they covered some short contracts and they added some long position, which showed you there's a swing factor of close to around 14,000 contracts out here. But keep in mind, they're still net short with 89% of their positioning on index futures on the short side. What also added to the enthusiasm was the FIs. They didn't just cover some shorts. They also wrote some puts. And they wrote puts rather aggressively in Friday's trading session. And there were a couple of strikes that were active. 26,300, 26,250 put, both of them very, very active in Friday's trading session. Just one word of caution out there that the Nifty PCR, because the kind of put writing that was seen both from the FIs as well as other market participants, the PCR has perked up closer to around that 1.5. Normally, we see some kind of consolidation, some kind of pause, which isn't so bad when the PCR goes to the upper end, which is at around 1.6. So just keep that in mind. The Nifty, well, support levels come in at the low that we saw on Friday. And otherwise, you're looking at the 20-day which is ballpark around the 26,000 odd mark. But I think the trend seems to be up on the Nifty. You have a lid on crude oil prices, what's going on with regard to Venezuela. Also, there is some cushion for rates softening globally. If crude oil is going to be well behaved. And then there'll be that enthusiasm in the run-up to budget 2026. Put all that together. I think the trend for the Nifty could be up, at least for the next 18 to around 20 trading sessions in that run-up to budget 2026. Stocks to track post the Venezuela issue. Well, beneficiaries from the US takeover of Venezuela oil could potentially be Reliance because of that GRM factor out there. They could get some cushioning out there. And we've seen that in the past. And ONGC, because of the outstanding dues, could come to them. While I'll also keep an eye out on gold financiers. Yes, these stocks have run up considerably, but gold could remain firm. And also, you could see the cost of borrowing could soften if central banks, go ahead and cut rates. So I think gold financiers will continue to remain in focus, putting up a few of them up on the screen.
Indeed, spot gold prices did move up 1.5% on the back of the geopolitical tensions. But for now, Asia is very, very strong, and they're shrugging off any sort of noise on the geopolitical front. You've got a 2.5% gain coming in on the Nikkei, that's the Japanese index, which has its first trading session of 2026. It was shut last week on account of the New Year holidays. And the other big mover is the Korean market. And across the board over here, it's the defense stocks which are doing very, very well. So in Japan, it's Kawasaki Heavy Industries, Mitsubishi Heavy Industries. They've gained close to about 6%. In the Korean markets, it's Hanwha Aerospace, Pungsan. These stocks are all trading higher. So defense seems to be the theme across Asia. Hang Seng is flattish, just up close to about 0.1%. But let's get to the equity calls as we begin trade get set for trade in India. Venugopal Gare of Bernstein says India has entered 2026 as one of the most expensive markets globally with 20 times plus forward PE. This compares with a high of 15.1 being the average across 15 economies that they are tracking. They say we are back to a phase of hefty valuations across markets, which in the past have rewarded cheaper markets well, as opposed to the phase when you started FY24, when more expensive markets attracted flows and got costlier. Moreover, their recent report discusses how years with limited catalysts are more of a valuation play and catch-up trades rather than being earnings-driven. He adds, while 2025 has been a modest year for earnings, even after assuming a 13.5% earnings CAGR till FY28 and 19 times multiple on the forward EPS, they come with a Nifty target of 28,100, which is a modest return of 7.5% this year. Their focus is on absolute return. They have cut the India rating to neutral. All right, let's also listen in to the latest statement that we've heard from Donald Trump when it comes to the India-US trade tensions. This is, response that Donald Trump had to a question on India and its purchases of Russian oil. This is what he had to say.
If you want to end this conflict, then put pressure on Putin's customers. He sanctioned the two largest oil companies in Russia, which is the biggest pressure anybody's put on Putin since the war started. But we have 85 co-sponsors to give this president...
It's hurting Russia very bad, the sanctions.
Oh, yeah. So this bill would allow...
And India also is pulled.
Yes, sir. So he put a 25% tariff on India for buying Russian oil. I was at the Indian ambassador's house about a month ago, and all he wanted to talk about is how they're buying less Russian oil. Would you tell the president to relieve the tariff? This stuff works. So I'm hoping we'll bring the bill up, and it's from 0 to 500. He picks the number. Nobody else does. But if you're buying cheap Russian oil, keeping Putin's war machine going, we're trying to give the president the ability to make that a hard choice by tariffs. I really do believe that what he did with India is the chief reason India is now buying substantially less Russian oil. So I hope we pass this bill soon. And after this...
They wanted to make me happy, basically. He wanted to... Modi's a very good man.
Yes.
He's a good guy. He knew I was not happy, and it was important to make me happy. They do trade. Yeah. And we can raise tariffs on them very quickly, and it would be very bad for them.
You know, lots of social media posts, etc. Rima, we're talking about that this is a threat once again. Yeah. But this is not a threat. He's kind of acknowledging the fact that, I mean, basically praising himself, saying, well, it's me who's at work. And that's the reason why India's purchases of Russian oil, etc. have come down.
So it's not a warning, but just an acknowledgement of the fact that the punitive tariffs have worked and India's reduced its Russian oil.
And it's important because, I mean, I saw a lot of social media posts, etc., saying that, well, you know, he's threatened even higher tariffs once again, etc. So that's that. Well, Ed Yardeni is president at Yardeni Research. He's with us now. Ed, good morning. Great to have you with us here. You know, incredible events over the weekend, Ed. And let's just talk about the effect, right? We'll talk about oil, etc. in just a bit. But the broader message I was saying earlier, and this is what I think, that it'll have a chilling effect across the world, right? I mean, who wants to end up like the president of Venezuela, especially some of the smaller Latin American countries? So people will start to take up the U.S. on its first offer and not... do you think so? I mean, fundamentally, do you think this changes the game?
I think when it comes to geopolitics, we get into a very unpredictable possibilities. I think the problem is we really don't know what's next in Venezuela. We don't know the extent to which the Venezuelan government that's left is going to cooperate with the United States, or the extent to which they're not. To the extent that the cartel is involved in the power structure there, they may not be very willing to just kind of roll over and move out of Venezuela. So that could be a complicating issue. Another possibility is that this might lead China to actually increase the pressure on Taiwan, maybe not invade it, but just continue to accelerate the hostile moves towards Taiwan. So there could be adverse consequences as well as some of the positive consequences, at least from the point of view of the United States. I mean, clearly it would be good from a Trump perspective if carrying a big stick works. Maybe you don't have to hit people anymore. You just have to threaten them after what just happened in Venezuela.
And Canada, right? I mean, all these are crazy things, but I'm just asking you, Canada, for example, a lot of leaders were saying, well, they want our oil. But, well, they don't need the oil, right? I mean, they've got right. Venezuela in that sense. I mean, they don't have it, but for all practical purposes in that sense. So what's your sense now? I mean, what happens? it's basically consolidating American influence in that entire hemisphere, isn't it?
Yes.
And kind of throwing out, at least, I mean, they'll try to throw out China.
Yeah, I think you're correct. I think this is going to increase, consolidate U.S. power in the Latin America and maybe influence the Canadians some more. But clearly the message is we want to keep other superpowers out. We don't want the Chinese meddling in Latin America. And they have been in Latin America in a big way, running ports in the Panama Canal, building production facilities in Mexico. So this is a clear message to China in particular that we don't want them to play in our playground. And the same thing for Russia. We don't want the Russians in Cuba. We don't want the Russians supporting Venezuela. We want everybody out. On the other hand, we're not going to be necessarily even Steven about it in the sense that, well, we certainly don't want the Chinese to invade Taiwan. And that's the question is, can the United States impose this Monroe Doctrine that we had back when President Monroe insisted on the United States having sole superpower status in this hemisphere? Can we now, do we have to worry about China saying, well, if that's the way you want to play it, if you want to play spheres of influence, all the more reason we should take over Taiwan. So it's a dangerous game in geopolitics, and we'll see how it plays out. But I think the stock market still has the attitude that geopolitical crises are buying opportunities, and we can see by the reaction of the markets that are open that we aren't even getting a buying opportunity. The markets are kind of ignoring the whole thing, other than gold. Gold obviously has had a good rally on it.
Ed, it's now the Monroe Doctrine, right? A portmanteau of Monroe and Donald Trump.
Right.
But U.S. can exert influence in its sphere, which extends to, say, Latin America, Mexico, etc. But as you said, just harping back on the China-Taiwanese market, because it goes back to what Xi Jinping said in his New Year address, the reunification with Taiwan is unstoppable now. And if China gets control of, say, the semis in Taiwan, TSMC, the implications for AI are profound. China can very well, justify its own actions in Taiwan, saying that if you can cause a regime change in your sphere of influence, so can we. So what kind of a geopolitical landscape are we entering 2026? And what does it mean for various asset classes?
Well, geopolitically, it's all quite dangerous, the game that everybody seems to be playing around the world here. The United States is certainly getting stretched. I mean, on Friday, President Trump warned that the Iranians, that if they shoot any protesters, he basically implied that we're going to go over there and start shooting. And we just, what was it, a week or two ago, the United States bombed some jihadist camps in Nigeria. So, this is the peace president. But on the other hand, he's certainly demonstrating America's military power around the world. But China may view this as a sign of weakness, that if they open up another front, that they really do attack or put a blockade around Taiwan, that the U.S. will be pretty much occupied in lots of other parts of the world and won't be able to give it full attention. Of course, the Chinese economy is not in good shape. It's not clear that China is going to take this as an opportunity to invade Taiwan. I hope they don't, but it's a tough call the way things are going.
Hi, Ed. Good morning and good to see you. Ed, you have been very, very bullish on gold, and numerous times, when you have joined us, you have been talking about the possibility of gold trending up. If I'm not mistaken, I think you don't rule out that gold doubles from here, say in the next 4-5 years or so as well. So your view on gold as an asset class, and also, what do you make of Trump's comments with regard to India and those tariffs? Social media is a buzz both ways, that either there's a deal coming or maybe a deal is far-fetched. Your take on that?
Well, I think with regards to India first, it seems to me that India is going to win here from what's just happened in Venezuela. It seems to me that the price of oil didn't react immediately to the downside. It's down a bit, and OPEC is still planning on maintaining their production. But there's a real possibility that the price of oil is really going to take a dive, in which case India would be a big beneficiary because then India really doesn't need Russia. India can get plenty of cheap oil in the global market in that kind of scenario, and can come back to the U.S. ambassador and then talk to Trump and say, we're not buying any oil anymore, and can we have a deal now? And so I think what we're seeing in the Indian market is some consolidation at the record highs, and I think if in fact a trade deal is worked out, which I think it will be, and India has access to cheaper oil, then the prospects are for the Indian market to go higher, in my opinion. I did think it would consolidate in 2025, which is what it's done, and now I think we're ready to move higher, recognizing, of course, that the valuation multiple is high, and so the upside may be somewhat limited. With regards to gold, since the beginning of last year, when gold rose above 3,000, I said I thought I was going to go to 4,000 by the end of 2025. We rose a bit above that. We're running around 4,400 now. I had been thinking we get to 5,000 by the end of 2026 this year. Now I'm thinking more like 6,000, and still predicting 10,000 by 2029. Now, having said all that, there's no magic model that I have here to value gold and to predict where it's going, other than seeing a very interesting relationship between the S&P 500 and gold. They do tend to go in the same trends. And if I'm right, that earnings will take the S&P 500 to 10,000 by the end of 2029, I think gold could get there as well.
Okay, all right, Ed, we'll leave it there. Thank you very much for joining us, and good speaking with you in very, very interesting times, unprecedented in more ways than one. We'll take a break, but let me just quickly run you through the interactions which are lined up here over the next 2.5 hours or so. 8:30, we have Dharmesh Kant of Chola Securities talking about specific stocks. 9 o'clock, we'll be joined by Alankar Garude of Kotak Institutional Equities to discuss the impact of semaglutide patent expiry, which comes up. 9:20, Ashwini Agarwal of Demeter Advisors and Pankaj Tibrewal of Ikigai Asset Managers are our market masters of the day. 9:40, management of PNB speaks with us on the outlook for H2 F5 26 and 27. And of course, the management of Bajaj Auto will be speaking with us on the back of the December auto sales numbers towards the end of the program. HPCL is with us. I mean, that's the big one, right? With everything which has happened with Venezuela, oil, etc. So we'll have Vikas Kaushal of HPCL with us in a bit from now.
Time to step into a quick break. Got a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. We're looking at Bajaj Finance, HDFC Bank, Marico, Nykaa, Bank of Baroda, Bank of India, ONGC, AU Small Finance Bank and RBL Bank. All of them will be reacting to positive news flow, while Avenue Supermarts will be the lone stock that will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. Let's get the GIFT Nifty up for you on your screen. On Friday, markets closed at record high levels, closing at the day's high. The GIFT Nifty is suggesting the momentum continues. It's a 100-point bump up to begin this trading week. Our research team is standing by to drill it down to the stocks you need to have on your radar where there is news. This is CNBC TV 18's list of top stocks for the day. And first up, Gaurav, lots of quarterly updates to reckon with. Begin with the big ones, HDFC Bank and Bajaj Finance.
Well, let's begin with HDFC Bank, because if you look at the numbers, they have reported 12% growth in its advances. Remember, this is the first time they're reporting double-digit growth in terms of loan book after the merger on a normalized base. If you look at deposit, that also grew almost by 11.5% in line with the growth of advances. And at the same time, if you look at system level growth, that came in at around almost 12%. So it is really in line with the system as indicated by management that in FY26 they will be growing in line with the system. Because if you look at FY25, the growth was just at 5.4% on year-on-year basis. Apart from that, Bajaj Finance, if you look at the numbers, AUM growth was in line with their guidance. Remember, last quarter they cut the guidance to 22 to 23%, and this quarter they have reported AUM growth of 22%. Customer franchisee, that improved almost by 19% on a year-on-year basis. If you look at new loans which were booked, that increased by 15%. If you look at the number, it actually looks lowest if you compare it since fourth quarter of FY24. But remember, there was a high base in third quarter of FY25, and that is the reason why the number looks low. So all in all, inline set of number, or rather we could say a better set of number for Bajaj Finance as well as HDFC in this quarter.
Okay, all right, Gaurav, thanks a lot for that. Going across to Mangalam, he's tracking quite a few updates as well. Avenue Supermarts, Marico and Nykaa. Hey, Mangalam, take it away.
Well, good morning. So Avenue Supermarts, the update was slightly soft. Why do I say that? Because, the standalone revenue for the company grew by 13%. The number you're looking at is around 17,612 crores. The 3-year CAGR for growth on the top line has been around 16%, so it's lower than that. And additionally, if you compare the number of stores last year to the current number of stores this year, the store additions have been 14% as well. So this implies there has been a negative same-store sales growth. However, my sense is that the realizations are also possibly lower because of GST cuts. So what was available at, say, 10 rupees same time last year is now available at 8 rupees. So there is that difference which is reflected in muted revenue growth. So it'll be very interesting to see what the street makes of these numbers, likely to open in the red. We have, the store additions which have come in better than expected, around 10 stores added in the third quarter. To that extent, again, the operating profits, the revenue mix of their third quarter numbers will be extremely crucial to track. You're looking at Marico, good performance coming in. Marico for the last many quarters and perhaps the next few quarters has been, reporting well and have been guiding for good numbers as well. They're saying the underlying volume growth in the India business is at high single digits. It's improved quarter on quarter. Add to that, Parachute continues to remain resilient. Value-added hair oil, which was under pressure for the last many years, over the last few quarters has begun to do well. So 20s is sort of the growth that they're seeing. Foods had a benign quarter, but premium personal care and digital first did well. The key raw material for their Parachute business, copra, is down 30% from the peak, and which is why they are likely to report EBITDA growth in double digits, and that's a positive, going with green on that one. And finally, for Nykaa, it's a good performance coming in yet again for Nykaa. Mid-20s sort of overall growth is what the company's reported this time around. And at the same time, if you look at the beauty business as well as the fashion business, consolidated net revenue growth is actually at the upper end of mid-20s. Beauty vertical's net revenue growth is expected to be again in the upper end of mid-20s. And fashion vertical, where the net sales value grew in mid-20s, the realizations were slightly lower out there, but it's again between 20 and 25%. That's a positive. So going with green on Nykaa as well as Marico, a red for Avenue Supermarts.
Okay, all right, Mangalam, thanks very much for that. Bank of Baroda, Bank of India are next with their updates. Gaurav is here with details. Gaurav, morning.
Well, yes, if you look at Bank of Baroda, it seems that the bank is actually on a trajectory of growth, which has been there for the last few quarters. Because if you look at the numbers, loan book growth, that is at around 14.5%, which is again higher than their own guidance of 11 to 13%. And within that, also, if you look at the retail advances that give almost more than 17%, this was actually indicated by the management earlier as well that in third quarter and fourth quarter, the growth will be higher. In terms of deposits also, if you look at the number, it came at around 10.3%, again in line with the system. And if you look at the CD ratio, it doesn't seem to be a problem for the bank for now. Apart from that, Bank of India, This bank also reported numbers which were higher than their own guidance. Loan book growth was at around 13.5%, higher than their guidance of 12 to 13%. And within that, retail, agri and MSME segment that grew almost by 17% on a year-on-year basis. And this also reflects 5% growth on a sequential basis. Deposit growth, that also came in healthy at around 11.6%, which is higher than their own guidance of 10 to 11%. So definitely, all in all, Bank of Baroda and Bank of India likely to open in green because we are seeing numbers which are better than their own guidance for this quarter.
Thank you. Moving on now to ONGC, which has investments in Venezuela. So Sonal joins in to explain that. Sonal.
Good morning. Well, yes, couple of investments that ONGC has in Venezuela. There's a 40% participating interest that ONGC Videsh has in San Cristobal project. Via JV with IOC and Oil India, they have 11% stake in another field. So yes, there are some dividends which are pending for ONGC to come by as well. Now remember, a US takeover for Venezuela's oil industry would also mean that the sanctions that there were on that crude would lift up. That would mean more oil activity coming by in Venezuela itself. And there could be some supply and there would be more supply and pressure on margins because of that. But if ONGC has the outstanding dues of around $500 million, that could come back to ONGC and that would be a positive. Other than that, Reliance also in the past has purchased 20% of daily crude requirement from one of the Venezuelan oil companies. If that comes by, Jeffrey says that would mean discounts of around $5 to $8 per barrel. That would meaningfully lift GRMs for Reliance Industries. So both of them tend to gain, going with green on these two stocks today.
Okay, all right, Sonal, thanks a lot for that. Well, let's hop across back to Gaurav. He's got some more updates for us. Gaurav?
Well, let's talk about AU Small Finance Bank. If you look at the growth for this bank, they have also been maintaining the growth about 20% for the last few quarters. And in this quarter as well, the growth came at around 24%, my apologies, for advances. Remember, if you look at deposit growth, that is also in line with the growth of advances. That came at around 23.3%. If you look at the bank's trajectory, let's also not forget that the bank is also going for its universal banking transition. So it is really a key thing to watch out that the bank is still growing about 20% despite all the changes. Apart from that, RBL Bank, the bank is reporting their numbers post the Emirates NBD deal announcement for the first time. For the last 3 months, we have seen bank rallying because of the updates. But now in terms of numbers, it looks like inline set of numbers because advances growth is at around 13%. But a key thing to watch out is that the secured retail advances that grew almost by 24% on a YOY basis and wholesale advances grew 19%. There was some fall in unsecured book as indicated by the bank already as their strategy. And that is the reason why the loan book growth overall looks 13%. If you look at deposit growth, that came at around 12% on a year-on-year basis. So all in all, good set of number from this bank as well for the quarter.
All right, and there's so many other stocks that we've not covered. There's Yes Bank, IDBI Bank, JNK Bank. We'll keep watching the ticker. Sudarshan has been updating them with the relevant information there. But here's a quick recap then of the top stocks. Stocks with positive news flow are Bajaj Finance, HDFC Bank, Marico, Nika, Bank of Baroda, Bank of India, ONGC, AU Small Finance Bank, and RBL Bank, while Avenue Supermart is the only stock which is on our radar that's likely to open in the red. So in a nutshell, it looks like the pre-quarterly updates are not bad as we begin the Q3 earnings season. But it's all happening in the world of crude. Manisha is now joining in for a complete roundup. Manisha, one would think that when there is such a big geopolitical shakeup, there would be a spike in crude prices, but the reverse has happened. Crude prices are actually negative now.
Oh, they are. And the reason for that is because the U.S. strike on Venezuela inflicted no damage on the country's oil production and refining industry. Instead, what they're talking about is that the U.S. companies will revive crude production going forward. So that would mean we perhaps are looking at sanctions being taken off, more production of crude in the years to come. But that really is about how much and when and which companies will really revive it. So there's a bit of an uncertainty onto that one. But at this point in time, markets do not see any reason to see further gains because remember, even if the Venezuelan crude does get out of the market, which is 1 million barrels per day, we are looking at an excess of 2.5 million barrels per day already for 2026. So no cause of concern there. But what has seen a lot of gain right now because of the geopolitics has been the precious metal prices. You have gold, which is back above 4,400. You have silver, which is trading 4% higher in the Asian markets right now. Even copper, for that matter, the tangibles seem to be doing really well. Copper is up 3% at this point in time. So tangible commodities and the commodities which have stronger fundamentals have continued to gain today also.
Thank you very much for that, Manisha. Let's slip into a very short break. On the other side, we'll invite Dharmesh Kant of Chola Securities, and all those stocks that we discussed which were in the news, we'll get his opinion on that.
Welcome back. You're tuned in to Bazaar Morning Call. As promised, we have Dharmesh Kant, Head of Research at Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning. Wishing you the best in 2026 and a very happy new year since it's the first time we're speaking. Well, Dharmesh, over the weekend, the big focus was with regard to US, going ahead and taking control of Venezuela. Now, we wanted to highlight a few stocks out here. And as my colleague Sonal told us, that ONGC could be one of those beneficiaries because there's an outstanding payment that could come in. While for Reliance, it gives them access to Venezuela crude, which in turn could support their GRMs. Your view on both these two stocks, ONGC as well as Reliance Industries?
Yeah, good morning, Nigel. Happy New Year to you and all at CNBC TV family. I hope this 2026 will be a much better and a steady year than the volatility which we saw in 2025. Having said that, I think, as far as the Venezuela crisis is concerned, what has transpired in Venezuela has to be seen over a period of time, because the business outlook, how it is going to unfold, and how Mr. Trump is going to negotiate all the past, contracts with the companies dealing with Venezuela, and India is in a corner as far as the Russian oil purchase is concerned. So maybe some negotiation out there can still be on the offing, and overall, I think it will be beneficial for the Indian companies. So ONGC, it's more of a one-off kind of event out there. Then it depends on their exploration and production going forward. And it's a long thing. It will take 1.5 years to play out. But Reliance can be the immediate beneficiary of it. Earlier, they used to draw quite a good quantity of oil from there, and various reports are suggesting, $5 to $8 per barrel kind of again. My own sense is it will be $3 to $4 per barrel, given the currency depreciation which we have seen recently. So overall, net constructive for Reliance Industries, and we have been bullish on this quarter for quite some time, given the sum of part valuation. So 2100 is the price target based on FY27 earnings estimates for Reliance Industries.
Dharmesh, hi, morning. Good to speak with you. Out of all the business updates, and there are, some 15, 20 business updates, pre-quarter updates, anything really stood out to you? Surprised?
Yeah, good morning, Prashant. Very happy New Year too. I mean, it was not a surprise, but again, confirmation of the fact which has been trending for last 4 or 5 quarters was the public sector banks when they came out with their updates. So for almost 3 or 4 quarters on a consistent basis, they have been delivering mid-teens kind of a growth numbers as far as their advances are concerned. As compared to the private sector players, I mean, HDFC came out with an update of 9% kind of advances growth. So clear advantage out there for them. The stock prices have rallied quite a bit, but I think more legroom is there for them to go ahead. We have been liking Bank of India from the space for quite some time. And we also have an IC on it at around 112, 115 kind of stock price level. The highlight was there that 13.6% was the overall gross advances growth, but domestic was 15% and retail was 17.7% with asset quality supposedly to be stable and good deposit growth. So I think going forward, as the steam is picking up, almost all the financial updates were great. But this is one which will again get a re-rating and likely a move by the time budget is rolled out can be 10 to 15% in the near term.
All right. Dharmesh, I wanted your view on some of these metal names, because metals clearly had a very, very good 2025, particularly towards the end. And some of them actually have shown strength. If you look at the valuations, actually they're looking a little bit elevated as of now. But metals is with momentum. Anything you like in this space? Metals, ancillaries?
Yeah, I think even 2026 would be good for the entire metal space. Given the fact that dollar index is not appreciating, that is where it is. And there's very high chance that 50 to the 75 basis point rate cut will come in US, given the government pressures which is there on the Fed. That is again a good beneficiary would be the entire metal space. And almost all the central bankers across the world has been accommodative monetary policy that also augurs well. I think if you look at historical trend, then the valuations do look on extended or elevated levels. But the type of numbers which are expected from the metal companies, these valuations may be justifiable if you forget the historical trend and value them on their. I mean, if the company is giving 15 to 20% kind of a profitability growth, why can't they command a P multiple of 12 to 14? Earlier, they used to be 7, 8 kind of a P multiple. So that re-rating is likely on the cards. So that is the take of the metal space. The stocks which we like here is one is the Hindalco, despite all the problems which they had, the fire and the debt issue. But I think Hindalco will remain to be in a good phase going forward. And on the ferrous space, we like JSW Steel quite a lot.
Yeah. Metals, autos, and PSU banks, right, Dharmesh? These are the three areas which have done very, very well in 2025. And actually, they've had a fantastic start to 26 so far. I mean, the few trading sessions that we've had. We had the December auto sales numbers. We'll have the Bajaj management join us a little later. Anything you like in that space?
Yeah, Prashant, I mean, auto numbers were great. If you look at on year-on-year kind of a comparison, almost everybody came out with 70 to 20% kind of a growth numbers. But you have to split it between two-wheelers and the three-wheeler, four-wheeler basket. As far as two-wheelers are concerned, the thing which I noticed was a declining trend in the month-on-month sales. September, October, November, and December, if you combine, be it Bajaj Auto or Hero MotoCorp or TVS Motor, they all have a slightly declining trend. I mean, that is a point to be, have in mind, having regard to the valuation multiples where they are trending out of now. But Maruti came out with a very strong set of numbers. I think going forward, there's a huge opportunity out there. Just to give you one macro number, I mean, there are 36 crores families in India. In last 20 years, the cars which have been sold is around 6 crores, around about. So, multiple headroom out there for the organic growth opportunity, almost 6x kind of a growth opportunity is there for the four-wheeler segment if you say one car per family. So I think Maruti has stabilized and consolidated its position quite well at the entry and mid-level segment. And that is one counter which I think will continue to do well. As far as two-wheelers are concerned, it will be more premium driven. I mean, almost 26 crore two-wheelers have been sold during the last 15 years. So that way, it's more of an upgrade and premiumization. And there, I think Eicher Motors stands a good chance. Going by the numbers as well, they have not shown a drift. So Eicher Motors from the two-wheeler pack and Maruti from the four-wheeler pack from the investment perspective remains the good buy. Others on decline, one can add.
Okay, all right, Dharmesh, request you to stay with us for just a bit. We'll take a quick break. But what lies ahead for the Indian market in 2026 and which factors will play the most important role? The results of the CNBC TV 18 market poll are coming up on the other side.
Okay, welcome back. I think 15 minutes to go for the pre-open session. Hormuz is here with the big movers that we saw on Friday, which were backed by heavy volumes. Hormuz, morning.
Good morning, Prashant. And PSU stocks were the ones that were outperforming on Friday, and particularly names like SJVN, that did very well. It was almost a double-digit gain on the stock during Friday's trading session, and it was the biggest single-day gain since March of 24. The stock has already gained in 3 out of the last 4 trading sessions. The volumes were the highest since July of 2024. Over 8 crore shares were traded on Friday, compared to a 20-day average of just under 32 lakh shares. And out of those 8 crore shares, though, only 91 lakh shares were marked for delivery compared to a 20-day average of just under 12 lakh shares. But the stock has been a bit of an underperformer. Like most PSU names, is down around 26% from its 52-week high levels. 2 names that were in the spotlight over the last couple of trading minutes of the session on Friday were Cupid and Tourism Finance. Both of them ended at a 20% lower circuit on Friday. And if you look at TFCI, there's 4.1 crore shares traded, the 20-day average of 50 lakh shares. And out of those 4.1 crore shares, 2.1 crore shares were marked for delivery compared to a 20-day average of around 25 lakh shares. And for Cupid, with a stock that ended at a lower circuit as well, the 2 crore shares were marked for delivery compared to a 20-day average of 42 lakh shares. And out of that, 62 lakh shares were marked for delivery compared to a 20-day average of 12 lakh shares. And lastly, of course, the name was Silver Touch Technologies. We spoke about this last week as well. The stock was up again on Friday, 5th straight day of gains. The stock is up almost 80% in the last 1 month. The stock has gained in 15 out of the last 18 trading sessions, so basically almost all of December. And volumes in 3 out of the last 4 trading sessions have been in excess of 10 lakh shares. And even on Friday, 15 lakh shares were traded, 20-day average of less than 65,000 shares. And out of those 15 lakh shares, only a lakh were marked for delivery, the 20-day average of close to 50,000 shares. The stock ending at a 52-week high on Friday.
Got it. All right, Hormuz. Thanks a lot for that. Well, let's go back to Dharmesh. Dharmesh, I wanted, I think you were in party mode as well for New Year's, but I wanted your take on some of these alcohol companies. In Friday's trading session, whether it was Allied Blenders or even Radico, both of them were down, I think, 3 to around 5%. The street is getting a little bit nervous because after what we saw with regard to, cigarettes, with that duty going up there, Street is a little bit cautious with regard to alcohol companies. Could they be next? However, there are various clarifications that have come out from various sell-side notes as well that state that, in fact, duties on alcohol are a state subject, while for cigarettes, it's a center subject. So that's why they believe that maybe, in fact, alcohol companies actually will not get hit. What is your take? Companies like Radico have gone up multiple times. Even Allied Blenders, from listing, I think it's close to have doubled, but they've come off considerably from the top. How do you approach them?
Yeah, I mean, there's always this overhanging sword on the alcohol companies. It's been a state subject, but in the past we've seen states have reacted to them, and they have acted against the alcohol companies, be it through duties or banning the entire, consumption of alcohol in the state. So there are multiple, how this will play out. It's a very, sensitive and subject to politics kind of a thing. But in this environment, there has been pace. They have been doing well. Radico in particular has done pretty well. So what I have seen, the last few days I was out, what I saw was the Radico, brands were selling far higher than the other brands. So there has been clear shift in the consumer, preferences out there, and there are a couple of brands as doing particularly well. So I think this is an opportunity to buy into quality names. So United States and UL and all are, things of the past as of now, it looks like. And the new players like Radico, Tilak Nagar looks pretty interesting. So out of the two, I would prefer Radico for any declines to get into. Valuations will remain a bit higher side. That is how the case has been because of the fewer players out there. But yeah, Radico is the topic out there.
Okay, all right. Dharmesh, stay with us. What we're going to do is bring in Sudarshan, who's now joining us to run us through the top brokerage calls that he's picked out. Sudarshan, morning.
Good morning, Prashant. So in the last few weeks, one sector that has been in the focus, the auto, and one theme that has worked is the commercial vehicle. So today, InCred has come out with a note on Tata Motors commercial vehicle. It has initiated coverage with a buy call and target is 513 per share. It says that growth is going to be led by small truck operators, and Tata Motors is the leader in that segment. And also, the demand has been aided by GST cut and rise in the freight rates. And Tata Motors CV has a strong presence among small operators and across tonnage portfolio, and that will help company to gain the market share going forward. Next one is Dixon Technologies. Over the last few days has been under pressure, but Nomura maintains the buy call while it has cut the target price to 16,589 per share. It said there's a sharp jump in global memory prices, and that can likely impact the near-term volumes for Dixon, and it has lowered mobile volumes too for FY 26, 27, 28, and the fall is in the range of 9 to 30%. Also, it has lowered revenue estimates by 12%, 2%, and 1% for FY 26, 27. As far as valuation is concerned, Nomura still finds that it's trading in the as at attractive valuation.
Got it. All right, sir. Thanks a lot for that. Well, let's take a break. You come back. We'll get you the pre-opening, and also we'll tell you what lies ahead for the Indian markets in 2026 and which factors will play the most important role. The results of the CNBC TV 18 market poll coming up on the other side. You don't want to miss this.
Okay, welcome back. 6 minutes to go for the pre-open session. Sudarshan Sukhani is with us, and so is Mitesh Thakkar. Gentlemen, good morning. Great to have both of you here. Appreciate it very much. Now, unprecedented events over the weekend in that sense, and I think we've used unprecedented many times in 25, but this is a new level of unprecedented. But anyway, I mean, I think as far as prices go, which is what we look at here, there's not too much by way of move, oil, gold, or anything else, or maybe gold a little bit right now. So let's start with, basically looking at the setup as we begin this fresh new week, Sudarshan. What do you think? We hit new highs, Nifty Bank on Friday. Is there more?
Yeah, good morning. There should be more. We have been in a trading range for almost 3 months. And since we never know when this trading range will break out, I went on saying buy on dips, buy above 26,000, whatever. And it could be right, it could have been wrong. But we had to be positioned because the markets don't tell us in advance when they go up. That has happened. New highs in the Nifty, new highs in the Bank Nifty are usually a signs of an upbeat market. So the trade is buy on any minor consolidation or dip, keep a tight stop at 26,200, prepare for some little volatility, but be on the long side.
Okay, be on the long side. Got that. Good morning, gentlemen. Sudarshan as well as Mitesh, and wishing you all a rocking 2026 since the first time we are talking in this year. Mitesh, coming across to you. What's your view on the index?
So, I think I'll begin with the short-term view, Nigel. The idea is that we've talked about the fact that getting past 26 to 20 to 30 was a move which the index had not been able to do. Closing above that. And if you join all the rising highs starting from the 23rd of October, we had a high at about 26,060 and then at 26,070 on the 29th. And then in November, we had some highs at 26,200. I think that line comes in at about 26,400, 2030. So I think today we might open over there. My first instant or reaction would be to take some profits off because you're opening right at the rising supply line. But in case we start getting past that, I think this entire range could break on the upside, and then we look at a target close to about 26,950 to about 27,000.
Okay, all right, got that. Mitesh, you continue then. Tell us, what are the stock picks you have for us?
Yeah, I have all buy calls today. Pidilite is a buy with a stop at 1464. I would look for targets of 1505 here. Popular Realty is a buy with a stop at 1705 for targets of 1780. Chola Finance, which made a fresh all-time high, that's a buy with a stop at 1754 for targets of 1835. And JSW Energy is a buy with a stop at 502 for targets of 528.
Sudarshan, what about you? What are your trades?
Well, Zydus Life is a buy with a stop under 900. SBI Card is a buying opportunity with a stop under 860. Prestige is a buy with a stop under 1590. And Astral, which is my fourth pick, and all of them are buys. Astral is a buy with a stop under 1425.
Okay, all right, got that. Mitesh, just wanted to ask you on Reliance Industries. That could be one of the stocks that will be in focus. That one, in fact, has been holding one end up, to be fair. What's the view on that name?
Okay. So, Nigel, Reliance, closed at a very important point on Friday. The highest ever weekly closing for Reliance before Friday's closing was 1586, way back in July of 2024. So that entire, consolidation, that decline, which kind of, terminated into a pattern, is breaking on the upside. Now, that gives you a target in the range of about 1650, 1700 to begin with, and then even higher levels based on how much extension we get on the chart. So very, very positive on Reliance.
Okay. All right. Very, very positive on Reliance at this point in time. Reliance, of course, at about 1592. I think the high on Reliance is about 1608, 1609. That's the all-time high on Reliance Industries. And it's basically just about 20 odd rupees away from that level. I think the high was made in September of 23 or 24 it was. Basically, it's almost back at those levels. Implied open about 78 odd points higher as we are sort of getting close to the pre-open session coming up. Sudarshan, Mitesh, thank you both for joining us. Good getting those views, and we'll get you back for the 9-10 calls in just a bit from now. Now, 2026 could be a game-changing year for weight loss drugs. Semaglutide goes off patent in Canada, and patent for semaglutide will also expire here in India by March. Remember, this class of drugs is already the best-selling, drug in India, and it's basically taken 6 months for that to become the number one money spinner in the space. Let's just talk about what the implications are from a company perspective. Alankar Garude is analyst at Kotak Institutional Equities. Alankar, good to have you with us here. Good morning. Thanks very much for joining us. Prashant this side. First up, wishing you a happy new year. I hope it's a great one for you guys. So just the context first, and what does it mean for companies? Many who've basically said that they're looking at this and they want to launch this. So just your thoughts, initial, just set it up for us.
Sure. Good morning, Prashant, and wish you and the entire team at CNBC as well as all the viewers a very happy new year. So if you look at the semaglutide opportunity in Canada, the patent just got expired yesterday, but we still haven't got any single generic which has been approved. So what's happening here is there are three players which are at the forefront. One is Dr. Reddy's and the other two are Sandoz and Apotex. Now, Dr. Reddy's got a notice of non-objection in end of October, which essentially means a delay of at least 6 months as far as their approval is concerned. So more likely that they will get an approval in May. Apotex, our current understanding is that they have a goal date around May or June. So broadly similar time frame as far as Dr. Reddy's, assuming both of them get an approval around the same time frame. And then Sandoz, which was actually supposed to be one of the first players to launch, they had commented a couple of months back that they would be launching around the first half of CY26. But I was reading an interview about 10 days back wherein the CEO of Sandoz has said that most likely they are now looking at a launch in the third quarter of CY26, which is actually not bad news for Dr. Reddy's. So we are looking at a situation that most likely there won't be any generic approval over the next few months. And amongst these players, you will have one player somewhere entering around May or June, most likely Dr. Reddy's or Apotex, and then Sandoz will be launching a few months down the line. After that, of course, we have three other companies which have filed. There are a few more Indian companies, non-Indian companies, which are looking to file in Canada. So it's going to take some time before you see more than 6-7 players entering the market. The key thing to understand here is if you look at the pricing structure in Canada, you have one generic entering the market, there is a 25% erosion. You have the second generic entering the market, there is a 50% erosion. You have the third generic entering the market, there is a 65% erosion. And we expect Novo to go all out as far as protecting its market share is concerned, given that Canada is the first market which is going to see generic entry of semaglutide globally.
Alankar, in India, specifically Canada is of course one, but in India, we had those numbers, right? Mounjaro is already the top-selling drug. What happens next this year?
I think what's going to happen is you already have three companies which have got approval in India. Quite likely that there will be many more which will be launching in the first wave somewhere around end of March or early April. Eventually, for the first couple of years, the competition is going to be pretty intense. But we do expect companies which have a stronger franchise amongst diabetologists as well as endocrinologists, companies which are amongst the top 10 or top 15 as far as diabetes today are concerned, will be the eventual winners. So eventually the market will consolidate. Our view is the top 10 or maybe the top 15 companies will have a 75 to 80% share of the market, whether you look at diabetes or whether you look at the obesity segment. And all the larger players which are strong in the diabetes segment will have a strong play in the obesity space as well.
All right. Hi, Alankar. Good to see you, Ben. Thanks a lot for joining. And this is Nigel on this side. I just missed out. What is the market size of the Canadian semaglutide opportunity? If you could help me out with the absolute number. And if I got that correct, you're expecting Dr. Reddy's to actually, come on board in the middle of 2026. Is that correct?
That's right.
Okay.
So if you look at, so from a value standpoint, the market today is more than $1 billion US dollars. From a volume standpoint, the estimate is that there are more than 1 million people today in Canada which are taking these drugs. This is the brand, of course. The expectation is the volumes will expand given affordability will no longer be an issue once the generics enter the market. So our view is from the current base of 1 million people who are actually taking this drug at the moment, this number could expand by 50%, 100%, even more than that, depending on how quickly the generics enter the market. So very likely that from 1 million, we'll have a number closer to 2.5 million over the next couple of years and possibly only expand thereon. The key thing to monitor, as I said earlier, is going to be pricing.
Got it. All right. And what about Sun Pharma? By when do you expect them to launch in Canada?
So Sun has filed via Taro in June of 2025. Typically, if you look at the review cycle of Health Canada, I think it's safer to assume that Sun will not be entering the market anytime in the first half of CY26. More likely towards the end of CY26 would be our sense, assuming they don't get a further CRL or a further delay from Health Canada. The other important thing to highlight here is if you look at the history of Health Canada, they have not approved a single GLP-1 generic till now. I'm not just talking about semaglutide, but I'm also including liraglutide here. And this is unlike any of the other global regulators. If you look at US FDA, if you look at UK MHRA, all of them have approved at least one generic GLP-1. So to that extent, Health Canada has taken a slightly different stance when it comes to approving these generics, at least till now.
Top idea, Alankar. Top idea from your coverage universe.
So within pharma on the large cap space, we like Sun Pharma, followed by Lupin and Cipla. Within hospitals on the large cap space, we would recommend Apollo Hospitals at this point of time.
Okay, all right. Alankar, thank you very much for that. So that's the conversation, especially focused, of course, on GLP-1, but there is other stuff which we will continue to talk about with Alankar through the course of 2026. Well, this is the time of the year, right? We kind of sort of ask people what they expect the year to pan out like, and we kind of sort of did this in a big way with a CNBC TV 18 market poll. Mangalam is here to decode what lies ahead for the market this year and which factors will play the most significant and pivotal role. This is the result of the CNBC TV 18 poll that we conducted. Mangalam, over to you.
Well, we reached out to 50 market experts across funds, brokerages, financial institutions, basically the people who make the market. And here's what the street is really thinking about in 2026. We obviously started with the returns. Remember, last year, the Nifty gave you 10%, but was a severe underperformer. And at the start of this year, the mood is positive, but it's not euphoric because over half the experts expect the Nifty to deliver between 10 to 20% results or returns over the next year. A third are between 0 to 10%, a more conservative number, and only a small minority is worried about a negative year. So the optimism is there, but the expectations are grounded. The second question, where should investors be positioned? And these were the options that we had given them. There was clear preference for large caps. About 41% of the experts say large caps are the ones that offer best risk reward in 2026. And this despite a sharp underperformance that we saw in small and mid caps in 2025. Mid caps and small caps do find support, but the enthusiasm clearly tapers off as you go lower down the market cap curve. Micro caps, they do not get a single vote. Sector-wise, again, we've been speaking to experts out here and the poll was pretty similar. One sector really stands out. It's financials that lead the pack, with half the experts backing the financial sector. So if you look at the results of that one, 50% backing financials. Yes, metals and other pockets also find favor. But even as people are, calling the correction and perhaps value accretion, tech and pharma by itself remain selective bets rather than broad consensus calls. So what really drives the market in 2026? The answer is very, very clear. We put out a few parameters and nearly 2/3 of the experts say earnings. Yes, earnings recovery will be the single biggest growth driver for the markets next year. Yet there will be trade deals and geopolitics that would matter, but not as much. Fundamentals are back at the center of the story. Speaking about the trade deals, on the India-US trade deal, the street is quite decisive. More than 3/4 expect that the deal comes through in the next 3 months. Remember, this was pretty similar to what we saw at the start of last year as well. But here, the point is that no one thinks it would be pushed out beyond this year. So next 3 months, 77%, within 6 months, 22%, and no one believes that it won't happen this year. Last year was a big one for gold and silver. What are the experts saying on commodities? Well, the street doesn't believe that gold and silver's outperformance will continue this year. Yeah, they will do well, but the bigger outperformers would be copper and aluminum. Nearly 68.18% of the respondents betting on copper and aluminum more than silver and gold. That's a clear reflection of infrastructure, manufacturing, and energy transition themes. And finally, to the qualitative questions, the risks, the words that keep coming up are geopolitics, the market concerns, and around AI, Donald Trump's policies. All these factors clearly remain the biggest swing factor. At the start of the year, we also ask, what's the one big thing to watch behind taxes and the announcements that would come in the budget? Well, most of the analysts on the street or the experts on the street are expecting these to be the important words out there. Any sort of tinkering with capital gains taxes, fiscal stimulus, higher government spending, and obviously market experts will watch out very closely for removal or changes in STT, STCG, and LTCG. So what's the takeaway? 2026 looks like a year of steady, earnings-led returns, less noise, more numbers, and a market that rewards patience over excitement.
Okay, all right, Mangalam, thanks a lot for that. Well, let's go back to our technical experts then. We have Sudarshan, who's back for our 9-10 call. Sudarshan, you go first.
Well, it's Astral. Buy Astral with a stop under 1425.
Got it. Okay. Astral is a stock that's Sudarshan's, on Sudarshan's radar. Mitesh, what about your 9-10 call?
We're going to buy on Pidilite for targets of 1505.
Pidilite, right? And the target was 15?
1505.
1505. Got that. Okay, gentlemen. Thanks a lot for that. But let's get back to some of the quarterly updates and let's revise a few stocks. Gaurav joins us to tell us about big boy HDFC Bank. Gaurav?
Well, as if you look at HDFC Bank, a key thing to watch out here is that the bank has reported double-digit loan growth post its merger on a normalized base. Now, they have reported loan growth of around 12% on a year-on-year basis, and now loan book that has reached almost at 28.4 lakh crores. If you look at deposit growth, that also came in line with the loan book growth of around 11.5% for deposit growth in this quarter. And lastly, if you look at the system level growth, that also came in at around 12%. So it seems that management, as they indicated that they will be growing in line with the system, they're actually achieving this target with 12% growth. If you look at other banks as well, we have seen some banks who have reported numbers which are even lower than 12%. So the bank of a size of HDFC coming up with the loan book growth which is in line with the system is actually a good thing, and as a result we will definitely watch out on how investors will react on these pre-quarterly numbers for HDFC Bank in this quarter.
Okay, all right. Thanks a lot for that, Gaurav. Well, Jefferies has come out with a note on metals and they enter 2026 with a positive view on Indian metals. On ferrous, they say companies, steel companies, they offer a healthy 6 to 9% volume growth over the next 2 fiscals. They also go on to say that reinstatement of the safeguard duty should further lift Indian steel prices, while Asian spreads should recover from the unsustainable levels of around, the lows that we've seen in the last 15 years or so. They believe that risk-reward ratio is favorable going by what history suggests. Data shows that steel companies like Tata as well as JSW Steel, if bought, when the spread is below $200 per ton, well, they have delivered good returns in the subsequent 1 year. Jefferies is also going ahead and raising their estimates on various companies. They're raising the EPS estimates for Tata Steel as well as JSW Steel by 9 to around 19% because they are assuming that India HRC price will be ballpark around 54,000 to around 54,500. That compares with the current pricing, which is less than around 49,000 rupees per ton. They also point out that there could be potential upside to these estimates. They also raised their FY27 and 28 EPS estimates for Hindustan Zinc as well as Hindalco by around 4 to around 7%. They're assuming higher steel, higher silver, as well as aluminium prices as well. And to wind it down, well, they're giving us the top buys which come up for you on the screen. Tata Steel, target price 230, JSW Steel, target price 1,400 rupees, and Jindal Stainless at around 1,020. So put everything together, Jefferies is sounding optimistic about prospects of metal companies in 2026.
Okay, all right, Nigel, thanks for that. What a run they've had. And, the question is whether non-ferrous continues its rally, whether it moves to steel, and whether gains can be as substantial as what we've seen, especially, of course, names like Hindustan Copper, etc., exceptional gains, 50% in December, and they've continued the run this year in the first couple of days of 26. Well, more as we kind of go along, but we are going to be waiting by for the market open as it starts in just a bit from now. And we'll come back. Let's just look quickly, if you have time, look at IOC, HP, BP, and then maybe your Reliance as well to see if there is any move. Underlying oil prices, of course, there's not very much in terms of price action. IOC on your screen, Reliance is up a little bit, but not very much at all. BP is down about a third, and HP, which has done well, by the way, is also in focus. So the HP is down at about 495, but I mean flat right now as far as market open is concerned. So that is the oil pack, oil and gas pack as that we are looking at. So it's a flat indicative start. We'll see if it is indeed that, or there is some buoyancy given Friday's session, which took us to new all-time highs. First rates, which will start to come up on your screens. It's what, 26,350 on the Nifty, the Sensex, okay, 320 now. The Sensex is starting, I mean, small red, but nothing at all. It's absolutely flat. Nifty Bank is more decisive, about 1/3% higher, I think. And you've got some opening rates coming up on the Midcap index, about 0.14. And the small cap index will also come up on your screen before we go any further. Yeah, about 1/4% of the small caps. The broader market, small caps, mid caps, etc., doing much better, at least as the word go, the start, as compared to the Nifty, which is almost unchanged at this point in time. I was talking about PSU banks, right? I mean, look at what's happening across banking. And, you know, you got a bunch of PSU banks which are all starting up in the green. Coal India, ONGC, State Bank of India are leading on the Nifty. This is about 25 up, 25 down, so it's kind of even Stevens. On the other side, you got HCL, Tech, Trent, Infosys, Maxill, etc., which are starting this morning. So it's a grand total of 2-point change on the Nifty over 26,327. But I think lots of action as far as single stocks go. Nigel.
Well, that's right. You know, some of these metal stocks continue to do well. So Hindustan Copper's up 3.5%. You have Hindustan Zinc as well that's holding in the green. After, they came out with their quarterly performance, remember? Silver's yet to pick up out there. But for the time being, the street is focusing more on pricing rather than the volume number. So explains why Hindustan Zinc is up. I think Vedanta as well has opened up with some mild green out there. Other stocks in focus, Cupid. That's down close to around 18%. Big downtick is what we are seeing out there. So that stock, in fact, is down 18%. Second day running, under pressure. Another one that should come up for you on the screen, I think, is TFCI. The stock actually started off in the red, but it's done a quick rebound out there. So that stock has bounced back. Remember, in Friday's trading session, TFCI was a stock that was under intense pressure. Other stocks that are doing well, you have Ujjivan Small Finance Bank, that's up close to 4%. Bank of Maharashtra up 2.5%. That one's actually had a good run in the last few trading sessions. IDBI Bank was buzzing the last couple of trading sessions. Today it's building on to those gains. The quarterly performance update, not too bad out there. So explains why that stock up and about in today's trading session. What else? Smaller stocks that are moving up. Lokesh Machines, that's up 6.5%. SJVN as well, moving higher on very, very good volumes. So that's a stock that comes up for you on the screen. Net, headline index, more or less flattish, while from the broader markets, you're actually seeing an outperformance that's coming in out there. Prashant.
Okay, that's basically the start. So at least, in the index, there is not very much to show for it. But as far as, specifics go, there is individual stock action, which we will continue to refer to. But let me quickly bring in our guests, right? Pankaj Tibrewal is founder and chief investment officer, Ekagai Asset Managers. And Ashwini Agarwal is founder and partner at Demeter Advisors. Gentlemen, good morning. Great to have both of you here on CNBC TV 18. Thanks for being, of course, part of the journey here. Wishing both of you a very happy and prosperous 2026 at the outset.
Morning, Prashant. Thank you, and wishing your viewers a very happy new year too.
Thank you very much. Let me start with, we thought, and I thought 2025 was a roller coaster year, and 26 has started with an absolute banger with what has happened in Venezuela. So it is, there's so much that we can sort of go on, but what does it mean in real terms for market? Are there any implications for market? At some point, Venezuela oil supply will increase, and that should put pressure, downward pressure on oil prices, etc. But here in India, we've been kind of negotiating with the US. Apparently, a deal is ready. It needs to be sort of, signed off. In that process, specifically with regards to India, is there any takeaway from what we've seen in Venezuela? Does it strengthen US's hand in any way whatsoever? I mean, it's kind of sort of shown the world who's the boss? Or you think, I mean, not really. What's happening here in India is going to be very much, between the US and India in that sense. Ashwini, you go first.
My view is that this is actually a good move on part of the US insofar as it brings USD as the currency in which Venezuelan oil will be traded. As you know, Venezuela has been selling its oil primarily to China, a little bit to other countries, and had offered India also a purchase of its oil denominated in INRs. Going back as a part of the U.S. Ecosystem in some sense, that local currency trade of Venezuelan oil is out of the picture. Of course, this gentleman, President Maduro, has been a thorn in the side of President Trump for a while. But I was also taken aback by the move, which unfortunately exacerbates the uncertainty that we have to deal with on a global macroeconomic basis, on a geopolitics basis. And I think uncertainty is the only certainty that we will have in 2026. Direct impact on India is relatively little, barring maybe on ONGC, which has some money stuck in Venezuela and might see some improvement in that outlook. But barring that, outlook for India seems unchanged. Softer oil, of course, helps, softer crude oil. We'll see how that goes.
Fair enough. So that's a quick view on what's happened with Venezuela, etc. Let me now get to the CNBC TV 18 poll that we conducted, asking participants what 2026 will be like. So what I'm going to do is, and can I request the producer and director to pull these graphics up, right? So I'm going to list out, each of these questions and ask both of you what you think. All right. This is the first question that we asked, and 50 market participants covered. Nifty returns in 2025. The majority is between 0 and 9%. Almost 38% said that returns in 2026 will be between 0 and 9%. Pankaj, do you agree?
I think I'll be more in the camp of 10 to 20%, in the sense that expect earnings to start improving from 27 onwards, which is FY27. FY26 was a single-digit earnings growth for Nifty, and that should be helped by banking, autos, and some of the other sectors. And we believe that FY27, we should look at about 12 to 13% earnings growth. And in that sense, our sense is that market finally should track the earnings momentum as you move into FY27. So my bet will be on the second part between 10 to 20%.
Okay, all right. Hi, gentlemen. Good morning and good to see you all in. Well, Pankaj, I want to quiz you about a couple of sectors, and very few people were positive on metals as a counter call at the start of last year. But I recall you telling me that. And you came on the channel numerous times, you said metals, that's the counter call that we have. You're bang on. Now, the question is there more to go?
I think absolutely. We believe that the broader commodity cycle is starting to unfold itself. And it's not driven by anything on demand supply only. It's also geopolitical. Don't forget that the supply of commodities has been in very few hands. And all the incremental changes which are happening globally, whether it be AI, EV, or new tech, all require commodities which are very supply concentrated in few countries. And these countries are using commodities as a geopolitical tool for negotiations. So we believe that it will be a new cycle which will be unfolding in front of us. We have seen that in the form of gold and silver last year. It's spreading across broader commodities now, especially non-ferrous. And over a period of time, ferrous should also see some momentum coming in. So our broader call remains that metals should be one sector which should be part of the portfolio as you move ahead.
Got that? No, absolutely. Let's just go through a few more of our poll questions before I can ask you your specific ideas, etc. So let's just put up question 2, right? Which is the category to bet on in 2026? And just quick answers, and then we can discuss these. Large caps, mid caps, small caps, or micro caps 40% said large caps, and about 32% said mid caps, 27% small caps. But large caps is top of the list. Pankaj?
So Prashant, I'll just take 2 minutes to explain.
I will come back. I want to, because there are 10 questions, I want to just quick answers, and then I'll come back to you.
Yeah, my bet will be mid and small caps combination of that from bottom-up perspective.
Ashwini?
Agree with that view. I will also be in the camp of mid to small caps, bottom up.
Okay. The third question, sectors to bet on, right? There was financials, tech, pharma, capital goods, metals, etc. 50% basically saying financials. The others are tech, pharma, capital goods, metals. Pankaj?
I'll add 2 more sectors to it, which is not the flavor of the season right now. One is consumer durables, and the second is chemicals.
Consumer durables and chemicals. Ashwini?
I agree with the view that financials will continue to do well this year. I think a lot of the underperforming sectors from last year, some names in the consumer sector, some names across the board. I wouldn't be sector specific, but I would focus on the cohort of stocks that are down 30-35% over the last 1 year and look for bottom-up opportunities there. Very sector agnostic.
Okay, all right. What about the key market drivers? Ashwini, you go first. What will it be? The India-US trade deal? Will it be geopolitics? Will it be earnings? What's your take?
I think nominal GDP growth, some uptick in inflation, stabilization of the US dollar versus INR. I think these would be the key to drive the market sentiment. If nominal growth picks up and the USD INR stabilizes, I think that's positive both for earnings growth and for foreign flows, and that's something I would look out for.
All right, Pankaj, what about you?
I think earnings will drive the overall momentum back into the market and FI flows returning back. I think we have seen 5 years of negative FI flows. I'm very hopeful that this year India will start seeing FI flows back.
All right, and I think, Pankaj, you pointed that out as well, that earnings are set to recover. Upgrades are more than downgrades, I think, in your newsletter as well. Ashwini, coming across to you, this is going to be a difficult one. But by when do we see a India-US trade deal? We thought we'll be first. We're still waiting by. Do you think it's in 3 months or 6 months?
Nigel, I have no idea. I would bet on 3 months. That's my hope, but it's a hope. There's no clarity on this at all.
Difficult one, Pankaj, to you though. I'm hoping it's in the next few days. What do you think?
Beyond our pay grade.
Okay, 77% of those polled up on your screen say perhaps in the next 3 months. I mean, that's expectation. But markets are made up of all kinds of expectations. But this is the one. Like question 6, right? Top commodity asset class. Gold and silver did phenomenally well. The graphics will come up. Copper and aluminum. 68% said copper and aluminum is the commodity asset class for 2026. Pankaj?
Completely agree to that. And also will add the other bulk commodities like iron ore and coking coal. I think incrementally you will see every nation negotiating with the globe on commodities they are strong in. So I think we are entering into a cycle where geopolitical repercussions will be very huge, and that will weigh on commodity price.
Ashwini?
Agree with that. Copper and aluminum. My sense is that real assets will see appreciation this year. A throwback to global uncertainty, which typically helps people focus more on real assets.
Okay. I'll skip question 7, which is the biggest risk to equities globally. And there's a bunch of geopolitics, US market, AI, etc. I'll come to question 8, which is much more immediate for us because the union budget is also in front of us. The one big announcement to watch is the question that we asked. That is capital gains, fiscal stimulus, something to do with STT, STCG, or is it higher government spending, and the results will come up. Pankaj, what would you say?
So if you ask me one risk which investors should be prepared for in 2026 is the global debt and deficit. I think very few will recognize that global debt has now moved to $346 trillion, and it is increasing at a pace of $660 billion every week. And that's something which is insane. In my view, at some point of time, if foreigners decide not to fund any more of US treasuries and the US yield starts to spike up I think that's a very big risk investors are carrying into 2026.
And the budget, Pankaj?
Budget, I think budget, as the government has shown in the last budget also, should not be negative. I think it should be positive, and the feedback which has gone from the marketplace that please support the domestic investors. So I don't think anything negative should be coming out in the budget.
Ashwini, what about you? Budget?
I'm hoping that we'll hear more noise on privatization, which will release resources for the government to invest into infrastructure. The spending has become more consumption-oriented and less investment-oriented, which worries me. And I'm hoping that privatization will provide the resources to change some of that.
Okay, all right. Pankaj, let me come back to you. I promised you I'll come back to you on your rationale. You always work with lots of data. And you had, on that question on mid-caps, small caps doing well, which is what your bet is for 26, right? Go on. Just explain that point briefly.
So, Prashant, if you look at last year, though the indices showed you single-digit gains, but the breadth of the market has been extremely poor. And this kind of a breadth I am seeing after almost 5-6 years. 18-19 was that kind of a year which we saw last year. And just to put two data points in perspective, though the NSE 500 is almost at a touching distance of 52-week highs, but if you look at the median drawdown, it's about 20%. And also the divergence between the indices have been very huge. So let's, for example, take the Nifty Midcap Small Cap 400, which is 250 of small cap, 150 of midcap. The indices since October 24 has given a headline returns of almost 2%. But the median return of that indices is negative 6.5%, which means a divergence of about 8%. And that is not only this index. You look at any other index, that's the similar story. And if you do an equal weighted index of NSE 500, it's negative 3% for the year, calendar year 2025. So the point is that very narrow leadership has taken the index higher. And our sense is that if earnings momentum starts to improve, which we are seeing for the last couple of quarters, we will see the broad basing of the market. And hence, you should see many mid-cap and small caps which have been delivering strong growth with balance sheet and cash. But only caveat which I would like to pick is, it won't be a runaway rally for the last 4 years which we saw post-COVID. I think it will be very bottom-up. Please don't forget the basic hygiene of balance sheet, cash flows, good promoter, good businesses. I think people should not chase too much of narratives. I think that can fall flat in 2026 because it will be a volatile and unpredictable year.
Okay, all right, Pankaj, quick fire to you then. Will India outperform in 2026?
My hope is yes, that after almost we saw the worst performance against emerging markets since 1994. We have underperformed by 28%. India is completely out of flavor. You speak to any foreigners, they will give you meetings just for relationship. But when India comes in, they have zero interest. I think that's a very, very big contrarian indicator that if something goes wrong globally in terms of AI valuations, US markets, I think India will find its flavor back among FIs.
And broader markets outperform the headline index in India?
I hope so. And but I will say that it will be a bottom-up stock pickers market. You have to pick your bets very, very, carefully. It will not be a runaway rally which we saw from 2020 to 2024.
And is gold closer to the peak? And between the two, gold or silver, what do you like?
I think geopolitical, this kinds of events will make sure that gold and silver both are bidded out. But there's such a sharp outperformance. Don't forget that we have seen sharp drawdowns in the past also. So investors should brace themselves for frequent, very sharp drawdowns as well. So don't, if you have an asset allocation process, just follow it. Don't get overboard on it.
And you were positive on metals, I recall, and auto ancillaries. And some of the stocks have started doing well. Would they qualify as the top themes for 2026?
I think precision engineering as a theme will be one of the biggest themes to bet in India. Globally, most of the large OEs, whether it be Airbus, Boeing, defense companies, are looking at these companies. And most of the auto companies, a few of them, are pivoting themselves from pure auto to industrials and precision engineering in these sectors. I think they can create huge value as you move into for the next 3 to 5 years. And few of the bets are part of our portfolio.
You want to name a few?
So we have been talking about, for example, Sansera. We have been talking about Happy Forging. And all these are through their CapEx and incrementally, the growth has started coming from aerospace, defense, industrials. And our sense is that many of them will see accelerated growth as you move ahead, because they are just pivoting them from a pure cyclical sector, which is auto, to other sectors which are more structural in nature from a growth perspective. So these are some of the names which are part of the portfolio. Don't take it as a recommendation to buy and sell, but we're just giving as a thought that precision engineering will be a great theme to play as you move ahead in the next 3 to 5 years in India.
You know, I remember Sansera very clearly, Pankaj. I think, was it about 1,100 rupees when you spoke about it, I think on the editors roundtable and maybe even earlier. So it's done well. Back to 1,900 rupees, I think almost at a new all-time high, I think, Sansera and others. So the theme is something you've been highlighting for a while. You know, I just have one other sort of setup, and we'll just pull the graphics up in a bit. So while we do that, Ashwini, one area, one sector, and which I think you track closely as well, is textiles. And of course, I mean, it's been bombed out because of this India-US thing. I call Gokul Das the India-US trade deal indicator, and that's back at 750, almost 750. What's your sense, Ashwini? Any hope?
So there are two issues there. One is underlying US consumer demand, where I think there is some uncertainty. It's been surprisingly strong, notwithstanding all the anecdotal evidence one is getting about job losses and about inflation being higher than what is measured in official statistics. But, you know, if that were to turn down for some reason in the United States, that's a risk, you know, for the sector. The second thing is what's going on, you know, with tariffs in other parts of the world and the deals that India is signing. I think, you know, textiles as an export opportunity for India will continue to do well. I think the companies would be well advised to look for a global customer rather than be overly dependent on the US is my take. I remain reasonably constructive from a medium-term perspective because we really have, you know, durable competitive advantage in this area. Yeah. And my belief is that, you know, when stocks get sold down, they should be looked into, and evaluations are appealing. One should be willing to purchase them. So in that context, you know, if something's done poorly, that's always an opportunity to at least investigate, if not invest.
Yeah, no, absolutely. You know, one other way, and there are so many ways in that sense to look at things, right? One, and Nimesh put this data out, he did this last year, I remember 2024, and he's done this on the Editors Roundtable last Friday. Simple thing, look at the big laggards of the year gone by and see if some of them can flip on the other side of performance tables in the new year. So these are the biggest sectoral laggards of 2025. Real estate, 18% down for the year. The IT index is down 15%. And of course, I mean, there's other stuff as well. But these are the two big ones, right? 18 on lower on real estate, IT down about 15%. And then stock-wise, the biggest laggards. Trent is down 40%. But of course, I mean, you know, Trent was up very big in 2024. So it's kind of flipped on the other side in 25. TCS down 22, ITC down 17, HCL Tech down 15, Wipro, Infosys, Power Grid are some of the other big laggards. And any cues from out of this which strikes you as useful, Pankaj?
So the way we have our framework, Prashant, is that we look at that demand is very hard to predict. Just to give you a data that 7 out of the last 11 years, India Inc. top line growth has grown in single digits and lower than the nominal GDP growth. So top line growth is becoming very difficult to predict. And hence we take a call on margins. And we look at sector by sector where the margins are at an almost all-time peak or where the margins are below their averages. And in that, the margins which are at all-time peak are sectors, for example, hospitals. Clearly, that sector has got re-rated significantly over the last few years, and margins, you know, there is a risk on margins. But when you look at some of the other sectors, for example, consumer durable we spoke about, the margins are closer or below averages this year and the last year. There has been huge competition, weather has not supported. And the second is chemicals. After almost last 4 years of non-performance, margins are very, very low. So I think trajectory starts to improve in these sectors, you can get earnings growth plus re-rating on multiples as well. So our bet will be that have this framework of margin and top line growth. Top line growth is difficult to predict, as we have seen in the last 7-8 years. I think what we can take a call is the margins. And I think in that's consumer durables, power, metals, that way, that was the reason we were contra positive at the start of the last year. And similarly on chemicals, I think that story is yet to play out. But we believe that 2026, you could see some of the events unfolding itself, which will be positive for chemicals as you move ahead.
Absolutely. Ashwini, out of that, on real estate, do you have a view? I mean, I'm only, the data point I'm using is it's the top sectoral underperformer for 25. Doesn't necessarily, it's not a sufficient condition, but maybe a necessary one. Something which is not done well.
So Prashant, my belief is that real estate cycles are relatively long cycles. They've historically tended to be decadal cycles. And we are, let's say, in the 5th year of a bull cycle in real estate immediately after COVID. So I'm not surprised that last year it took a little bit of a breather. But we need the Indian stock market to do well for the real estate demand to sustain. We've seen these two markets very correlated because it is essentially the earnings or savings from the marketplace which feed into real estate demand as well. Whether it's high end or medium end, it doesn't really matter. I think affordability in relation to income has reduced somewhat over the last 3 years. But if the real estate, if the stock market were to give more than 10% return, as Pankaj is alluding to, then I think real estate may also do well, especially having corrected so much. I think the operating risks and uncertainties of the sector, which used to be a huge problem in the past, are behind us. So if you can again find high quality balance sheets with managements that have the ability to deliver and stock prices have corrected, there might be an opportunity to make money if the underlying equity markets are strong.
Okay, got that. We'll leave it there, gentlemen. Slightly longer chat today, but very useful and interesting. Wishing what all of us are hoping for 26 to be a better year, that it comes true. And we'll track it with both of you. Thanks very much, Pankaj. Thanks very much, Ashwini.
Thank you, Prashant. Thank you, Nigel. Bye-bye. Thank you.
Part of the program. Thank you. We'll take a quick commercial break here. We're going to come back, the management of Punjab National Bank, to discuss their outlook for FY27. Stay tuned. Coming up.
Welcome back. Mildly lower now for the benchmark indices. IT is on the back foot. The top 4 Nifty losers belong to the large cap IT names: Infosys, HCL Tech, Wipro, Tech Mahindra. CLSA, in its Q3 preview, said that they are trimming their positions to the IT sector after the outperformance seen in Q3. That's the October to December quarter, where the Nifty IT index went up 14%. higher than the 4% return that the Nifty generated. So valuations had hit fair territory. So that could be putting pressure on the IT index. But moving on now to PNB. The stock is holding up in the green with a gain of about 1%. The bank's sequential loan growth was strong at 5.4% on a quarter-on-quarter basis. On a year-on-year basis, both the global and domestic advances growth was about 10-11%, so in line with the bank's guidance of 11 to 12%. Ashok Chandra, MD and CEO of PNB, is now joining in. Mr. Chandra, morning. Thank you very much for joining in, and Happy New Year from the entire CNBC TV 18 team. You know, the three talking points that we'd like to discuss with you is that will the loan growth momentum improve now, say in Q4? Deposit growth, because that's been lagging at least in the first half. Is there a pickup expected? And the improvement in your net interest margins, considering that we've had another rate cut, which potentially caps the NIMS improvement. So, Mr. Chandra, beginning with the loan growth, you know, the expectation was that because of the interest rate cuts, the GST simplification and the cuts, the credit demand would pick up. While you are tracking in line with your overall guidance of 11 to 12%, can Q3 credit growth be better than what we saw in Q3? And what will the overall loan growth look like for the full year?
Good morning, and wish you and the entire CNBC TV 18 viewers a very, very happy New Year. Yes, the guidance which we have given for the credit growth for the entire year is in the range of around 11 to 12%. And we are very much holding to that guidance, and the momentum which has picked up in the Q2, latter part of Q2 and the Q3, and going forward also, the momentum which we are seeing in this financial year, the Q4 of this financial year, I think we are very much on track, and definitely I think we will surpass this guidance which we have given. There is a good momentum. We are seeing it. We need to wait for the final audit to happen, and then the final figures, the sector-wise, we will show it to you. But the performance which we had shown in the Q2, I think all the sectors are growing very well now.
Okay. So particularly on the corporate credit offtake, because last time you had indicated a massive sanction pipeline of nearly 1.7, 1.8 lakh crore, which was expected to drive double-digit corporate growth in the second half of the year. So out of this pipeline of 1.78 lakh crore, what has been disbursed in Q3 and what will corporate growth actually hit double-digit in H2?
I will give you one number. I think that speaks about our corporate loan credit growth momentum. One is that last full year, that is 24-25, the total corporate credit sanction which has happened in our bank was in the range of around 2 lakh crore. And this year, up to 31st of December, we have already crossed 3,15,000 crore of corporate loan book now. And that still around 2 lakh crore of sanctions are there, which is yet to be disbursed. So that is the pipeline, and that is the projections which we are holding on, and we are very much confident that, we are not working on the 1 or 2 quarter. We being one of the largest banks in the country, second largest public sector bank and fourth largest bank in the country, we know our responsibility for the growth of the economy. So all our actions are in the direction of the long-term sustainable growth, and this corporate loan credit growth which is happening, I think this is all for the long-term, the projections which the bank has projected.
So in Q4, do you think you will be able to, at the end of FY26, do you think you will be able to get to, say, closer to 4 lakh crore in terms of corporate sanctions, because you still have a pipeline of 2 lakh crore? Is that possible?
Yes. 100% we are going to surpass that number. And that number will be almost double the growth which we will be seeing over the last year, corporate loan book.
All right. Hi, good morning, Mr. Chandra, and always good to have you on the show, sir. Nigel on this side. Well, let's turn our attention a little away from the corporate sector then. Within RAM, if you could give us some clarity. RAM is retail, agriculture, MSME. Are there any particular areas that you're targeting? I ask you this because a few NBFCs are mentioning about heightened competition from PSU banks in affordable housing segment. Is this something you're actively focusing on?
We are working on the overall RAM sector, and in the RAM sector, particularly the MSME and agri, that is one of the very, very focused areas for the bank, because that was one area we were lagging behind for the last 2-3 years. And this year, we are seeing a lot of good momentum happening in this MSME and the the agri sector. Even housing loan sector also, if you have seen our performance in Q1 and Q2, we were growing more than 14-15%, and the number will come out after the final audit comes for this quarter also. You will see that good momentum happening across the RAM sector. And that is one of the priority areas for the bank, along with the corporate loan book. So let us wait for the final number to come sector-wise. I think once the audit comes, I think we will know that actual growth which has happened in that sector-wise.
How was the deposit accretion, sir, in Q3 and expectation in Q4?
You have seen the growth in this particular quarter. That is, the global deposit has grown by 8.5%, and we were very mindful and conscious of the deposit mobilization. There were different routes of funding that credit growth. So we have gone to the alternate sources also, and that is the reason the actual growth in the deposit is muted in this particular quarter. And we have done this to improve the profitability and long-term sustainability of the profit. We have consciously taken this decision. But we don't have the dearth of deposit. You know that our CD ratio was 72% to 73%. And we have enough room to grow up to 75-76% with the existing deposit itself. So absolutely, there is no reason that anything which has happened in the deposit front. This is a conscious decision of the bank management.
All right, Mr. Chandra, let's turn our attention to NIMs then. In the near term, these rate cuts, actually, they plague the NIMs. And we've got another rate cut. And you're still 20 basis points behind your NIM guidance for, FY26. Now there could potentially be another rate cut on the cards. So what's your take with regard to NIMs? Do you think the number that you've set out is achievable?
I think that is one of the challenges which we are seeing it. Of course, the profitability will, whatever we have projected, we will be surpassing the profitability number, whether the net profit or you are seeing the operating profit also. We have crossed 7,000 crore of operating profit quarter to quarter. And definitely we are going to hold on to this performance. Specific about the NIM, there is a challenge. I think all of us know that the 125 basis point, the rate cut which has happened in the calendar year 25, and definitely that has got some impact on our profitability margin because we do not want to reduce drastically the deposit rate. And that is one of the reasons there will be some strain on our NIM. But overall profitability is not a challenge, and all the guidance related with the profitability, bank is holding on to that, and we will surpass those figures.
Do you think, because you're saying NIMs is a challenge, so do you think you will, getting to your NIM guidance of 2.8, 2.9 is difficult?
I think somewhere I am expecting that definitely 2.8, 2.7 to 2.8, we should be in a position to hold on, because this 25 basis point cut which has happened in the Q3, I think definitely that is going to make some impact in the Q4, because to that extent, we have not reduced our deposit rate. And we don't want to reduce drastically our deposit rate because profitability bank is in a comfortable position. So I think definitely we will be in a position to reach the NIM between 2.7 to 2.8 in the Q4.
Okay, so that's slightly lower than the 2.8, 2.9 that you had earlier guided for. Now you're saying Q4 will be 2.7, 2.8.
Okay, all right. Yes. Got it. Mr. Chandra, the next big event that most experts will be looking at from the macros, from an equity perspective as well, is going to be Budget 2026. What are the expectations you have with regard to a push for particular sectors, or what would be on your wish list?
I think you are seeing for the last several years, Government of India has come out a lot of reforms, and the last year, one major reform which has happened in the income tax simplification and the improvement in the tax, I think up to 12 lakh, almost the tax has been made zero. So that has brought a lot of consumption activity in the economy. And related with that, a lot of thrust was there on the rural development, infrastructure, MSME. Again, I think all those things will be the key focus area for this year also. And all these things we have seen brought a lot of momentum in the economy. And today, when the world economy is growing between 3 to 3.3%, that is the GDP world over, I think India is in such a better position when the Q1, the performance was 7.8% and Q2, 8.2%. Despite all those challenges, if India is performing so well, I think that speaks about the regulatory framework of the Indian government and the Reserve Bank of India. And I'm very hopeful. I think this financial year also, we will have that momentum, and budget will provide that impetus to see that growth continues in the economy. Another good thing which we are seeing it about the Indian context, that there is a high growth rate, and at the same time the inflation rate is one of the lowest. So these two things definitely speaks about the resilience of our Indian economy and the framework of the fiscal and the monetary policy.
Okay. Just very, very quickly, you sold about a 10% stake in Canada HSBC Life Insurance, and the sale generated 1,000 crore of proceeds. How will you utilize it? Very quickly, sir.
I think you just wait for this month, and once our final audit report comes, you will see the impact of all those things on our profitability and different ratios.
All right, so we'll leave the conversation here. Thank you very much for joining in. That's the word coming in on PNB. Shifting focus now to the commodity markets. Manisha is back with us, and she's focusing on crude. Manisha, what's happening?
Oh, well, absolutely. Thank you so much for that. Well, we started the day slightly on the positive note as markets were trying to get in more clarity on what really could come in from Venezuela, but it clearly seems to be very, very volatile start to 2026 right now. We did see crude prices start positive, and there you can see it's trading 0.25% on the weaker side right now. So clearly, markets are not concerned about any oil supply disruption coming in from the U.S. takeover in sense of Venezuela. That also is after we've seen Venezuela proven crude oil reserves, remember, stand at a huge 3.8 million barrels there, billion barrels there, which is clearly 17% of the global total when it comes to oil reserves in the global markets there, much higher than various other OPEC countries as well. Now, Venezuela's current production stands much lower, less than 1 million barrels per day. And out of that, when you look at the overall exports, well, 80% of Venezuela exports go to China, which stands at around nearly 740,000 barrels per day there. Apart from that, the U.S. Chevron's exports stand at a very small 140,000 barrels per day. And then you have Cuba, which also accounts for nearly 24,000 barrels per day. So as you can see, India is quite isolated with what's happening in Venezuela. In sense of supply concerns, there's no concern there. And when you look at the overall numbers as well, as Venezuela produces less than 1 million barrels per day, we are looking at an excess supply of nearly 2.5 million barrels per day for 2026. So even if the Venezuela oil was completely get out of the market, we still would be looking at a surplus situation for 2026. Well, the U.S. strike inflicts, one, no damage on oil production and refining industry in Venezuela. So that supply concern is not into the markets there. The second thing is about U.S. Saying that the companies would start taking over to Venezuela. And that would mean that the sanctions which are on Venezuela crude sales right now perhaps would be uplifted. It also does mean that you would be looking at U.S. companies investing, and that would mean billions of dollars to revive that production. How will that happen? When does that happen? Which are these companies? So that is a bit of a clarity that the street is awaiting at this point in time. But there's a very interesting Goldman Sachs report which says that a $4 billion of a downside, $4 per barrel of a downside is what you could be looking at in case of crude oil prices if the Venezuela crude production rises to 2 million barrels per day, and that also by 2030. And that really isn't too much right now. And the markets do believe that instead of positive, it is a negative view that you are looking at from US in sense of Venezuela. But that's one part of it. The other is US comments that are coming in on Iran issues that could take the prices on the higher side. And then US also has said, or rather warning the narco-terrorist states, which is Mexico, Colombia and Cuba, of action going forward. If that happens, that geopolitical impact or sentiment is what we could be looking at in sense of prices. But currently, with the kind of surplus that we are dealing with, there is no impact on the higher side coming in for crude prices there. The other thing that the markets are dealing with is the OPEC Plus meeting, which was on 4th of January. The oil output has been unchanged. Last year, remember, OPEC Plus has brought in nearly 2.9 million barrels per day into the markets. So the first quarter, Jan to March, there is no increase in production. And the OPEC meeting, the next one, is on 1st of Feb, is when they would take a further sense on what really do they want to do in 2026. Having said that, there's a lot of data coming in this week, especially from US. You have ISM manufacturing, employment data, Fed official comments. All of that would tell us on where the crude prices will move in the days to come.
Okay, all right. Thanks a lot for that, Manisha. Well, let's focus a little bit on the tech companies ahead of the Q3 numbers. Rima, CLS has put out a note.
Yes, and the key takeaway is recommend reducing positions given the recent rally in the Indian IT sector and largely soft Q3 FY26 results expected. So they argue that the Nifty IT index has gone up 14% quarter to date, which is October to December period, while the Nifty, the benchmark index, is up 4%. And therefore, valuations are entering fair zone. So that is the broad call on the tech index. Secondly, they're downgrading HCL Tech from an outperform to a hold. They're downgrading Tech Mahindra from its high conviction outperform to an outperform. So basically for Tech Mahindra, they've removed it from the CLSA focus list. And the key reason they say is that Tech Mahindra's revenue growth pickup in the last 1.5 years is not commensurate with their own and consensus expectation. And for HCL Tech, the argument is that HCL Tech is trading at a 5% valuation premium over TCS and Infosys. So that explains why CLSA has downgraded both HCL Tech and Tech Mahindra. The stocks that they like in the mid-cap space, Persistent and Coforge. Persistent, they say, is delinked, delinked to the macro because with its strong capabilities and execution. And Coforge also, post the recent correction on the back of the Encora acquisition, looks attractive. And in the large cap space, though they've downgraded Tech Mahindra, removed it from the focus list, they still like it. It's an outperform rating, and Infosys is their other big bet. So that is the call coming in on technology. Moving on now, back to the market technical. Siddharth Mangala, Senior Research Analyst at Stockbox Technologies, is with us on the show. Very, very quiet, Siddharth, to start the trading day. What's the trading call on the Nifty, Nifty Bank and individual stocks?
Hi, Rima. Good morning and Happy New Year to you out there. So, see, if we talk about Nifty, Rima, after the big rally of Friday, today's consolidation actually seems to be very good for the market because, for one, the PCR in this market was very high when we ended the Friday session. So it has cooled off a bit after this consolidation. Plus, Nifty has still managed to sustain above 26,300, 26,250, these important levels very comfortably. So I do think that the momentum is definitely going to extend from here. And if anybody wants to take a fresh long position in Nifty, they can definitely do it because as long as we are above these 26, 250, 26, 300 levels, the momentum in Nifty seems to be very good on a positional basis. So we will definitely be seeing 26, 500, 26, 600 being hit over probably by the end of this week itself. So Nifty looks good as of now.
Okay. All right. Hi, Sid. Good morning. Good to see you in. Nifty looks good as of now. What about individual stocks? Give us a couple of trading ideas.
Hi, Nigel. Good morning and Happy New Year to you as well.
Happy New Year.
See, two stocks, both of these we have to buy. The first one is from the banking space. The name is AU Small Finance Bank. See, the stock was probably in a very good mode, but it was showing consolidation for the past few days. Today's move has confirmed that a fresh momentum is beginning in this counter. So AU Small Finance Bank can be bought here. Right now, the spot is trading around 1015, 1016-ish. It can be bought here. The stop loss will be at 999, and our targets being the first target 1050 and the second target being 1075. The second stock is Exide Industries. See, for the past 3-4 sessions, there has been a very strong round from its in this counter from its lows. Today's move is a very special one because the stock has almost made an open low. It started running just from the levels from where it opened. So the momentum is very good. Exide can also be bought. Right now, the spot is trading around 372. We'll keep the stop loss at 367 and our targets being the first target 385, the second target being 390.
Okay, thank you very much for that. Getting to a break on the other side, we'll invite the management of Bajaj Auto to talk about their December auto sales numbers and FY27 outlook. Stay tuned.
Welcome back. Let's turn our attention to the auto space. In Bajaj Auto, December auto sales numbers were more or less in line with estimates. The total sales numbers rose by around 14.5%, while export sales continued above that 2 lakh units per month for the third straight month. But the domestic business, well, that was a bit of a drag. To discuss this, what's the outlook for FY27? We're now joined by Mr. Rakesh Sharma, the ED at Bajaj Auto. Hi, Mr. Sharma. Good morning. Welcome to 2026 and wishing you, family and team, a cracker of 2026 ahead.
Thank you very much. Great to be here. And I wish you all a very, very happy and healthy 2026.
Appreciate it. Let's get straight then to the numbers. How do you see the export numbers pan out from here on? I recall, the last 18 months or so, we have been asking you, how do you see this number scale up? Will it go to 2 lakh? Well, now it's holding at around 2 lakh. So on a monthly basis, how do you expect the export number to pan out? And also, if you could help us out with what's the current market share in your focus segment, that 125cc plus segment?
Yeah. So the export tempo for quite a few months, as you know, has been maintaining at about 15 to 20% growth, which is what is giving us above 2 lakh performance. It's being driven by the combination of a very smart recovery, continuing recovery in Latin America, and also of late in Asia, particularly in places like Philippines, etc. The third spot, which has sort of become very bright, is East Africa, parts of Southern Africa. So these have come, the industry over there has come into a growth path. And in all these markets, we are enjoying a very good competitive position. And I think we are getting better than, disproportionate share of the industry growth. And that's what is driving this 2 lakh number. I expect the tempo to continue and hopefully for us to keep beating the 2 lakh number.
Okay. On the domestic front, the market share?
Yeah, so I was coming to the domestic market share, helped by, the GST cuts, which have, I think, triggered a significant uptrade sentiment in those customers whose wallets were strong enough and giving us a very good sort of environmental support for our strategy of always putting out differentiated and better products out there and trying to seek the customer to, them to upgrade to us. Q3 saw, of course, an outstanding performance overall. It is the highest ever and also resulted finally in a gain in the core segment, which we focus on, which is the 125cc plus. So Q3 over Q2 was an improvement in the market share by, I think, about 1.2 percentage points. And this was driven by actually a significant uptake in the market share in our Heartland 150cc plus segment, which, as you know, is the home ground of the brand Pulsar, from where it all started. And that has shown a very nice market share increase.
Okay.
And we are hoping that this will continue because, the sentiment of upgrade, supported by, let's say, lower inflation in the economy, encourages customers to be optimistic about the future. It should be very helpful going forward, particularly because beginning December, actually from November onwards, we have been introducing upgrades, and that also somewhere in the mix is contributing to the improvement in market share we are getting. We've already put in, I think, 4 or 5 new models in the period November and December, and we will see in January and February, or let me say in Q4, a further 3-4 new models coming in.
So you're saying that, earlier you were at 21% market share, it went to 23%, and now it should be in that vicinity of around 24% plus. Is that correct?
Actually, I think it is around 23% plus. We were at 21, it went to 22, and now it's 23 point something in the M3 plus S segment in Q3. Yeah, that's right. Based on Vahan reports. But I must also tell you that, Vahan doesn't give you precise numbers. So these are based finally on estimation, but then you follow the same sort of ratios over a period of time. So the real merit is in the comparison with the previous quarter, which shows a trend line rather than the absolute number.
While you're doing well, sir, in your focus segments, the overall domestic growth for two-wheelers continues to remain very sluggish, just up about 3%, say, for the month of December. If I look at it from April to December, the number does look very weak. Is there any target, is there any number that you can share for the overall domestic, two-wheeler growth for the full year, or say by FY26 end, what you are targeting?
Well, it's difficult to give you a precise number because, as you know, these are outcomes of many, many things, how the industry behaves, competitive action, all that. But I can say that with the improvement in market share, we are looking at a sequential improvement. This is a very, very important area. Sometimes the growth numbers also get sort of influenced by the base effect, which is stock management. I can tell you that December, we damped down on the billing a little bit. So our retails were slightly ahead of our billing to the dealers. So there is that effect to be conscious of. The most important thing for us from a market share point of view is to look at share, how it is going in our core segment, sequentially quarter and quarter, which is what I just explained. And going forward, I think with the new upgrades coming to full play in January, February, March, because this is the time when the consumer demand sort of picks up post-festive in second half of November, and then in December, because there is an anticipation of the model year change. Demand is a little bit dampened. There are less degrees of freedom, and the numbers are very, very small for the industry and everyone. But yeah, so hopefully the new products will give us a good full play in January, February, March.
Okay, and you spoke about sequential improvement in the overall domestic sales also, right?
Yes.
Okay. Higher exports also should lead to better margins on the back of better realizations. What kind of margins should we look at, say for Q3 and Q4 end?
Well, I think we just have to wait for 2-3 weeks. We have our board meetings and declaration of results in the third week, or let's say the last week of January, and which is when we will be talking about our financials from Q3.
Okay. In terms of launches, I think Rajiv Bajaj was talking about launching several Pulsar bikes. That the year will be the year of the Pulsar. What's on the pipeline?
Yeah, so it's a full spectrum. You will see launches in our core segment from 125cc upwards, and they are aimed at sub-segmenting the market and trying to, identify particular use cases and then positioning fit-for-purpose variants in opposite those use cases. And that will sort of upgrade our portfolio and expand our Pulsar portfolio in the coming months.
Okay. Any updates, sir, from the government with respect to ABS?
Yeah, we're waiting now. There has been a very healthy dialogue between the Ministry of Heavy Industries and us, including with the minister. And they are considering the points which the industry had raised. And hopefully in due course of time, we should be getting a firm policy direction from them.
Thank you very much for joining in, and season's greetings to you. Happy New Year 2026 to you, your family, and the entire Bajaj Auto team. Get into a break. On the other side, we'll invite the management of HPCL to discuss their outlook for FY27 and the impact of the US attack on Venezuela and the crude market.
Fly Emirates, fly better.
Welcome back. In a surprise move over the weekend, the U.S. attacked Venezuela, captured the long-serving president, Maduro, and his wife. U.S. President Donald Trump has promised to put the country under American control for now and will tap into its oil reserves. Oil, of course, is the big story. The general consensus expectation is that this basically over a period of time, not immediately, means more oil out of Venezuela into the global markets, and that should pressure oil prices lower. We're very pleased to welcome in Vikas Kaushal, Chairman and Managing Director at HPCL, to talk us through implications. So thanks very much. Good morning. First up, let me wish you and your team a very happy and wonderful 2026 from everyone here at CNBC TV 18.
Thank you, and wish you, your team and your viewers a very happy new year.
Let's kick it off then, sir. What do you think? Is there any way to tell? Oil out of Venezuela is running at about under 1 million odd barrels per day. What will this do to oil prices, in your opinion, sir, in the next year, 2 years?
Well, I think, is that Prashant?
Yes, Prashant there, sir.
Or is it Nigel?
Prashant.
Yeah, hi, Prashant. Prashant, that's an interesting question. I'll talk on that, but before that, let me just share an exciting update from our side at HPCL. As you might have caught the news over the weekend, HPCL announced commencement of a very futuristic project called Residue Upgradation Facility at our Vizag refinery. It is one of the most technologically advanced projects done in the Indian refining sector, and what it does is take up a lot of bottom residues in the distillation column and converts them into light distillates. It is a technological marvel, and we've been very, very pleased that this project's now been commissioned and dedicated to the nation.
Mr. Kaushal, so allow me to
you
come
have more questions on that, but
no. Let's flip it then, because I think I had these questions, but I just wanted to get a quick view on this entire oil. So let's come to the oil broader things later, right?
I'll address that. No worries.
Yeah, let's stick with HPCL first. Yes. In the release about this, the upgradation in Vizag that you pointed out, you're essentially saying that you are, this basically will mean much better margins with this upgradation out of Vizag. Could you give us some numbers, sir, what this will mean, this upgradation at Vizag for earning? How much will it add to earnings for HPCL?
Sure. I think I'll just answer that question in two parts. Let's first understand what is being done here. We have created a facility which allows us to take the bottom of the barrel products after distillation and convert them into essentially diesel. What that means is something which is a negative crack is going to go up into a positive crack. And our distillate yields from the refinery, which were traditionally around 74%, will go up to 86%, close to 86%, all of which, of course, lighter distillates are positive crack products. To specifically answer your question, this would be roughly around $2.5 plus dollars per barrel increase in GRM. And obviously, that places us very well. It has an impact on our margins. We've done the calculations in terms of the crudes which we are buying. Basically, this unit allows us the flexibility to buy dirtier crudes and process them into lighter distillates, mostly diesel, but to some extent MS also. And that gives us an additional margin. So roughly around $2.5 plus dollars per GRM, plus a barrel is the GRM we are anticipating from this project.
And diesel cracks, etc., have been very solid. I have some numbers with me in terms of earnings impact, addition to PAT. They're very large, thousands of crores. Would you be able to share in the ballpark what this could mean?
I would not like to give the numbers right now. We are in the period where results are going to be declared soon, and this has been so we'll probably come out with the numbers, more specific numbers at our earning call in about 2.5 weeks. We are in the non-disclosure period right now. So I hope you understand. But GRM up from this project has been publicly talked and placed before the investors also. $2.5 plus is the GRM we are anticipating from the projects. And our maths shows us that we are going to get those numbers once the unit is fully stabilized and running smoothly.
Okay. All right. Hi, sir. Good morning and good to see you in. Now this is Nigel on this side. A couple of quick questions. As you said, because of this upgradation, you could use various types of input. Could you tell us about your current sourcing mix? Break it up for us. And if you could particularly tell us anything, what's the quantum coming in from Russia? I understand it wasn't too much. Post this upgradation, do you believe that proportion will increase? And just clarification with regard to Venezuela as well. Any sourcing from there?
Sure. See, Venezuela has been under sanctions, so obviously nobody sources from there. Regarding the remaining mix, we source both on term and short-term, the spot cargoes. The terms are agreements done on a longer-term basis for, you can say, sort of an annual rate contracts, which we do, which comprise 50% of our total purchase, and remaining is spot. The spot decisions are all very economical decisions, which are taken, when you go to the market, whatever are the best crudes which are available. And depending on what you already have in your mix, then you pick up those crudes and which are economical. You asked a specific question on Russian crude.
Yes.
Well, in the last couple of months, we didn't have much Russian crude. Obviously, we don't buy from the sanctioned entities, but there are non-sanctioned cargoes available. Just it so happened in the last couple of months, we didn't pick up much Russian crude because it was not fitting into the crude basket we already had with us. But there is non-sanctioned crude which is available, which can be picked up. I hope that answers your question.
Yeah. Mr. Kaushal, I just wanted to come back to HPCL specifically. The next big one is going to be the Barmer refinery in Rajasthan, right? Which is up for commissioning. And I think Prime Minister Modi is going to be there to do it. Sometime in January, I understand. Could you give us the timeline? And again, out of this, once this is commissioned, how does the earnings profile change for HPCL?
Yeah. Yes, you're right. Barmer is in a very advanced stage. The first part of the project, which is the refining of crude and getting some of the basic products, which are MS, HSD, etc., we are anticipating commissioning in the next few weeks. Starting the commissioning process. Commissioning, as you can imagine, for a greenfield refinery takes multiple weeks and couple of months to ramp up each unit step by step. But we are hoping to kickstart that in the next few weeks, the whole process. Already things are in advanced stages on that. The second part of that project is going to be the petchem coming on stream. That will happen later in the year because that is refineries in more advanced stages or refinery sections are in more advanced stages of completion. We are in a greenfield refinery. There are always ramp up time which is taken up for getting it running smoothly and coming out with the earnings profile which we would want. I would hold back onto the numbers till maybe a few weeks till we settle down on the commissioning date and what crudes we are buying and how the remaining units are lining up, etc. Maybe it's a tad early to comment on what margins we are looking at it, but as HPCL, we are mightily pleased that we are coming to a situation where one of the largest refineries, greenfield refineries built in India, is coming to a fruition. And both these projects, the Vizag Rough project and the refinery project at Barmer, are technologically very advanced. Just to give you one L1 level depth on that, Barmer will be the most complex greenfield refinery ever done in India because it comes with an integrated petchem process. Of course, in the first stage, we are only doing the refinery section. Petchem is, as I said, a few months later. Similarly, on the Vizag Rough, we just to share a bit more details around it, the LC Max technology, which is actually a CLG technology, has been deployed for the first time globally. It allows 93% conversion of the bottom of the barrel from the CDUs to lighter diesels, mostly lighter distillates, mostly diesels. It's a hugely complex project. Just to give you in a layman's term on, so that you, me and the viewers can understand, the core reactors of this are 2,200 tons each. Just the wall of the reactor is almost a feet thick. Imagine these vessels, and they run at 420 degrees centigrade, 200 bar pressure. And the beauty of this project is most of the vessels have been built in India. L&T has been our partner on it. These reactors have been built in their facility in Hazira. which is a big boost to Indian refining sector, because it talks about how we are becoming more self-reliant on those. So we are very pleased as a company that both our flagship projects are now seeing light of the day. One has been commissioned, and second one, the Barmer refinery is going to come soon.
No, fascinating details, Mr. Kaushal. I've been to one large refinery over 20 years ago, and it's just, the site is just stunning. I hope we have the ability to visit, some of what you're talking about, and maybe, show it to our viewers as well, and we can sort of, it'd be lovely. Just give us some sense over the next year, 2 years, what will refining capacity be at HPCL? I think you were on record giving us some numbers in terms of how earnings will double all the way into F5, 28, 29. I mean, just give us those numbers.
Yes, sure. I think first on the refining capacity, as on date, under HPCL books, we have 25 million tons of refining capacity, and HPCL and the Mittal Group jointly own the HMEL refinery in Bhatinda. We are equal partners on that. That is another 13 million tons. HRRL will add 9 million tons of refining capacity. So the whole basket of refining capabilities available with HPCL come close to 40 million tons, depending on how you attribute the ratios between the partners. HPCL also has a 16% stake in MRPL. So we do have a reasonable amount of refining capacity. On the earnings, I'll quote what we had said in the last analyst call. We had shared that, and this is again in public domain, so I can easily speak on this, that over a 5-year period, we would be doubling the EBITDA from, if I remember the numbers correctly, from about 20,000 crores a year to about 40,000 crores a year. We are in that trajectory. And with the completion of these two projects, of course, I say again that a greenfield refinery will have its gestation period. So we are not expecting bumper returns in the first quarter or the second quarter. But once it stabilizes, we are on the trajectory which we had already communicated to the analysts in our ongoing dialogues with the analysts.
Just one final question, Vikas, and this is Rima here. Now that, these were two heavy capex, related items for you, this upgradation and Barmer, which is now near completion. So now as the heavy capex period is ending, the expectation is that the cash flow from these projects, from these units, will be used to A, bring down your debt, which stands at 1.07 in terms of debt to equity, and 2, help you increase your dividend payout. Say by FY27, you were called historically the dividend king. On both these two, can you give a guidance? Net debt to equity, and secondly, dividend payout. Can you increase it?
Yeah, sure. So, Rima, thank you. Good questions. Again, I will not give a forward-looking guidance at this point of time, given that we are just anticipating, or our results are going to be declared in a couple of weeks from now. But I'll share what was shared in the last analyst call. You're very right. One of the deleveraging is something we are working on and creating more room for the future growth. Over the last year, we've got the debt equity down from on March 31st last year, it was around 1.35 or 37, if I remember the number correctly. It's down to 1.07, etc. And we are hoping to bring it down even further and deleverage, which creates room for the next wave of growth. On dividend, we already announced an interim dividend at our half-yearly board meeting. And you can anticipate similar trends to continue in the future. At this stage, I would refrain from giving a specific thing because this is a matter to be discussed by the board at the right time.
Okay, all right. Final question, sir, before we let you go. There's been a bit of a hike in cigarette duties the last week, and the fear is, everything is looking up for you. The fear is there could be a duty tweak for companies like yours. Have you heard something? What's the probability? That's the only lingering fear, I think, with regard to the numbers going ahead. Your take.
I think that's a question best. Probably that's beyond my remit to answer that question. All I would say is, as an organization, we are on very strong trajectory. If you look at our half-yearly results, our profit after tax at 83-odd crores was more than the whole last year's profit after tax. So we are braced up for any tweaking which might happen on the entire thing, whether it's oil prices, whether it is foreign exchange going up. Over the last many quarters, we have actually got HPCL into a much stronger rhythm organizationally, improving our efficiencies, accelerating our projects, etc. And I would say we have become financially much more resilient, which allows us to look at shocks. And shocks excise duty is only one of the things. Exchange rate change also is something which impacts us significantly. But now we have that resilience where the minor shocks can be absorbed easily by the organization without creating bigger challenge.
Mr. Kaushal, allow me to ask this one last question. And in the Barmer refinery, HPCL is 74, Government of India, Government of I think Rajasthan is the other shareholder, right? Is there? Will you look at? Is the thinking on the lines of getting in a partner into the project? Is there any transaction brewing at all?
The refinery is currently owned 74% by HPCL and 26% by Government of Rajasthan. Both the partners are working very well, complementing each other. We have tremendous support from Government of Rajasthan on various issues, and we look forward to completing the project. There is our focus right now is on completing the project. First, the refinery section, and second, the petchem section, and making it a strong asset there. So that's all I would say on this. We are very focused, both us and Government of Rajasthan, jointly in creating this as an asset which will be a feather in the cap for Indian refining sector and also a big boost for the state of Rajasthan, because this asset has the potential to change the economic trajectory of many districts around where it is being done. And we are all very committed to doing that.
Okay, fair enough. That is not a no, that is not a yes, but point taken, Mr. Kaushal. Great conversation. Thank you very much for joining us early on in 2026, and I hope this is the first of many through the course of the year. Lovely catching up. Thank you very much.
Yeah. No, thank you. Thank you, and I will definitely take the request, and we'll look forward to hosting you at one or both of the assets so that you can show the technological advancements of the Indian refining sector to your viewers. So absolutely, wish you all a very happy new year.
We will be more than happy to take up on the offer, sir. Thank you very much once again for being here on the program. Well, I think markets up 20 points, 26,350 is where we're at. That's a wrap on this edition of Bazaar. From all of us here, goodbye. Thanks for watching Chartbusters. Up next, we'll take the action forward.
Reliance Industries, it's a record high, above that 1,600 rupees a mark on the share. It's one of the top performers on the Nifty in the third quarter, rising nearly 20%.
Avenue Supermarts is under pressure as a realization dip in the third quarter. Nykaa rises as the street cheers its growth outlook. V-Mart Retail too rises as it sees a 15% revenue growth in the second and the third quarters.
Bandhan Bank rallies as it records a double-digit-led loan growth in the third quarter. CSB Bank too hit a record high as advances rise led by gold loans, while RBL Bank is under pressure after reporting its third quarter update.
HCL Tech is the top loser on the Nifty as CLSA downgrades the stock to a hold rating with a target price of 1,692 rupees a share as the revenue growth fails to meet the brokerage's expectations.
And the record rally for copper continues, and as a result of which it's reflected in the price move of Hindustan Copper. The stock is up over 100% in the last 6 months.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you see, the market's holding in the green. Hey, Mangalam.
Hi, Nigel. Wish you a very, very happy new year.
Happy New Year.
It's the first time that we're anchoring together in this new year. May 2026 be incredible as well. All the frontline indices doing extremely well. But let's talk about Piramal Finance. CRISIL has upgraded Piramal Finance's long-term credit rating. Jairam Sridharan, the MD and CEO of the company, joins us. We'll be discussing, obviously, the following key points. We'll speak about the rating upgrade impact on the cost of funds, AUM growth that exceeds about 25%. That's the guidance. Will that happen? Net interest margins, will that reach 7% sooner than the street expects? Thanks a lot, sir, for joining in, and wish you, your team, your family a very happy 2026. There's been an upgrade that has come by. Obviously, that would have an impact on your cost of funds. If you could quantify that, that's point number one. And secondly, 2025 was a year of serious foreign capital inflow into the NBFC space or the banking space.
Very good morning to you. Thanks for having me, and a very happy new year to all your viewers here. Firstly, a small technical point. CRISIL has rated us AA+. Our current are from ICRA and CARE, who have rated us AA. So technically, the word upgrade is used when the same rating agency changes your rating. In this case, it's a new agency that we've brought on board, and they've rated us at AA+. So just in case my friends at CRISIL get worried about using the word upgrade.
No, they won't get
clarification.
All right. Now, you spoke about the impact on cost of borrowing. See, from a bond market perspective, NCD rates between AA+ and AA, the delta is about 100 basis points. The CP market, the delta is somewhere between 60 and 70 basis points. In the loan market, it is about 50 basis points. So that's kind of the delta for the various kinds of sources. So at least 50 basis points should be the expectation, going all the way up to maybe 70 odd basis points, 70 to 80 basis points one can expect, but it'll happen over time as we roll over our old debt into new debt at these prices. So that's what I expect.
Our director helpfully has flashed the borrowing structure, where about NCDs account for about a little under 40% of your borrowing, and then you have all the others that come by as well. 35% comes in from loans, CPs and ECBs around 10% each, and others at 9%. So on a weighted average basis, what would the impact on your cost of funding be? Would it be this 50 to 70 basis points, or would it be on just one of those aspects?
So no, it will be across the board. It will be a little bit different, but weighted average, I would say anywhere from kind of 50 to 80 basis points we should expect to see over time, particularly as we roll over our debt. Right? The existing debt will continue as it is. We will keep rolling over as we get new debt. We will borrow at lower and lower rates. So that's kind of what I expect.
And on the second point you didn't mention, if a foreign institution is looking to write a big check, would you be open to paring some stake?
See, never say no to capital that's looking to come in. So no, certainly not. But see, as a company, we have a capital adequacy right now of 20.5%. So we are very, very high on capital adequacy. Don't really need new capital. If you look at the upper layer NBFCs, there are 7 or 8 AAAs. There are maybe 4 or or 5 AA pluses now, including us, and there is one AA, right? So that's kind of the structure of upper layer. So we were kind of at the lower end from a rating perspective. Now we have joined the gang in terms of kind of AA plus and AAA population. So I think we'd be fairly competitive with respect to cost of borrowing. So I don't feel a lot of competitive intensity pressure requiring us to do something different. We in the equity markets trade at about 1.3, 1.4x price to book in terms of multiples. The multiples are okay, much better than where they were a year ago, but still not at a level where we would be super keen to actually do any dilution of existing shareholders. So
as of now, Mr. Sridharan, if I got you correct, there's no talks as of now, but maybe at a higher valuation, something could happen.
Correct. That's I think a good summary.
All right, but you're not got.
Sorry.
Please go ahead, sir.
Yeah, you had a question on growth and kind of growth outlook and so on. We have a full year growth outlook of 25% out in the market. We feel very good. We ended Q2 at 22%. Of course, Q3 numbers we will share in about 3 weeks. And we are well on track. I feel very confident about our ability to get to 25% plus AUM growth this year.
All right, Mr. Sridharan, then let's focus on that point with regard to lower borrowing cost. You had indicated the NIMs are likely to reach 7%. Which quarter does that happen in? Somewhere in FY27? Could it be in the first half of FY27 that takes place?
Yeah, I think in FY27, that should happen. We are well on track, and with this action that has happened now, this certainly helps in getting us to that position, and we will be able to quickly churn some of our assets, request some of our existing lenders for a rating review, for a rate review as well, and I feel pretty good about our ability to get there in the next year.
Right. If we look at your quarter-on-quarter NIMs over the last few quarters, it has on an average seen about a 10 basis points increase sequentially. Does that mean that, by the end of this year itself, you'll be closer to 6.5 than 7, and then obviously the rate at which it is going with the reset, etc., coming in, it is pretty possible that the first or the second quarter of FY27 itself, you get to that 7% mark.
यार मेरी टारगेट का काम तुम मेरे प्रोमोटर्स को दो और तुम लोग पब्लिक में मेरी टारगेट सेटिंग कर रहे हो. I think it is possible, and hopefully we will get there, but no promises yet.
Okay. All right. Final question, sir, before we let you go. Some of your non-core businesses, there were reports that suggested that you're looking to exit it, a couple of insurance firms as well. Could you give us what is the update on that front? And by when? You mentioned in the past you want to exit non-core businesses. By when should we be looking at that? And approximate money that could flow in?
See, we have 3 insurance businesses in which we have stakes, or
yes,
we had stakes. One was Shriram's life insurance business. Then there is Shriram's general insurance business, in which we hold 15%. And then Pramerica Life, in which we hold 50%.
Yes.
Shriram Life, we made an announcement last week.
Yes.
Last 10 days ago, that we have exited that at pretty at decent valuations, 2x ish valuations. I think we have so that part of it is done, which leaves to the general insurance business and the Pramerica Life business. We will keep looking at opportunities as they come along. There is nothing to report on those fronts yet. And we will continue our conversations in the external world and figure out when the timing is right. Right now, as I said, the company is flush with capital, so there is no need necessarily for us to do any divestments, and we are quite happy with the level of equity that we have in the firm.
What's your internal estimate of the valuation that you have on these 2 assets or these 2 investments?
See, I think deals have happened in the insurance space anywhere between 1.5 and 2x kind of EVs. When deals have happened, there are not that many deals that have happened here, but they have happened around those price points. Let's see what happens. We are not in a tearing hurry, and we are quite happy to wait for the appropriate valuations to come up.
All right, we take that point. Thank you so much, Sridharan, for joining in and giving us an outlook. Yes, we gave you some targets. Maybe you'll have a conversation with your promoter then, and thereafter, after having a conversation with your board, your shareholders, etc., come back on this show, and then we'll revisit some of those guidances that you've given us as well. But a good start to this year, and wish you a very happy 2026 as well. We take a short break, come back, focus on the markets. We have Shivangi Sarda of Motilal Oswal joining in for a quick technical check after this short break.
You want to talk business? Meet me in the On-Board Lounge. Welcome back. The Nifty marginally in the green. Maruti Suzuki continues to do well. All the auto stocks actually were the stocks of 2025, and now they start 2026 also on the fast lane. We have Maruti up 2%. The second largest gainer on the Nifty right now is Bajaj Auto, which too has moved to the high point of trade alongside Eicher Motors, which is up around 2% too. Let's get in Shivangi Sarda, who joins in with her outlook on 2026 and now as well on the indices and individual stocks. Shivangi, wish you and your family a very happy 2026.
Very good morning, Mangalam and Nigel. Thank you for having me and wishing you all a very spectacular 2026. We've already seen the markets cheering the new year, and Nifty is trading at its lifetime high levels. The outlook for now would be to buy on decline with a support of 26,200 levels, with an upside move immediately 26,500 and then 26,600 marks. So this is the take on Nifty. Talking about Bank Nifty, of course, this has been the strongest pillar of the previous year, and it is still continuing to show strength thanks to the BSU space stocks. And we've seen, there is a strong follow-up buying in most of the counters, which is helping Bank Nifty float at the higher levels. We're looking at 60,750 and then 61,000 for Bank Nifty, with a support of 60,000 levels, and buy on decline to continue for both the indices.
All right, got that, Shivangi. Good to see you in. A quick take with regard to individual stocks.
Individual stocks, first up on my radar is Voltas. We've seen a good amount of long build-up from the last 3 trading sessions. And on a monthly basis as well, it is coming out of a consolidation of the last 8 trading months. And we've seen that, there has been a slow and steady up move, but the kind of buying which has been seen at the support levels is quite smart and, quick. So this one's definitely positive. The previous resistance is now acting as a support here. So quite positive, and we're looking at Voltas for 1550 targets with a support of 1440 levels. And the second up on my radar is from the defense space, which is getting a lot of action from the last 4 to 5 trading session. BEL is what I'm looking at. This stock has actually come out of a consolidative band, and it is on the verge of a breakout of a monthly pole and flag pattern formation breakout. We've seen excellent amount of short covering in this, series so far, and we've seen positive divergence in the RSI front as well. So looking quite positive, and we're looking at BEL for the next target of 430 levels with a support of 405.
Okay. All right. Thanks a lot for that, Shivangi. Wishing you a good day ahead and a rocking 2026. Well, time to slip into a short break, but what lies ahead for the Indian markets in 2026 and which factors will play the most important role? The results of the CNBC TV 18 market poll coming up on the other side. Mangalam's waiting by.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Well, as promised, Mangalam is here to decode what lies ahead for the Indian markets in 2026 and which are the factors which will be the most important. The results of the CNBC TV 18 market poll. Mangalam, over to you.
Well, you know, as we do at the start of every year, we poll a bunch of experts, the market makers, the decision makers, and all of them on what their outlook for 2026 is. And this time as well, we reached out to 50 experts across funds, brokerages, financial institutions, and this is what the street is really looking at. Last year was a 10% return for the frontline index. Dollar adjusted, it was mid-single digits and a serious underperformance as compared to the world. So we started with what the street is expecting in 2026 for Nifty returns. About 55% said 10 to 20%, about a third of them said 0 to 10%, and very few expect a negative return. So the street is expecting some optimism, but expectations are fairly grounded. The second part, where should investors be positioned? Should it be large caps, mid caps, small caps, or micro caps? Remember, last year mid caps and small caps were serious underperformers. But this time, preference for large caps is fairly high. 41% of experts say large caps still offer the best risk reward. This despite the sharp underperformance that we saw in mid and small cap indices in 2025. More than that, you know, the street, while it is positive on mid and small cap, as we move lower down the market cap, we see the enthusiasm clearly tapering off with literally no one vote coming in for micro caps. If you look at the sectors as well, you know, financials have been the favorite for all the market experts we speak to on the channel, while some also speaking about tech and pharma as contra bets. But this time around, if you look at the results of the survey, nearly half of them are still pinning their hopes on the financial space, with metals and other sectors also finding some favor. Tech and pharma still, however, remain selective bets rather than broad consensus calls. What could be the driver of the market in 2026? Will it be geopolitical, India-US trade deal, earnings, or others? Well, while everyone talks about India-US trade deal as of now, earnings, that's something that will be the biggest driver of the market. Nearly two-thirds of the experts say earnings will be the single biggest determinant for markets next year. Trade deals and geopolitics, yes, they do matter, but fundamentals back at the center of the story. And speaking about trade deals, on the US-India trade deal, the start of last year, everyone was fairly optimistic. That didn't happen. This time around as well, you know, people are fairly optimistic. Nearly two-thirds or three-fourths of them believe that the deal will happen in the next 3 months itself, with some expecting within 6 months. In fact, no one thinks it is not likely this year. So that's the one thing that we have to monitor in 2026. What about commodities? Last year was big for both gold and silver. The street believes that outperformance may perhaps not continue. They're betting on what? Copper and aluminum. Copper and aluminum, nearly 68% outperformance, 18 and 13% for gold and silver. This is a clear reflection of infrastructure, manufacturing, energy, transition themes that are taking place. What are the risks now? These are qualitative questions that we asked them, and the most used or frequently used words that came in terms of biggest risk to equities next year: geopolitical developments, the US markets, concerns around AI. Will that bubble or trade unravel? And Donald Trump's policies. That is something you can never take off the table. And clearly, the biggest swing factor when it comes to budgets, that's the one thing that we ask at the start of every year. What are the things that they will be watching out for in terms of announcement coming in? And here too, the market wants a couple of things. They don't want much tinkering with capital gains taxes. That's exactly what they're expecting. A fiscal stimulus coming in to boost consumption, higher government spending, and no removal or changes in STT, STCG or LTCG. So those are a bunch of important, insightful data, opinions and expert calls coming in for 2026. The big outlook, the CNBC TV18 poll, it looks like a year of steady earnings-led returns, less noise, more numbers, and a market that rewards patience over excitement.
All right, Mangalam, thanks a lot for that. Well, that's a wrap on this edition of Chartbusters. You stay with us. The team of Trading Hour is coming up next, and birthday girl Ritu Singh as well will be joining in. Stay tuned.
and welcome to Trading Hour live from the CNBC TV 18 Motilal Oswal studio. I'm Ritu Singh and with me is my colleague Hormaz Fatakia. Markets continuing to chase new highs after hitting that 26,340 mark earlier. Now, the broader markets are up more than 30 points. Nifty at about 26,360 as we speak, and the Sensex up about 78 points as well. Take a look at the bank Nifty, a slew of business updates that have been announced with good numbers coming in from HDFC Bank that has posted a double-digit loan growth for the first time since the merger. Bank of Baroda, PNB, all these stocks in the green, and then you have the likes of Yes Bank, Union Bank with slightly disappointing numbers compared to the rest of the street. But the market breadth very much in favor of at the moment declines, but it's been pretty much even Steven before that. Plenty of stock-specific action as always. And Hormaz, that event over the weekend of the strike on Venezuela, I guess some stocks like ONGC will also be in focus on your list today.
Oh, indeed. And before we get to the show, Ritu, wishing you a very, very happy birthday. Hopefully you have a very, very wonderful 2026 as well. And to mention...
Thank you.
To mention the fact that the markets have had a fairly steady response to what transpired over the weekend, barring the rise that you saw in the precious metals, be it gold or silver, the other asset classes have been fairly subdued, to say the least, because the oil prices are down, the cryptocurrencies are higher, and most of the other equity markets across Asia are doing fairly well for themselves as well. But as you mentioned, highlight being pretty much stock specific, and that's where the trend lies as we go into this new action-packed week.
Well, an action-packed week it is, Hormaz. I mean, from the indices, if you look at it, IT and energy are the only two names that are sort of dragging, the street lower. FMCG has made a recovery from the kind of downward action we saw over the course of last week on the back of some news. But all other indices trading in the green, so it looks good on the screen. Plenty of stock-specific action, as we were telling you as always. Hormaz is walking by to the vault with a spotlight on some of the top movers in market today. As always, he's prepared his list, and it's over to you, Hormaz.
Well, the activity lies in a lot of these business update reactions or even the non-business update ones as well. Now, you'll start off with two names that grabbed the headlines on Friday with that sharp, sudden fall that you saw on both Cupid and on tourism finance. You're seeing divergent moves, but Cupid is now recovering from the lows of the day. At one point, the stock was down 20%. It's now cut its losses down to 9%, and tourism finance too is up 20%. Cupid has had 2.5 crore shares traded already. Tourism finance has had 11 crore shares traded already. And take a look at the 20-day average. Both of them at 20 lakh shares. So significantly high volumes on both these stocks in today's session as well. The two new F&O entrants, Premier Energies and Vari Energies, are continuing to face some selling pressure. Both of them down between 5 to 6% in today's session as well. And both of them are declining on very strong volumes. Now, both of these stocks have seen 28 lakh shares and 12 lakh shares traded, and both of them are significantly off and significantly higher than their 20-day average as well. And the other one that we wanted to highlight is SJVN. We spoke about this on Bazaar in the morning, and considering the 11% up move that you saw on Friday, it is extending those gains up another 6% in today's session. It's gained in 4 out of the last 5 days. The volumes today are already half of what we saw on Friday. So Friday we saw close to around about 11 crore shares that were traded on SJVN. We've already had close to 6 crore shares traded today. The 20-day average is just 12 lakh shares. So moving on very, very strong volumes. The stock has moved above its 100 DMA, which is at 86, and now it's going up to its 200-day moving average, which is at 91, and still remains around about 20% lower compared to its 52-week high, Ritu.
All right, thanks very much for running us through that list, Hormaz. But let's focus on another bank that has reported its provisional updates. Yes Bank came out with its third quarter business updates, a 5% plus growth both year on year on advances as well as deposits, although sequentially deposits did see some decline. But for more on that and more importantly, the outlook for the year ahead, joining us now is Mr. Prashant Kumar, the Managing Director and CEO at Yes Bank. Mr. Kumar, firstly, a very, very happy and healthy, prosperous 2026 to you. And thank you so much for taking the time out.
So, Ritu, first, like a very happy birthday to you. And a very happy
Thank you very much, sir.
Family and all our viewers.
Well, thank you very much for your wishes there, Mr. Kumar. Let's start with those provisional numbers that you've come out with. Compared to some of the peers, perhaps the numbers are not looking as good, especially on deposits. If you could tell us why the sequential decline, and more importantly, going ahead in the year, what kind of improvement do you see? What kind of outlook could you give us for 2026?
I think our numbers are in line with our strategic and stated objective of chasing a profitable growth. But we'll speak more about this when we would declare our quarterly results on 17th of this month. We are in silent period. I would not talk about the bank, but I think the FY26 outlook, I think we are very optimistic because if we see in terms of our GDP growth, if we see the very proactive steps taken by the government as well as by the regulator, I think the coming year would be very, very good for the overall economy and for the banking sector.
So, Mr. Kumar, in light of that, since you mentioned you're optimistic about FY26, what are the trends that you are witnessing? I'm not asking you specific numbers, but how has loan growth demand been on the ground? What sectors have led this loan growth that you reported this quarter?
I think if we see in terms of, say, the demands which are coming, I think it is coming across all the sectors. And I think the best part is that we are seeing the demand coming from the corporates and especially the both manufacturing as well as services sector. I think this is happening after quite a long time. And I think if this demand continues, and especially the private capex start happening, then I think the corporate side, we are going to see a very good demand. We are also seeing a good demand coming from the rural sector and also the consumption-led economy from the urban market also.
In that case, Mr. Kumar, retail, that's almost half your book and has been a bit of a pain point, though. Without getting into specific numbers, sir, is the book overall nearing break-even? Do you expect a meaningful contribution to profits going ahead? Particularly, what is the strategy on the retail front? And also, we understand, Mr. Rajan Pental, who's been looking at this portfolio for the better part of the last decade, is also moving on. So what kind of changes should we expect?
Ritu, I think I would again say it's a silent period for us. I will not speak about these issues. But in terms of retail, if you see the most of the growth which we are getting in terms of what is happening in the market is happening on the gold loan and also on the vehicle loans. Now, like gold loan, we are not there. This is one business which we don't have any significant number. The vehicle loans are very, very thin margin business. So I think overall retail, if we see, we have taken certain corrective actions, both in terms of the kind of asset classes which we are chasing, and also seeing in terms of improving the credit quality of these. So I think we are moving absolutely the direction which we have set for the bank.
Mr. Kumar, RBI came out with that financial stability report, and it really paints a good picture for banks. I mean, profitability is one of the best we've seen in decades. Asset quality at multi-decadal lows, 2.2% kind of a number for the industry, and capital position is strong as well. But going forward from here on, at least from the initial numbers that we've got from the banks that have reported provisional estimates, including Yes Bank, is that LDR ratio is again inching up. In fact, it's at an all-time high now. Do you see that impacting the metrics going ahead? Is that something that concerns you? Will we see more deposit hikes? Or, how do you expect this to play out?
No, absolutely. I think this is one of the risk factors. And this is something which we need to fix. I think for quite some time, what we are seeing that loan growth is surpassing the deposit growth. And that's why the LDR numbers are showing a increase. Somewhere, I think this is one area where we need to figure out, and I think this is the year where we need to make some changes, because this is a structural shift which is happening. That deposits are not moving on the banking side. So I think if the banks need to grow on the loan side, say 12 to 14%, I think at some point of time we need to see the deposit growth happening also more than the loan growth. I think this is one area where all of us together, we need to work and getting more and more deposits into the banking. But I think this is a structural problem which we are witnessing for quite some time.
You know, Mr. Kumar, in your previous answer, you mentioned that you do not have any exposure to the gold loan business. But do you have any plans of getting into it? Because a lot of your peers down south are doing fairly well when it comes to their gold loan business, as evident from their business updates.
No, I think this is definitely one of the good profitable business. We are not there, but definitely we would think in terms of should we enter into this business in a meaningful way. But I think it's still some time away. I think once we finalize our strategy for the next 3 to 5 years, we would definitely explore this opportunity.
Okay, so gold loan is something you will explore. But Mr. Kumar, what about wealth management? I mean, that is an area you've spoken about as an opportunity, especially after the deal with SMBC. Is there any update on that front? And, how really to sort of give our viewers a sense of how your life has changed since SMBC? Any strategic objectives, that have been relooked at?
No, I think definitely wealth is something which is very, very critical for all the banks, because the way the wealth, this sector is growing, it offers a good opportunity. We are there, but we are not in a meaningful manner. And this is what I spoke earlier also. This is one area where we are very seriously looking into in terms of setting up this business in a big way.
Mr. Kumar, thank you very much. Just a few seconds left, to leave us with some of the key themes to watch out for 2026 for the banking sector. In a line, what would those be?
I think the banking sector, like in terms of the profitability, the asset quality, one of the best. We just need to figure out in terms of challenges because of the deposit growth. But I think on the loan growth, we are very, very optimistic. There are absolutely no issues on the capital side also. So I think the only thing would be the deposit growth. But overall, I think the banking sector will see the FY26. I see in a very optical way.
Amen to that. Mr. Kumar, thank you again for your time here. Always a pleasure speaking with you. Thank you so much.
Thank you.
Okay, on that note, we're going to slip into a break. But up next, we'll focus on the bond markets with Manisha Gupta. So stay tuned.
Fly Emirates, fly better.
CNBC TV 18 and India Bonds presents Bond Street.
Welcome to Bond Street, and if you look at the week, or rather the quarter for that matter, we've seen the government bond prices slightly on a decline. This is after we've seen the state indicative borrowing calendar for the month between January to March, the quarter that is, stand at around 5 trillion rupees there. The street was anticipating a much lower number at 4.5 trillion, but you have a higher one there. Now, because of this higher supply of higher yielding state government securities is the reason that we have started the quarter, or the week for that matter, on a slightly weaker note. But interestingly, the traders expect that the RBI will intervene to cap yields, and there is potential bond purchases in the secondary market that you could be looking at, balancing the markets therein. The other thing that I want to talk about on the bond street is one of the opening of the non-convertible debentures that is going to be issued by Adani Enterprises. The issue opens tomorrow, that is Jan 6th, and it closes on 19th of January. If you look at the overall size of this issue, that stands at around 1,000 crores at this point in time. This is also rated AA- investment grade with a stable outlook from both the major agencies, which is ICRA and CARE as well. Interestingly, the base size issue, of course, is at 500 crores, and option to retain oversubscription up to an additional 500 crore rupees is what is open to the investors therein. NCDs with a face value of 1,000 rupees each, and if you look at the bond tenure, well, that is up to 24 months, 36 months and 60 months as an availability as well. Also, the proceeds from issuances, what the paper tells us, will be utilized towards repayment of existing debt and general corporate purposes as well. So interesting day tomorrow on how that was going to be lapped up. Last time we saw that one coming in, it was all oversubscribed in 3 hours. Let's see what happens today. Well, with that, let's slip into a short break. When we return, we will discuss market technicals with Nagaraj Shetty of HDFC Securities.
CNBC TV 18 and India Bonds presents Bond Street.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. Continuing to remain in a very narrow range on the index. Business updates continuing to trickle in. Central Bank of India's updates are on your screen. Advances of growth of close to 20%. Deposits growth close to 8.5% compared to the same period last year. And speaking of business updates, you take a look at Avenue Supermarts. That stock on last check was down around 2%. The growth being lower than the 3-year CAGR, and still continuing to maintain those losses of around about 2%. What is doing well, though, within the broader markets in today's session are stocks like Netweb Technologies. That's up around 8%. Metropolis, after its business update, also is up 6% as we speak. So Netweb Technologies is at the highest point of the day. Did not have a very good year in 2025. Metropolis has moved to the day's high. It's close to 6% higher there as well. Sobha is up 4.5%, reacting to its business update as well. So a lot of these broader market names reacting positively to their business updates. Quick chart check time now with Nagaraj Shetty of HDFC Securities. Nagaraj, good morning. Thank you for joining in. We're moving towards the 26,400 mark now on the index, but would you advise waiting for a dip before taking fresh positions, or this is still a good time to aim for new highs? Your call on the index and your specific stock recommendations as well.
Good morning, Hormons. Yes, rightly said. I'm in favor of going aggressively because we have seen some clear-cut upside breakout recently around 26,200 level. That was the larger consolidation breakout. We can see as a triangle breakout. And technically, we believe once the underlying breaks above such a consolidations, it tend to move higher further. So momentum is very strong, no doubt about that. And I'm not expecting any reasonable downward correction at this point of time. We have a strong support at the higher levels, and one can look to buy at this point of time. And my target for the Nifty is around 26,700 for immediate basis. And I have two stocks on the long side. First one is from PSU banking side. That was Union Bank. And chartically, if you can see, a lot of PSU banking stocks have broken above the hurdles, the consolidation, clear-cut witness upside breakouts. Even the Union Bank is also showing a breakout of the larger consolidation somewhere around 115 and 160. Currently trading around 161.70. One can look to buy at this point of time. 172 is going to be the immediate target. One can place a stop loss at 156. Second one is from a shipping side, GE Shipping. GE Shipping, just I'm preempting the upside breakout in GE Shipping, has been in a consolidation phase over the last few months, placed at the edge of breakout of the consolidation somewhere around 1125, 1130 levels. Buying can be initiated at this point of time. The immediate upside target would be around 1190 levels. One can place a stop loss at 1100.
Nagaraj, very quickly, speaking of PSU banks, you spoke about Union, but what about SBI? That stock actually hit a milestone 1,000. It crossed 1,000 rupees, on the stock on Friday. Any view there, on further upsides?
Yes, even whole host of PSU banks are moving up, technically very strong, and even SBI has also moved up above the hurdle of around 990, 985, 990 levels. I'm expecting this stock to move further highs. I'm waiting this SBI to hit the next overhead resistance somewhere around 1,050 levels in the next couple of weeks.
We're expecting SBI to move to 1,050. Nagaraj, thank you for spending time and joining us today with your views on the index and your specific stock recommendations as well. Take a short break. On the other side, we discuss the trajectory of the Indian economy in the new year and get you a poll of top economists. And to take that discussion forward, Samiran Chakrabarti of Citi will be joining us on the show as well. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. As 2026 begins, the question is how will the Indian economy fare going forward? And to decode India's growth trajectory, Ritu now brings us a poll of the top economists. Ritu.
It's the first week of 2026 and the big question for India's economy is a fairly straightforward one. Can growth hold up even as uncertainty rises globally? The CNBC TV 18 macro outlook poll of leading economists suggests India is starting the year on fairly solid ground, but once you look a little ahead, opinions begin to diverge quite sharply. Let's begin with growth, where real GDP is expected to pick up from 6.5% in FY25 to about 7.5% in FY26, helped by steady consumption and continued government spending on infrastructure. But beyond this year, the confidence starts to fracture a bit. For FY27, growth is pegged at 6.8%, but economists are clearly split. Half believe that growth could slip back towards 6.5%, while the other half think India can still manage 7% or higher. Now, this divergent opinion we're getting really captures that push and pull between domestic resilience and a slowing global environment. Now, the same story shows up in nominal GDP as well. After cooling to 8.3% in FY26, growth is expected to rebound to 9.7% by FY27. But again, there is no clear consensus. Economists are evenly divided between 9.5% and 10%, depending on how various domestic and global cues pan out. And that brings us to inflation. 2026 is expected to continue with the sharp disinflation story we saw in the later half of 2025. CPI inflation is expected to drop sharply to around 1.9% for FY26, largely because of the favorable base effect, but that relief may not last. By FY27, inflation is seen moving back towards 4%, with economists again split between those who see it staying under control and those who are worried about the upside risks from food prices, fuel, and global supply disruptions. On the macro stability front, fiscal consolidation is expected to be on track, with deficit narrowing from 4.7% in FY25 to about 4.3% by FY27. The current account deficit is expected to remain manageable at just over 1% of the GDP, but the more important figure is that of balance of payments, where economists on average see inflows of $7.6 billion. And finally, the rupee, it is expected to depreciate gradually, moving from 85.5 we saw in FY25 and the 89.90 levels we're currently seeing to about 92 by FY27. So the takeaway as 2026 begins, India starts the year with momentum, but the real test will be whether that momentum can be sustained once global headwinds start to bite.
Ritu, thank you for summarizing all of that for the year ahead for the Indian economy. To take this conversation forward, we're now being joined by Samiran Chakraborty, the chief economist at Citi India. Samiran, good morning. Thank you for joining in. Season's greetings to you. First up, to you, your family and your team as well. And well, as you heard Ritu summarize the road ahead for the Indian economy, what are your house calls at Citi when it comes to the GDP growth for the year? And more importantly, with inflation remaining as benign as it remains, do you see further case for an easing stance from the Reserve Bank of India to continue as well?
Thank you. Good morning and season's greetings to you as well. So first on the growth side, I think all of us, we understand that the extent of fiscal and monetary stimulus that supported growth in FY26, the same kind of stimulus might not be available another year in FY27. So obviously it's possible that the FY27 growth numbers are a tad weaker than what was reported in FY26. But I think compared to the poll that you just presented, our numbers are slightly on the higher side. We think FY26 would still be an above 7% real GDP and a marginally above 10% nominal GDP growth. That's because we think the global headwinds also will be much lesser for India this year. In general, global growth has sustained much better than feared. And if we get our tariff deal in the early part of the year, then that could also be a positive from a global perspective. So altogether, it's possible to get a 7% real GDP and a 10% nominal GDP type of numbers for FY27. On inflation, we are slightly lower than the poll. We are at 3.8 average for the full year. that means from a growth inflation standpoint, there is space for RBI to ease marginally more. The question is the timing about it. Would RBI wait for the new GDP and CPI data series to be released to get confirmation that even in the new series growth and inflation is like this? And to what extent this whole dynamics about the external sector and the currency will play a role in further rate cuts? I think that's something that we have to see. But a small space for monetary policy easing is there.
Okay, Mr. Chakravarti, hi. This is Ritu stepping in, and season's greetings to you. But while you're talking about 7% plus real GDP, 10% nominal growth rates, and even in the past year with the kind of GDP numbers we've seen, what has really played out is this detachment between what's happening on the macro front and the markets underperforming. Why do you think the markets are not really believing this broader macro improvement story? And secondly, on the rupee as well. The balance of payment numbers, the economists are very, very split. The average is about $7.5 billion of inflows. How do you expect the rupee to move? And, will it more be linked to BOP than, typically what we see with interest rate differentials? And what is the best and worst case scenario?
Why this disconnect between markets and macros? I think there are three things that is pushing the GDP growth numbers higher, but at the same time is not getting reflected in the company performance. The first is that in India's consumption story now, services has now a disproportionately higher share in last 3 years. 60 to 80% of incremental consumption is coming out of services. And clearly in the market space, the proportion of services companies are relatively lower compared to the goods companies, and that's where the disconnect is there. The second is that in this cycle, the rural is doing better than urban. Again, the same argument applies that the rural representation in the market is relatively lower compared to urban. So that's creating a gap. And third is this whole listed versus unlisted companies. Our sense is that the unlisted companies' growth is much better. And that's why this is pushing up the overall GDP growth numbers with a somewhat disconnect between what the market is thinking about growth is. There is a fourth one which people are talking about the nominal versus the real. I think that problem is a temporary problem. If your forecast is correct and next year nominal GDP growth picks up about 10%, then automatically that will pull up the nominal earnings numbers as well. On rupee, it's more complex. It's more complex because we are expecting that next year we will get into positive BOP situation. In fact, our forecast is that even in the Jan-March quarter, the BOP should turn into surplus. If not for anything else, seasonally, the current account is much better in this quarter. Even for next year, our forecast compared to your poll is much better on the current account. We are expecting only a current account deficit of 0.5% of GDP. So that gives us some confidence that next year, the currency dynamics will be determined more by the traditional driver of the currency, which is inflation differential. This is a year, FY26, where the inflation differential did not play a big role. Our inflation was much lower, but still our currency depreciated. I think next year this pattern would change. And that's why we think that RBI should be able to keep the currency broadly around that 91 kind of number rather than the 92 that your poll is probably forecasting. So that's where we are slightly non-consensus in thinking that there's a possibility that the rupee underperformance of 2025 might not repeat in 2026.
Okay, but Mr. Chakravarti, rupee aside, you earlier mentioned the policy space that is available. I mean, how real is this sort of policy exhaustion risk? The RBI, as per most in the market, is nearing the end of the easing cycle. How long can it stay accommodative? And even on the fiscal front, the government has already taken the hit in terms of lowering the GST rates. How much more can it really do to prop up growth without really hurting its finances?
First, on monetary policy side, I think the focus should not be on how much more rate cuts can be there. I mean, that's probably a smaller number. The bigger focus should be on how long RBI can elongate this easy rate situation through guidance, through liquidity. I think that's going to be the main story for 2026. We've already seen that RBI has been very proactive with its OMO announcements in December. Despite that, bond yields have not come off as much. So one could easily imagine that where bond yields could have been if those OMOs were not announced. So that's where the fiscal thing comes in, that while it's true that in late phase of the rate cutting cycle, the term premium goes up, the long end bond yields go up. But in this cycle, particularly, I think the fear that fiscal will be a challenge. The supply will be a challenge. Even we are forecasting that for FY27, the gross supply of bonds, state plus center, could cross 30 trillion rupees. So that's a very big number for the markets to digest. That's where RBI will have to be cognizant that any further rate cut could affect the bank deposit growth and in turn could affect the demand for bonds as well. So it's a very relatively more complicated late cycle fiscal and monetary policy management that the RBI will have to do in 2026.
Yeah. Mr. Chakravarti, just to close in one line, what will matter most for India in 2026 from a macro point of view? Is it, what will really enable that Goldilocks scenario to continue? I mean, is it sort of strong macro fundamentals or a return of the capital flows? What will be the big focus area for you?
I think return of capital flows. I think it's important that India gets back into a BOP surplus situation. In India's post-liberalization history after 1991, we have never had 2 consecutive years of BOP deficit, which we are going to have in FY25 and FY26. So in FY27, that BOP needs to turn into surplus, and that will solve a lot of our niggling issues, is what our sense is. So I'll be very much focused on that number in the short term.
All right, Mr. Chakravarti, many thanks again for giving us your time, and it was a pleasure speaking with you. On that note, we're going to have to slip into a short break, but don't go anywhere. We're back with market fundamentals on the other side.
Welcome back. A choppy trade continuing for the index as of now. It's slipping back into the red for the Nifty, and good time to get in the latest trends from the F&O space. Mangalam is here to tell us just that from the F&O desk. Mangalam.
Well, I was talking about the fact that markets will return to full steam and find their water once volumes come back the next week, when we were seeing a big rally over the last couple of trading sessions, and that seems like it is happening. After hitting a record high, we are seeing some sort of consolidation with volumes picking up. So markets consolidating at record high, the Nifty Bank and the Midcap index flitting between red and green. And while this is happening, remember the volatility index, which was basically fairly benign over the last few trading sessions, is now perked up as well. That's a good sign for the market. That's telling you that, there is no complacency in the index. The Nifty is actually, consolidating, while the India VIX is up around 7.5%. The advanced decline, that's something we need to monitor closely as we move along this week, because the last 2-3 trading sessions, post the New Year's rally that we saw, the advances were firmly outnumbering the declines, but now there has been some consolidation out there as well, with 1,600 stocks in the red for about 1,250 in the green. The other thing we need to monitor as we move along is the India VIX, or rather, apart from the India VIX, is the Nifty PCR. That's about 1.45 right now. It's the higher end of the range. So that moderating would perhaps provide some more room for the market to move higher as against where it is right now. The options activity denotes that as well. Support at lower levels and a lot of supply at higher levels as well. 26,300 put writers, fairly active in trade today, telling you that around 26,270 or 26,260, we will see a lot of support. Remember, tomorrow is when these options expire. So the very near-term call that these option writers are taking, 26,250, important support. On the way up, however, around 26,400, a little above the all-time high, we will continue to see some sort of supply. Why do I say that? Because 26,350 call writers still fairly active, 50 rupees of premium on offer out there. Amidst all of this, a lot of stocks are seeing a fair amount of bidding and selling. So we have Voltas and PG Electroplast. Both of them were underperformers in 2025. Now starting 2026 with a lot of long positions being added on both Voltas and PG Electroplast. Whereas Premier Energies and Vari Energies are both seeing big positions being built up on the short side. These stocks are down about 5.5%.
Both new names in the F&O space. Mangalam, thank you for that update there. Premier and Vari, both of them are trading lower by around 5.5%. Now, George Joseph, the Chief Investment Officer and CEO of ASK Investment Managers, is joining us. George, good morning. Thank you for joining in. Happy New Year to you, your family and your team as well. Talking about these renewable energy players, right, and as Mangalam was also highlighting the new entrants in the F&O space, but there have been concerns with regards to overcapacity, and there have been some circulars issued as well. Do you have any exposure to this renewable energy theme? If so, what are you playing it through? Playing it through these names or through the financiers?
Good morning and Happy New Year to you and your family as well. It's wonderful having me here. The point you're highlighting on renewable energies, specifically, we don't have exposure. We think that is an overcrowded space, and the valuations doesn't seem to be in sync with the fundamentals. So we are quite away from that.
Hi, George. This upside you're expecting as we move into 2026, on the broader markets, given what we're seeing over the weekend, U.S. striking Venezuela, generally the rise of geopolitical tensions all over continuing as we step into 2026 as well. Do you think that could, to some extent, cap the upside as far as the valuations are concerned?
Yeah, it's an interesting time. If you look at the way globally, things are not in a very good shape, especially from a US point of view. The valuation momentum divergence, which we can see very clearly at this point in time. Earnings growth is focused on only few mega caps, while broader market breadth is deteriorating. And bond yields would have peaked out, but unlikely to collapse. So when we see from the valuation expansion perspective from here on, it looks very difficult from a global standpoint, and China remaining weak and Europe range bound and liquidity is no longer a story or a tailwind. So what we believe at ASK is, the world is moving from a liquidity driven market to a more of a cash flow driven market. So we need to be more careful about what you buy and, the resilient businesses which you need to onboard. That is the theme what we are clear on. And when we look at from that lens, we see earnings rebound very clearly in India. India can be, one of the bright spots in the world, especially from the large markets perspective. And India still remains the structural growth story among the large economies. But the returns from here on will be very moderate. We have to be very, very selective. And, you look for good domestic resilient stories, capex cycle stories, consumption-driven, consumer discretionary stories. Liquidity is not going to be abundant. So businesses which has been beneficiaries of liquidity but not of fundamentals will start tumbling down. So that is our broad view. But mid-teens growth is visible, and that's a consensus estimates for FY27 and probably towards FY28 as well. But FY26 between 7 to 12% range, the earnings growth has been. So we think broad index will give similar kind of range in FY27 and 28. Some inch up in the earnings growth in the broader markets, but the valuations also needs to be taken into consideration. So valuations is about normal.
Drill that down for us, George. You mentioned a few sectors, but in this broad gamut of themes that you mentioned, where specifically are you betting on for the consumption-driven themes and so on?
No, what we are betting very clearly is on the private financials. Some of the large cap private financials are, to us, it looks like a dirt cheap valuation. Maybe at 5-year low valuations, it is available, which looks very attractive from a next 3 to 5 year perspective. And, entire private financial space looks very interesting. So last 5 years, if you look back, it was more of a recovery theme. And, PSU banks and some of the large private banks who had a lot of NPA, they were the biggest beneficiaries. But next 3 to 5 years, we think more of a credit growth play. And, that's where some of the private financials will look good. And also we are quite bullish on the NBFC space, where you see the MFI problems, coming off, and MSME, SME problems coming off. So there is a good tailwind for growth, and as well as the benefits of the rate cuts also clearly going to come through for these companies. So NBFCs, private financials, that's a space we are quite bullish on and looks attractive as well. But otherwise, most of the sectors are fairly valued or overvalued. So we need to be picking and choosing the right ones in these other sectors.
Pleasure having you today, George. Thank you so much for sparing time and joining us today with your views on the markets and the themes that you're betting on as well. Now take a short break, but before that, CNBC TV 18's brand new offering, the Macro Signal, on the other side. Stay tuned. Welcome back. It's now time for CNBC TV 18's new offering, the macro signal. The aim is to isolate the macro forces that actually matter for the day and explain how it translates into market moves. And who better to inaugurate a new segment than the birthday girl herself, Ritu? And you're focusing on the development in Venezuela and the impact on the oil markets.
Well, yes, this is our new segment, Macro Signal, which is your daily pulse on the big picture forces that are shaping the markets. And today it is about war, oil, and the oil markets and the historical playbook that investors fall back on when geopolitical headlines start to heat up. Now, two things that history teaches us. First, headlines alone rarely move oil markets. And secondly, supply disruptions and fundamental changes, those definitely do. Now, has the U.S. targeted Venezuela before? Well, yes. Rather than military action, it was through sanctions before. In 2015, you had the Obama administration freezing assets, imposing visa bans on key Venezuelan figures. Then between 2017 and 19, the Trump administration restricted U.S. financing of the government and its state oil company, PDVSA, freezing its assets. But did this crush oil production? Well, Venezuela's output had been falling anyway for years because of mismanagement, other reasons. To give you a sense, for instance, in 2005, the production was around 2.6 million barrels a day. By 2013, that was down to 2.4 million, 2.2 million by 2016. And when sanctions hit in 2019, production had already fallen to about 800,000 barrels a day. And by 2020, further to 500,000. But here is the key point. Oil prices did not spike dramatically because this was a slow decline, not because of a sudden supply shock. Brent crude, for example, fell from about $110 in 2014 to less than $30 in 2016, thanks to global oversupply. Prices then recovered a bit in 2018 and collapsed again in 2020 because of the COVID demand shock. Now, do wars move oil prices? Sometimes they do. That's what history shows us. Historical shocks like the 1973 Arab oil embargo, the 1979 Iranian Revolution, the 1990 Gulf War, and more recently the Russia-Ukraine war in 2022 drove oil prices sharply higher. But then you had, on the other hand, conflicts like the 2003 Iraq war or the Israel-Hamas flare-ups that we've seen. They've only caused short-term spikes at most. Now, let's look at where Venezuela stands today. Symbolically, very important for the crude market. Systemically critical, not really. It has the largest proven oil reserves in the world, but actual production is under 1 million barrels a day, and that's less than 1% of the global output, global demand. Now, compare that to Saudi Arabia at over 11 million barrels, Russia at around 10 million barrels a day, Iran at about 3 to 4 million. Those are the real oil shock zones. There's also this dollar dimension that some have been talking about. For instance, Venezuela operates a largely dollarized economy. Historically, now we've seen attempts to bypass the dollar have raised concerns. So Iraq in the early 2000s explored selling oil in euros under the UN Oil for Food program. Libya under Gaddafi proposed a gold-backed African currency. While none of these directly triggered wars, they did become part of a broader geopolitical narrative, which the markets do track closely. So the market signal from all of this, Venezuela alone cannot trigger an oil shock because it produces less than 1% of the global supply. But over the long term, if US control results in higher oil supply from the region, which is what they were indicating, that could weigh on oil prices. Inflation risk will only arise if oil prices stay elevated for a sustained period, which does not seem to be the case for now. But this stress does strengthen the US dollar, so watch out for the impact on the currency. Safe haven assets like gold and silver, while equities, of course, see some initial risk-off reaction. But the broader message is, the messaging from the US exerting its power, consolidating its position in the region, and, of course, the risk of continuing geopolitical escalation.
Indeed. The big talking point of the day, as has been over the all weekend as well, is Venezuela and its impact on various asset classes. Ritu, thank you for summarizing that for us. Take your leave on this edition of Trading Hour. From Ritu and me, thank you for watching. Halftime report on the other side.
Market trades flat as we start the first full trading week of 2026. Defense, real estate, PSU banks trade strong. The IT index, the top loser, down 1.5%.
Venezuelan President Nicolas Maduro is slated to appear in Manhattan federal court Monday. The ousted Venezuelan leader, brought to New York with his wife after their capture by American forces in a dramatic military operation on Saturday, faces charges related to cocaine trafficking. He's being held in Brooklyn jail.
Bandhan Bank rallies as it records double-digit loan growth in the third quarter. CSB Bank too hits a record high as advances rise led by gold loans. RBL Bank under pressure after it's reported its third quarter update.
In corporate conversations, the management of Bajaj Auto tells CNBC TV 18 that they have seen a healthy recovery in most export markets. HPCL management says that the upgradation at the Vizag refinery and commissioning of refinery in Barmer provides strong earnings outlook. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra and today with me is Mangalam Malu. Hey Mangalam, good afternoon actually. We are starting a full week of trade. This is the first full trading week for 2026 and there are no fireworks to be honest. We have been sideways. Nifty is absolutely flat as we speak. It's around 50 points off the lows of the day, but again 50 points off from the highs of the day as well. Nifty Realty Index is doing really well. We do have a lot of quarterly updates coming by and that is something we'll keep focusing through the week and then we'll analyze all the earnings as well. We also will be preparing ahead of budget, so there's so many cues to track. For now, markets absolutely sideways. Some action coming in from Bank Nifty, but that is largely led by the PSU banking index.
We take that point entirely. You know, when the markets were rallying all of last week, we were making the point that it's on low volumes and the clear direction will emanate only once full volumes return. And that's exactly what's happened. And nothing, more significant of how the market is moving than HDFC Bank. After the merger, the first time it's the company that reported a double-digit loan growth. The street expected some fireworks coming in on HDFC Bank, but a large part of that may have perhaps been priced in already, which is why the stock is down about 2%. It's an FII favorite. So if FII volumes have returned, has the selling in some of these names returned or not is something that we will be tracking. The other pack, which is pressurizing the Nifty right now, is the IT index. But while it's consolidating, the good part is we're consolidating at record highs. We're not seeing a further sell-off. So far, so good for the markets. Not particularly bad, it's consolidating.
It is consolidating, resting after what's been an action packed last month as well, right? But it's time for our movers and shakers segment where we track a whole host of stocks buzzing in trade. Of course, it has to be all about quarter three updates. Among them, we are focusing on Avenue Supermarts. There's Nykaa as well. And of course, then we'll get Gaurav in for the BFSI updates.
Yes, we will get Gaurav in for the BFSI updates as well. But I'll look at both Avenue Supermarts as well as Nykaa on opposite sides of the spectrum. Why is that? Because Avenue Supermarts, they reported their third quarter updates and the revenue growth, the standalone revenue growth has been 13%. This is lower than what the street anticipated. Why is that? Because if you look at it over the last 3 years, the CAGR has been closer to 16%. So it's lower than that as well. And if you look at the number of stores last year and the number of stores this year, that addition itself has been around 14%. So with a revenue growth of 13.1%, store addition is higher, CAGR of 3 years is higher, implies that there could have been negative same-store sales growth, which does not work well for the margins of the company. But my sense is that these realizations are possibly lower due to GST cuts. Remember, same time last year, the prices at which things were available, from then to now, the sharp rationalization that we've seen in GST, and more so for consumer staples, the kinds of products that DMart sells, you know, that would have had a realization hit. So to that extent, watching the operating performance, the assortment mix, and outlook on store opening remains extremely crucial to track in the actual numbers that the company will report on Jan 10th itself, which is Saturday. But at the same time, the good part is that they've increase the pace on store additions. So this quarter, they've added about 10 stores. And the first 9 months of this year, they've added 27 stores. The first 9 months of last year, they added 22 stores itself. So
the fourth quarter, which is seasonally strongest for them in terms of store additions, maybe they do a little better this year than the previous year, and that could be a positive. On Nykaa, the consumer discretionary demand continues unabated. The growth out there expected to be in late 20s, further supported by wedding season, the festive season, all these factors doing extremely well for Nykaa. And they have two major segments, beauty and fashion. Guess what? The beauty grew in the upper end of their mid-20s on a consolidated net revenue and net sales value basis as well. And the fashion business, that continued to do well too. Remember, the company had a few chinks in their fashion business in the first half of this year. They expected it to improve by the second half of this year. Out here, the key monitorable will be whether this business breaks even in the third quarter and makes a little bit of a profit in the fourth quarter or not. So NSV, or net sales value growth of mid-20s in fashion business, beauty doing well, overall mid-20s growth, which is why Nykaa is up about 2%.
Okay, all right. So that's about the consumer space. But other stocks which are on our radar, let's talk about Bajaj Finance first up from the BFSI space. Gaurav, how did it look?
Well, as if you look at the numbers of Bajaj Finance, those are broadly in line with the management's expectation and guidance. Because let's understand, if you look at AUM growth, that is at around 22%. Last quarter, management cut down their growth guidance from 24 to 25% to 22 to 23%. So if you look at the numbers, that is actually in line. If you look at customer franchise, that has improved almost by 19% on a year-on-year basis. And in fact, the new loan addition in this quarter specifically, that increased by 15%, although the number looks a bit low. But if you look at the base, that was high, and that is the reason why the number looks low. In fact, if you look at the total number overall, that has reached 13.9 million. So definitely, if you look at the numbers, those are in line. But what has happened is that for Bajaj Finance, people were expecting a better number, given that this was a festive season and Q3 usually is stronger because of the festive season. That is number one. Second is that if you look at the AUM growth, that has come to 22%, which is the lower end of the guidance. And given that Bajaj Finance is already trading at 4.5 to 4.6 times price to book, which is still a reasonably higher valuation if you compare it with the peers. So any kind of what we can say a flat number is still a disappointment for Street, and that is the reason why we are seeing some kind of stress in the stock price at this moment.
All right, Gaurav, that's about Bajaj Finance, but all the others, AU Small Finance Bank, RBL Bank, how have those updates been?
Well, AU Small Finance Bank numbers have been good, and we have seen this for the last few quarters as well. Even in this quarter, the deposit growth was at around 23%, while advances that grew almost by 24% on a year-on-year basis. In fact, if you look at CASA, now that has declined, but that is again the industry trend. But overall, the numbers have been better. And on a sequential basis, the number looks 6.5% growth on a sequential basis. So definitely a strong number from AU Small Finance Bank. And let's also not forget that the bank is also transitioning towards the universal bank. So despite transition period, we are seeing this kind of number, which is actually healthy. On the other hand, if you look at RBL Bank, now this is the first time when RBL Bank is reporting their numbers post the Emirates NBD deal. We have seen the bank stock rallied because of the NBD deal that happened and which was announced. And if you look at the numbers for now, loan book that increased by 13% on a year-on-year basis, and within that, if you look at secured book, that increased by 24% on a year-on-year basis, while unsecured degrew almost by 6%. Other than that, the deposit growth that also remained kind of in line, because 13% growth is what we are seeing, and they are also focusing on the granular deposits. But overall, because of the weak number, because let's not forget that for FY27, people have already increased their expectation from the bank that it can grow as high as 20%. And given that there was a 13% growth which was reported in this quarter, we are seeing some kind of negative reaction, at least for the day, in this stock.
Okay, all right. Thank you so much, Gaurav. So that's all about the BFSI space. Let's also look at the realty space. It's the top gainer in terms of sectoral moves. Sobha reported its Q3 update, and it looked decent on a YOY basis. If you look at the pre-sales growth, that came in at 12%. Sobha's share in pre-sales was up 18% on a YOY basis. But if we talk about the volumes, they were flat on a YOY basis to come in at 1.3 million square feet. Looks like a lot of the sales came in, one, from pricing growth, and second, contribution coming in from high-ticket projects. And that's the reason you see realizations going up by 13%, which is largely in line with the sales value growth that we have seen as well. And Bangalore continues to be their biggest market again. It recorded highest ever quarterly sales, saw a growth of 51% on a YOY basis, more than 70% contribution coming in from Bangalore itself. NCR region is picking up for them as well. Around 350 crore rupees or sales came in there. And Kerala contributed substantially, 18% growth on a YOY basis, taking its sales to 154 crore rupees. They continue to be bullish on demand going forward. The stock is high by 4.5%. Also, the entire Nifty Realty Pack or the Realty Pack continues to do well. So those are some stocks on our radar today. But with that, actually, let's go across to Hormuz now. He has all the other stocks that are moving around in trade. Hormuz, over to you.
Well, the index continues to consolidate, but near record high levels. And there are names that are at 52-week highs as well within the Nifty. And they include the likes of Nestle. Maruti is now moving towards a 52-week high as well. And as is Eicher Motors, was one of the top performers on the index in 2025. Some of the other names that are doing well in today's session, of course, you spoke about all of these names, but Metropolis is one such name that is reacting to its business update, 5% higher on that stock as well. So that is one standout from the business updates that were reported earlier in the day. We, of course, spoke about Avenue Supermarts and Sobha. Some of the other names that are reacting in today's session, SJVN, the stock was up 10-11% on Friday. It's the second day of gains that you are seeing on the stock, and more importantly, on very significant volumes as well in today's session. And lastly, the new F&O entrants. We spoke about those just a few minutes ago, both Vari and Premier. Both of them now. Premier Energies is down almost 40% from its post-listing highs. Vari is down almost 30% from those levels, so 5 to 6% lower on these names. And ever since they have entered the F&O space, there has been consistent selling pressure in both of these stocks.
Take that point, Hormuz. Thanks a lot for that. We'll speak about the F&O setup shortly as well, but these are seeing a lot of short build-ups. We'll take a short break. On the other side, the management of SmartWorks connects with us to talk about their second half FY26 outlook, speak about 2026, the growth trajectory going forward. Stay with us.
Fly Emirates, fly better.
Welcome back. You're still tuned into Halftime Report. Let's talk about SmartWorks co-working space. That is the first management on the show. Kotak Institutional Equities recently initiated coverage on the stock. They're quite bullish. They believe company's EBITDA will grow at 38% CAGR during FY25 to FY28, which will be aided by an increase in operational area to 14.5 million square feet. To understand more about their growth trajectory, we now have with us Harsh Binani, who's the co-founder and executive director at the company, joining us now. Harsh, good afternoon. Thank you so much for joining in and wishing you and everyone at the company a very happy new year. The new year started with Kotak releasing a bullish note on the company. So let's talk about that first, because they are expecting a 38% CAGR, which will be led by expansion. What, according to you, would be the triggers for that growth? You recently saw an expansion in Kolkata. Will such cities or tier 2, tier 3 cities would be on your radar? What are the growth plans going forward?
Good afternoon, Sonal and Mangalam. Firstly, a very, very happy new year to you and to all the viewers. 2026 is already off to a great start. And before I answer the question around the growth trajectory plan for us, it's very important to talk this new revolution that has happened in India, particularly around managed workspaces. So India undisputably has been at the epicenter of the office revolution in the last decade, particularly more so. This trend has accelerated during COVID. And to put into larger perspective, in the last 80 years since independence, India has produced only about 1 billion square foot of office space, which is just a tad more than New York and London combined. And within this, we know for the next decade, 15 years, another 1 billion square foot is going to get added. So you can only imagine the amount of new office space that's going to come up as India traverses its next trajectory of growth. Now, within the larger frame of office market, managed workspaces and flexible workspaces has emerged as the phoenix in this category. And today, India is the largest market for flexible workspaces globally. More than 10% of commercial RE today is flexible workspaces. And we see this not as a small-time shift. It is a structural shift. It has become the new world order, where you're starting to see a lot of behavioral shift moving towards managed workspaces. So we know for the next decade, not only will a lot of new office space emerge, but majority of it is actually not going to be leased. It's actually going to be managed.
Got that. Harsh, that's good setup for the industry on the whole. But, if I'm looking at SmartWorks in particular, a couple of things stand out. While you came to the street, you were obviously loss-making on a reported basis on EBITDA and the bottom line. The second quarter changed that, where at least on a free cash flow basis, you turned positive. The belief here is that, this is a high operating leverage business. As occupancies increase, as leased space increases, you will obviously see a better up move on your EBITDA from here on. What I'm trying to understand is also the contribution that will come in from ancillary services, because a lot of your peers are looking at premium services just more than, a basic rental that these companies are giving to their clients. What's the proportion of that in your overall mix right now? And how is that likely to grow from here? Because that's more margin accretive.
Certainly, Mangalam. So SmartWorks has, of course, emerged as the largest player in this segment. As the largest platform today, we manage about 14 million square foot. While the industry has been growing at about 20% odds, we've been growing 1.5 times more. And the primary driver behind this is the fact that we have created this unique differentiation of ours, where not only are we the largest, but we are also growing the fastest. We are adding about 2.5 to 3 million square foot. And our business model is largely focused on getting large enterprises to come and sign up large contracts for a very large duration. So from that perspective, the positioning of our business is more around a REIT-like annuity model. While it's still very early days for us as we're expanding our value-added services and other new avenues of growth, but we still believe that the core business by itself has so much ample runway for growth that we want to continue focusing all our energies on growing this platform. So today we have close to about 14 million square foot with plans to add about 2.5 to 3 million square foot every year. So primary driver for margin upliftment, as I had mentioned during our Q2 earnings call as well, will be the operating leverage and the scale that's going to come from the core business, while all of these value-added services, etc., will be an addition to that, which you will start to see in next few quarters.
Okay, we'll start seeing that in the next 2 quarters. You're also quite confident on the second half, talking about 1 million square feet of additional leasing come by, and there'll be around 1.4 million square feet which will mature in the second half. How long before you get renewals on the leases which are maturing? And also, how confident are you of leasing out the 1 million square feet? Are you already in touch with tenants, or are some contracts already signed?
Look, if you look at our past trajectory, the company has demonstrated very strong growth. We've been growing at more than 40% CAGR for the last few years. In our Q2 earnings call, we had also reported very strong occupancy for our new campuses, while our mature cohort, which finishes about 12 months or so, is standing at close to about 90%. So if you were to look at our past trajectory and the very rapid growth that you're seeing in the company, there is no reason for us to believe that the second half, as we had guided during Q2 as well, where a lot of our portfolio is going to get mature, you will start to see these numbers pick up even more. But the more important context to appreciate here is the fact that the business of SmartWorks has been fundamentally a cash flow focused business. So while our EBITDA growth has also rapidly happened, this has happened with cash flow, which is much greater than EBITDA. And that is what makes this business self-sustaining as well. So post IPO, the company's balance sheet has strengthened significantly. So today, while we are net debt negative, but for the future growth trajectory of ours, the company will not require any further capital, and all of that is going to be self-sustained. The 350, 400 crore that we have guided.
No, we take that point, Harsh, and I'll just correct myself. Earlier, I said that you turned cash flow positive in the second quarter. It was the first quarter, and thereafter you turned negative in the second quarter as well. What explains that? Point number one. And secondly, from here on a reported basis, what's the annual free cash that you are expecting? And at the same time, when do you, on a reported basis, turn EBITDA and net profit positive?
Absolutely. So in Q2, we had reported the cash flow trajectory of the company to continue to be on the upward trajectory. What led to the metric being smaller than what it was in Q1 is because we are seeing immense opportunity, Mangalam, in terms of growth. So we leveraged Q2 strategically post IPO to block a lot of great supply. As you're aware, our business has been fundamentally built on the foundation of India's commercial real estate, where 80% is non-institutional. And that has been the reason why, through speed and scale, we've really scaled this platform. But the more fundamental shift which has happened in the last 2 quarters is that all the large titans of India's real estate, DLF Group, Panchsheel, Hiranandani Group, they have also now all come to the platform, which indicates to you that even the larger real estate giants now acknowledge and realize that flex space is here to come. And the cash flow that we had deployed to block a lot of this supply, which is now going to go live in 26 and 27, was largely the reason behind why you saw the numbers to be what they are.
Okay. All right, Harsh, always a pleasure speaking with you. Thank you so much for joining us today with the outlook on the business going forward. We'll touch base again when you release your Q3 numbers to be able to give us more numbers in terms of guidance as well. That's the word coming in from SmartWorks. With that, we'll slip into a short break, but a quick note for our viewers. Get ready for CNBC TV 18's all-new lineup starting Monday. Incisive analysis, sharp commentary with CNBC TV 18's brand new offerings. Watch our new segment, Cut the Balance Sheet with Mangalam and Sonal Bhutra. Watch Macro Signal with Ritu Singh that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV 18's most trusted in-house technical experts.
Welcome back. A bunch of stocks actually firing up right now. From record lows, we are seeing a big move on Ola Electric for second day running. That stock's now up 7.5%. And the other one, there was a big gash that we saw on Tourism Finance Corp, TFCI, on Friday's trading session alongside Cupid. Both those stocks were locked in lower circuit. But thereafter, the bulk deal data did suggest that, maybe one of the insiders, the promoters of the company, bought in Tourism FinCorp, and that stock has now moved higher, locked in a 20% upper circuit after seeing a decline of 20% on Friday. But we have Sudeep Shah, who's the head of technical and derivative research, SBI Securities, joining in now. Sudeep, we're consolidating at higher levels. Volumes have returned to the market. What's your sense of direction on the frontline indices?
See, what we feel is that while since morning the markets have traded in a tight range, and that is that is quite acceptable post the move that we have seen in the last 1 week. So overall, we feel that 26,200, 26,150 will now act as a strong support on the downside until the time this zone is guarded. Fresher highs up to 26,500, 26,600 would be on the cards. From the Bank Nifty perspective, 59,800, 59,900 would now act as a strong support on the downside. And till this holds, a fresh high up to 60,600, 60,800 is very well on the cards.
What about individual names? Anything that you are tracking?
Yeah, so from the Bank Nifty, and last week we have seen PSU banks outperforming. That is still continuing, but this time we feel now within the private banks, Axis Bank, ICICI Banks, ICICI Bank is looking good. So within both of them, Axis Bank we feel can be bought at the current levels around 1280, 1285 with a stop loss of 1250. The potential upsides here could be around 1340, 1370. The second stock that is on our radar is Minda, which is auto ancillary. Here we have seen a fresh breakout on the weekly as well as monthly charts, and we feel that 1310 can act as a strong support as a stop loss, and potential upsides here could be up to 1375, 1390.
Okay, all right. Take that point, Sudeep. By the way, take a look at... thank you so much for joining in. With that, let's move on and talk about some other stocks which are on our radar. Mangalam just spoke about TFCI. That stock is locked in upper circuit. We also have Gandhar Oil Refinery. The stock listed last year hasn't seen the best financial performance, but today it is seeing gain of around 14.5% as we speak. Netweb Technologies is the other one, up around 12%. But that was all about the technicals of the market. What's the F&O setup looking like? Mangalam is joining us with more. Mangalam.
Well, the market, is consolidating at higher levels, so no real problems out there. Where it goes from here will be extremely crucial to monitor, especially on the broader market end of things. The good part, however, is that the India VIX, which was languishing in the last few trading sessions as the market moved higher on lower volumes, is now back up above that 10 mark. And that's good because, typically lower India VIX means that market is complacent, and now complacency is out and the excesses may be getting out. We'll talk about more in just a bit. The advance decline ratio as well. The last three trading sessions firmly in favor of, advances, and now we're coming closer. Yes, we have more stocks which are declining, but a 1,300 number of stocks which are advancing as well means that there is better balance in the market today. And now, speaking about the excesses that are being taken out, the put-call ratio, which on Friday was 1.46, up until 1 hour ago was 1.45. Now that is moderating to around 1.35 as well. Typically, upwards of 1.25, 1.3 is where the market is overheated, still overheated, but needs to moderate a little more for the market to make further room for an up move. The good part, however, is that with this up move sustaining, the put writers are fairly active. These are options that expire tomorrow, and they believe that the support for the market has moved higher to around 26,250, 26,270 to be precise, because the 26,300 put has a premium of almost 35 rupees. So that's a positive, but the market needs to surpass and cross past that 26,400 mark for a further up move, because the 26,350 call writers are still fairly active. With the excesses being taken out, more room for an up move. would perhaps take the markets then. Until then, these option writers who are playing for an expiry tomorrow expect the Nifty to be around that 26,400 mark as well. So the rough range this street is working with, 26,250 to 26,400. A couple of stocks doing well. We had Voltas do well all through today's trading session. Blue Star is now seeing long positions being added. Nestle India, among the top gainers on the Nifty with a 3% up move, has seen some fresh long positions being added as well. But the recent additions in FNO, Vari Energies and Premier Energies, are seeing a huge spike on the short side and a lot of short build up. Those stocks lower by about 5.5%.
All right. Okay. Thank you so much for all those FNO cues. With that, we'll do one thing. We'll take another break. On the other side, we'll get in Manisha Gupta joining in with Sanjay Kumar of Resens to discuss Budget 2026 wish list from the food sector. Stay tuned.
Welcome back. Joining us on the show now is Sanjay Kumar. He's CEO and MD at Resens. Sanjay, hi, thank you so much for joining in. First of all, 2026 has started on a stronger note when it comes to many of the commodities, especially the non-agro ones. But that perhaps would tell us on how agriculture would be. What the markets are watching out right now is, of course, monsoons for India, tariff situation globally, geopolitics, biofuel mandates, currency volatility. I mean, every next year that we go into, the list just about continues. What is it that you're looking for in 2026?
Hi, Manisha. Thanks. First of all, a very happy new year. It started well, as you've seen the markets. I think the biggest challenge for the commodity sector, particularly agriculture commodities, is the trade-off between the impact of a depreciating rupee, because that has an impact on the price of edible oils and pulses, which we consume in large measure. India is one of the biggest importers of pulses globally. And it has a consequential impact on overall food prices. So while we do recognize that there has been pressure on the rupee because of certain geopolitical risks that we are now grappling with, the fact is that the only way we can offset is if net FDI increases, and that we are seeing is not happening. If you take a benchmark today, India is at 0.8% net FDI as percentage of GDP compared to, let's say, even a Vietnam, which is at 4, and a China, which is at 1.9. And unless we see some increase there, we believe that the rupee will continue to slide, which has an impact both on logistics cost and agricultural commodities. So coming back to your question, that how do we see this going forward? Well, if demand were to pick up, I think it will have a significant impact on inflation. I mean, a demand for food. Right now, what we see is stable. But if we see the incentives that the government is given for manufacturing to start, yielding results, you will see a spike in food inflation on the back of some of these geopolitical risks. So that's where our concern is, and we hope the government does bring about more changes in the investment environment. There's a lot of good intent at a federal level, but when you try to implement it at a state level, it is really complex. To run a food business in a single site, you need about 9 licenses. Compared it to China, it's 3. So need to simplify, and the government is doing a lot around that. We've seen the new labor code. All of this will help, but the bottom line is simplification, and for the food sector, reintroduction of input tax credit so that the formalization of the agricultural business becomes a reality.
That's exactly what I was coming to you with, formalization. And how have you seen that grow in the last couple of years? How has 2025 been for you? And exactly for that one reason, what is it that you think needs to be done from the government? Budget is just around the corner. Do you think perhaps you could hear something from there?
Well, I think at a federal level, there's a lot of intent to try and simplify things for businesses. But the irony is, because equity has become so attractive, businesses are increasingly, small and medium businesses like ours, finding it difficult to raise debt. So in order for that to happen, the formalization in the food sector, the formalization requires the reintroduction of input tax credit, because most food businesses have between 60 to 70% of their cost as the cost of goods, which is agricultural commodities and oils. So if that has to be accounted for, ITC becomes crucial. And it was there in the budget, when GST was introduced. It was removed after 1 year, and the food service was co-equated with the QSR business, which is the restaurant business. But that's not where the bulk of the consumption lies. So our hope would be that the government would address this issue in this budget. It would look at, more formalization of labor, because while the laws exist, the ground level implementation of the labor laws sees a lot of gaps, especially at a state level. And, for example, let's say you're serving food at an office, you need 9 licenses in India compared to 3. It was 3 in China, it's now 2. Even to get people moving within the country, you need 2 licenses. So we are hoping that the intent of the federal government also percolates at a state level to see that doing business becomes easier. And that is our single biggest wish list, because if you see more and more Indian businesses are investing abroad, outflow of the, net FDI outflow is almost 30 billion. We have one of the lowest net FDIs amongst the developing economies. So I think there is a need for us to make it easier to do business in India.
Taken. You talked about state level, environment in sense of investment. You also talked about input tax credit. What about the policies therein? Because a lot of other sectors continue to tell us that it is about long-term vision that they are waiting for. Would you say that is yet another thing that food sector in overall is also watching out for?
Yes, and in India's context, that becomes a more complex challenge, because agriculture still is not a federal subject. Plus, over the years, we've seen fragmentation of land holdings, which has resulted in drop of yields, lowering less mechanization. If we have to get around that, then the laws have to enable aggregation. Now, right now, it actually disables that because of the effort to protect the small farmer. We're actually incentivizing them from being more willing to take credit, and that credit flow will only happen when the sector gets formalized. So what we would expect is, of course, alongside the reintroduction of input tax credit, some of the dismantling, and that was actually there in the bill that the government had once intended to bring in, which saw a lot of protests, but which was actually could have been quite beneficial for this country. I think something which enables consolidation of agriculture, higher investment and credit flow into the food service sector, which is the second biggest employer after real estate, can be a flip for domestic consumption, which can help us, therefore, to create wealth in the lower and the middle income segments rather than just at the top.
All right.
All right, take that point. Thanks a lot, sir, for joining in, and Manisha for taking us through with that conversation. There's the wish list for the agri sector in 2026. Before we take that short break, a couple of stocks which deserve mention. We have seen a big move in Cyient, even as the large cap IT stocks are seeing a sell-off. A large part of the mid cap IT also under a wee bit of pressure. We have Cyient, which is outperforming with a big gain of almost 6% on that counter, and volumes picking up on that as well. And alongside that, we are seeing, some of these names fairly well bid. Greenlam, for one, is also higher, alongside Globus Spirits, which is, higher ahead of its numbers tomorrow. The stock has done well, continues to be fairly well bid. Take a short break, come back. On the other side, Abhishek Pathak of Motilal Oswal Financial Services joins in to talk about his expectations from the IT sector ahead of the third quarter earnings. Welcome back. The top drag on the Nifty today is the IT space. And ahead of numbers, we've also had a brokerage downgrade coming in on HCL Tech. Let's focus on the sector ahead of the third quarter earnings as it rings in the earnings season once again. Motilal Oswal expects the demand environment to stay steady at best, marginally incremental. They say that mid-caps are expected to outperform once again, not very different from what we've seen in the market. The stock moves itself with a range of about 2.5 to 3.5% in growth. Abhishek Pathak, who's the research analyst at Motilal Oswal Financial Services, joins in with his view. Abhishek, while a lot of people are saying that IT's underperformance makes it an interesting pick right now, it's at that confluence of value yet underperformance and perhaps some bit of optimism after weakness that we saw last year. Do you believe anything in these numbers will cause that shift and accelerate it, or you believe that it will stay consistent and consolidatory in 2026 as well?
Yeah, hi. Thanks for having me. So I think we're actually in the camp that IT has actually bottomed out. Whether it's a short-term call or not, that's probably a debate. We do believe 3Q will be a bit of a non-event, considering it's a seasonally weak quarter for the sector, and we've generally had furloughs and impact of that weighing in on numbers. But that said, we do think that in 26, as AI services sort of revenues pick up, as attention shifts from AI capex to AI services, we do expect some of that benefit to trickle down to IT services as well. So yeah, that's the camp we are in.
Okay, so you said mostly IT has bottomed out. You're not sure whether it's a short-term call or a long-term call. But if it does happen, say after Q3, which is supposed to be a weak quarter, we do see recovery. Will it largely be led by large caps, or do you think mid caps will still continue to outperform? And what are some triggers that the market is watching out for post Q3, which would lead to that recovery?
Yeah, I think let me just clarify. What I meant was I'm not sure if the upgrade call works in the short term, but over a 2 to 3 year period, we are quite positive. So that's one. The second question around mid caps versus large caps. I mean, historically, in the last 5 years, mid caps have definitely had the upper hand. But considering the valuations at which the large caps trade right now, we do believe that there are pockets of opportunity to pick from in case demand turns around. And hence we largely sort of like mid caps, but we do believe that large caps selectively offer great value at these prices as well. On the question of around what happens post 3Q and sort of what to look for in terms of demand trends. So we think a leading indicator of IT recovery will be short cycle deals sort of coming back, and these short cycle deals will largely be AI implementation deals where the enterprises will move from pilots to serious implementation, and we think that will start happening maybe from mid CY26. So we are looking at sort of partnership agreements signed between, let's say, Anthropic, OpenAI, and the likes, and Indian IT services. So we're beginning to see that happen. We are seeing Anthropic sign agreements with Accenture, with Cognizant. If we see more of that in IT, we'll probably have a good indication of where things are headed.
Right. A lot on the street do believe that mid-cap IT is likely to do well. Apart from results, I wanted your thoughts on what you made of the Coforge deal, $2.5 billion acquisition that they've done from a PE firm. Some argue the valuations, but some also say that Coforge has been, known to turn some of these acquisitions around.
Yeah, no, I think this is the acquisition which has been done for its capability. So I think we're actually quite happy about what capabilities and what what verticals this allows Coforge to participate in. On the valuations front, it is slightly expensive as compared to what Coforge is generally bought. But if it is an AI native / digital engineering company, it's not a surprise that it's slightly expensive. So the asset is good. I guess the only concern from our end is the potential dilution that may happen, going forward in the next 1 year once the deal is integrated. So we like the asset. The dilution is the key concern for us.
Okay. That's about Coforge. When we are talking about some recovery or the triggers going forward across the board, be it large caps or mid caps, what's your sector view? Is there any specific segment which would do really well, something that would continue to disappoint?
Yeah, so I mean, logically speaking, companies which are application development heavy could face some troubles initially as clients move to productivity gains from application coding, right? So from that perspective, companies with higher infrastructure management services, or let's say higher data practices, etc., they might do better than the ones who are mainly application development heavy. But most large caps are fairly diversified, and I think it's a top-down call rather than a bottom-up call right now. I think the industry has been in the middle of a massive downturn for the past 3 years. And if things turn around, if clients actually move to spending on AI and on discretionary spends, I think the benefits should be well spread out.
Okay, and Abhishek, what would your top picks be in the IT space?
Right. So right now, we upgraded Infosys after almost a 7-8 month we're on the sidelines. So we like Infosys a lot right now. HCL remains our top pick because the portfolio is very well balanced. It's kind of an all-weather stock for us. And on the mid-cap side, we like Coforge a lot. We like the sales engine. We like the growth momentum. We like the valuations as well. So I think Coforge is probably a top pick there, followed by Emphasis, which I think has a lot of good deal wins in the bank right now. So the next 2-3 quarters for Emphasis, in my opinion, look very good. And the third pick in the mid-tier space would be Hexaware, which I think is probably primed for a turnaround if a couple of deals get signed and things improve from here on.
All right, and you don't think that HCL valuations are any concern? Because this morning itself there was a note that came in from an MNC broker. They've downgraded HCL and they believe that the valuation premium over TCS and Infosys at 5% is something that caused them to go ahead and downgrade the stock.
Yeah, I think it's an interesting debate. We've generally had so over the years we've generally had a bellwether, and we've had a lot of other companies follow, and we've notched down their valuations to bellwethers right in each business cycle. We are probably in a bit of a unique business cycle where we've got we don't really have a very clear and strong bellwether, which means that any company that manages to outperform their peers has a right to be valued at a premium, right? So I think margins for HCL are a concern, but if they maintain their growth momentum, if the next couple of years they can sort of maintain what they've been doing on top line, I think the valuation premiums can be justified. So in my opinion, the cycles are slightly different this time, and the right to win is not as obvious as it was maybe 10 years ago.
Interesting one, Abhishek. Thank you so much for joining in and giving us that perspective, because you believe that the multiples aren't sacrosanct anymore. They're basically growth-led, and the ones that outperform will perhaps get better multiples, and the ones they don't will get derated. Wish you good luck. We'll speak to you post the results season, during the results season as well, once those numbers do come by. We take a short break, come back, get you more on the stocks and markets on the other side. Welcome back. As we move towards the end of the show, just watch out for a few stocks. As the frontline indices are consolidating, there are more numbers of decliners than the advances. Cummins is a stock that is seeing some accelerated selling, so down about nearly 3%, and most of the cuts have come by in just the last half an hour or an hour or so. It was in the green for a large part of the day, thereafter saw an accelerated decline, currently at the low point of trade, and with more cuts and counting. So we'll monitor that stock. And the other couple of stocks that I'm looking at
are Sapphire and Devyani. Remember, on Thursday evening, day one of the new financial year or the new calendar year, there was a deal that was announced where Sapphire decided to, amalgamate with Devyani, and the ratio was largely at par. The deal, which was viewed as a positive for Devyani, is now seeing a bit of a decline for Sapphire because the street were expecting a bit of a premium. So on the day of the announcement, the stock was 267. Now Sapphire down to 236. We take your leave on halftime report. With that, Business Lunch takes all the market action ahead. Stay tuned.
Markets are flat as we start the first full trading week of 2026. Defense, real estate and PSU banks are stronger. The IT index, though, is the top loser, down over 1.5%.
Venezuelan President Nicolas Maduro is slated to appear in Manhattan federal court Monday. The ousted Venezuelan leader, brought to New York with his wife after their capture by American forces in a dramatic military operation on Saturday, faces charges related to cocaine trafficking. He is being held in a Brooklyn jail.
Bandhan Bank shares have gained as they recorded a double-digit loan growth in the third quarter. The CSB Bank stock has hit a record high as advances rise led by gold loans, while RBL Bank is under pressure after its third quarter update.
In corporate conversations, the management of Bajaj Auto tells CNBC TV 18 that they have seen a healthy recovery in most export markets. HPCL management says that the upgradation at its Vizag refinery and the commissioning of its refinery in Barmer provide strong earnings outlook.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios at the start of this first full week of 2026. I am Hormuz Fatakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Good afternoon, Hormaz. Hi, guys. I mean, what a way to start the week, right? We hit record highs, but coming off those highs and we're absolutely flat now, but the broader market's faring slightly better.
The broader markets are doing well for themselves, and the coming off the highs also because of the fact that the biggest constituents of the index are not supporting the Nifty up move as of now. The recovery is also because of the fact that the IT stocks are slightly off the lows of the day. But if you take a look at the contribution chart, you will find that HDFC Bank is at the top of that pile. So 41 points coming from HDFC Bank, and Reliance Industries, which had earlier hit a record high in the morning session, has now moved into the Lagards. So that has come off significantly from the highs of the day. And so if now your two biggest index constituents are in the red, the upside definitely remains capped because HDFC Bank and Reliance both are moving on the downside. And of course, that contribution coming in from the IT names as well ahead of the result season. And of course, there are a slew of banking updates, slew of earnings updates that have come in as well from the banking sector, from the retail sector. There's a lot of stock-specific activity in the broader markets.
Absolutely. And let's take a look at some of those sectors that are doing well today, right? Realty names are doing really well in trade. Soba is up nearly 5% after a good business update. Other realty names like Lodha and Godrej also doing well, gaining over 1%. Most banking names, as Hormaz pointed out, were also gaining in trade after most of the business updates coming in strong. PSU banks like SBI, Bank of Baroda and PNB, all of them higher in trade. We've got those defense names in the green amidst all the geopolitical tensions. Hindustan Aeronautics up nearly 3%. And then we've got Bharat Dynamics also higher in trade. On the downside, we've got those IT names after brokerages downgraded some of those stocks. Infosys, HCL Tech, Wipro, all of them lower between 1% and 3%. ONGC and Oil India also losing in trade as oil prices fall on US strikes on Venezuela. And that's the big story in focus today, right? In a surprise move over the weekend, the United States attacked Venezuela and captured the long-serving president, Nicolas Maduro, and his wife. US President Donald Trump has promised to put the country under American control for now and will tap into its oil reserves, even as Venezuelan officials vowed defiance. Let's hear out his initial comments following the capture.
The United States Armed Forces conducted an extraordinary military operation in the capital of Venezuela. Overwhelming American military power, air, land, and sea, was used to launch a spectacular assault. And it was an assault like people have not seen since World War II. All Venezuelan military capacities were rendered powerless as the men and women of our military, working with U.S. law enforcement, successfully captured Maduro in the dead of night. We're going to run the country until such time as we can do a safe, proper, and judicious transition.
Now, Maduro and First Lady Celia Flores are charged with narco-terrorism conspiracy, cocaine importation conspiracy, and weapons offenses. The Venezuelan leader is scheduled to make his first court appearance in New York City later this evening. Take a look at this detailed report.
Venezuela's toppled leader, Nicolas Maduro, was in a New York detention center on Sunday, awaiting drug charges. That's after President Donald Trump ordered an audacious raid to capture him, saying the U.S. would take control of the oil-producing nation. The image of the 63-year-old Maduro blindfolded and handcuffed en route to the U.S. has stunned Venezuelans. It was Washington's most controversial intervention in Latin America since the invasion of Panama 37 years ago. Maduro is due to appear in a Manhattan court on Monday.
Good night. Happy New Year.
While many Western nations oppose Maduro and say he stole the 2024 election, there were many calls for the U.S. to respect international law and resolve the crisis diplomatically. There were also questions over the legality of seizing a foreign head of state. Democrats say they were misled at recent Congress briefings and demanded a plan for what is to follow. At home, Maduro allies were still in charge and have denounced what they call kidnapping as part of an imperialist oil grab. The UN Security Council plans to meet on Monday to discuss the U.S. move, which Secretary General Antonio Guterres described as a dangerous precedent. Russia and China, both major backers of Venezuela, criticized the U.S. Pope Leo said he was following events with a soul full of concern and called for Venezuela to stay independent and respectful of rights.
In Venezuela.
Well, you know, it won't cost us anything.
Trump said the U.S. would, for now, manage the South American nation, plus its oil reserves. It is unclear just how Trump plans to oversee Venezuela. Trump's focus on foreign affairs fuels Democrats' criticism and also runs the risk of alienating some supporters who have backed his America First agenda and oppose foreign interventions.
Let's also hear out what U.S. Secretary of State Marco Rubio said defending the recent U.S. operation in Venezuela that led to the arrest of the country's longtime leader, Nicolas Maduro, saying congressional authorization was not required. Take a look.
This was not an invasion. We didn't occupy a country. This was an arrest operation. This was a law enforcement operation. He was arrested on the ground in Venezuela by FBI agents, read his rights, and removed from the country. I encourage everyone, I know it's Sunday, people are busy, but the indictments have now been unsealed. People should read this indictment. They should read this indictment. They should read what this man did for the last 15 years of his life against the United States, him and his wife. He was arrested. Obviously, this was not a friendly territory. So in order to arrest him, we had to ask the Department of War to become involved in this operation. The Department of War went in, they hit anything that was a threat to the agents that were going in to arrest him, and they hit anything that was a threat on the way out.
Now, in a separate development, Donald Trump, replying to a question on India and its purchases of Russian oil, had this to say.
If you're buying cheap Russian oil, keeping Putin's war machine going, we're trying to get the president the ability to make that a hard choice by tariffs. I really do believe that what he did with India is the chief reason India is now buying substantially less Russian oil. So I hope we pass this bill soon. And after this...
They wanted to make me happy, basically. He wanted it. Modi's a very good guy.
Yes.
He's a good guy. He knew I was not happy, and it was important to make me happy. They do trade. And we could raise tariffs on them very quickly, and it would be
people are
very
afraid of that.
On that note, it's time for us to head into a short break. But what lies ahead for the Indian market in 2026 and which factors will play the most important role? The results of the CNBC TV 18 market poll coming up on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Mangalam Malu is here to decode what lies ahead for the Indian market in 2026 and which factors will play the most important role. The results of the CNBC TV 18 market poll. Mangalam?
Well, you know, as we do at the start of every year, we poll a bunch of experts, the market makers, the decision makers, and all of them on what their outlook for 2026 is. And this time as well, we reached out to 50 experts across funds, brokerages, financial institutions, and this is what the street is really looking at. Last year was a 10% return for the frontline index. Dollar adjusted, it was mid-single digits and a serious underperformance as compared to the world. So we started with what the street is expecting in 2026 for Nifty returns. About 55% said 10 to 20%. About a third of them said 0 to 10%. And very few expect a negative return. So the street is expecting some optimism, but expectations are fairly grounded. The second part, where should investors be positioned? Should it be large caps, mid caps, small caps, or micro caps? Remember, last year, mid caps and small caps were serious underperformers. But this time, preference for large caps is fairly high. 41% of experts say large caps still offer the best risk reward. This despite the sharp underperformance that we saw in mid and small cap indices in 2025. More than that, you know, the street, while it is positive on mid and small cap, as we move lower down the market cap, we see the enthusiasm clearly tapering off with literally no one vote coming in for micro caps. If you look at the sectors as well, you know, financials have been the favorite for all the market experts we speak to on the channel, while some also speaking about tech and pharma as contra bets. But this time around, if you look at the results of the survey, nearly half of them are still pinning their hopes on the financial space, with metals and other sectors also finding some favor. Tech and pharma still, however, remain selective bets rather than broad consensus calls. What could be the driver of the market in 2026? Will it be geopolitical, India-US trade deal, earnings, or others? Well, while everyone talks about India-US trade deal as of now, earnings, that's something that will be the biggest driver of the market. Nearly two-thirds of the experts say earnings will be the single biggest determinant for markets next year. Trade deals and geopolitics, yes, they do matter, but fundamentals back at the center of the story. And speaking about trade deals, on the US-India trade deal, the start of last year, everyone was fairly optimistic. That didn't happen. This time around as well, you know, people are fairly optimistic. Nearly two-thirds or three-fourths of them believe that the deal will happen in the next 3 months itself, with some expecting within 6 months. In fact, no one thinks it is not likely this year. So that's the one thing that we have to monitor in 2026. What about commodities? Last year was big for both gold and silver. The street believes that that outperformance may perhaps not continue. They're betting on what? Copper and aluminum. Copper and aluminum, nearly 68% outperformance, 18 and 13% for gold and silver. This is a clear reflection of infrastructure, manufacturing, energy, transition themes that are taking place. What are the risks now? These are qualitative questions that we ask them, and the most used or frequently used words that came in terms of biggest risk to equities next year: geopolitical developments, the US markets, concerns around AI. Will that bubble or trade unravel? And Donald Trump's policies. That is something you can never take off the table. And clearly, the biggest swing factor when it comes to budgets, that's the one thing that we ask at the start of every year. What are the things that they will be watching out for in terms of announcement coming in? And here too, the market wants a couple of things. They don't want much tinkering with capital gains taxes. That's exactly what they're expecting. A fiscal stimulus coming in to boost consumption, higher government spending, and no removal or changes in STT, STCG, or LTCG. So those are a bunch of important, insightful data, opinions, and expert calls coming in for 2026. The big outlook, the CNBC TV 18 poll, it looks like a year of steady earnings-led returns, less noise, more numbers, and a market that rewards patience over excitement.
Patience over excitement should be the motto of 2026. Well, Mangalam, thank you for summarizing that for us. Let's pull up HDFC Bank. That is down to the lowest point of the day now. and continues to contribute significantly to the Nifty downside. The index now trading around 30 points lower, and HDFC Bank at the lowest point of the day. Speaking of HDFC Bank, along with that, a lot of other financial names are also reacting to their business updates. Gaurav is joining in with more details on this. Gaurav.
Well, first let's talk about Bajaj Finance. If you look at the numbers, those were actually in line with the management guidance. Now, AUM grew almost by 22%, and management also had guided AUM growth target for 22 to 23% in this year. Remember, they had actually cut down this growth target last quarter, and they are actually in line with the new growth target. When it comes to customer franchise, that improved almost by 19%, and new loan addition, now that grew almost by 15% on a year-on-year basis. Although this number looks a bit low, but remember, last year in the same quarter, the base was high, and that is the reason why this 15% number looks lower and lowest since fourth quarter of FY24. But apart from that, what is hurting the stock right now is that given that the number, the AUM growth has come to 22%, which is the lower end of the guidance, it seems that the market is not taking it in a positive way, specifically given that the valuation for Bajaj Finance is already higher than its peers. It's trading at 4.5 times price to book on FY27 earning. Apart from that, if you look at AU Small Finance Bank, this bank actually reported good set of number, and as a result, if you look at stock performance also, it is up. Advances that increase almost by 24%, which also results into 6% growth on a sequential basis, and deposits, they also grew almost more than 23% on a year-on-year basis. Lastly, let's also focus on RBL Bank. If you look at this bank specifically, they actually reported 13% growth on a year-on-year basis, and remember, this is the first time when they are actually reporting something about numbers post the announcement of Emirates and BD deal. But given that this growth was specifically driven by the secured book, and unsecured book degrew almost by 6%, the number looks lower. This is actually in line with what the management had guided ever since they have been slowing down their deposit, they're slowing down their unsecured book. But apart from that, this is something which is seen as some negative, because Street is now expecting more than 20% growth for FY27, and in the third quarter, if the bank is reporting 13% growth, it is something a bit of a concern, and that is the reason why we are seeing some pressure in RBL Bank today.
All right, Gaurav, many thanks for those details. But before we head into a short break, a quick note for our viewers. Get ready for CNBC TV 18's all-new lineup starting today. Incisive analysis, sharp commentary with CNBC TV 18's brand new offerings. Watch our new segment, Cut the Balance Sheet, with Mangalam and Sonal Bhutra. Watch Macro Signal with Ritu Singh, that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV 18's most trusted in-house technical experts. On that note, it's time for us to head into a short break. More news and updates on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. Still 20 points lower on the index, but a lot of buzzing names in the broader markets. PG Electroplast is one such name. The stock is now up, 5%? Yes, it's now about 650 rupees is where PG Electroplast currently lies. Now, getting you the unit economics of quick commerce companies, Mangalam is here with a breakdown on how gig worker payouts and order values affect the financials of these companies. Mangalam, over to you.
Well, quick commerce has become one of the most disruptive changes in India's consumption story. And at the heart of it is the gig worker, visible, omnipresent, and now the center of a national debate. Demands for higher payouts by delivery partners have been met with pushback from quick commerce companies. So to understand this ecosystem and how it really works, I dug into publicly available data and spoke to friends, sources who want to remain anonymous across Blinkit, Zepto, Instamart, Big Basket, along with delivery partners who came to my house themselves. So just to understand, when you place an order, what does the platform get? Where do they spend? What gig workers get? And also a stress test on the model. Now, this is not about getting to the last decimal. The idea is here to understand approximately the anatomy of the business. I've approximated my thesis based the actual average order values by Blinkit and Instamart in their last quarter. So that's what the numbers suggested. In the second quarter for Blinkit, the average order value was closer to 700, as was for Instamart, and contribution margins at 3.7% positive for Blinkit. Instamart was minus 2.6. So how does the quick commerce business work? I've taken my average order value at around 600 rupees. When that happens, platforms make money three ways. First is a gross margin or take rate, depending on whether you're an inventory model or a marketplace model, which is about 15%. So on a 600 order value, it comes up to 90 rupees. The second part is brand commissions and advertising fees that account for about 3 to 4%. 3% is what I've taken here at 18 rupees. And then there are delivery and other handling charges, which is about 2 to 3%. These are increasingly waived to push higher order values, but put together on a 600 rupee average order value, the revenue that a platform makes is about 120 rupees. Remember that number. Now, look at the cost. The biggest expense is the payout to the rider, which is roughly 50 rupees per order. And then you have dark store operations like picking, packing, logistics. That costs about 42 rupees or 7% of the take rate. And thereafter, you have dark store rent, which is about 4%, and shrinkage as well, which is about 1%. All in all, total expenses put together is roughly 132 rupees. Remember the number of 120? Now add 132 to that. So on a 600 crore average, 600 rupee average order, the revenue is 120 rupees, fulfillment cost is 132 rupees, implying a contribution loss or contribution loss margin of 2%. This explains why average order value is everything in this business. At about 752 rupees, this is the model that finally breaks even. And above that, we have contribution margins which are positive. Now, let's go across to the gig worker. A quick commerce delivery partner typically earns about 40 to 50 rupees per order. Food delivery pays about 50 to 70 rupees per order, but covers longer distances. So to that extent, what really matters is the earnings per hour. Now, if you take out, the costs that they have on fuel, etc., about 20%, and, look at what the average work month of a delivery personnel looks like, the average monthly income is close to around 16,000 to about 31,000 rupees. After fuel maintenance, the net earnings that they do per hour is roughly 70 to 120 rupees. That translates to about 16,000 to 31,000 rupees a month. For many workers, this is flexible work with earnings that are often better than available alternatives. So what makes or break this model? The biggest revenue drivers obviously are average order values and gross margins or take rate. The biggest drags are rider payouts and dark store inefficiencies. Free deliveries and aggressive discounting also matter because they directly hit contribution margins. And here's the actual pressure point: delivery prices. The business model is extremely sensitive to rider payouts. As you look at it, at current cost, the system just about works at around 700 rupees. These are lower average order values. But if you move on to the next plate, you will see that, at current costs, it just about works. But if you increase the, delivery payout from 50 rupees to 60 rupees, the average order value break-even moves from 700 rupees to 800 rupees. And if you hike it by another 10 rupees, take it to 70 rupees, then the break-even moves all the way up to 1,000 rupees. And that is why this debate matters, because gig workers aren't just a cost line. Their earnings per hour determine efficiency, engagement, long-term sustainability. So the next time you place a quick commerce order, think about your basket size, the cost of fulfillment, and maybe ask your delivery partner how their day is going. Well, that in many ways, is the anatomy of quick commerce.
There's a lot that we need to know from this. Mangalam, thank you for summarizing all of that for us. Take your leave on this edition of Business Lunch. From me and the team, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Hormuz Fatakia. Hormuz, good afternoon. We've been talking about markets being quite range-bound today, consolidating at record highs, but there's been a dip from the highs of the day. Not a major one, but yes, Nifty is seeing a cut of around 50 points. We are off around 80 points from the highs of the day. Mid-caps participating as well, and banks, which were actually in the green because of the contribution coming in from PSU banks, have also turned red.
Good afternoon to you, Sonal, as well. And the index heavyweights, we were just talking about this a few minutes ago, and when they are not supportive, that's what has happened. Reliance turning towards the red, HDFC Bank at the lowest point of the day. We talk about all of that as the day goes by, but here are the headlines at 1:30 this afternoon. The markets are flat as we start the first full trading week of 2026. Defense, real estate and PSU banks are among the gainers. The IT index, though, continues to remain the top loser.
RBL Bank is under pressure after reporting its third quarter update, while AU Small Finance Bank surges in trade on the back of healthy growth in advances. Dhanlakshmi Bank rallies after a strong Q3 business update.
Realty developer Sobha has surged in today's trade on the back of its strong business update for the third quarter. The company's pre-sales grew 12% from last year. Realizations were also up 13% during this period.
Tourism Finance Corp shares locked in 20% upper circuit after a 20% fall in the previous session. The promoter, Ekta Halwasia, bought 3.7 lakh shares at 55.14 rupees per share in the open market on Friday. Okay, all right, those are the top headlines that we are tracking today. Of course, as Hormus pointed out, heavyweights are not participating, and that's why that fall from the highs, that is something that we are tracking very closely, whether this accelerates or we do see some buying on the dips or we consolidate at these levels. It's been very tricky, but yes, we are trading with full volume since the first trading week, full week for the new year, and we do have earnings to track closer to the budget. So a lot of cues we'll be watching out for, but yes, the market breadth in terms of what's happening with the mid-cap space and small-cap index. We track that on the show. That continues to be on our radar.
We've been telling about the fact that the real test for the market will begin only today onwards, when the fact that when you're moving to full volumes after returning from holidays. But of course, the first IPO of 2026 is here. Bharat Coking Coal, a wholly owned subsidiary, they announced a price band earlier in the day. And of course, we'll talk more about that from our management when we hear from them. But before that, let's hop over to Sudarshan, who's here to tell us about the movers in the broader markets in today's trade. Sudarshan.
So while market is consolidating in a range after Nifty hitting the record high in the opening trade, some of the stocks are buzzing in the trade, especially after those companies have reported quarterly updates. So first on the list is Union Bank, high in the trade, up almost 3%, while YY, if you take a look, the growth is lower than expectations. But if you take a look at on a sequential basis, growth is as per company's expectations. Loan growth is up almost 4 to 5%. That's the reason this stock is higher. RBL Bank is down. Now, like Union Bank has reported a growth on a sequential basis, while if you take a look in the RBL Bank on a sequential basis, growth is lower than the expectations. That's the reason the stock is under pressure. Avenue Supermarts has given Q3 revenue growth. It's just 13% versus expectations of around in the range of 15 to 16%. That's the reason this stock has fallen. UCO Bank and IDBI Bank are under pressure after quarterly updates are largely slightly below expectation. That's the reason these stocks are under pressure. After the news related to Venezuela, all the defense stocks are buzzing in the trade. You can take those Solar Industries, Bharat Dynamics, HCL, Data Patterns. All these stocks are higher, but upstream oil companies have fallen on an expectations of crude prices to move lower going forward. That's the reason you are seeing Oil India currently trading with a cut of more than 2%. All these AC names are today higher in the trade on an expectation of improvement in the demand. That's the reason PG Electroplast up more than 4%. 1 point was up almost 6%. Voltas, Blue Star, Compton, Amber Enterprises, all these stocks are trading with a gain somewhere in the range of 2 to 4%. Some of the other stocks which are in the focus, Premium Energies and Wari Energies, recently added stocks in the F&O segment. Today, these stocks, both these names, are seeing selling pressure. Those stocks are down somewhere in the range of 4 to 6%. And Cupid today saw change of hands via block list of more than 1% equity. Stock is down more than 13%. Key Industries has been in the focus for the last few days. Today also, this stock is under pressure.
Okay, all right. Continues to be on our radar. Thank you so much, Sudarshan, for joining us with all those details. Those are some mid-cap movers, but a lot of action in the primary space. Bharat Coking Coal Limited, or BCCL, a wholly owned subsidiary of Coal India, is set to launch the first main board initial public offering of 2026 with a price band of 21 to 23 rupees per equity share. Reema caught up with the management of the company. Listen into a slice of that conversation.
We are now producing 40.5 million ton of coking coal, and our plan rest 5. First of all, you should know that BCCL is the largest producer of coking coal limited, that produces around 58.5% of the total India coking coal production, and we have a huge reserve around 8 billion ton. Means our reserve will go up to the more than 100 years. In that way, there is no any shortage of reserve, and our plan is year to year. And now we are doing 46, target is 46, and up to 29-30, it will produce around 54 million ton of coking coal. And we are having washeries, and we wash coal, and that is the main raw material for the steel. Now we are giving, as a BCCL, around 1.7 million ton clean coal, and in the years to come, our washing capacity will be up to the 27 million ton. Now it is 13.65 million ton washing capacity of our 5 washeries, 3 washability come. In the totality, our coking coal production and washability capacity will increase. And one thing interesting in our company is this, that demand of coking coal will never come down.
Okay. Mr. Singh, Sanjay, if you could explain what led to the revenue decline. In the first half of this year, your revenues have fallen by close to about 17% and even the growth from FY23 to FY25 has been fairly modest. So what explains this slowdown? What is the growth projection?
So see, it's a one-time phenomena. We had a very huge rainfall last year. With a total rainfall was around 2200 millimeter against a normal rainfall of 1200 millimeter. So it's badly impacted our open cast operation. At the same time, you see our pricing is also linked with the imported coking coal prices. So market is subdued in imported coking coal. That also leads to a less realization.
Yeah.
So our pricing is also linked with the imported pricing. So BCCL supplies coking coal to steel sector. It's another PSU sale at a MOU price of 62.5% of FOB Australia pricing.
Now, India's coking coal production target is 140 million tons by FY30. This is a part of, developing self-resilience and reducing the dependence on imports. Now, you're saying your contribution will be 54 million tons.
Yeah.
Which means your market share, which was 58% as of last year, comes down to 54 divided by 140, which is about 38%. So, and where will the balance come from? And is that not a concern? Is it not possible for you to up the production?
We will naturally upgrade it. The contribution is from the CCL, our another subsidiary, and some private players, Tata. And in the totality, we will go for 140 million ton of coal. Our share will be 54 million ton, but we will try to increase it. And there is total scope to improve it.
Got it. So when you get to 54 million tons, is there any estimate of the kind of revenues you will enjoy? Last year, you were at 13,800.
By 29-30, when we are expecting a production of 54 million ton, my revenue will be close to 20,000 crore rupees.
Okay, got that. And margins also have been very volatile. It's all linked to the top line?
So margin is little volatile, not very volatile. We are right now at the bottom of the curve. So in future, it always go upwards. So right now market is subdued. At the same time, offtake is less. So we hope a better future.
Mr. Mukesh, Coal India will be selling 10%, getting about 1,071 crore. So that is a windfall for Coal India. I know you all have always been paying dividend, but would you all look at a special dividend?
Madam, the dividend we are paying at a very good rate. And in the addition, this 1,000 rupees is not a big amount. We are going for a diversification of around 1 lakh crore rupees capex program is there in the next 5 years. This money will be utilized mostly in the diversification program.
Okay. And you all are selling 10%. You all have a mandate to go up to 25, to go and sell up to 25%, which means there's still balance 15% stake that you all can monetize. Yeah. What is the plan with respect to that?
But we had not formed up any timeline for this dilution of the balance 15%. We had come up with the 10% after testing the market and the other condition we will come for the balance 15%.
And with respect to the end-use revenues, now your RHP itself says that one of the challenges is that the quality of coking coal produced by BCCL is slightly inferior to what we import from Australia. And therefore, the amount that you supply to the steel industry is less compared to the power industry, and steel has higher margins. Is that going to change by FY30?
Actually, the coal, you have to understand the formation of the coal. We have in India, having coal, coking coal, prime coking coal, medium coking coal, we are having around 39 to 40% ash content. And in Australia, they are having 8 to 9% ash content. And after washability, we come to the 19 to 20% as percentage of the washed coal. And after mixing imported 8 to 9% of the Australian coal with our 18 to 9% actual requirement of the steel is around 12 to 13% as content coking coal. So the formation is like that. This formation, years to years coal, we can't change that formation.
Rima rightly said the realization fetch from the steel industry is much better than the power. So you see, if you see our growth story now onwards, we are growing from 40 to 50, 54, 55. So this 15 million ton is focused towards steel itself. Right now we have supplied close to 1.7, 1.8 million ton of vast coking coal. As per our plan, we are going to 9 to 10 million ton. So almost six-fold increase in the supply to steel sector. So our revenue, net realization balance will be moved towards the steel instead of power. We are keeping power at current level itself.
The management of Bharat Coking Coal IPO opening for subscription later this week. It's a quick note for our viewers. And get ready for CNBC TV 18's all-new lineup starting today. Incisive analysis, sharp commentary with CNBC TV 18's brand new offerings. Watch our new segment, Cut the Balance Sheet with Mangalam and Sonal Bhutra. Watch Macro Signals with Ritu Singh that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV 18's most trusted in-house technical experts. Take a short break. Back on the other side.
And finally, the broader markets have started showing some good momentum during the last week. So the support base is shifting higher. 26,000 now becomes a very good support immediately. And 26,200 to 26,150 range, if we get on the index, then that would provide a good risk-reward ratio. So we would advise to go long on index on dips in the range of 26,200 to 250. These are spot levels, keeping a stop loss below 26,000. And in the next leg of a move, we expect targets around 26,450, 500 on the Nifty. Well, a couple of stock recommendations to ride this uptrend, especially in the broader markets, which we have seen. Marico is one stock where we recommend to go long on. The stock has given a breakout of its previous swing highs as well, that too with good volumes. So keeping a stop below 750, short-term traders can go long on Marico for potential up move towards 820. And Minda is one stock which technically looks quite positive. Now, post this recent run-up move in auto stocks, we believe that also auto ancillary would be one segment which should be focused for the short term. So Minda, technically it's looking quite strong. A breakout from a symmetrical triangle pattern has been there. So with stop loss below 1300, one can go long for potential targets of 1420.
Okay, all right. Thank you so much, Rajat, for joining in. So those are some technical trades and market outlook in terms of levels. For now, we'll slip into a break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.
Thank you.
Welcome back. Keep an eye out on the market. There's further pressure that has come by. The Nifty is at the day's low, down 70 points as we speak, and a whole host of stocks which have come off from the highs of the day as well. We have Bajaj Finance, which is at the day's low, HDFC Bank, the big boy, Reliance Industries. Some of these big names are leading to the losses that we're seeing from the highs of the day as well. Bank Nifty is struggling further, so a 220-point cut on Bank Nifty as we speak. SBI too is contributing to the losses. It has come off sharply from the highs of the day. We do have Dr. Reddy's, Bajaj Auto, Kotak Mahindra Bank is the other big name, which is leading to the losses that we are seeing from the highs on the Nifty currently. Even the Midcap index, which was down 0.1% when we started the show, is now down almost 0.3%, and the advanced decline ratio that also is worsening in favor of the declines as we speak. So watch out for that. And of course, quarterly updates, we are tracking that, and Sobha is one of them. The Nifty Realty Index is doing well today, and that is on the back of a lot of updates. Of course, the biggest one is coming from Sobha, the only one actually, where they reported decent growth this time. There's an 18% growth if we talk about Sobha's share in pre-sales, while the pre-sales overall are up 12% on a YY basis. For Sobha, it has come in at 1,818 crore rupees. Volumes are flat at 1.3 million square feet, but realizations, they have gone higher by 13%. Looks like a lot of it has come in because of pricing growth and more sales from high-ticket items or luxury segment. Bengaluru continues to be the biggest market, more than 70% sales there, which has grown 51%. NCR has contributed around 350 crore rupees, and Kerala contributed around 150 crore rupees, which is a growth of 18% on a YY basis. So across the board, they've seen some growth, and the management commentary is quite positive too.
And that shows up in the price as well. A strong management commentary, 4.5% higher for Sobha. So bucking the trend in what is otherwise turning to be a bit of a wobbly market now as we speak. But on the flip side, there were two other business updates from the financial space that came out. Actually, not necessarily on the flip side, because CSB Bank is at record high levels as well. And the other one, of course, being Dhanlakshmi Bank. Both of them are doing well on the back of their business update. Gaurav is here to tell us more on that. Gaurav.
Well, yes, in the quarter gone by, if you look at the gold financiers, we always spoke about Muthoot Finance, Manappuram Finance and all the NBFC players. But let's not forget about the banks who are also in the gold finance business, because they have been reporting very strong set of numbers. So first, let's talk about CSB Bank. Total loan book that increased almost by 29% on a year-on-year basis. And the main reason, if you look at their gold portfolio, that has increased almost by 46% on a year-on-year basis. This along with that, if you look at deposit growth, that also came in healthy at around 21% for the bank. And that is the reason why, if you look at the overall stock performance, it is also up in trade. Remember, they have also been talking about the CASA ratio, and if you look at the CASA growth, that remained a bit muted, but that is not something that the market is focusing on. Apart from that, let's also talk about Dhanlakshmi Bank. If you look at the loan book size, it is not that big, but they have reported loan book growth of around 24% on a year-on-year basis. And here as well, we saw gold portfolio actually shining, because that increased almost by 50% on a year-on-year basis. Now, this also translates into 20% growth on a sequential basis for the bank, specifically in terms of gold loans. And as a result, if you look at stock performance of Dhanlakshmi Bank as well as CSB Bank also, both the stocks are up more than 5% in trade today.
Okay, some interesting updates there. Thank you so much, Gaurav. Been a very, very busy day for you. But Hormans, we've been tracking stocks while some like TFCI have been logged in upper circuit. Look at the fall that we're seeing in the Nifty currently.
Indeed, and now 70 points lower on the index. Now we're heading towards that 26,250 mark as we speak, as we go down to the final 90 minutes of the trading session. TFCI recovered everything that it lost on Friday. Can't say the same for Cupid. It has had a very, very volatile trading session. It opened around 19% lower, then recovered a bit from the lows of the day. And again, that recovery is getting sold into. So another 14% down on Cupid in today's trading session. Remember, the stock was up well over 500% in 2025. Take your leave on this edition of Midcap Radar. From Sonal and me, thank you for watching. Finding Alpha with Nigel on the other side when we return.
Cool.
Well, hello and welcome to Finding Alpha. I'm Nigel D'Souza, joining in from the Mumbai News Center. Well, with Budget 2025 putting more money in the consumer's hands, GST becoming leaner, and travel demand accelerating post-COVID, discretionary spends appear to be on the rise. Well, planning a holiday is just one thing, but playing the travel theme in markets is another. To help us out, break it down, we have Shobhit Singhal, research analyst at Anand Rathi Institutional Equities, who joins us on the show. Hi, Shobhit. Thanks a lot for coming down to the studio, and good to have you in Finding Alpha.
It's been a pleasure, Nigel, doing this show with you.
All right. Well, let's get straight then to the point. Let's get a couple of data points out of the way. India is expected to grow by what? 7 to around 8% approximately. Could you tell us what is travel demand expected to grow at? You know, there is a ratio that we look at with regard to travel demand in comparison to GDP growth. And also, what are the risks to this entire travel theme that everyone is so excited about?
So as you rightly said, so travel demand is directly related with the GDP growth. If India GDP growth is will continue to grow at around 6 to 8%, historically we have seen the trend that travel demand grows at around 1.5 to 1.8x of GDP growth, which is around 10 to 12%.
Okay.
Right? Now with the government initiative like GST rate cut and income tax bracket increase, and recently 8th pay commission. So we believe that discretionary spends in the hands of people will increase.
Okay.
And as per our calculation, around 1 lakh crore savings will be in the hands of people, and some part of it will be spent in the travel and tourism, right? And also, government is now aggressively promoting tourism, be it spiritual tourism like Ayodhya or Varanasi, island tourism like Lakshadweep, Andaman Nicobar, the winter tourism in north, and also infrastructure spending has increased, right? So just to give you an example, pre-COVID in 2019, we just had around 90 airports.
Okay.
And currently we have around 160 to 165 airports, new airports, right? And it has directly been in tier 2, tier 3, they have the new airports have been increased, right?
Okay.
And better infrastructure, better roads, and now with the new trains like Vande Bharat. And so we believe that combining all these factors, we believe that travel or tourism theme will continue to do good going forward as well.
Okay, all right. So you're saying broadly, if I look at a ratio, it should be 1.6, 1.7 times what the GDP growth is. That should be the rough estimate.
Yes.
And just that point with regard to the number of airports, what was it pre-COVID?
It was around 90.
And now it is at?
Around 160 to 165.
All right. So that's what's helping you get into the interiors as well of India.
Yeah.
What are the risks to these estimates though?
So
one-off thing with like COVID or something like that?
Yeah, so for travel, external factors plays a very key risk, right? So geopolitical tension globally, we are seeing the war-like situations.
Yeah.
Pandemic, COVID, we have seen.
Yeah.
Other than that, we don't see any problem.
Okay, all right. You know, Shobhit, I've been traveling more as well in the last few years, and I'm sure you as well have been traveling more. But that discussion for another day. Let's focus on a couple of themes then. IndiGlo Aviation, you know, that's the market leader. The flight, though, ran into some rough weather of late. What's your take on it? You know, better times ahead, or do you believe, you know, the flight has just landed, temporary stop, and it'll take off yet again? What's your view on the stock? Plenty of chatter in the last month or so when they ran into trouble. Do you think it's a buying opportunity? If yes, why?
Okay. So IndiGo is a market leader with around 63 to 65% market share.
Okay.
Okay. And this market share they have gained organically. So post-COVID, we have seen two airlines have been shut, right?
Correct.
Go Air and Jet. And we have seen some operational challenges in other airlines due to supply issue from Boeing,
Correct.
right? So they have organically gained market share from 40% to now 60%. And also, IndiGo has strategically placed their order with Airbus since 2015.
Okay.
So currently, the order book size is around 900. Okay. So which will, and if you compare this with the other competitors like Air India, so they have order book size of around 500.
Okay.
And SpiceJet and Akasa, they have around 150 to 200.
Okay.
So we believe that IndiGo will continue to get one plane per week. till 2035.
All right. So when you talk about 900 order book, that is 900 aircrafts in the pipeline.
All right.
And that's how you're saying that every week we'll see one aircraft that will be coming out of their stable, for the next few years. Is that correct?
Yes.
All right. Tell us a little bit more about this, because I recall that Interglobe or Indigo was always the market leader domestically. But globally, I think Air India was still ahead. However, that has changed, right? So give us a few details on that front.
So recently, they have marginally went ahead as compared to Air India, and they have become the market leader with around 21.9% kind of market share in the international segment as well, as compared to Air India, which is around 21.5%.
Okay.
Largely because so Indigo has placed 321 XLRI and 350 wide body as well.
Okay.
So now you can go directly from India, from like Delhi or from Mumbai to directly to London, Athens, etc.
Okay, all right. So it's a leader both on the domestic aviation front as well as the international front as well. Got that. If you could tell me roughly two more questions with regard to Interglobe. It's a lean machine. Of late, it's been a mean one, but it's a lean machine. Could you tell us how does Interglobe's margins compare? See if I'm comparing it with global peers, point number one. And since you spoke about international travel, could you tell me as a percentage of their mix, how much comes in from international revenue?
So international, as of now, contributes around 23 to 25% of their revenue.
Okay.
And in terms of capacity, it is around 30% currently, which they envisage to increase it to around 40% by 2030.
Okay, all right. And margins?
And in terms of margins, so they are doing around 23-24% kind of EBITDA margins, which is highest in the globally. So if you see globally, global average EBITDA margin is around 16 to 17%.
Okay, all right. So you put your case out there. Interglobe is something that you like from here on. Let's move on to hotels then. Occupancies and ARs, well, they have been increasing. Though one would have expected one to cool off as well, in terms of one of the two, either ARRs or maybe the occupancy. In this sort of a backdrop, which stock should one check into?
So, post-COVID, we have seen in hotels, it's a prolonged upcycle. So last upcycle, we have seen in 2004 to 2008 cycle, right? And largely due to the demand-supply mismatch. So demand is growing at around 10 to 12%, whereas supply post-COVID is growing at around 4 to 5% just.
So there's a demand-supply gap in the industry on the whole?
Industry as a whole.
Okay.
Right. And the top 10 metro cities, which contributes around 70% to the...
Sort of a backdrop then, what do you like? In terms of Indian hotels, we know has re-rated big time. But there are various other companies that believe that you see some valuation comfort. So which is the company that, that you would be betting on?
Right. So post-COVID, we have seen that many hotel chains like Indian hotels and all, so their stock price has increased by like around 10x. Right now, the valuations are not that attractive.
What is it at?
So Indian hotels is trading at around 25x EBITDA FY28 and around 28 times FY27 EBITDA.
Okay. And so you have a cheaper, stock that you like, and if you could give us triggers?
Yeah. So in the hotel space, we like chalet hotels. Okay. So chalet hotels has two segments: hospitality and the commercial annuity business. Right?
Correct.
Hospitality contributes around 80 to 85% of the revenue, and the rest is coming from the commercial annuity business. So we have seen that, and they are present in the top 10 metro cities only. So Mumbai, Bangalore, Hyderabad, etc. And now they are expanding into leisure as well.
Got it.
Okay. So currently they have around 3,300 kind of keys, which will expand to around 3,800 to 4,000 keys by FY28 in next 2 to 3 years, right? And in annuity business also, currently they have around 1.4 million square feet of space, which they have leased out. And it will, in next 2 to 3 years, it will expand by around 2.4 million square feet, which is like a double only.
Okay, all right. So
yeah, and here the margins are also higher in annuity business. So around 95% they make EBITDA margins.
Okay, all right. So chalet hotels is something that you like from the hotel industry itself, and valuation-wise, Indian hotels is at 25 to 28 times EBITDA, forward EBITDA, while chalet is at?
Around 16 to 20x.
16 to 20 times, all right, got that. Okay, but if you're taking a flight and you're checking in, require back to pack, right? Safari has been the market leader. What a story by Mr. Jatia. Brilliant over the years. Now, however, VIP has got a new promoter. What do you prefer from this space?
So we continue to like Safari Industries, right? So Safari has gained market share from both VIP and Samsonite, and they were the beneficial from the shift from unorganized to organized, right? So in 2015, Safari has around 15% kind of market share.
Right.
Currently, they have around 35% kind of market share, right? And they have strategically also increased their capacity as well to around 0.7 lakhs per month.
Right.
Right. So, and going forward, and they are beating the industry growth as well. So if industry is growing at around 10 to 12%, Safari continues to grow at around double the industry size.
Right.
Right. And so we believe that, so we remain positive on the Safari.
You remain positive, but I think officially you have got a hold rating on the stock.
Officially, largely due to the run-up in the stock price.
Okay, all right. But still, preference between the two is Safari over VIP.
Right.
Just one quick word, there has been these new D2C premium brands. Mokobara, for example, they have made their presence felt. Does this pose a risk to a company like Safari? Because so many of these D2C premium brands is what I've been noticing in the market. How much do they constitute first of the entire market, if you could give us a rough number?
So all these new D2C brands like Mokobara or Nation Miles, Uppercase, right? So they combined contributes around 10 to 12% of the overall organized industry.
Okay, all right, 10 to 12%, and you believe they're not a big challenger to Safari because the focus area itself is premium, which is not such a big pull for Safari. Is that correct?
Right.
Got that. All right, let's focus on online travel agencies then. I believe you find some of these companies attractive. Ixigo, that's a stock that you like to us. So just explain to us first the business, what stands out for it, and the rationale that you're positive on the stock.
So Ixigo started in 2007 as a meta search platform.
Okay.
They pivoted to online travel agents in 2019. Okay. So currently in all the three segments, like railways, so they are the market leader with around 70 to 75% market share in the online train bookings.
Right.
They are the second leaders after Make My Trip in bus as well as airline segment.
Right.
Right. And they continue to gain market share across the segments. And post-COVID, we have seen that in B2C segment, not many players are there now actively.
Okay.
So after Make My Trip, Ixigo. Clear Trip was acquired by Flipkart in 2023.
Yes.
And Ixigo is also, and Is My Trip also, they are not doing that good.
Okay.
Right. So they are, Ixigo continues to gain market share across the segments.
Right.
So if industry is growing at around 13 to 15%, Ixigo will continue to grow at double the industry size.
Interesting. And Ixigo, I believe they're into trains, buses, as well as flights. But you're seeing that there is a bigger trigger once they start penetrating into hotels. Is that something that you're working with? If you give us some analysis, what is the differentiator here? Is there better margins with there, better take rates? Help us out with some numbers there on Ixigo.
Okay. So currently that combined take rate across these three segments is around 5 to 6%.
Okay.
Right. And now they are, because they got the money from Proxys around 1,300 crores. So they are now aggressively pushing into hotel segment.
Okay.
So in hotels, we have seen that so the take rates is around, gross take rates is around 15 to 20%. And even the margins are double as compared to the other segments.
Okay.
So in next 3 years, if Ixigo execute well in the hotel segment, so we believe that their EBITDA margin can easily reach from current 8% to around 13 to 15%, and their take rate can also double from 5-6% currently to around 11 to 12% in next 3 years.
So executing on the hotel part of business is going to boost their take rate, is going to boost their profitability as well. That's going to be important. All right, keeping that in mind. What about a company like TBO Tech? That's a B2B platform, right? We've been talking about that as well. What do you make of the recent large inorganic growth of TBO Tech? And also, how does that help them in growth, and how do valuations stack up for this one?
So TBO Tech is a B2B aggregator, right? So they connect offline travel agents to the suppliers like hotels, airlines, car, etc. 80%, so 60% of the GTV comes from the hotel segment and 40% comes from the airline segment.
Right.
So from the 60% GTV, So 80% of the hotels is from the international side,
Right.
which is a high margin business. Okay, and airlines GTV, which is 40%, it's from the Indian segment, India to India or outbound India travelers, right? And so with the latest acquisition, Classic Vacation in US, so they were earlier trying to get into the US market, but with the Classic Vacation, they have got entry into US, right, which is a very big market. So we believe that going forward on an organic basis, they will continue to do it around 25 to 30% kind of revenue growth,
Okay.
right, with steady margin expansion. And with Classic Vacation, they can easily do around 80, 100% kind of growth.
Oh, all right. But this Classic that they have gone ahead and acquired, which helps them strengthen their presence in the United States, is there an execution risk? Because, see, they got it at very good multiples. And also, it adds substantially to the EBITDA number. Could you give us some numbers on that front? How much does it add in terms of profitability, in terms of revenues as well, this Classic acquisition? Because if I look at 2025, one of the big inorganic growth that took place was from TBO Tech. So tell us more.
So if you see Classic Vacation, GTV is 1/8 of the TBO Tech current GTV, but their revenue is just 1/3 of TBO Tech revenue.
Oh.
Largely because their take rates are higher. TBO Tech take rates is around 7 to 8%, whereas the gross take rate of Classic Vacation is around 23%.
Oh.
So they cater to the ultra high luxury hotel segment.
So net, this will be then, accretive.
Value accretive for TBO Tech.
All right, great. All right, Shobhit, I request you to just hold on to your thought for the time being. We'll take a short break, come back, we'll continue our discussion. We'll also answer some of the queries that we have received. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha, and we are discussing the entire travel theme. So, since it's that part of the year where travel is picking up pace. And we have with us Shobhit Singhal, research analyst at Anand Rathi Institutional Equities, who joins us. Well, Shobhit, you've given us a fair bit in terms of your picks with regard to the entire travel themes. But we've got a few queries that are coming there. So, I request you to take a few of them. Rohan Kumar writes to us from Hyderabad. He holds around 500 shares of Interglobe. Unfortunately, he bought it at around 5,700 rupees. He wants to know what's the long-term outlook on the stock. And he also wants to know if it's the right time that he should actually consider to switch into SpiceJet. What is your take, Shobit? Just as an observer, SpiceJet, if it was a real competitor or really was going to seize the opportunity, the stock price would be up much more. It appeared there was that trading rally that fizzled out. But what would your advice be to the person who's writing in? He's got Interglobe at higher prices. Would you tell him that, maybe buy some more of Interglobe? Or would you say you could take a punt and maybe invest some in SpiceJet?
Sure. So there is a serious supply issue going on in the airline industry, right? So pre-COVID, it used to take around 7 years to get delivery.
Okay.
Currently, it is taking around 14 years, double, right? So someone who has strategically placed the orders will get the first delivery. So we remain positive on the Interglobe, largely due to the supply issue in the industry, and company has strategically placed the orders. And the order book is like a highest in the industry now. Currently, they have order book of around 900, as compared to 500 with Air India and around 150 to 200 with the SpiceJet.
Okay. So you wouldn't, you would say, and in fact, if someone is asking you, rather buy more of Interglobe if you bought it at a higher price, that would make better sense?
Right.
And stay away from SpiceJet, would that be the call?
So we don't actively cover SpiceJet, but we remain bullish on Indigo.
On Indigo, got it. All right, so I hope that answers your query. We also have Shyam Krishnan, who writes to us from Chennai. He holds around 50 shares of Yatra Online. The purchase price he has is around 148 rupees. He wants to know what are the future prospects with regard to this particular name. What's your advice to Shyam? Yatra, I'm not sure whether you'll have official coverage, but that stock sometimes has been making some big moves. Your view on it?
So Yatra has pivoted from a B2C to B2B after they acquired Globe Travel in FY25. So currently their B2B, which is like a online corporate travel, now contributes around 65 to 70% of the GTV. And B2C contributes around the rest, around 30-35%, right? In B2B online corporate travel, so the customer stickiness is there. Because once you integrate into their platform, okay, so you don't have to incur any cost of acquisition, or you don't have to give any discounts. So here in B2B, the margins are also higher.
You're right.
Right? It's actually double as compared to the B2C, but here the growth rate, because the market is very restrictive, right? So the growth rate will be half of what the B2C player can do, but margins are double from B2B, from B2C players. And now the valuations are also very attractive. So if you see on the valuation front, Yatra is now currently trading at around 20 to 22x of FY27-28 earnings, as compared to the other players like Make My Trip, which is at around 40 to 45x, and Ixigo, it's around 55, 60x.
Okay, so you believe there is some valuation comfort in there.
Right.
So, I mean, but officially you all don't have coverage on the stock, but it appears that you all are quite positive on the prospects.
Yeah, right.
Just a quick word, since you mentioned B2B and B2C, TBO Tech as of now, they're totally only into B2B?
Yeah, so they are into B2B.
Oh, into B2B.
Yeah.
All right, all right. And the other one, Ixigo, just refresh that, because I've got a query that's come with regard to Ixigo. And they are asking us just to revise what is the take rates, currently in the verticals that they are. And as you said, hotels, it's much better take rate out there. So just revise that number.
So in bus, they have the take rate of around 11 to 12%. In airlines, around 7 to 8%, and in railways, they have around 5%. Okay. And if they execute well on the hotel segment in next 3 years, so the hotels take rates are much higher, around 15 to 20%.
Got it. All right. Also, your call with regard to Safari, where you're more or less bullish. Now, VIP, they have very able promoters who have come in there. And some believe that maybe with a brand like VIP, after all, everyone has a VIP suitcase at home. Do you think that turning around the company will be a challenge? Or do you think that can happen with a kind of brand recall? I'm aware that it's no longer the market leader. I think Safari has overtaken it of late. But how do you see that panning out? And also Samsonite, I think they were increasing some capacity as well. A quick word on that with regard to supply in the market.
Okay. So VIP, so there is a strong brand recall of VIP, right? So there were some management issues in VIP. That's why they lost market share, and they got the wrong because the demand shifted from soft to hard luggage. So there was a inventory piled up of soft luggage.
Yes.
Right. So with the new promoter P multiples, right? So we believe that if they come out with the good new collections in the mid to premium range, right, and if they execute well, I think again the VIP growth and margins can come back, but it will take some time to execute.
All right, and clarity is still awaited with regard to the vision of the new promoter, I think so.
Yeah.
All right, and what about Samsonite, the capacity that they are adding? Because I think they are, in third place, around 29 to 30% of the total market.
Right. So currently the capacity is around 7 to 8 lakhs per month.
Okay, and they are adding some capacity?
No, so with this recent added capacity, so the new, so overall the capacity is around 7 to 8, but pre-COVID it was half.
Okay, all right. Well, it's been a pleasure talking to you, Shobhit. Thanks a lot for coming on Finding Alpha. And just to revise to our viewers, Shobhit believes that from the aviation space, IndiGlobe is something that you're betting on. From the hotel space, Chalet Hotels is the one that you're looking at. And from luggage, Safari is the one that you pick up. And other plays, TBO Tech and Ixigo are the stocks that you like, and fairly optimistic on the prospects of Yatra as well. Thanks a lot for joining in, Shobhit. It's been a pleasure having you on the show.
Thanks a lot, Nigel.
Well, on that note, though, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching. Stay tuned.
to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
It's a positive start compared to where we ended off last week.
We're going to run the country until such time as we can do a safe, proper, and judicious transition.
Over the last many months, they've been building up naval presence. There was almost a blockade around Venezuela, trying to sort of, cut a sea lane.
And at the start of this year, the mood is positive, but it's not euphoric.
It's 26,350 on the Nifty, the Sensex, 320 now.
So the export tempo for quite a few months, as you know, has been maintaining at about 15 to 20% growth.
HPCL announced commencement of a very futuristic project called Residue Upgradation Facility.
CRISIL has rated us AA+. Our current are from ICRA and CARE.
The CNBC TV 18 macro outlook poll of leading economists suggests India is starting the year on fairly solid ground.
Well, quick commerce has become one of the most disruptive changes in India's consumption story.
Heavyweights are not participating, and that's why that fall from the highs, that is something that we are tracking very closely.
Well, that is the day so far, and it's been a slightly disappointing start to the week. It's the first full week of 2026. The Nifty is down 85 points. This is Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Prashant. With me, my colleague Reema. Nigel will be with us in just a bit from now. Reema, hi, afternoon.
Hi, the sentiment just turned about 1 o'clock. Pull up that intraday chart. Markets were flat, cruising along. There were no gains to boast of, but we weren't declining. And then came 1 o'clock and markets started dropping, especially in the face of strong global cues. Look at the way Asia closed up. You've got 3% plus rallies coming in on the Korean markets, on the Japanese markets. The Taiwanese market was up close to about 2.5%. So very, very strong close coming in on Asia. Europe right now is holding up in the green. I can see about a 0.5% gain on the CAC. The German index, its DAX, is up close to about 1%. So any guesses why we suddenly turned?
I don't think there's any, I've not seen any news or anything of that sort, which is kind of leading to this kind of action. But that's what it is. It's not a large cut. I mean, but it's not up. Let me put it that way. And I think that stands at a bit of a contrast with regards to what's happening, as you said, with some of the other global markets.
And it doesn't help when an HDFC bank is down 2.5%.
Yeah.
The IT index, the entire technology basket, is down 1.5%. Reliance Industries opened up at fresh record highs on, just in the hopes of what happened with US Venezuela, but that is turned. Reliance is down 1%. So most of these large companies are dragging.
I'll tell you, Reema, market breadth is negative, sharply down. But, it's not a bad-looking screen, because what is down is, the list of volume-led losers is very short. It's about 8-10 names. That's it. So numerically, it looks like, it's a very, very poor breadth. But you got to sort of, throw in the other factor of volumes as well. And suddenly it doesn't look all that bad. Actually, when you look at the broader market and look at what's going on, actually, it's a pretty good-looking screen, I would say. Despite the the absolute number of stocks far outnumbering the absolute number of stocks which are higher. And it's a really long list of solid volume-led gainers, which I can maybe highlight a few, right, before we go any further. Okay, let me do that. NetWeb, if you can pull it up, 8-9% higher. And NetWeb is showing some signs of life after a long time. It's, by the way, the number one volume-led gainer on the NSE, 6.5 million shares on NetWeb. Ola Electric is up 6%, is the number two volume-led gainer. SJV, and that is Satluj, Jal Nigam, is up 6%. There is Tourism Finance Corporation of India, which was one of those names with a common shareholder thread, which was down, circuit down on Friday. That is up, circuit up 20% right now. There is PG Electroplast. Friday was a good day. PG Electroplast is up another 5%. There is CSB Bank, which is up 9.5%. Ujjivan Small Finance Bank, Sobha. Look at something like MTAR Tech, 4.5%. Cyient is up 4%. Data Patterns is up 4%. I could go on. Jay Balaji, Lumax Industries, Kernex, and so on and so forth. So that's why I'm saying that it's looking a little sideways to down in the index on the Nifty Bank, etc., and maybe a sector like the IT index where there is some pressure. But in the broader space, I mean, I think it's not a bad-looking screen. There is a fair bit of buoyancy. So that's a short bit about markets. But let me just quickly run you through what's coming up here on the program. So we'll, of course, talk more about markets and broadly where we are headed. And whether some of these levels will hold. HDFC Bank leads losses in the Nifty despite strong growth. So what's worrying it? Gaurav will get us details shortly. There's a note from Bernstein which highlights the caution over the rate of rebound in India's power demand and remains negative on solar module makers. Some of these like Vari, Premier, etc. are down, and we'll get you details there. And of course, names like PB Fintech and maybe insurers also in focus. There's a story which Yash is going to put out in a bit from now. So that's the lineup here over the next 60 minutes. How should you position yourself? That's a question in the last 60 minutes. Mitesh is here to help us with that. Mitesh, good afternoon.
Good afternoon, Prashant. I think, the Nifty, as I've been maintaining, we will have a fresh breakout about 26,400, 2030. We didn't get there, kind of have tapered off. But the Bank Nifty had a breakout, and, it's coming back to the levels of the breakout, which is around 59,800. So I think in case we don't break below 59,800, 750, 720 zones, then I think this will be a buying opportunity. We haven't bought as yet, but we already have some bullish spreads in the Bank Nifty, so that position is on hold. I think the chances are that, eventually if we don't break 59,750, then I think we should again head towards levels of around 61,000 on the Bank Nifty. So I maintain a positive view on the upside, despite the fact that there has been some pullback today. And even on the stock side, I have two buy recommendations. The first one is a buy on BDL with a stop at 1520 for targets of 1595, and Cipla is a buy with a stop at 1506 for targets of around 1540.
Okay. Got that. Mitesh, thanks very much for that. Really appreciate it. Well, let's just talk about HDFC Bank as we just promised. And what's happening with HDFC Bank, right? Loan growth has been strong for the third quarter, October to December. What's worrying the street? Stocks down 2% and more. Gaurav, tell us.
Well, as if you look at HDFC Bank and the updates that they have given for third quarter, they actually look very strong. In fact, the loan book growth that came in double digits after the merger for the first time on a normalized base, that came in at around 12% on a year-on-year basis, and now the loan book currently stands at around 28.4 lakh crores. Along with that, if you look at deposit growth as well, that came in at around 11.5% on a year-on-year basis. And in fact, if you look at the numbers, they are actually in line with the system as guided by the management that in FY26, they will be growing in line with the system. But what is worrying the street right now is the LDR ratio. Now remember, post-merger, we have seen HDFC Bank's LDR ratio as high as 110%. From there, they have brought it down to around 98% to 99%. But remember, they had also been telling the street that they will be bringing it down further to 90% level. Now, what has happened for the last two quarters? LDR ratio that has remained high. For the last quarter, we have seen LDR ratio as high as 98.5%, and in this quarter, it has gone up even more, almost by 50 to 60 basis points to around 99%. Now, what is happening is that because of the higher LDR ratio and management who is saying that in the coming quarters, the LDR ratio will come down, there has to be deposit growth which has to be higher than the loan book growth. Now, if we consider that 12 to 13% of the loan book growth can be achieved by the industry in FY27, and given that management is expecting loan book growth to be higher than the system, so let's assume 14 to 15%, deposit growth has to be even higher than that. And that is something which is worrying the street. That first is that if the deposit growth does not come through, it can be a constraint for advances growth. And second is that if you look at LDR ratio, in order to bring it down below 90%, they have to focus more on deposits, which can actually put some pressure on growth as well as margins. So definitely that is the reason why, despite giving good numbers in third quarter in terms of provisional updates, we are seeing some pressure building up in a stock today.
Okay, all right, Gaurav, thanks very much for that. So that is the explanation coming through on HDFC Bank. Deepan Mehta, Director, Elixir Equities, is with us. Deepan, good afternoon. Good to have you with us here. Just your thoughts. You heard Gaurav on HDFC Bank. What do you make of it?
Yeah, Prashant, good afternoon. Thank you for having me on your show. I think the concerns are justified, but nonetheless, we're getting very cautious on all of these large cap private sector banks. They've been great wealth creators, but I think the center of the entire banking universe has shifted to the PSU banks, where loan growth, balance sheet quality is equal, if not better. And then there are these smaller fleet-footed banks which are delivering higher growth rate. Like, look at what the numbers came through from AU Small Finance Bank. I think solid double-digit, solid 20s, mid-20s type of growth rate. And I think investors are flocking to such counters rather than HDFC Bank, where earnings for last several quarters have been disappointing according to us. And going forward also, because of the base effect and the size of the P&L, it's difficult for HDFC Bank to grow at significantly higher than say 10-11% net profit. So I generally avoid companies where I don't feel that they can grow at least at 15-16%. They are best avoidable, and a lot of the large cap banks are falling, large cap private banks are falling in that category.
So AU Small Finance Bank, anything else which piqued your interest?
So I think this is when the banking sector starts to do well the way it has, and we are behind the NPA cycle. And mind you, RBI says that our NPA of the industry is at multi-year lows. It's good to look at some of the smaller turnaround banks, like say Ujjivan Small Finance Bank, or Utkarsh Small Finance Bank, or Equitas. These are the companies which were under a lot of stress for whatever reasons, mainly to do with microfinance, unsecured lending. But now they seem to have got their act in order. Valuations are reasonable. Base effect will benefit them because whatever growth in loans and profitability they show will be compared on a low base. And there's always scope to improve the PE multiple. So I think it's better to go with the smaller banks. Even within the PSU space, smaller banks, IDBI Bank, Bank of Maharashtra, Jammu and Kashmir Bank, the smaller ones, I think, although they're not the best banks, but they seem to be good investments from our point of view.
The ones which stand out are the ones with a higher exposure to gold loan. Look at a CSB Bank. While the overall loan book went up by 29%, its gold loan book went up 46%, and CSB Bank has surged about 10%. Gaurav also highlights Dhanalakshmi Bank, where the gold loan book went up 50% on a year-on-year basis, which led to a strong 24% increase in its overall loan book. So these two banks stand out. Stocks are also higher today. CSB Bank up 11% now, Dhanalakshmi Bank up 5%. Is it too late to back, CSB, Dhanalakshmi on the back of the strength that we've seen in gold? I mean, has the rally played out?
No, I don't think so, Rima. I think that these companies will report solid earnings because typically gold loans have a higher net interest margin than some of the more secured, safer products. And I don't think it's completely discounted in these companies. So as I said, I think it's good to go for the smaller banks, even smaller NBFCs also. I think they may also do very well. I mean, this could be a great turnaround time for some of the microfinance companies also. They've been like completely out of investors' mind frame because of very poor numbers. But all of these things are, I think in the banking sector, let's look at the turnaround companies, the companies which are under stress. I think they will do well, and the good trading rally over there. I'm not sure of an investment on a 3-5 type of a perspective. For that, then you look at Bajaj Finance or Cholamandalam or something like that, which are absolute gold standard. But a lot of the stressed out banks and NBFCs can give great trading rallies.
Okay, I've got that. We'll stay with financials, but insurance now, right? The Department of Financial Services has sent letters to Life Insurance Council and General Insurance Council on high commissions. Remember, the Department of Financial Services Secretary, Mr. Nagaraju, spoke with our colleague Sapna Das, this was a few days ago, and highlighted that IRDAI, the sector regulator, is going to issue draft regulations with regards to commissions. Yash, tell us more.
Well, Prashant, just last week, end of last week, the insurance regulator had issued its annual report. And one very striking part of that annual report, which we also highlighted, was the fact that insurance commissions have grown significantly. And when you compare those significant growth in insurance commissions to, growth in premiums or increase in new policy issuances, that hasn't happened, and that was a sign of worry as far as the regulator is concerned. Now the Department of Financial Services has looked at that very part of the insurance regulator's annual report. They've written a letter to Life Insurance Council, the industry body, as well as General Insurance Council, and sought explanation from insurers on how and why high commissions are not leading to growth in premium or new policy issuances. Also, along with that, along with the concern on high commissions, Department of Financial Services has also sought suggestions from life, general as well as health insurance companies on the ways in which insurance commission will be brought down in coming days. So things are moving very fast as far as regulating insurance commissions are concerned. Now, on a separate note, we've also been given to understand that the 9-member committee which CNBC TV18 had first reported on, the life insurance 9-member committee is expected to meet today itself. The committee, as we understand from sources, is expected to finalize the regulations and framework when it comes to deferred commission model before seeking an approval from the IRDAI. Essentially, what the committee is expected to finalize is a 5-year deferred period for commissions when it comes to corporate agents, that is banks and web aggregators, and a 3-year deferred period for individual insurance agents. What does a deferred period mean? Assuming 40% is the first year commission on a term life insurance policy, then the commission paid to web aggregators or banks would be 8% each year, and the next year commission will only be given if the policy gets renewed, and no front loading of commissions will happen in the first year itself. Similarly, for individual agents, that would be deferred amongst in 3 years as compared to 5 years for corporate agents. This is what we're picking up. All eyes, of course, would be on that important meeting as it happens and the outcome for the same.
All right. Thanks very much, Yash, for that. I mean, this is a story which is now picked up momentum quite a bit. We've heard from DFS, we've heard from IRDAI, we've heard from the Reserve Bank of India last week on this. Any thoughts, Deepan?
See, that's the reason I avoid buying any insurance policies, because the commission on the first year premium is absurdly high as compared to sort of other financial products. And rather than reducing the overall commission, it is better for them to try and do some tweaking over there so that there is incentive to go after collection second year, third year, so on and so forth, and improve the overall kind of loyalty of the customer. But this is a tough question, because mind you, selling insurance policies is very difficult. And if there's a cut in the policy, the commissions which are paid, it will affect the growth of the insurance companies per se. There are a lot of middlemen also involved, and a lot of sharing of commission also takes place. So, and despite that, the insurance companies are able to grow as they have. So if they cut the commission, it's going to get very, very difficult. But look, I'm not an expert on this particular kind of a situation. All I know is that from a customer point of view, the kind of commissions, at least on the first year premium, are extremely high and clearly justified that there should be a cut over there. And yes, I think Policy Bazaar will certainly get impacted significantly over there. But the management over there has been focusing on renewal premiums, and how much of that is going to, work for them, only time will tell.
What did you make of Bajaj Finance's Q3 update? Because I think last time you said it's a part of your portfolio, so you would track it. I mean, last quarter, they lowered the AUM guidance only by 100 basis points, but they lowered it. And this quarter, Gaurav was also telling us that the new loan growth at 15% is lower than what we've seen in the last couple of quarters, maybe on account of a high base. But considering the valuations, the run-up over the last so many years, any signs of slowdown that is visible to you in the numbers?
See, Rima, it's now pretty large NBFC, India's largest NBFC, and base effect is certainly going to play over there. And despite that, I'm satisfied with these kind of growth rates. Valuations also have come off significantly from what they were trading earlier. And I think that the company can maintain these kind of valuation ratios, price to book, price to earning. And also, we have lowered our expectation for returns in the stock to be in line with what the earnings growth could be. And the earnings growth could still be around 17-18% to 21-22% in that particular range, which we are fine with it, because it's been a multi-bagger stock for us, part of a core holding. And on such a large holding within a portfolio, if you get 17-18%, which is index beating, I think you should be satisfied. This is not a kind of a multi-bagger stock from here. But then you need such consistent performers within your portfolio, where there's a high degree of safety as well.
Oh, yeah, absolutely. You need stabilizers in your portfolio, right? Not all rockets, or at least trying to be rockets. Okay, Vari and Premier, Deepan, coming to you on these. They're under pressure, down 5%. Bernstein highlights some concerns. So what is Bernstein saying?
So Bernstein has today come out with an interesting note related to power sector. It's saying that there is an expectation that demand for power sector will improve in 2026. But if you are expecting a big rebound, that is very unlikely, as weather is unlikely to be unlikely to be supportive as far as 2026 is concerned. And now it has also given segment-wise expectations. So for renewables, it says it remains negative as expects moderation in the total additions. For solar PV, it believes that concern till now was supply, but now there is a concern related to demand as well. For nuclear, it expects real action with possibility of bulk ordering of equipment. For thermal, it remains positive as government is expected to raise the long-term target. For discoms, bailout package is awaited and there should be a buzz on privatization going forward. For data centers, it believes that it could be a big driver for the broader sector. But talking specifically about these two, Waaree Energies and Premium Energy, it says it can't give high multiples on peak margin as big wave of supply is still 12 to 18 months away. And oversupply thesis is gradually seeing acceptance, but market is still missing the soft demand story, and demand for domestic sales to come only from FY 28-29, not FY 27, and it expects margin compression to start showing visibility from Q3 FY26. And considering these factors, on Waaree, it has underperformed call and target is to 2109 rupees per share. For Premium, it maintains underperform call and target is cut to 718 from rupees 780 per share.
Sir, when they say that weather is not expected to be very supportive, what do they mean? Not enough sun, not enough wind? What?
No, weather
or colder.
Supportive for the demand of power. So normally in the summer season, you see the demand for ACs and all to rise when weather is supportive. So basically there is summer season is peak.
So it's going to be cooler, basically, right?
Yeah, correct.
Okay. That's what I thought. I mean, that's a question we put to Blue Star as well. I mean, there is these La Nina conditions, which basically mean that it's going to be a cooler winter, which perhaps extends a little longer. We asked the Blue Star management last week, I think they were with us. But Deepan, specifically on these names, Waaree and Premier, any thoughts?
Yeah, I'm disappointed with the correction because first the disclosure, we are invested in Waaree Energies. And I thought that the solar equipment, wind equipment industry is growing pretty well, and the order book position also is very strong. But when these news items appear, we need to go dig a bit deeper. But nonetheless, I think for the time being, considering the valuation, considering the earnings visibility, I would remain invested and keep it on a watch list. Let us see how the demand evolves. Also, all of these companies, especially Waaree and Premier, are going into backward integration as well, as much as they can. And that certainly should support margin growth going forward, even if there is softer end product prices. And Waaree in particular, I think the US business also, I think, is quite interesting. And certainly it kind of protects the company in terms of tariff issues with the US. So I'm still very positive on Waaree. It's the largest solar equipment manufacturing company, very strong order book position. They also have a retail business when it comes to solar rooftops. So I would say that it is better off than a lot of the other solar equipment manufacturers.
Thank you. Deepan, great chatting with you. Always look forward to the next one. Slip into a break. On the other side, we'll invite Mithun Ashwath of Kiva Advisors, so stay tuned.
Welcome back. Actually, there's a bit of a pullback from the lows of the day, so that's pretty heartening to see. Shriram Finance, that one's cut its losses. It was down, I think, 1.5%. That's pulled back a little bit. Tata Steel as well is up and about in today's trading session. That one, in fact, is up close to around 2%. Now the prospects of steel price hikes coming through are, quite high. And Asian steel spreads, they're at a 15-year low. So there is optimism that that's not sustainable. So in turn, you'll see some higher prices globally as well. From the broader markets, Cupid is the stock that I'm looking at. That has recovered close to 8% from the lower of the day. And Jaiswal Nico, another one that was in the red, that as well has popped up in trade. That said, let's hop across to Hormuz. He's here to tell us all the stocks that are buzzing around. Hormuz.
There are plenty of movers, stock-specific reactions in the broader markets in reaction to business updates and so on. But you can look at Netweb Technologies. The stock is up 9% today. It's the top gainer on the Nifty 500. It's the biggest single-day gain and volume moves in the last 3 months that the stock has had, where we've had over 70 lakh shares that have been traded today. The 20-day average is just under 4 lakh shares. So it's 18 times its 20-day average. The stock has moved above its 100-day moving average. The 50-day moving average on the upside comes at 33.55. So that's some distance away. The stock had recovered some of those losses later part of 2025, ended with gains of 14% in the year gone by. You mentioned Cupid, both of them seeing some divergent moves today. At one point, Cupid was down almost, 18-19%, still down 7%. Tourism Finance, though, locked in upper circuit for a better part of the trading session today. And the volumes in today's session as well. Cupid has had almost 6 crore shares that have been traded today. The 20-day average volume is just 50 lakh shares. Tourism Finance, 12 crore for an upper circuit of 20%. A 20-day average of around 60 lakh shares. Gandhar Oil Refinery is another name that's moved higher today. It snapped a 2-day losing streak. It's the biggest single-day gains the stock has had since its listing back in November of 23. And this is the highest volumes as well since the listing day that it had. Close to 4 crore shares have been traded today on Gandhar Oil. The 20-day average is around 3 lakh shares, so significantly high volumes as well. The stock has moved above its key moving averages, and as a result of this 35% up move that the stock has seen in the last 1 month, it has returned back to its IPO price, which is 169 rupees. And lastly, CSB Bank is a stock reacting to its business update, now 10% higher on the stock. The biggest single day gain in over 3 months. It's gained in 5 out of the last 6 trading sessions. The stock is at a record high, almost 25% in this 6 days. The stock has moved. Volumes are the highest today since December of 2023. The highest volumes in over 2 years. Now it's close to 60 lakh shares have been traded on CSB Bank. The 20-day average is less than 3 lakh shares. And at record high levels from the stock, the IPO price of close to 190 rupees. So it's moved almost 2.5x from those levels.
All right, Hormuz, thanks very much for that. Those are big buzzing names. And actually, it's a fairly healthy, robust, long list of volume-led gains. And Hormuz highlighting some of them. Mithun Aswath is with us, managing partner at Kiva Advisors. Mithun, happy 2026. Welcome to the program.
Happy New Year to you as well, Prashant.
So, a slightly better year, much better year. We, by the way, did a poll and we'll put up some of those graphics and we asked them what do they expect in returns. I mean, just as a starting headline question. And most, I mean, the majority of the responses landed in the between 10 to 20% range. This is Nifty returns for 26. Would you agree?
I think broadly that seems likely, Prashant. After a year where last year we were more treading water, I think that could be, potentially something that one could look at.
Okay. All right. Hi, Mithun. Good to have you in. Wanted to ask you about, we get back to that poll, but I believe normally when you join in, you give us that one big call, right? And this time around, you believe that Dixon has corrected enough and things could look up from here on. Give us your rationale.
Yeah. Good afternoon, Nigel. So I think, on the electronics manufacturing space, we've seen tremendous growth across the sector. And Dixon clearly is the standout, company in that space. There was tremendous growth last year with, the mobiles business growing exceptionally well. This year seems to be slightly a year of consolidation. And next year, again, you will see a ramp up of growth. We do think, they are going to do something like about 60 million mobiles this year. And as the next couple of years progress, you will see a lot of backward integration also happening, where they're going to go into the camera as well as the basically the display space. This is one part of the story. The other part of the story is that they are going to be a very large player on the IT hardware side. So there is a government impetus even on trying to manufacture IT hardware in India, and Dixon is very well placed with tie-ups with several of the OEMs.
Got that. How does Dixon compare with the other peers? Now, if someone wants to play the EMS, because broadly as a macro theme, what you outlined is applicable for many other players. So how would it compare with other peers?
I think there you have to kind of try to understand what is the underlying business and segments that each one is catering to. Amber is another large company on the space, but a large proportion of their revenues is aligned to, say, the air conditioners, right? You see a couple of quarters where air conditioning volumes go down, and then the stocks react quite sharply. So one needs to kind of take that into account before taking allocations, and you need to be able to time the entry point as well, where valuations are reasonable. The whole point here is, over the next 2-3 years, we do think, and it's a stated guidance from Dixon itself, that their revenues could be about 1 lakh crores. And margins could be in the range of 4.5% to 5%. So there is definitely going to be revenue growth on a base of 50,000 crores. To double the revenues is not a small task. So that's where we are coming from. Because after this correction, the market cap is in the region of about 70,000 crores. And if you're talking about this company going to about 1 lakh crores of revenue and about 4.5% of margin, that's almost 5,000 crores of EBITDA. So it doesn't look, frightfully expensive if you have a 1 to 2 year horizon of view on this.
Any other stocks where you are betting stocks had a sharp fall towards the end of 2025? Like, for example, Dixon was one, stock corrected. Any other stocks which could be perhaps a contra bet, or stocks fell into reasonable valuation territory?
I think there are several in the small and mid cap, which I may not be, be able to kind of really name, but something which we've, held for a long time. We had booked profit, and then, we've still continued to hold positions is maybe Tata Motors passenger vehicles. Tata Motors has demerged into the commercial vehicles and the passenger vehicles business. And Tata Motors passenger vehicles has gone through a little bit of a turmoil in terms of the JLR business because of the cyber attack that they had. So I think that is behind them now. So you may have a clear runway for the next 3-4 quarters where that may not be a problem. There could be some rebound in the JLR business. And if you remember, JLR as well on the Jaguar side are likely to launch some EV vehicles in 2026 itself, maybe in the second or third quarter. So, this seems to be a reasonably valued company, with both the passenger vehicle business in the domestic market also picking up, and a turnaround on the JLR business.
Okay, all right. One more quick question, Mithun, since Rima asked you about a contra call. Something that didn't do well or lagged last year was actually tech. The Nifty lagged global peers. And the IT index, underperformed what the Nifty did, though the last quarter actually outperformed. You believe valuations are okay out there now, and it's time, that could be actually the big contra bet of 2026? Would you go that far?
Yeah, I think this is more like a defensive valuation play. I think, I think we've talked about it in the last couple of calls also, that, the large cap IT companies are trading at about 4.5% dividend yields. So if you were to time it reasonably well, you could make double-digit returns in some of these companies. And our sense is that, you could get those double-digit plus dividend yield sort of returns in this space. Is it going to be a stellar year? It may not be. But if we are able to make, index-beating returns without too much of volatility, I think, the large cap IT guys may be well placed right now.
Okay. All right. Well placed. I mean, the other sector is real estate, right? I mean, Nimesh put out that piece on Editors Roundtable, the IT and real estate, the two big laggards of 2025. Mithun, we'll continue this conversation. Thank you very much for joining us. Good speaking with you and taking us through your views. Let's take a quick commercial break here. As always, we'll get you a quick check on what's happening with dealing rooms with Nimesh on D Street Chatter. That's coming up, and of course, some trading ideas as well after that. Stay tuned.
Welcome back. Markets down close to 70 points, and the breadth of the market has turned in favor of the number of stocks declining from midway through the trading session. A good time to get you an insight into what's going on in D Street Chatter. Nimesh joins in to tell us exactly that. Nimesh?
Hi, Nigel. So a bit of a combination of, the geopolitical risk which is playing out, and also the fact that on Friday the market looked a bit overbought as well. The PCR had moved almost to 1.5, and normally we've seen from those levels you see a bit of a correction. So I think that's playing out in today's market, including the Nifty, Bank Nifty, as well as in the broader markets as well. Within financial, it's a mixed day. There are a lot of reactions to the quarterly updates, and accordingly, we've seen a bit of reaction to the broader, banking and the financial names as well in today's market. But I guess now that the PCR has fallen below 1 again, and there is an expiry tomorrow, weekly expiry, so watch out for that, and maybe you'll see after that a bit of a pullback as well. Flow seems to be quite mixed, but there is a small MOC basket selling towards the end, is what I understand. So maybe the institutional data could be quite interesting. And remember, today is technically the first day when you'll see a lot of action from the institutional investors as well. So maybe that's playing out as well in today's market. I guess in the very near term, the quarterly updates from companies will be quite interesting, and that's going to dominate the near-term trend as well for many stocks. So that's something to watch out for. But I guess today's fall seems to be more of geopolitical risk as well as a bit of unwinding in the futures market.
Okay, Nimesh, in terms of individual stocks, what's on the radar?
Well, the first stock on the list is Polycab. We saw a large block in the opening today, and the stock has been under pressure today. I understand that the leading domestic mutual fund was a seller in today's block, so disclosures could be quite interesting. But it looks like that fund has sold out in today's block deal. So that's the first name. The second name is Glenmark Pharma. Interestingly, I understand some of the smart HN investors are booking profits in Glenmark Pharma, but there could be a big development as well as far as further monetization of one of the molecules. So that's a trigger there. But at least from the recent lows of say 16,700 to almost 2,000, you've seen some bit of profit booking as well from HN investors. And the last is Merck Electronics. They locked at 10% upper circuit, large volumes as well. The stock actually has done well in the last few days, essentially because there is a big expectation that maybe you're going to see a big management rejig very soon as far as Merck Electronics is concerned. Remember, there are some investors who bought and made an open offer as well. So that's the next big logical thing to see, that there is a new management in Merck very, very soon.
Okay, all right. Nimesh, thanks a lot for that. I think the stock of the moment, though, is CSB Bank. Just pull up that stock. It's almost at circuit. Big move, massive volumes. The intraday chart will tell you the picture. I don't know whether we could pull up a volume-based chart out there. but that one is just bursting up, post the quarterly update, and they have a significant amount of gold in their portfolio. I recall explaining the company actually on our earlier series, when Sonal and me used to do a show on Monday afternoons, and that time the stock was around 230 to 40 rupees odd. It's done very, very well from there. One of the biggest outperformers actually in the last 3 years or so. At the day's high, massive volumes in that one. Midesh Thakkar is back with us though. Midesh, what are the trading ideas you have?
I think, as I said, these levels look like, some kind of a pullback happened, and unless we break levels of around 59,750 on the bank Nifty, or for that matter, 26,200 on the Nifty, I think chances of this trend surviving are there. So on the BTST side, I have one sell and one buy. On the selling side is Cummins, which is a STBT, which is stopped at about 43.30 for targets of around 42.65, and Dabur is a BTST. It's come off after a good rally yesterday, so from today's high, so it's giving you a fresh entry with a stop at about 517.5. Look for targets of 530.
Okay, got that. IT, though, continues to struggle in trade ahead of the Q3 FY26 earnings, which begin next week. So TCS reports their numbers on 12th, and I think HCL Tech is also on 12th. That's the coming Monday. Now, CLSA today, ahead of that, is recommending to reduce positions in IT sector, saying that the Nifty IT did well. It's underperformed in the last 1 year, but purely in the October to December quarter, the Nifty IT index went up 14%, outperformed the benchmark, which was up 4%. And plus, it's not that generally Q3 is going to be a soft quarter on account of furlough seasonality. There is no big pickup seen in the demand outlook, discretionary spending. Secondly, they have downgraded HCL Tech and they've downgraded Tech Mahindra. On HCL Tech, the rating has come to a hold because the stock trades at a 5% premium to Infosys and TCS. On Tech Mahindra, it's still an outperform, but they've removed it from their focused conviction list. And the reason they're saying is that the revenue recovery, the revenue growth that we've seen in the last 1.5 years on the back of the new CEO taking over, it was seen as this big, revival kind of a turnaround stock. That's not commensurate with their own expectation and consensus expectations. That said, they still like Persistent. They like Coforge in the mid-cap space. And in the IT pack, their recommendations are Infosys and Tech Mahindra. But we'll get greater clarity on the individual stock expectations through the course of the week once we start making the previews. Amrish Baliga, Independent Market Research, is also now joining in on the last leg of the show. Amrish, looked at CSP Bank, 17% up now. Is there a play still left?
I think, see, the sort of a run which you have seen in the last 2 weeks, I think is more or less fully done. In fact, it has gone beyond the sort of a target price which I had. I think it's moved up basically because of the sort of gold loans which they have. I mean, it's about 47% of the total bank's advances. And I think the yield is about 11.5 to 12%, which is recently good for this bank. So I think this is what was getting priced in, and I think it's fully priced in at this point of time. Because of momentum, yes, I mean, you'll have a lot of traders getting in, and because of which we could see possibly either 4-5% more. But then I think that should be utilized by people who have been holding on for such a long time. I think it's a good time to start booking profit.
Got it. Amrish, stay with us. Good afternoon. Let's go across to Nigel, who's walked across to the F&O desk with the latest update. Nigel, over to you.
Well, in today's trading session, the Nifty has come in for some profit taking, but it's par for the course, right? The VIX has moved up, but the VIX has moved up from bond out levels, so I wouldn't read much into that. One cue that we had given you earlier today was one word of caution was that the PCR has moved to the higher end of the range. It was at around 1.45. The last time I checked, it's at around 0.98 or thereabouts. So some cooling off in the PCR isn't such a bad thing. It's more par for the course, actually. And if you look at it, call writers have come back. They believe that high levels can get protected. So if you look at the 26,300 call, the premium is down sharply out there and massive open interest built up. In fact, the premium is down by 75% on that one. If you look at the 26,250 call as well, the premium is down by 68%. So the call writers believe that they can defend this level of around 26,500 or thereabouts. So that's going to be the important mark on the upside. The next leg of the rally will start once, in fact, we can get closer to around the recent high and then make a move to get past 26,500 and beyond. The stock that I'm focusing on is Sammaan Capital. The last time I checked, it appears it's a certainty that this one comes into the F&O band because the total open interest as a percentage of the MWPL had moved to around 100%. It needs to breach the 95% mark to get into the band. So, that's the one that I'm looking at. In all probability, the file today will be interesting. Muthoot Finance, we pointed out earlier today that certain gold finances could possibly do well from here on, and that's a stock that's seeing fresh buying today. While you have Union Bank that's actually coming in for a bout of short covering in today's trading session because that one's up, open interest is down. And finally, PG Electroplus is a stock that's seeing fresh buying as well. Net, the markets still appear to be in an uptrend, support level at around that 26,000 odd mark, while the stock that we'll be looking at is Sammaan Capital, which could probably come into the F&O band. So that one's on the radar.
Well, Sammaan Capital up on your screen as we speak. Nigel, thanks very much for that. Well, we'll take a quick commercial break here. We'll ask Ambrish to talk to us about the stock which is on his radar, which is Action Construction Equipment. That's coming up in just a bit. I think we've still got about, 12 minutes to go for market close. Stay with us. Okay, welcome back. There's 85-point pressure on the Nifty, 26,243. But as we've been saying, this is largely, index-led in the broader market. Even though numerically many more stocks are down as compared to stocks being up, it's not a bad-looking picture. It's actually pretty robust with lots of volume-led action on the upside, which is important. Ambrish is with us. Ambrish, your idea, your pick of the day for this interaction is Action Construction Equipment, 950. It's been actually trending sideways for almost 2 years now, Ambrish. What's the play here?
Action Construction is a manufacturer of cranes, construction equipment, material handling equipment, agricultural machinery, and they have a wide range of products, and they have dominance in pick and carry and towered cranes. So market share of about 63% in mobile cranes, close to about 80% in self-erecting tower cranes. And revenue comes mainly from infra, real estate, manufacturing, and logistics sectors. And clearly, government and private sector spending is also happening in this space. They've also started supplying to defense sector. Recent order of about 1,121 rough terrain forklift they have received from Ministry of Defense, which is around 420 crores. Exports, as of now, is about 7% of revenue, expected to get into double digits in the near future. Already they have footprints in about 37 countries. Last 2 years, like you rightly said, it was more or less sideways. Consolidation was happening. But I'm expecting an EPS for FY28 of about 56. And with this, the price target is about 1260.
Got it. Okay. All right. Ambrish, so ACE is a stock that you like from here on. Just looking at a few stocks actually from the broader market. Stock is one stock that's actually coming on the radar. That one's moved to the high point of the day. Recall the stock running along, and then from the top, in fact, it did see some selling pressure. So I think TARC should come up for you on the screen, not Spark, TARC, T-A-R-K-C. We should get that 180 rupees. Last few trading sessions moving quite well. Volume's quite high as well, one of the top volume movers. And RR Wires, it's Rajratan Wires as well. Let's get that stock up for you. That as well is holding strong. One of a mix of an auto ancillary because it's used in tires mostly. So RR Wires is another stock that's up a good 5.5%. But let's focus on the metal stocks. And Jefferies came out with the note. They are entering 2026 with a positive view on the Indian metal stocks itself. On ferrous, they say the companies, like various steel companies, they could deliver a 6 to around 9% volume CAGR growth over the next two fiscals. They go on to make the point that the reinstatement of the safeguard duty should lift Indian steel prices, while Asian spreads should recover from the unsustainable levels, which is near 15-year lows. They believe that the risk-reward ratio is actually favorable, going by what history. As data shows that stocks like Tata Steel as well as JSW Steel, if they are bought when the spread is below $200 per ton, they have delivered good returns in the subsequent 1 year. Jefferies is also raising estimates on various companies. Case in point being, they're raising the EPS estimates on Tata Steel and JSW Steel by 9 to around 17%. They're assuming that HRC prices will perk up to around 54,000 rupees per ton. That compares with the number which is a little south of around 49,000 rupees per ton. They go on to make a point that there's an upside potential even to this estimate. Also, they're raising their EPS estimates for the next couple of years on Hindustan Zinc and Hindalco because they're factoring in higher silver, higher aluminium prices. Their top picks come up for you on the screen, which is namely Tata Steel, JSW Steel and Jindal Stainless, all of them up and about. And they were the ones that made this point as well, that the spreads at 15-year lows is not sustainable. Amrish, what do you like from the metals pack? It's had a phenomenal run of late, but obviously it's not for the faint-hearted because, stocks like Hindustan Copper, we have seen them make very volatile moves. But in the last 6 months, the stock is up more than a double. Your take?
In fact, if you're talking of Hindustan Copper as well as Hindustan Zinc, I think most of the run has happened. I mean, we can see some more upside because there's momentum. But from an investment perspective, I would still suggest ferrous and aluminium. So one should be looking at something like a Tata Steel or the JSW and Nalco and Hindalco. Because here, I mean, although we have seen a decent move up in the last 1 year, but I think the full potential, I think we should see in 2026. In fact, something like a Tata Steel, I have a price target of about 250.
Okay, Tata Steel and aluminum names like Nalco and Hindalco. Amrish, ever looked at this name, NetWeb Technologies? Sharp correction from the highs. It's coming up with some gains today. No.
Absolutely no idea.
PG Electroplast, 10% from the recent lows.
Which is the other one you said?
PG Electroplast.
PG also, I've not really been tracking it very closely.
Okay, fair enough. We are exactly about a month away from the union budget, Amrish. Has it come up in conversations with clients or otherwise at all? Budget and what it may throw up?
I mean, again,
pockets of the market which may be in play before that, leading into the budget.
See, I mean, again, there is some talk of. Again, these are expectations from investors that there could come considering in the transaction taxes. Because, we have transaction tax as well as, a high capital gains tax. So they're expecting some amount of reduction out there. So that's the expectation. Otherwise, if you talk of budget as a whole, then most of the decisions are now, taken outside the budget. Even a huge decision like the recent cigarette taxes increase. Normally this was normally taken in the budget earlier, but now you're seeing most of the decisions are outside. So I think whatever reaction we see from the budget also doesn't last beyond a day. If you see the last 5 to 6 budgets or maybe more. So I think it's an event which everyone waits for, but then it's forgotten too soon.
Yeah. By the way, this on the oil marketing pack, right? HPCL. We had the management, we had the chairman of the HPCL with us in the morning. Very, very confident sounding. Some upgrades are in their Vizag refinery, which is very large. 9 million metric ton refinery in Barmer, which is coming up, which is being commissioned sometime in January. Part commission, refinery, and then other parts of the refinery will get commissioned. basically very strong outlook, saying earnings are going to double in the next, I think the forecast was given about 2 years back. So, I mean, I guess another 3 years or so. Any thoughts, Amrish?
No, I mean, I would be bullish on all the OMCs, not just HPCL. Again, because of whatever happened over the weekend, I think that's quite positive from a crude perspective. Because after this issue which has happened with Venezuela, I'm quite sure at least the crude prices will not shoot up from where it is. I think it would be more or less at the same levels, or could in fact correct a bit more from where we are. So that's quite positive for most of the OMCs. And I clearly see the margins holding up, at least for the next foreseeable couple of quarters. And I think if you're talking of longer term, there has been this fear that EVs will finally take over. If you see the latest figures, across the globe as well as India, that ICE, vehicles have again started picking up compared to the growth in EVs.
Ambrish, Ola Electric up 7% today, Ather down 7%. Any thoughts?
Yeah, I think this was basically because of the sort of numbers which we saw in December, where at least they've tried to make a comeback. And also, with the new batteries, it's expected that there won't be too many issues with the scooter as what we have seen in the past. And they've been working on their service quality also. So I just hope they learn from the lessons and don't make the same mistakes what they've done in the past. And the other, I think, big news which has been there is the Shakti inverter. From whatever I read in the papers, it's a great product, but then unless you see it working, it's difficult to really comment on that. But on paper, it looks good.
You mean Ola's model, is it?
Ola's inverter model, which works on solar as well as the normal power for charging. So I think that, like I said, on paper, it looks like a great product because it is dual charging.
Okay. All right. Well, Amrish, thanks a lot for that. Just a minute to go for markets on the first trading session of the week. So let's wind it down. Then if we go about.
As a pack, defense did well, even back home in India. So BEL was higher in trade, but and some of the others, there you have the India Defense Index itself was up close to about 2%. In terms of the quarterly updates, Avenue Supermarts ended lower by nearly about 2% on the way up. Shobha Developers had a good session, V-Mart Retail, and a couple of the other banking names, Union Bank, Yes Bank, Marico, where the volume growth is in high single digits. Stock ended up with a gain of about 2%. And even Nykaa, FSN, e-commerce had a good session.
I just want to leave with one name, Kiri Industries. If you can have the maybe the intraday up or maybe the last 3 days, last 1 week. The stock is sold off 25% from its high, which was made, I think, last Thursday. Remember the deal for the cash out from Dystar was announced on Wednesday. And Wednesday, that stock saw a very large move. Thursday, it hit a high of 780. And Thursday morning, the management joined us on Bazaar. And they basically said that they want to use 90% of the proceeds of the sale towards businesses, futuristic businesses, leaving very little for shareholders as a one-time special dividend and such. So from that day, from the high that day, which was made early morning, it's lost about 26%. So one-way correction. And now, by the way, the stock is below, way below the point where it was when the deal was announced. The Dystar deal was announced. Well, it's a wrap of this edition of Closing Bell. We'll keep it with the channel. Markets Forward will pick up on the action in just a bit from now. Stay tuned.
A majority of market participants expect 10 to 20% Nifty returns in 2026, according to a CNBC TV18 poll. Financials emerge as the top sector, followed by metals. That's a CNBC TV18 exclusive.
RBL Bank slips post its third quarter update, while AU Small Finance Bank surges on strong advanced growth. Consumer stocks, they're mixed. Avenue Supermarts under pressure on weaker Q3 realizations, even as Nykaa rises on a positive growth outlook.
Venezuela's interim president offers cooperation with Washington after forces extract Maduro and his wife from the country. Oil prices edge up after a weekend sell-off. Reliance Industries rallies on expected spillover benefits.
Good evening. You're watching us here on Markets Forward. This is your go-to show where we aim to get you all key data points together for the next trading day while recapping today's trading day. I'm Manglam Malu, and with me is Arundhati Ramanan. Good evening.
Hi, good evening, Manglam. Thanks for that. Well, yes, we've got you covered for the next 20 minutes with all the big news and the key developments on Dalal Street, top corporate voices and events to track ahead. But let's kick off with the day's market action. Manglam, first full trading week of the year. We saw the markets consolidate after hitting, all those record highs, ending in the red, all of them, the Nifty Bank ending flat.
Yep, it was consolidating for most of today's trading session. There was a jostle between the bulls and bears, and eventually we saw some bit of a sell-off towards the end, perhaps on account of full volumes returning as well. And the nature of the stocks that declined told you that maybe there could be FII selling that may have resumed. The Nifty, however, closed at very close to support levels. Towards the end, there were far more number of stocks declining than the number of stocks which are advancing. And as we move forward, the biggest trigger to track will be the earnings season.
Absolutely. The earnings season coming up, and we saw that IT index also falling quite a bit today ahead of those earnings season on brokerage downgrades, right? But here's a lineup of what we have in store for you today. We start with top movers and shakers of the day with Sudarshan. We bring you Q3 business updates from leading banking and consumer names and explain why IT stocks came under pressure. Last but not the least, we delve into the key market events to watch out for in tomorrow's trading session.
All right, then let's go across to Sudarshan, who's joining in from the wall to tell us all about the big movers and shakers of the day. So
amongst frontline indices, one index, that is the Nifty Bank, if you see it has closed in the flat. And majority of the losses has come from one stock, that is HDFC Bank. The biggest weighted stock in the Nifty Bank slipped more than 2%. And the reason? First, it has given the Q3 updates and loan growth was healthy, both on a sequential basis as well as YY, up nearly 12% each. But the reason stock fell because of LDR, that is loan to deposit ratio. It has risen 50 basis points to 99%. And if you go to management's commentary, in the near term, their target is to bring it down below 90%. That was the reason the stock was under pressure. But in contrary, CSB Bank has hit upper circuit. Loan growth was healthy. Total loan growth in Q3 was 29%, and it was led by gold loan book. YOY, that book was up 46%, and on a sequential basis, it has risen 16%. That is the reason CSB Bank at the close up more than 15%. Avenue Supermart from the retail space has given standalone revenue growth of 13%, slightly below expectations. And if you compare against 3-year CAGR was around 16%. So it was below expectations. That's the reason stock was down almost 2% in the trade. Two stocks from power space were under pressure, and those are Premium Energies and Vari Energies. Bernstein has come out with a note on power sector, and it believes that there will be a recovery in the power demand in 2026. But if you are expecting strong demand, you would be disappointed because weather in 2026 is likely to be unsupportive to the power demand, and it believes that it cannot give high multiples as big wave of supply is still 12 to 18 months away. And tracking that note, you can see a big fall in both the names, down somewhere 5 to 7%. Now, defense pack, if you see, all the defense names were sharply higher. Bharat Dynamics, Solar Industries, HAL. Now, on Friday, there was a report that in the budget, government is likely to increase the defense budget sharply. Might be the reason because you have seen big move in all the defense names. And lastly, all the AC companies, after big down move, these stocks have seen over the last few days. Today, majority of the names were higher. PG Electro up almost 5%, Amber Enterprise up almost 4%, and similar move was seen in Voltas as well.
All right, Sudarshan, many thanks for taking us through all those big movers and shakers of the day. But to take the discussion forward, I'm now joined by market expert Ambrish Baliga and Jed Thakkar of ICICI Securities. Gentlemen, thank you so much for joining us on the show today. And here's wishing both of you a very happy new year. But Jay, let me start by asking, the market's consolidating after hitting record levels, right? So Jay, where do you see the Nifty moving going forward?
Thanks for best wishes, and I wish you and Mangalam both a very happy and a prosperous new year as well. Arundhati, I think that after the sharp short covering, what we are seeing is just some consolidation happening again into the market. But I think it's because the PCR had actually gone up to almost 1.6 and above levels. Whenever put call ratio actually inches above 1.6 levels, you see this kind of profit booking from the higher levels. But I think that markets are likely to slowly and gradually inch towards the levels of 26,600 at least by next week. And in the best case scenario, we see Nifty hitting 27,000 prior to budget. And we don't see Nifty, in fact, falling below 25,700, which is the previous month's or maybe November series VWAP. The current VWAP is around 26,000, 26,100 range. So we're not expecting below 25,700, even if that happens due to some reason, maybe because of the geopolitical reasons or something like that. We don't see Nifty, in fact, going below the levels of 25,200. So I think the range for the budget is going to be 25,200 to 27,000. However, Arundhati, we think that for the next week, at least until then, we see 26,600 to be, achieved going forward. And I think on an immediate basis, 26,100 is a very critical support for the Nifty. Once the weekly expiry of tomorrow is over, I think it should again resume its uptrend. And market would go up along with the rising wicks, because ahead of the budget, you see 20-25% kind of jump in wicks. But this time around, both are going to go up.
Interesting there. You expect the Nifty to hit 27,000 before budget. That's about 750 points from here. But this week itself, post the expiry, 26,00, 26,100 is an important support to track. Jay, bulls would be happy with that projection coming in and that reality happening as well. But let's talk about the fundamentals, the banking space. For the markets to actually achieve the targets that you're speaking about, some of the big banks have to perhaps do the heavy lifting. HDFC Bank didn't today, but shares of AU Small Finance Bank surged on the back of a healthy growth in advances in the third quarter. RBL Bank came under pressure. Gaurav Jawarkar joins in with more. Gaurav.
Well, yes, if you look at AU Small Finance Bank, and even if its trajectory for the last few quarters, it has been delivering that 20% plus growth in terms of loan book, and it has continued to do so because loan book growth has been at around 24% on a year-on-year basis, whereas deposit growth, that also followed the same. It grew more than 23%. In fact, that is the reason why market actually cheered the stock and it was up in trade. On the other hand, if you look at RBL Bank, now this was the first time when bank actually reported its number post the Emirates NBD deal announcement. And after that, if you look at the numbers, now the loan book had increased by 13% on a year-on-year basis. There are two factors to follow here. First is that the secured loan book within that increased almost by 24%, while the unsecured, that declined almost by 6%. That is the reason we saw a bit of a drag. And second is that the wholesale advances that grew almost by 19% on a year-on-year basis. Apart from that, deposits that actually increased almost by 12% on a year-on-year basis. But what happened is that because of the deal and all the other aspects, market was already expecting some big jump in terms of growth. In fact, they have already raised, we have seen actually brokerages raised their target for growth in FY27. And given that just 13% growth was there in third quarter of FY26, we saw some kind of pessimism in the stock price. As a result, it was down more than 1% in a trade today.
All right, Gaurav, thank you so much for taking us through those details. But Ambrish, let me bring you into the conversation, right? We saw RBL Bank, AU Small Finance Bank, a bunch of PSU banks and HDFC Bank as well come out with their numbers, right? With their business updates. So what do you make of these numbers? And also, what are your top picks in the sector?
The numbers overall have been good. But then I think the stocks have reacted to the numbers they have declared. For example, AU Small Bank, I think the numbers were extremely good. And they've got that increase in foreign investment limit to about 74%. They've got the universal banking license now, in principle approval from RBI. I think because of all this, we have seen Small Finance Bank perform. Whereas RBL, if you look at the numbers were decent, no doubt, but then it's already run up quite a lot because of that Emirates deal. So clearly there was some amount of profit booking. But I was a bit surprised with the HDFC Bank correction, because HDFC Bank hasn't really performed anything in the last 1 year if you look at the stock. But then, the numbers are decent, but the stock is corrected, no doubt. But if you ask me which side of the market I would be quite bullish on the banking side, I would still go with the PSU banks even as of now, because I see the consolidation happening going ahead. So there, in fact, I mean, my picks would be SBI, Bank of Baroda, Canara Bank, and PNB.
Interesting one. SBI, Bank of Baroda, Canara Bank, PNB, all of them. You like the PSU pack, despite them having rallied a bit, because you believe that that's where, there is better performance ahead. Let's talk about the consumption space then. We got Q3 updates coming in from Avenue Supermarts as well as Nykaa as well. DMart was actually lower. It ended lower, largely because, the company reported 13% standalone revenue growth. Now, if you compare it with the 3-year CAGR, it has been about 16%. Or even if you look at year on year, the number of stores that they added was about 14% higher. So what this basically means is that if your revenue has grown 13% and your store count has grown 14%, then it could be an implied negative same-store sales growth. The stock ended lower, but did not fall off the cliff for two reasons. One, it has been an underperformer. Second, between last third quarter and this third quarter, the realizations were possibly lower due to GST cuts, especially given the assortment that DMart sells. On that, we've seen big cuts because of GST 2.0. So lower prices would have meant lower revenue as against lower volumes. So to that extent, watching the operating performance, the assortment mix, and the kind of outlook that the company has on store opening will be crucial, because the only silver lining in this update was that the company opened 10 stores this quarter, which on a 9-month basis also is higher than the same time last year. The other stock, on the other hand, is Nykaa. That did well because for the last many quarters, the company's been outperforming. This time around as well, consolidated gross merchandise value, net sales value, all of them grew in late 20s, above 27% that is. And that's led by both beauty and fashion business. So if you look at the beauty business, there too, the net sales value grew at the upper end of mid-20s. And the fashion business that turned around last quarter continues to do well, and that sustains its growth as well. The third quarter typically fairly strong for Nykaa given the festive season and the wedding season as well. So fashion business, beauty business, both of them doing well for them means that the stock ended about 2% higher. The only thing that we need to watch out for Nykaa going forward is how the operating performance of the fashion business comes by as well, because in its last communication to investors, it did indicate that this business may perhaps turn around in the financial year that we are currently in. Now that we know about these fundamentals, let's go across to Jay once again. Jay, do you have a chart check on Avenue Supermarts and Nykaa? Because Avenue Supermarts has been an underperformer, but in the past, wealth creator, whereas Nykaa has been a bit of an outperformer in recent past, but over a longer period of time, wealth destroyer.
Absolutely. In fact, Mangalam, I would say that it's been quite a while that, we have seen DMart, in fact, consolidating since, October 21. The stock has been consolidating now, and it's heading towards the lower end of the range, which comes to around 3,400 rather, I would say. So another 5 to 6% kind of a fall, if at all, there is in the DMart, or that is Avenue Supermarts. I think it should be a very good buy from the point of view of risk reward, because we haven't seen this stock, in fact, breaking 3,200, 300 in this past couple of years. And it's been a long consolidation, Mangalam, which we have seen. And generally, post this kind of consolidation, we see there is going forward a long or a bigger outperformance as well. So I think this could be the last leg down of Avenue Supermarts. And I think 34 to 3,500 should be a good bet. On the long side, we have seen good short build up out here. So initial move on the upside would be because of short covering, but following which we would see the long build up as well. So now the stock is heading toward a good risk reward long side kind of a bet levels. And Nykaa, you are right that earlier it had been a well destructible story, and gradually we have seen good long build up, Mangalam, happening in this stock. However, there has been some profit booking, but then since the stock is holding its a 20 weekly moving average quite well, that is the 20 weekly exponential moving average, I think till 250 levels are held in the near term, the stock is likely to range towards the levels of 300 plus.
All right. But, let's take a look at the IT sector as well. Now, shares of HCL Tech declined 2% after CLSA downgraded it from outperform to hold. The brokerage firm also expects soft earnings from the IT pack in the third quarter. Reema Tendulkar joins us now with all of those details. Reema?
So ahead of the earnings season, CLSA has come out with a note where they recommend reducing positions in the Indian IT sector on account of two reasons. One, the Indian IT sector did well in the October to December quarter, that's Q3. The Nifty IT index was up 14%, outperforming the benchmark index, which gained 4%. And secondly, Q3 is generally a soft quarter on the back of seasonality and furloughs. So that's the big call, that reducing positions in Indian tech sector. Secondly, they've also downgraded HCL Tech from an outperform outperform to a hold and downgraded Tech Mahindra from a high conviction outperform to an outperform. So they basically removed Tech Mahindra from their CLSA high conviction list. Now for Tech Mahindra, they're saying the revenue growth seen pick up in the last 1.5 years is not commensurate with the turnaround that the street had, the consensus expectations after the new CEO came on board. In HCL Tech, they believe valuations are fair. Stock is already trading at a 5% premium to Infosys and TCS. Persistent and Coforge are CLSA's top picks in the mid-cap space, and Infosys and Tech Mahindra in the large-cap pack.
All right, Rima, many thanks for those details. Ambrish, you know, the IT index was the largest underperformer in 2025, right? It was probably one of the few indices that ended in the red. How do you see that IT pack in 2026?
I think the next 1 or 2 quarters will continue seeing subdued performance. I don't really see a valuation uptick. So I would not surely give a sell at this point of time, but to buy, I think one needs to wait for at least another 2 or 3 quarters more.
All right, you'll wait a couple of quarters more for a buy, but you won't yet give a sell after this underperformance. Jay Amrish, thank you so much for joining us and adding your values, giving your valuable insight on stocks, sectors, as well as the index levels. With that, we'll take a short break, come back on the other side, get you all the top corporate voices along with the key market events to watch out for in tomorrow's trading session. Stay with us.
Welcome back. You're still with us on Markets Forward. Onto the big corporate voices of the day. Hindustan Petroleum expects its EBITDA to double over the next 5 years while continuing to deleverage its balance sheet. Speaking to CNBC TV18, Chairman and Managing Director Vikas Kaushal added that the company's new bottom-of-the-barrel conversion facility is expected to boost refining margins by over $2.5 per barrel.
We also had the Yes Bank CEO Prashant Kumar join us here on CNBC TV18. He said that the third quarter numbers are actually aligned with the company's strategic objectives and the bank does remain positive on FY26. He highlighted broad-based demand across corporates, improving private capex trends and continued strength in rural consumption.
Piramal Finance is confident of future growth with no immediate plans for divestments. Speaking to CNBC TV18, MD Jairam Sridharan said the company expects assets under management to grow over 25%, with NIMs reaching 7% by FY27, supported by higher credit ratings.
Right, we told you what the market experts are making of the big moves today and also what the corporates told us here on CNBC TV18. And now, just before we wrap, let's tell you all the key market events that you need to keep an eye out on in tomorrow's trading session. For that, let's go straight across to Gaurav, who's standing by on the wall.
Well, yes. First, let's talk about some of the geopolitical issues that we have seen and some developments around that. Tomorrow is the day when Venezuela President Mr. Maduro is scheduled to appear in Manhattan Federal Court. That is something that we will be watching out for. And other than that, we've got Zelensky and European leaders who will be meeting in France. So that is also something, a key thing to watch out for tomorrow. Other than that, from the macro point of view, the S&P Composite PMI final number will come for the US market. So that is something, let's track that as well for the US market. And from the Indian market, let's not forget about it's Tuesday. So it is going to be the expiry day for Nifty and Bank Nifty. And other than that, we are also going to get some results in the likes of GM Breweries and Viji Finance. So it is still very light day for results going ahead, but we are going to get these companies tomorrow. Other than that, let's focus on Adani Enterprises because company is going to launch its 1,000 crores NCD with green shoe option. And lastly, let's also not forget about IEX. Now, the market coupling case that we have been seeing, tomorrow is the day when APTEL, which is Appellate Tribunal for Electricity, now they are going to hear this case further. So let's watch out and let's see if any material development comes out from this hearing and if anything which is shaking the IEX stock tomorrow.
Take that point already. A big move on IEX on either side of that appellate tribunal decision would come by. And GM Breweries, you spoke about, the stock's been doing well ahead of numbers. Let's see how those pan out as well. But above everything else, Aru, we will be watching out for how the US markets perform today because it'll be the first trading session post the developments that took place over the weekend with Venezuela. With that, we'll wrap up.
Yes, absolutely. And that's a wrap on this edition of Markets Forward. And we will be back with more news and updates on the other side. Stay tuned.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Venezuela's interim president Rodriguez offers to collaborate with Washington less than 48 hours after the U.S. forces extracted Maduro and his wife from the country. The captured leader is set to appear in a New York federal court to face charges of narco-terrorism. Oil prices inched higher after a weekend sell-off. Russia, China and major Latin American nations slam Maduro's capture, call Washington's move a violation of international law. The UN Security Council will hold an emergency meeting at Beijing's insistence. G7 allies largely toe the US's line. India expresses deep concern, calls for peace in a carefully worded statement. A majority of market participants expect 10 to 20% Nifty returns in 2026 as per a CNBC TV 18 poll. Financials emerge as the top sector, followed by metals. That's a CNBC TV 18 exclusive. Leading economists expect India's growth to pick up to 7.5% this financial year, with steady consumption and government capex adding wind to the sails. But caution that global headwinds may bite next fiscal. Economists also expect India's fiscal glide path to remain on track, see the rupee hovering around 92 to the dollar by FY27. Amidst a raging debate on gig workers, a stress test of the quick commerce business model points to a fragile ecosystem. Gig workers can be paid more provided certain scenarios play out and the average order value sees a sharp rise. The Supreme Court denies bail to Omar Khaled and Sharjeel Imam in the 2020 Delhi riots conspiracy case. Both have spent over 5 years in jail without trial. The court says the period of incarceration is substantial, but it has not crossed constitutional limits. 5 others accused get conditional bail. The souring diplomatic ties between India and Bangladesh spills onto the cricket field. Bangladesh refuses to play the T20 World Cup in India, bans the broadcast of the Indian Premier League. This after Kolkata Knight Riders released Bangladeshi cricketer Mustafir Rahman after a nudge from the BCCI. Well, let's start Monday afternoon with the day's market action. The markets failed to hold on to levels that were around record highs, with the Nifty ending below the 26,300 mark, finally closing flat, about 78 points lower. The Sensex down 300 points. The Nifty Bank also a flat close there, a 100-point cut finally. And the Nifty Midcap Index, similar story playing out there. All indices closing in the red. HDFC Bank dipped over 2% today. IT stocks were also under pressure, while defense and FMCG stocks ended the day higher. That was the picture as far as the markets were concerned. But how will the Lal Street fare in the new year? CNBC TV 18 has polled top investors to gauge the market's mood. A majority of the participants that we spoke to expect 10 to 20% returns on the Nifty in 2026. Sonal is standing by with the highlights of the big CNBC TV 18 market outlook poll. Sonal.
We reached out to 50 market experts across funds, brokerages and financial institutions. Here's what the street really thinking about 2026. So let's start with returns. The mood is positive, but it's not euphoric. Over half the experts expect the Nifty to deliver 10 to 20% returns next year. Around a third are more conservative and see 0 to 10%, and only a small minority is worried about a negative year. So optimism is there, but expectations are grounded. Now, where should investors be positioned? The clear preference is for large caps. Around 41% of experts say large caps offer the best risk reward in 2026. This despite the sharp underperformance of mid and small caps in 2025. Mid caps and small caps still find support, but enthusiasm clearly tapers off as you go lower down the market cap curve. Micro caps do not get a single vote. Sector-wise, there is one standout. Financials lead the pack, with half the experts backing the sector. Metals and other pockets also find favor. Tech and pharma, though, remain selective bets rather than broader calls. So what really drives the market in 2026? The answer is very clear. Earnings. Nearly 2/3 of experts say earnings growth will be the single biggest driver for markets next year. Trade deals and geopolitics matter, but fundamentals are back at the center of the story. On the India-US trade deal, the street is quite decisive. More than 3/4 believe a deal comes through in the next 3 months. No one thinks it gets pushed out beyond this year. What about commodities now? 2025 was a big year for gold and silver, but the street does not believe that outperformance will continue. Copper and aluminium are the top picks for 2026. a clear reflection of infrastructure, manufacturing and energy transition themes. These are what markets are betting at. Now to the risks. The word that keeps coming up are geopolitics, the US market, concerns around AI and Donald Trump's policy stance. Global cues clearly remain the biggest swing factor. And finally, budget 2026. What is the one big thing to watch? Taxes and spending. The street is watching closely for any tinkering in capital gains, possible changes in STT, STCG and LTCG, and higher government spending to support growth. So what is the takeaway? 2026 looks like a year of steady earnings-led returns, less noise, more numbers, and a market that rewards patience over excitement.
All right, Sonal, many thanks for joining us. That is the big CNBC TV 18 poll. 10 to 20% returns is what the market hopes for, is certainly betting on for the year ahead. Let's talk about commodities now. Crude oil prices inching higher. This after witnessing a sharp sell-off over the weekend following the US's capture of Nicolas Maduro, the president of Venezuela. President Trump claims that US will run the country, at least for now, and has cited potential revenue from oil that will offset any expenses that it will incur in administrating Venezuela. Trump said the US will, and I quote, take back oil from Venezuela, and major oil companies will spend money to build infrastructure. But oil companies are yet to comment. Venezuela is home to the world's largest known oil reserves of more than 300 billion barrels. It is more than Saudi Arabia, Iran, or any other major oil-producing nation. But the country lacks oil infrastructure to ramp up output. All the oil fields in Venezuela were nationalized 2 decades ago by its former president, Hugo Chavez, forcing U.S. companies out of the country. Venezuela is currently producing only 1 million barrels per day, which ranks it 18th in the world and far below top producers like the U.S., Saudi Arabia and Russia. Now, current oil production from Venezuela is down 2/3 of what it was 2 decades ago. Oil analytics firm Kepler estimates that investments of over $160 billion will be needed to bolster the output of Venezuela to nearly 2 million barrels per day over the next 3 years. Oil analysts also say that U.S. firms will be keen to enter Venezuela, but no company is jumping at the opportunity just yet.
US companies, if you've seen of course, they'll be interested in going back, but nobody's really jumping on this simply because it is a really big undertaking. Every single layer of it, right? Because you have to rebuild from scratch. Also, let alone the fact that so many personnel have left. They have a massive brain drain as well.
And the developments in Venezuela and the U.S., that is the big story this evening. Deposed Venezuelan leader Nicolas Maduro will appear in a New York City courtroom today. This after he was captured by U.S. forces. The 63-year-old and his wife have been charged with providing support to major drug trafficking groups. President Trump has continued to reiterate that America is in charge of Venezuela. Venezuela's interim president, Delcy Rodriguez, who initially attacked the Trump administration over Maduro's capture, has softened her stance, calling for cooperation with the U.S. This after Trump warned of a second military strike if the interim leadership does not comply with American demands. China has condemned the U.S. attack and called for an emergency meeting of the UN Security Council, which will take place this evening. China is the top buyer of crude oil from Venezuela. Russia echoed Beijing's sentiment and asked the U.S. to rethink its action and release Maduro. The reaction across Latin America has been mixed. Brazil's President Lula da Silva has said the act crossed an unacceptable line, while Mexico said it was a violation of the UN Charter. Countries like Argentina and Chile have supported the U.S. Argentinian president has called the strike excellent news for the field world. G7 allies largely towed the U.S. line. India has expressed deep concern over the development in Venezuela in a carefully worded statement and has called for peace.
All Venezuelan military capacities were rendered powerless as the men and women of our military, working with U.S. law enforcement, successfully captured Maduro in the dead of night. We're going to run the country until such time as we can do a safe, proper, and judicious transition.
This is not an invasion. We didn't occupy a country. This was an arrest operation. This was a law enforcement operation. He was arrested on the ground in Venezuela by FBI agents, read his rights, and removed from the country. I encourage everyone, I know it's Sunday, people are busy, but the indictments have now been unsealed. People should read this indictment. They should read this indictment. They should read what this man did for the last 15 years of his life against the United States.
Venezuela's toppled leader, Nicolas Maduro, was in a New York detention center on Sunday, awaiting drug charges. That's after President Donald Trump ordered an audacious raid to capture him, saying the U.S. would take control of the oil-producing nation. The image of the 63-year-old Maduro blindfolded and handcuffed en route to the U.S. has stunned Venezuelans. It was Washington's most controversial intervention in Latin America since the invasion of Panama 37 years ago. Maduro is due to appear in a Manhattan court on Monday.
Good night. Happy New Year.
While many Western nations oppose Maduro and say he stole the 2024 election, there were many calls for the U.S. to respect international law and resolve the crisis diplomatically. There were also questions over the legality of seizing a foreign head of state. Democrats say they were misled at recent Congress briefings and demanded a plan for what is to follow. At home, Maduro allies were still in charge and have denounced what they call kidnapping as part of an imperialist oil grab.
Meanwhile, Denmark's Prime Minister has urged President Trump to stop threatening to take over Greenland. This comes after President Trump reiterated his wish to take over the country during an interview to The Atlantic magazine. In a statement, the Danish Prime Minister said, and I quote, "It makes absolutely no sense to talk about the U.S. needing to take over Greenland. The U.S. has no right to annex any of the 3 countries in the Danish kingdom," end of quote. Ukraine's claims that Russian forces killed 2 people in an overnight attack on Kyiv. These are the first casualties in the capital in 2026. Russia's military also carried out drone attacks on northeastern Ukraine, killing at least 2 people in the Sumy region. Ukrainian President Zelensky has claimed that Russia launched more than 2,000 air attacks on his country during the first week of the new year. And President Trump has dismissed claims that Ukraine attacked President Vladimir Putin's residence. Trump said that although something happened near Putin's residence, U.S. officials found that Ukraine did not target it after reviewing the evidence. This comes after Trump initially accepted the Kremlin's version of events at face value. The Yemeni government, troops backed by Saudi Arabia, have retaken multiple cities from the UAE-backed forces in the southern parts of the country. A safe corridor has been designated for the rebel forces to withdraw. At least 80 rebel troops have been killed in fighting with Saudi-backed forces in the last 3 days. North Korean leader Kim Jong-un oversaw the test firing of the hypersonic missiles. Yesterday, the missiles struck targets about 1,000 kilometers away from the sea east of North Korea. The launch followed a North Korean statement on Sunday denouncing the U.S. strikes on Venezuela as a violation of that country's sovereignty. And more from President Trump. He's warned India over importing oil from Russia yet again. Trump has said the tariffs imposed on India can rise very quickly, quote unquote, if New Delhi does not cooperate with Washington on Russian oil. Trump also said that India has reduced oil imports from Russia because they wanted to make the Trump administration happy. Standing beside the U.S. President, U.S. Senator Lindsey Graham claimed that the Indian ambassador Vinay Quatra asked the U.S. government to relieve the 25% additional tariff imposed on India for buying Russian oil earlier.
If you're buying cheap Russian oil, keeping Putin's war machine going, we're trying to get the president the ability to make that a hard choice by tariffs. I really do believe that what he did with India is the chief reason India is now buying substantially less Russian oil. So I hope we pass this bill soon. And after this...
They wanted to make me happy, basically. He wanted it. Modi's a very good guy.
Yes.
He's a good guy. He knew I was not happy, and it was important to make me happy. They do trade. And we could raise tariffs on them very quickly, and it would be...
People are afraid of that.
Well, that's President Trump once again reiterating his tariff threat on India. We'll take a break, but up next, amidst a raging debate on gig workers, a stress test of the quick commerce business model points to a fragile ecosystem. That and more when we return. Demands for higher payouts by gig workers has been met with pushback from quick commerce companies, and this has opened up a national debate on the business model and the perceived exploitation of these workers. It's a debate as old as time, of profits being put above people. Manglam Malu dissects the prevailing business model to understand how it works, who gets paid how much, and whether the model can survive higher payouts to gig workers. Take a look.
At a 600 rupee average order value, the platform actually makes a revenue of 120 rupees, fulfillment cost is 132 rupees, and they make a contribution loss of 12 rupees or a negative contribution margin of 2%. That explains why the average order value is everything in this business. At around 700 rupees, as you can see, the model finally breaks even around between 700 to 750, as you can see, and thereafter, there is contribution margin positive that comes in for these companies. Now let's talk about the quick gig worker. A quick commerce delivery partner typically earns about 40 to 50 rupees per order on quick commerce, and food delivery, which pays a little more than quick commerce per order, covers longer distances. So to that, what really matters is the earnings per hour, which could be between 70 to 20 after you account for about 20% in terms of fuel and other expenses. So for average work of around 9 to 10 hours per month and 25 to 26 days per month, we have an average monthly income of gig workers between 16,000 to about 31,000 rupees per month, which is actually slightly higher for a flexible work with earnings that are better than available alternatives. So what makes or breaks this model? The biggest revenue drivers, as we spoke, are average order value or the gross margin or take rate that these companies make. On the other hand, the biggest draggers are the rider payouts and dark store inefficiencies. Free deliveries and aggressive discounting also matter because they directly hit contribution margins, and in a competitive scenario, that's something that we will be monitoring. And here's the actual pressure point, which is the rider payouts. The business model is extremely sensitive to that. As you can see, at current costs, at 600 rupees, most of them are making contribution losses. But as you move ahead, 700 rupees of average order value, it is breaking even. But if 50 rupees moves into 60 rupees, if you look at the next plate, you would see that the average order value for you to be contribution positive or break even moves from 700 rupees to 800 rupees. And that's not all. Another hike of 10 rupees from 60 to 70 pushes it by about 1,000 rupees. So that is where the debate matters, because gig workers are not just a cost line, their earnings per hour determine efficiency, engagement, and long-term sustainability. The next time you place a quick commerce order, think about your basket size, the cost of fulfillment, and maybe ask your delivery partner how their day is going. That, in many ways, is the real anatomy of quick commerce.
All right, Manglam, many thanks for joining us. Now, after sparking panic in the cargo industry, the Mumbai airport says cargo operations will not be brought to a complete halt later this year. The airport had earlier said cargo flights will be impacted for 10 months, starting August of 2026, due to infrastructure upgrades. Madhiya is here with the details. So, Madhiya, what is the latest now? Will cargo operations continue in some form or fashion, or won't they?
What triggered the panic in the cargo industry was a letter sent by Adani Airports to airline partners on the 11th of December 2025. In that letter, Adani Airports informed airlines about major airside infrastructure works, including runway carpeting, construction of a new taxiway, and reconstruction of Apron G, the only apron used by dedicated freighter aircraft, the cargo aircraft. The letter said this would require demolition of existing cargo infrastructure and that freighter operations cannot be accommodated from August 2026 to May 2027. While the letter did not explicitly say that the cargo terminal would shut, that wording of demolition of existing cargo infrastructure set off alarm bells across the cargo ecosystem. Industry bodies and freight forwarders started warning that without freighter access and cargo infrastructure at the same airport, Mumbai would become unviable for cargo operations, triggering fears of a de facto shutdown at one of India's most critical cargo gateways. The Air Cargo Agents Association of India flagged a lack of clarity on sequencing, mitigation, and transition plans, warning of what it called a systemic capacity shock. Freight forwarders said customers were already discussing shifting their cargo to alternate gateways like Delhi, Bengaluru, Goa, and the neighboring states.
raising concerns over higher logistics costs and also a delay in processing of shipments. Now, responding to these concerns, Adani Airports has issued a clarification to CNBC TV18. The airport operator says that reports of a full cargo shutdown are incorrect. It has clarified that only dedicated cargo freighter operations will be temporarily suspended, while overall cargo movement at Mumbai Airport will continue. They say that with around 65% of the cargo already moving through the belly space on passenger flights, the belly space where even our baggages go, that also has enough space to carry the cargo. So Adani Airports also says that it is working closely with freighter operators to ensure that no freighter capacity moves out of the Mumbai region, pointing to new capacity coming up at the Navi Mumbai International Airport. And that also is a catch here because Adani Airport says that it will add 5 lakh tons of capacity per annum. But suddenly moving the cargo to Navi Mumbai, while the ecosystem of cargo operators is around the Mumbai airport, will again mean the same challenge. And that is what the freight operators are worried about.
All right, Madhiha, many thanks for joining us. Staying with aviation, the Minister Ram Mohan Naidu says the government does not want to disrupt IndiGo's operations in places where the airline is the sole provider of connectivity. Speaking with Madhiha, Naidu added that the government is reviewing the report on IndiGo's flight cancellations and will take appropriate action soon. Listen in.
Trading the capacity, we have already done it. And it is not with the idea of restricting connectivity because we are making sure that wherever IndiGo is giving connectivity solely, we don't want to disrupt those operations because ultimately connectivity should prevail. On top of that, where they might be doing multiple routes, that is where we want to do the curtailment. And the idea here is also give that kind of encouragement to other airlines to explore those operations. So we are encouraging other people so that the competition is also maintained in the sector. And regarding the actions taken, we are deeply going through the report and very soon we are going to take action.
Well, that's the aviation minister. In court corner, the Supreme Court has granted relief to Adani Power in a 15-year-old dispute with the centre over the payment of customs for electricity supplied from Mundra's SEZ. The top court has said there will be no customs payable by Adani for power generated from the Mundra Special Economic Zone and transmitted to domestic tariff areas outside the SEZ. The court has directed for a refund of around 500 crore rupees, customs dues already paid by the company. So that's a relief there for Adani Power. The Supreme Court has denied bail to Omar Khalid and Sharjeel Imam in the 2020 Delhi riots conspiracy case. Both have spent over 5 years in jail without trial. The court said the period of incarceration is substantial, but it has not crossed constitutional limits. 5 others accused have managed to get conditional bail. Meanwhile, Dera Sacha Sauda chief and rape convict Gurmeet Ram Rahim walked out of a Haryana prison after being granted 40-day parole yet again. This is the 15th time he's been released since his conviction in 2017. He was last granted parole only 5 months back in August. The souring diplomatic ties between India and Bangladesh spill onto the cricket field. Bangladesh refuses to play the T20 World Cup in India and bans the broadcast of the Indian Premier League. This after the Kolkata Knight Riders released Bangladesh cricketer Mustafizur Rahman after a nudge from the BCCI. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a moment with the mega CNBC TV 18 market poll.
Cool.
Hello and welcome to this special Outlook 2026 on CNBC TV 18. Well, we're going to decode what lies ahead for Indian markets, economy and more. Before we get started with our guests on the program, let's go across to Mangalam Malu, who's standing by with the results of the mega CNBC TV 18 market poll. Mangalam, take it away.
Well, you know, as we do at the start of every year, we poll a bunch of experts, the market makers, the decision makers, and all of them on what their outlook for 2026 is. And this time as well, we reached out to 50 experts across funds, brokerages, financial institutions, and this is what the street is really looking at. Last year was a 10% return for the frontline index. Dollar adjusted, it was mid-single digits and a serious underperformance as compared to the world. So we started with what the street is expecting in 2026 for Nifty returns. About 55% said 10 to 20%. About a third of them said 0 to 10%. And very few expect a negative return. So the street is expecting some optimism, but expectations are fairly grounded. The second part, where should investors be positioned? Should it be large caps, mid caps, small caps, or micro caps? Remember, last year, mid caps and small caps were serious underperformers. But this time, preference for large caps is fairly high. 41% of experts say large caps still offer the best risk reward. This despite the sharp underperformance that we saw in mid and small cap indices in 2025. More than that, you know, the street, while it is positive on mid and small cap, as we move lower down the market cap, we see the enthusiasm clearly tapering off with literally no one vote coming in for micro caps. If you look at the sectors as well, you know, financials have been the favorite for all the market experts we speak to on the channel, while some also speaking about tech and pharma as contra bets. But this time around, if you look at the results of the survey, nearly half of them are still pinning their hopes on the financial space, with metals and other sectors also finding some favor. Tech and pharma still, however, remain selective bets rather than broad consensus calls. What could be the driver of the market in 2026? Will it be geopolitical, India-US trade deal, earnings, or others? Well, while everyone talks about India-US trade deal as of now, earnings, that's something that will be the biggest driver of the market. Nearly two-thirds of the experts say earnings will be the single biggest determinant for markets next year. Trade deals and geopolitics, yes, they do matter, but fundamentals back at the center of the story. And speaking about trade deals, on the US-India trade deal, the start of last year, everyone was fairly optimistic. That didn't happen. This time around as well, you know, people are fairly optimistic. Nearly two-thirds or three-fourths of them believe that the deal will happen in the next 3 months itself, with some expecting within 6 months. In fact, no one thinks it is not likely this year. So that's the one thing that we have to monitor in 2026. What about commodities? Last year was big for both gold and silver. The street believes that that outperformance may perhaps not continue. They're betting on what? Copper and aluminum. Copper and aluminum, nearly 68% outperformance, 18 and 13% for gold and silver. This is a clear reflection of infrastructure, manufacturing, energy, transition themes that are taking place. What are the risks now? These are qualitative questions that we ask them, and the most used or frequently used words that came in terms of biggest risk to equities next year: geopolitical developments, the US markets, concerns around AI. Will that bubble or trade unravel? And Donald Trump's policies. That is something you can never take off the table. And clearly, the biggest swing factor when it comes to budgets, that's the one thing that we ask at the start of every year. What are the things that they will be watching out for in terms of announcement coming in? And here too, the market wants a couple of things. They don't want much tinkering with capital gains taxes. That's exactly what they're expecting. A fiscal stimulus coming in to boost consumption, higher government spending, and no removal or changes in STT, STCG, or LTCG. So those are a bunch of important, insightful data, opinions, and expert calls coming in for 2026. The big outlook, the CNBC TV 18 poll, it looks like a year of steady earnings-led returns, less noise, more numbers, and a market that rewards patience over excitement.
Mangalam, thanks very much for that. Joining us now on the program are Ikagai Asset Managers is Pankaj Tibrewal and Demeter Advisors is Ashwini Agarwal. We're going to talk about what's ahead for the markets in 2026. So I'm going to start off with a poll of market participants on Nifty returns for 2026. Our poll showed that a majority expects 10 to 20% return this year, that is 2026. Around 32% expect returns ranging between 0 to 10%. And what we're going to do, Pankaj and Ashwini, is go over the poll quickly, and ask you whether you agree with the findings of this poll. And maybe on the second half, on the other side of this, we can discuss some of those reasons in greater detail. Pankaj, let me start with you. Do you agree?
I think I'll be more in the camp of 10 to 20%, in the sense that we expect earnings to start improving from 27 onwards, which is FY27. FY26 was a digit earnings growth for Nifty, and that should be helped by banking, autos, and some of the other sectors. And we believe that FY27, we should look at about 12 to 13% earnings growth. And in that sense, our sense is that market finally should track the earnings momentum as you move into FY27. So my bet will be on the second part between 10 to 20%.
Okay, all right. Hi, gentlemen. Good morning and good to see you all in. Well, Pankaj, I want to quiz you about a couple of sectors, and very few people were positive on metals as a counter call at the start of last year. But I recall you telling me that. And you came on the channel numerous times, you said metals, that's the counter call that we have. You're bang on. Now, the question is there more to go?
I think absolutely. We believe that the broader commodity cycle is starting to unfold itself. And it's not driven by anything on demand supply only. It's also geopolitical. Don't forget that the supply of commodities has been in very few hands. And all the incremental changes which are happening globally, whether it be AI, EV, or new tech, all require commodities which are very supply concentrated in few countries. And these countries are using commodities as a geopolitical tool for negotiations. So we believe that it will be a new cycle which will be unfolding in front of us. We have seen that in the form of gold and silver last year. It's spreading across broader commodities now, especially non-ferrous. And over a period of time, ferrous should also see some momentum coming in. So our broader call remains that metals should be one sector which should be part of the portfolio as you move ahead.
Got that? No, absolutely. Let's just go through a few more of our poll questions before I can ask you your specific ideas, etc. So let's just put up question 2, right? Which is the category to bet on in 2026? And just quick answers, and then we can discuss these. Large caps, mid caps, small caps, or micro caps. 40% said large caps, and about 32% said mid caps, 27% small caps. But large caps is top of the list. Pankaj?
So Prashant, I'll just take 2 minutes to explain.
I will come back. I want to, because there are 10 questions. I want to just quick answers, and then I'll come back to you.
Yeah, my bet will be mid and small caps combination of that.
Okay.
From bottom-up perspective.
Ashwini?
Agree with that view. I will also be in the camp of mid to small caps, bottom up.
Okay. The third question, sectors to bet on, right? And there was financials, tech, pharma, capital goods, metals, etc. 50% basically saying financials. The others are tech, pharma, capital goods, metals. Pankaj?
I'll add 2 more sectors to it, which is not the flavor of the season right now. One is consumer durables, and the second is chemicals.
Consumer durables and chemicals. Ashwini?
I agree with the view that financials will continue to do well this year. I think a lot of the underperforming sectors from last year, some names in the consumer sector, some names across the board, I would.
Your newsletter as well. Ashwini, coming across to you, this is going to be a difficult one. But by when do we see a India-US trade deal? We thought we'll be first. We're still waiting by. Do you think it's in 3 months or 6 months?
Nigel, I have no idea. I would bet on 3 months. That's my hope, but it's a hope. There's no clarity on this at all.
Difficult one, Pankaj, to you though. I'm hoping it's in the next few days. What do you think?
Beyond our pay grade.
Okay, 77% of those polled up on your screen say perhaps in the next 3 months. I mean, that's expectation. But markets are made up of all kinds of expectations. But this is the one. Like question 6, right? Top commodity asset class. Gold and silver did phenomenally well. The graphics will come up. Copper and aluminum. 68% said copper and aluminum is the commodity asset class for 2026. Pankaj?
Completely agree to that. And also will add the other bulk commodities like iron ore and coking coal. I think incrementally you will see every nation negotiating with the globe on commodities they are strong in. So I think we are entering into a cycle where geopolitical, repercussions will be very huge, and that will weigh on commodity price.
Ashwini?
Agree with that. Copper and aluminum. My sense is that real assets will see appreciation this year. A throwback to global uncertainty, which typically helps people focus more on real assets.
Okay. The one big announcement to watch is the question that we asked. That is capital gains, fiscal stimulus, something to do with STT, STCG, or is it higher government spending and the results will come up? Pankaj, what would you say?
So if you ask me one risk which investors should be prepared for in 2026 is the global debt and deficit. I think very few will recognize that global debt has now moved to $346 trillion, and it is increasing at a pace of $660 billion every week. And that's something which is insane. In my view, at some point of time, if foreigners decide not to fund any more of US treasuries and the US yield starts to spike up, I think that's a very big risk investors are carrying into 2026.
And the budget, Pankaj? One big announcement?
Budget, I think budget, as the government has shown in the last budget also, should not be negative. I think it should be positive, and the feedback which has gone from the marketplace that please support the domestic investors. So I don't think anything negative should be coming out in the budget.
Ashwini, what about you? Budget?
I'm hoping that we'll hear more noise on privatization, which will release resources for the government to invest into infrastructure. The spending has become more consumption-oriented and less investment-oriented, which worries me. And I'm hoping that privatization will provide the resources to change some of that.
Well, time for a quick commercial break. Don't go anywhere. We're right back on Outlook 2026. Welcome back. This is Outlook 2026. You heard the mega market poll that we conducted. Lots of questions, lots of answers, but some clarity shining through. Pankaj, let me come back to you. I promised you I'll come back to you on your rationale. You always work with lots of data. And you had, on that question on mid-caps, small caps doing well, which is what your bet is for 26, right? Go on. Just explain that point briefly.
So, Prashant, if you look at last year, though the indices showed you single-digit gains, but the breadth of the market has been extremely poor. And this kind of a breadth I am seeing after almost 5-6 years. 18-19 was that kind of a year which we saw last year. And just to put two data points in perspective, though the NSE 500 is almost at a touching distance of 52-week highs, but if you look at the median drawdown, it's about 20%. And also the divergence between the indices have been very huge. So let's, for example, take the Nifty Midcap Small Cap 400, which is 250 of small cap, 150 of midcap. The indices since October 24 has given a headline returns of almost 2%. But the median return of that indices is negative 6.5%, which means a divergence of about 8%. And that is not only this index. You look at any other index, that's the similar story. And if you do an equal weighted index of NSE 500, it's negative 3% for the year, calendar year 2025. So the point is that very narrow leadership has taken the index higher. And our sense is that if earnings momentum starts to improve, which we are seeing for the last couple of quarters, we will see the broad basing of the market. And hence, you should see many mid-cap and small caps which have been delivering strong growth with balance sheet and cash. But only caveat which I would like to pick is, it won't be a runaway rally for the last 4 years which we saw post-COVID. I think it will be very bottom-up. Please don't forget the basic hygiene of balance sheet, cash flows, good promoter, good businesses. I think people should not chase too much of narratives. I think that can fall flat in 2026 because it will be a volatile and unpredictable year.
Okay, all right, Pankaj, quick fire to you then. Will India outperform in 2026?
My hope is yes, that after almost we saw the worst performance against emerging markets since 1994. We have underperformed by 28%. India is completely out of flavor. You speak to any foreigners, they will give you meetings just for relationship. But when India comes in, they have zero interest. I think that's a very, very big contrarian indicator that FIs, if something goes wrong globally in terms of AI valuations, US markets, I think India will find its flavor back among FIs.
And broader markets outperform the headline index in India?
I hope so. And but I will say that it will be a bottom-up stock pickers market. You have to pick your bets very, very, carefully. It will not be a runaway rally which we saw from 2020 to 2024.
And is gold closer to the peak? And between the two, gold or silver, what do you like?
I think geopolitical, this kinds of events will make sure that gold and silver both are bidding out.
Okay.
But there's such a sharp outperformance. Don't forget that we have seen sharp drawdowns in the past also. Okay. So investors should brace themselves for frequent, very sharp drawdowns as well. So don't, if you have an asset allocation process, just follow it. Don't get overboard on it.
And you were positive on metals, I recall, and auto ancillaries. And some of the stocks have started doing well. Would they qualify as the top themes for 2026?
I think precision engineering as a theme will be one of the biggest themes to bet in India. Globally, most of the large OEs, whether it be Airbus, Boeing, defense companies, are looking at these companies. And most of the auto companies, a few of them, are pivoting themselves from pure auto to industrials and precision engineering in these sectors. I think they can create huge value as you move into for the next 3 to 5 years. And few of the bets are part of our portfolio.
You want to name a few?
So we have been talking about, for example, Sansera. We have been talking about Happy Forging. And all these are through their capex, and incrementally the growth has started coming from aerospace, defense, industrials. And our sense is that many of them will see accelerated growth as you move ahead, because they are just pivoting them from a pure cyclical sector, which is auto, to other sectors which are more structural in nature from a growth perspective. So these are some of the names which are part of the portfolio. Don't take it as a recommendation to buy and sell, but we're just giving as a thought that precision engineering will be a great theme to play as you move ahead into the next 3 to 5 years in India.
I remember Sansera very clearly, Pankaj. I think was it about 1,100 rupees when you spoke about it, I think on the editors roundtable and maybe even earlier. So it's done well. Back to 1,900 rupees, I think almost at a new all-time high, I think, Sansera and others. So the theme is something you've been highlighting for a while. I just have one other sort of setup, and we'll just pull the graphics up in a bit. So while we do that, Ashwini, one sector, and which I think you track closely as well as textiles. And of course, I mean, it's been bombed out because of this India-US thing. I call Gokuldas the India-US trade deal indicator, and that's back at 750, almost 750. What's your sense, Ashwini? Any hope?
So there are two issues there. One is underlying US consumer demand, where I think there is some uncertainty. It's been surprisingly strong, notwithstanding all the anecdotal evidence one is getting about job losses and about inflation being higher than what is measured in official statistics. But, if that were to turn down for some reason in the United States, that's a risk, for the sector. The second thing is what's going on, with tariffs in other parts of the world and the deals that India is signing. I think, textiles as an export opportunity for India will continue to do well. I think the companies would be well advised to look for a global customer rather than be overly dependent on the US is my take. I remain reasonably constructive from a medium-term perspective because we really have, durable competitive advantage in this area. Yeah. And my belief is that, when stocks get sold down, they should be looked into and evaluations are appealing. One should be willing to purchase them. So in that context, if something's done poorly, that's always an opportunity to at least investigate, if not invest.
Yeah, no, absolutely. One other way, and there are so many ways in that sense to look at things, right? One, and Nimesh put this data out. He did this last year, I remember 2024, and he's done this on the editors roundtable last Friday. Simple thing. Look at the big laggards of the year gone by and see if some of them can flip on the other side of performance tables in the new year. So these are the biggest sectoral laggards of 2025. Real estate, 18% down for the year. The IT index is down 15%. And of course, I mean, there's other stuff as well. But these are the two big ones, right? 18 on lower on real estate, IT down about 15%. And then stock-wise, the biggest laggards. Trent is down 40%. But of course, I mean, Trent was up very big in 2024. So it's kind of flipped on the other side in 25. TCS down 22, ITC down 17, HCL Tech down 15, Wipro, Infosys, Power Grid are some of the other big laggards. And any cues from out of this which strikes you as useful, Pankaj?
So the way we have our framework, Prashant, is that we look at that demand is very hard to predict. Just to give you a data that 7 out of the last 11 years, India Inc. top-line growth has grown in single digits and lower than the nominal GDP growth. So top-line growth is becoming very difficult to predict. And hence we take a call on margins. And we look at sector by sector where the margins are at an almost all-time peak or where the margins are below their averages. And in that, the margins which are at all-time peak are sectors, for example, hospitals. Clearly, that sector has got re-rated significantly over the last few years. And margins, there is a risk on margins. But when you look at some of the other sectors, for example, consumer durable we spoke about, the margins are closer or below averages this year and the last year. There has been huge competition, weather has not supported. And the second is chemicals. After almost last 4 years of non-performance, margins are very, very low. So I think when trajectory starts to improve in these sectors, you can get earnings growth plus re-rating on multiples as well. So our bet will be that have this framework of margin and top-line growth. Top-line growth is difficult to predict, as we have seen in the last 7-8 years. I think what we can take a call is the margins. And I think in that's consumer durables, power, metals that way, that was the reason we were contra positive at the start of the last year. And similarly on chemicals, I think that story is yet to play out. But we believe that 2026, you could see some of the events unfolding itself, which will be positive for chemicals as you move ahead.
We have to wrap up on this edition of Outlook 2026. Ashwini and Pankaj, thank you very much for staying with us. Viewers, don't go anywhere. More news and updates on the other side.
Hello and welcome. You're watching News Center. I'm Parikshit Luthra. 2.5 hours. That's all it took United States Defense Forces to breach Venezuelan territory and successfully extract its president, Nicolas Maduro, and his wife from the presidential palace. The high-precision operation is the first of such a nature since U.S. invaded Panama to capture its leader over 3 decades back. Venezuela's interim president, Delcy Rodriguez, has offered to collaborate with Washington less than 48 hours after U.S. forces seized Maduro and his wife, Celia Flores. The captured leader will appear in a New York federal court to face charges of narco-terrorism. President Donald Trump said that the United States is in charge of Venezuela and will run the country until there is a judicious transition. However, Secretary of State Marco Rubio suggested that the U.S. would not take a day-to-day role in governing Venezuela. Rubio clarified that U.S. would continue to enforce the existing oil quarantine and push for policy changes. Trump also said U.S. will take back oil from Venezuela and claimed major oil companies will be spending money to build infrastructure.
All Venezuelan military capacities were rendered powerless as the men and women of our military working with U.S. law enforcement successfully captured Maduro in the dead of night. We're going to run the country until such time as we can do a safe, proper, and judicious transition.
Let's now focus on what it means for oil prices. A major shift was not expected because Venezuela is a member of OPEC, so its production is already accounted for there. Oil prices inched higher after a weekend sell-off. Venezuela is home to the world's largest proven oil reserves with an estimated 303 billion barrels. This is more than Saudi Arabia, Iran, or any other major oil-producing nation. However, the country lacks oil infrastructure needed to ramp up the output. Oil analytics firm Kepler estimates investments of over $160 billion will be needed to bolster the output to nearly 2 million barrels per day over the next 3 years. Now, let's understand what US's actions mean for Latin America and the world. Trump administration seems to be embracing its old policy of interventionism, making Venezuela's neighbors nervous. Soon after Maduro's extraction, Trump issued a warning to Colombia's president, saying he needs to watch his back. But Gustavo Petro gave a sharp retort, saying he's not a narco and is ready to take up arms to protect his country. Trump also claimed that Cuba was on the brink of collapse while accusing drug cartels of dominating Mexico, suggesting the U.S. may need to intervene in both cases. Colombia and Cuba and Mexico all have condemned the United States. Brazil went further, saying Washington had crossed an unacceptable line. Beyond Latin America, Trump has repeated threats to seize Greenland, raising fresh concerns among United States allies. Critics warn that such actions undermine the rules-based international order, potentially sending the wrong signal to Russia and China, as Moscow continues its military campaign in Ukraine and Beijing seeks to assert its claims over Taiwan. China and Russia called for an emergency meeting of the United Nations, alleging an act of aggression by the U.S. The question now is whether U.S. actions risk normalizing the use of force and eroding respect for international law. Joining us right now is Navteej Sarna, former Indian ambassador to the United States, the UK and Israel, and Deepak Bhojwani, former Indian ambassador to Venezuela and Colombia and Latin American countries. Thank you very much, gentlemen, for joining us. Ambassador Sarna, how does this help United States and Donald Trump at this point? Clearly, this is something that will create distrust among allies and even those in the Gulf. Even OPEC will not be able to believe Donald Trump or trust the U.S. under Donald Trump over the next few years.
Thank you, Parikshit. Pleasure being here along with Deepak. I don't think Mr. Trump is looking for approval from anybody. He has done what he's been wanting to do for several weeks and months. And as details of the very complex operation emerge, you can see that it's been in planning for quite a while. I think at a very quick analysis, this is something which he's implementing what he's called the Trump corollary to the Monroe Doctrine, or as people are now calling it, the Donroe Doctrine. Basically, that in the Western Hemisphere, he will do whatever he wants. And clearly, he's been wanting Maduro out not for the purposes that are there for public consumption, that is ensuring human rights and democracy, but essentially for the resources, which is essentially the oil resources. He's made it clear that they will run Venezuela, and I don't think he means it in day-to-day governance. He means it in the fact that they will run Venezuela's resources by sending U.S. oil majors back into that country. We'll have to see how this goes in the days to come. The day after is not at all clear. There are many different scenarios, and we will have to see what happens. But at one go, I think Donald Trump has given the killer blow to international institutions, international law, something which he has had scant respect for in any case.
That's indeed important, and there is a UN Security Council meeting later today, and one really wonders what will really emerge from there either. Ambassador Bhojwani, just a month back on CNBC TV 18, you had said that whatever Donald Trump was trying in Venezuela, they had carried out strikes at that time on certain drug boats, and you had said that this was clearly an attempt to take over Venezuelan oil reserves, maybe carried out a regime change. All of that has happened. But will taking over Venezuelan oil reserves be easy? Can they do so overnight?
Parikshit, I think there are a couple of things here. First of all, I don't think the US is interested in really taking over in terms, as Navteej said, the day-to-day governance of the country. They are interested in regaining their lost influence in Venezuela. Venezuela, as you know, since over 2 decades, has moved away from the US influence and has radically opposed US presence in the Caribbean and elsewhere. It has co-opted Russia and China in a way, militarily also, and also economically, because China today buys the majority of 70% of the oil that Venezuela produces, which is very low compared to what it could produce. But nevertheless, so the US has primarily seen this as a strategic problem. Secondly, they needed an in because their majors, the Exxon, ConocoPhillips, etc., had been threatened by Hugo Chavez, who had raised royalties and so on and so forth, and they opted out of the country. Hugo Chavez then expropriated the wells and their concessions, and they've been fighting legally now for 2 decades without any success. So what Trump has done in one fell swoop, he's got rid of a so-called thorn on his side, Nicolas Maduro, who basically, by getting the military to back him and the militias that his predecessor Hugo Chavez had created, he's managed to stay in power, okay, by hook, mainly by crook, actually, we can all say that. Now the thing is that Trump wants American companies to get back in. Why does he want Venezuelan oil when there's so much oil already being produced? He's trying to reduce the purchases that any country makes from Russia, so Venezuela can offer an option. And in fact, our foreign minister had said so in so many words, that you're blocking us off from Venezuelan oil, Iranian oil, and now you're going to block us off from Russian oil. Now, if this opens up, what will happen, in my opinion, is that first of all, the US companies that were kicked out, literally out of Venezuela, will be allowed to go back in, make and recoup their losses, and get production moving again. And after that, we'll see what it really means. First of all, I think they will never tolerate a government that is in any way hostile or even inimical to US interests. So let's see how far that goes.
Right. Ambassador Sarna, coming back to you, do you think this current interim president, Delcy Rodriguez, can she put together a strong counterattack against Donald Trump? Will Venezuela, under the present government, stand up to US pressure, or are they going to give in? Because we hear varying remarks and reports.
I think it's very unclear, Parikshit, at this stage, because this is the former vice president, and she basically has
also the oil minister.
And the oil minister, and shown loyalty to Maduro, but she seems to have a kind of clearance as far as Trump is concerned, because he's at the moment come down against the Nobel Prize winning other candidate, who logically one would have expected that if Venezuela is going to move towards democracy and protection of human rights and so on, would have been the choice. But that's not what Trump wants. So at the moment, you have a very complex situation there, where you have people who have been supporting Maduro, who are still in many ways supporting Maduro, and are sort of there for the moment. How the internal rivalry between the former vice president, the interior minister, and the defense minister pans out. These are three very strong figures there. We will have to see. And whether there's going to be, an upsurge of protest against Maduro and all his cronies, that also is one option, but that doesn't seem to be happening at the moment. So it's very difficult to see where this is going to go at the moment.
Right. Coming back to the implications for India, Ambassador Bhojwani, OVL had stakes there. Of course, we were not importing much from Venezuela since the sanctions were put into effect. The oil embargo was put into effect in 2023. And even the oil production via OVL has been quite low. But do you think if the US lifts sanctions on Venezuela, OVL will be able to make good on its losses? We believe that the losses are somewhere to the tune of $500 million. And if their revenues increase, they could secure something like $1 billion.
Yeah, look, the thing is that OVL's presence dates back about 15 years. after Chavez came to India on his visit and signed up. And he was trying very much to attract India's attention. In fact, he wanted to have a strategic relationship, which we wisely avoided because it would have been a red rag for the West. Now, the thing is that, of course, their oil reserves are something which we definitely want to be involved with, not only because they're so vast, but also because our refineries, mainly the Reliance refineries, but now increasingly also our public sector refineries, have engineered and tooled up to refine the heavy crude, which is very cheap. See, when you have cheaper crude, $1 per barrel makes a huge difference. We import 7 million barrels a day. Now, can you imagine how much that means? It means $7 million if you get a discount on one barrel. So the point I'm making is that OVL will definitely look at this as an opportunity, and their shares have risen recently. Reliance, which has been importing at peak about 400,000 barrels a day till the sanctions kicked in, and thereafter in trickles also, they are tooled up for Venezuelan crude, and they've been making a lot of money in terms of refining margins, despite the freight costs from that distance. So it's a tremendous win-win for India, if sanctions are lifted on the export of Venezuelan crude. Now, what does that mean? It's possible, in fact, I would say probable, I could be wrong, that the Americans will first say, look, our companies are going in, you can have joint ventures with them, but instead of the Venezuelan oil company, PDVSA, the state oil company, we'll have our companies exploiting that oil and they'll sell it to you. So what will the price be? Secondly, if they're only going to allow exports or whether they'll allow concessionaires like OVL and others. We have a 40% stake in San Cristobal, which was producing over 100,000, maybe 200,000 a day. Now we have another concession in Carabobo, which is even bigger. But the problem is that these fields have either been shut down or they're producing oil that goes to China and we're not being paid for it. So OVL has $500 million plus outstanding, and even accounts haven't been settled as yet. So there's a lot that's going on, and if we can get to even import Venezuelan crude at a discount, that would be a start.
All right. That, of course, would be, as you said, would be a big win-win for both Indian public sector and private oil companies. We're taking a short break, but I'll request both Ambassador Sarna and Ambassador Bhojwani to stay with us. We'll be right back. Welcome back to News Center. We're discussing the implications of Washington's actions in Venezuela. Reports suggest that a US-led restructuring of Venezuela's oil sector could be beneficial for India. It could potentially help India recover nearly $1 billion in long-pending payments and restart crude production from oil fields operated by Indian companies. India used to be one of the largest buyers of Venezuelan crude, but this came to a halt when US imposed sanctions on Venezuela in 2020. Let me go back to our guests right now. We have Ambassador Deepak Bhojwani, former Indian ambassador to Latin American countries, and Ambassador Nafteet Sarna, former Indian ambassador to the United States. Ambassador Sarna, how do you see this? Economically and energy-wise, it could be a tremendous opportunity, but how should India read the developments in Venezuela? We, of course, have a lot of stakes in the Latin American region, exports from the auto sector. We're trying to have critical mineral partnerships.
Parikshit, I think, this has to be handled carefully. There are temptations to celebrate over, say, some economic gains for our oil industry. There are also constituencies, not in India, but all around the world, who are celebrating the exit of Maduro because he was known as a brutal dictator, and so on and so forth, and several million Venezuelans had to leave the country. At the same time, I think India has to keep in mind the manner of this operation, what it does to international order, what the precedents it sets for the time to come, and are we comfortable with that? Are we comfortable with the complete disregard for international law? What happens to multilateralism? What happens to predictability in relations? This is worse than regime change. It's basically leadership change. That I don't like you, so I'm removing you. And this might not stop at Venezuela. He's talked about Cuba, he's talked about Colombia, he's talked about Mexico. Statements have been issued by Greenland anticipating what might happen there after his comments in the same context. So I think India has to balance all these things. Whether economic gains, return of assets and money of OVL as against what it does to the fundamentals of our foreign policy, we have to stick to that. We have to stick to the fact that countries have to relate to each other in a certain way. And there's some things which are done and which are not done. And you don't just fly in and pick up the sitting head of state of a country and take him away at the only legality being of the Southern District of the Southern District Court of New York. There's no UN authority behind it. There's not even the US Congress authority behind it. And that is why opinion is quickly fracturing within the West and in the US.
Right. That's the next question that I'd like to ask you, Ambassador Sarna. What happens to the international order? You've got China. There are all reports stating that China is getting ready to invade Taiwan by 2027 or early or even in 2026. Russia has already not... the Russian war has been going on for 3 years and they don't want to put an end to it either. Middle East is on the edge. Does this give a free pass to everyone to say that if US is doing it, if Donald Trump can go ahead and do whatever he wants in a second country, we can do too?
Well, you can't replicate situations all over because, the contexts are different. The intersea power play in each region is different. But essentially, you are correct. These rules don't apply only, one way. While Russia and China have condemned this, you're quite right. They can, smugly feel that, they can actually do what they want. So it's a game now of raw power. It's not a very comfortable direction for the global South. Definitely not for countries like India, whose development, whose growth is dependent upon stable relationships, predictability, and having relationships all around the world. And so this does not say anything positive about the future of the international order or whatever remains of it.
Right. Ambassador Bhojwani, this is the first every year there has been a flashpoint for the last 5 years. This is the first flashpoint of 2026. What could this lead to for Latin America, for the global order in the next few months? This is not the end of it. There will be ripple effects.
Yeah, but there have been flashpoints all over the world, even in 2025, which continue. The Ukraine war is still on. You've got flashpoints in the Middle East. I mean, look at Syria. It's on the boil continuously. Look at Gaza, what's happening. And if the Arabs had anything in them, they'd be fighting Israel all the time. So it's not as if things are at peace. I mean, you've got, for instance, on the Thailand-Cambodia border, it's just, I mean, there are flashpoints everywhere. There's a lot going on, a lot of interests at stake. To the point about will this give a free pass to China and Russia, I think also we need to consider what capabilities these countries have. China can stomp around in the South China Sea and say, host a couple of boats of the Philippines and so on and so forth, but it cannot prevent US ships from sailing through the South China Sea. The US is the preponderant world power. And I think this is the most dangerous thing today. It's been the most dangerous thing for at least half a century because the US has just dominated world affairs, and it has done so in a manner which is extremely hostile. Let's not forget the Iraq war. And you don't even have to look at Iraq. Right. Look at Libya. Look at all over the world. I mean, the US has been brazen. Even the Yugoslavia invasion was not sanctioned by the United Nations. It's just that Europe went along with it. So the whole world thought, all right, fine. So the US and its allies go in wherever they want, and the UN is left to clean up things. And then everybody says, all right, let's go back to business, and so on and so forth. What I was saying about...
Bhojwani,
yeah. Sorry.
Ambassador Bhojwani, do you think there are any legal options available to Maduro? Yes, he will get an attorney in the US. He will be represented. But can he get out? Can the rule of law be restored?
Look,
can UN actually do anything?
Look, Parikshit, let's not be naive. I'm sorry. I don't mean that you're being naive. But all this assumes that there is still room for debate, dialogue, and decision-making at the international level. That's gone. That world order has been destroyed. It was destroyed even earlier in this century when the Iraq invasion took place. What did we do? It was, I think, a parliament that about 10 days after the Iraq invasion issued a statement talking about Ninda. What else did we do? Nothing. We've not done anything about Gaza. We've hardly said anything. This is nothing new. These are great power plays to which we are considered peripheral. And we are peripheral. And then we see what our interests are. In this case, okay, fine, maybe we'll get the oil out of Venezuela eventually. So let's not kid ourselves that and Maduro, as far as he's concerned, I don't know if at some point the regime or collaborators or whatever will come to an understanding, because as you know, Trump, about 3 weeks back, pardoned the former president of Honduras, serving 45 years in prison since 2022. He pardoned him. He was jailed for 45 years on drug offenses. And Trump pardoned him 3-4 weeks ago. So this is just it's a cruel joke. There's nothing that anybody can do, and Maduro, I think, will stay in jail.
Absolutely. Let me put the final question to Ambassador Sarna. Ambassador Sarna, now I'll ask about the India-US relationship right now. The trade deal talks are over. You know, Ashok Malik, he appeared on our program some weeks back, and he was of the view that the mood is turning sour in New Delhi because we've done everything we could. We've reduced our purchases of Russian oil, but we're not getting a deal. Trump is not signing on it. Now, in this new atmosphere that has emerged, what has happened on Venezuela, should we keep our guard up? If this deal doesn't happen, should we let things go?
Parikshit, I think the mood has been sour for quite a few months now. And I don't see, I don't see the trade deal, even if it comes through, as a kind of silver bullet, which is going to rescue the entire relationship and bring it back to status quo ante. I think we have to reassess the relationship from the fundamentals. At the moment, we have kept everything that we can keep in motion, all the pieces, the defense piece, the trade piece we are desperately trying to keep in place, and other aspects which are essentially security related. But the wide basis which was built upon a trust, which was built upon a strategic convergence of India's role vis-a-vis China in the Indo-Pacific, all that is at the moment open for question. So, while clearly our present stance on Venezuela is meant to be cautious, is meant not to anger, I suppose, the United States more than they already seem to be for some reason of Mr. Trump's knowledge alone. But I think at some stage we have to realize, we will realize, I'm sure, particularly if the trade deal, as you said, doesn't go through, that there's, we have to stand for certain things, no matter what happens to the India-US relationship. You can't have the India-US relationship, which is anyway in a sort of, kind of a coma, governing our positions on all global issues, just because Mr. Trump shouldn't get more angry than he is. At some point, this bluff will have to be called.
At some point, the bluff will have to be called. Thank you very much, Ambassador Sarna, Ambassador Bhojwani, for joining us with those very important views. We've completely run out of time, but thanks once again for being with us. That's a wrap on this edition of News Center. More news and updates continue right here.
Well, hello and welcome to Finding Alpha. I'm Nigel D'Souza, joining in from the Mumbai News Center. Well, with Budget 2025 putting more money in the consumer's hands, GST becoming leaner, and travel demand accelerating post-COVID, discretionary spends appear to be on the rise. Well, planning a holiday is just one thing, but playing the travel theme in markets is another. To help us out, break it down, we have Shobit Singhal, research analyst at Anand Rathi Institutional Equities, who joins us on the show. Hi, Shobit. Thanks a lot for coming down to the studio. And good to have you in Finding Alpha.
It's been a pleasure, Nigel, doing this show with you.
All right. Well, let's get straight then to the point. Let's get a couple of data points out of the way. India is expected to grow by what? 7 to around 8% approximately. Could you tell us what is travel demand expected to grow at? You know, there is a ratio that we look at with regard to travel demand in comparison to GDP growth. And also, what are the risks to this entire travel theme that everyone is so excited about?
So as you rightly said, so travel demand is directly related with the GDP growth. If India GDP growth is will continue to grow at around 6 to 8%, historically we have seen the trend that travel demand grows at around 1.5 to 1.8x of GDP growth, which is around 10 to 12%.
Okay.
Right? Now with the government initiative like GST rate cut and income tax bracket increase, and recently 8th pay commission. So we believe that discretionary spends in the hands of people will increase.
Okay.
And as per our calculation, around 1 lakh crore savings will be in the hands of people, and some part of it will be spent in the travel and tourism, right? And also, government is now aggressively promoting tourism, be it spiritual tourism like Ayodhya or Varanasi, island tourism like Lakshadweep, Andaman Nicobar, the winter tourism in north, and also infrastructure spending has increased, right? So just to give you an example, pre-COVID in 2019, we just had around 90 airports.
Okay.
And currently we have around 160 to 165 airports, new airports, right? And it has directly been in tier 2, tier 3, they have the new airports have been increased, right?
Okay.
And better infrastructure, better roads, and now with the new trains like Vande Bharat. And so we believe that combining all these factors, we believe that travel or tourism theme will continue to do good going forward as well.
Okay, all right. So you're saying broadly, if I look at a ratio, it should be 1.6, 1.7 times what the GDP growth is. That should be the rough estimate.
Yes.
And just that point with regard to the number of airports, what was it pre-COVID?
It was around 90.
And now it is at?
Around 160 to 165.
All right. So that's what's helping you get into the interiors as well of India.
Yeah.
What are the risks to these estimates though?
So
one-off thing with like COVID or something like that?
Yeah, so for travel, external factors plays a very key risk, right? So geopolitical tension globally, we are seeing the war-like situations.
Yeah.
Pandemic, COVID, we have seen.
Yeah.
Other than that, we don't see any problem.
Okay, all right. You know, Shobit, I've been traveling more as well in the last few years, and I'm sure you as well have been traveling more. But that discussion for another day. Let's focus on a couple of themes then. IndiGlo Aviation, you know, that's the market leader. The flight, though, ran into some rough weather of late. What's your take on it? You know, better times ahead, or do you believe, you know, the flight has just landed, temporary stop, and it'll take off yet again? What's your view on the stock? Plenty of chatter in the last month or so when they ran into trouble. Do you think it's a buying opportunity? If yes, why?
Okay. So IndiGo is a market leader with around 63 to 65% market share.
Okay.
Okay. And this market share they have gained organically. So post-COVID, we have seen two airlines have been shut, right? Go Air and Jet. And we have seen some operational challenges in other airlines due to supply issue from Boeing, right? So they have organically gained market share from 40% to now 60%. And also, IndiGo has strategically placed their order with Airbus since 2015.
Okay.
So currently, the order book size is around 900. Okay. So which will, and if you compare this with the other competitors like Air India, so they have order book size of around 500.
Okay.
And SpiceJet and Akasa, they have around 150 to 200.
Okay.
So we believe that IndiGo will continue to get one plane per week till 2035.
All right. So when you talk about 900 order book, that is 900 aircrafts in the pipeline.
All right.
And that's how you're saying that every week we'll see one aircraft that will be coming out of their stable, you know, for the next few years. Is that correct?
Yes.
All right. Tell us a little bit more about this, you know, because I recall that IndiGo was always the market leader domestically. But globally, I think Air India was still ahead. However, that has changed, right? So give us a few details on that front.
So recently, they have marginally went ahead as compared to Air India, and they have become the market leader with around 21.9% kind of market share in the international segment as well. as compared to Air India, which is around 21.5%.
Okay.
Largely because so Indigo has placed 321 XLRI and 350 wide body as well.
Okay.
So now you can go directly from India, from like Delhi or from Mumbai to directly to London, Athens, etc.
Okay, all right. So it's a leader both on the domestic aviation front as well as the international front as well. Got that. If you could tell me roughly two more questions with regard to Interglobe. It's a lean machine. Of late, it's been a mean one, but it's a lean machine. Could you tell us how does Interglobe's margins compare? See if I'm comparing it with global peers, point number one. And since you spoke about international travel, could you tell me as a percentage of their mix, how much comes in from international revenue?
So international, as of now, contributes around 23 to 25% of their revenue.
Okay.
And in terms of capacity, it is around 30% currently, which they envisage to increase it to around 40% by 2030.
Okay, all right. And margins?
And in terms of margins, so they are doing around 23-24% kind of EBITDA margins, which is highest in the globally. So if you see globally, global average EBITDA margin is around 16 to 17%.
Okay, all right. So you put your case out there. Interglobe is something that you like from here on. Let's move on to hotels then. Occupancies and ARRs, well, they have been increasing. Though one would have expected one to cool off as well, in terms of one of the two, either ARRs or maybe the occupancy. In this sort of a backdrop, which stock should one check into?
So, post-COVID, we have seen in hotels, it's a prolonged upcycle. So last upcycle, we have seen in 2004 to 2008 cycle, right? And largely due to the demand-supply mismatch. So demand is growing at around 10 to 12%, whereas supply post-COVID is growing at around 4 to 5% just.
So there's a demand-supply gap in the industry on the whole?
Industry as a whole.
Okay.
Right. And the top 10 metro cities, which contributes around 70% to the hotel chains, branded hotel chains. Okay. So there the supply is just around 4%. And large part of the supply is coming beyond the 60% of the supply is coming beyond the top 10 metro cities. So that's why post-COVID, we have seen a strong double-digit kind of growth in ARR.
Okay.
And occupancy has been also increasing steadily.
Got it, got it. But in this sort of a backdrop, then, what do you like? In terms of Indian hotels, we know has re-rated big time. But there are various other companies, I believe, that you see some valuation comfort. So which is the company that, that you would be betting on?
Right. So post-COVID, we have seen that many hotel chains like Indian hotels and all, so their stock price has increased by like around 10x. Right now, the valuations are not that attractive.
What is it at?
So Indian hotels is trading at around 25x EBITDA FY28 and around 28 times FY27 EBITDA.
Okay, and so you have a cheaper, stock that you like, and if you could give us triggers.
Yeah. So in the hotel space, we like chalet hotels. Okay. So chalet hotels has two segments: hospitality and the commercial annuity business. Right. Hospitality contributes around 80 to 85% of the revenue, and the rest is coming from the commercial annuity business. So we have seen that, and they are present in the top 10 metro cities only. So Mumbai, Bangalore, Hyderabad, etc. And now they are expanding into leisure as well.
Got it.
Okay. So currently they have around 3,300 kind of keys, which will expand to around 3,800 to 4,000 keys by FY28 in next 2 to 3 years, right? And in annuity business also, currently they have around 1.4 million square feet of space, which they have leased out. And it will, in next 2 to 3 years, it will expand by around 2.4 million square feet, which is like a double only.
Okay, all right. So
and here the margins are also higher in annuity business. So around 95% they make EBITDA margins.
Okay, all right. So chalet hotels is something that you like from the hotel industry itself, and valuation-wise, Indian hotels is at 25 to 28 times EBITDA, forward EBITDA, while chalet is at?
Around 16 to 20x.
16 to 20 times, all right, got that. Okay, but if you're taking a flight and you're checking in, require bag to pack, right? Safari has been the market leader. What a story by Mr. Jatia, brilliant over the years. Now, however, VIP has got a new promoter. What do you prefer from this space?
So we continue to like Safari Industries, right? So Safari has gained market share from both VIP and Samsonite, and they were the beneficial from the shift from unorganized to organized, right? So in 2015, Safari has around 15% kind of market share.
Right.
Currently, they have around 35% kind of market share, right? And they have strategically also increased their capacity as well to around 0.7 lakhs per month,
Right.
right? So, and going forward, and they are beating the industry growth as well. So if industry is growing at around 10 to 12%, Safari continues to grow at around double the industry size.
Right.
Right. And so we believe that, so we remain positive on the Safari.
You remain positive, but I think officially you have got a hold rating on the stock.
Officially, largely due to the run-up in the stock price.
Okay, all right. But still, preference between the two is Safari over VIP.
Right.
Just one quick word, there has been these new D2C premium brands. Mokobara, for example, they have made their presence felt. Does this pose a risk to a company like Safari? Because so many of these D2C premium brands is what I've been noticing in the market. How much do they constitute first of the entire market, if you could give us a rough number?
So all these new D2C brands like Mokobara or Nature Miles, Uppercase, right? So they combined contributes around 10 to 12% of the overall organized industry.
Okay, all right, 10 to 12%, and you believe they're not a big challenger to Safari because the focus area itself is premium, which is not such a big pull for Safari. Is that correct?
Right.
Got that. All right, let's focus on online travel agencies then. I believe you find some of these companies attractive. Ixigo, that's a stock that you like to us. So just explain to us first the business, what stands out for it, and the rationale that you're positive on the stock.
So Ixigo started in 2007 as a meta search platform.
Okay.
They pivoted to online travel agents in 2019. Okay. So currently in all the three segments, like railways, so they are the market leader with around 70 to 75% market share in the online train bookings.
Right.
They are the second leaders after Make My Trip in bus as well as airline segment.
Right.
Right. And they continue to gain market share across the segments. And post-COVID, we have seen that in B2C segment, not many players are there now actively.
Okay.
So after Make My Trip, Ixigo. Clear Trip was acquired by Flipkart in 2023.
Yes.
And Ixigo is and Is My Trip also, they are not doing that good.
Okay.
Right. So Ixigo continues to gain market share across the segments.
Right.
So if industry is growing at around 13 to 15%, Ixigo will continue to grow at double the industry size.
Interesting. And Ixigo, I believe they're into trains, buses, as well as flights. But you're seeing that there is a bigger trigger once they start penetrating into hotels. Is that something that you're working with? If you give us some analysis, what is the differentiator here? Is there better margins with there, better take rates? Help us out with some numbers there on Ixigo.
Okay. So currently that combined take rate across these three segments is around 5 to 6%.
Okay.
Right. And now because they got the money from Proxys around 1,300 crores. So they are now aggressively pushing into take rate can also double from 5-6% currently to around 11 to 12% in next 3 years.
So executing on the hotel part of business is going to boost their take rate, is going to boost their profitability as well. That's going to be important. All right, keeping that in mind. What about a company like TBO Tech? That's a B2B platform, right? We've been talking about that as well. What do you make of the recent large inorganic growth of TBO Tech? And also, how does that help them in growth, and how do valuations stack up for this one?
So TBO Tech is a B2B aggregator, right? So they connect offline travel agents to the suppliers like hotels, airlines, car, etc. 80%, so 60% of the GTV comes from the hotel segment and 40% comes from the airline segment.
Right.
So from the 60% GTV, so 80% of the hotels is from the international side,
Right.
which is a higher margin business. Okay. And airlines GTV, which is 40%, it's from the Indian segment, India to India or outbound India travelers, right? And so with the latest acquisition, Classic Vacation in US, so they were earlier trying to get into the US market. But with the Classic Vacation, they have got entry into US, right, which is a very big market. So we believe that going forward on an organic basis, they will continue to do it around 25 to 30% kind of revenue growth. Okay. Right, with steady margin expansion. And with Classic Vacation, they can easily do around 80-100% kind of growth.
Oh, all right. But this Classic that they have gone ahead and acquired, which helps them strengthen their presence in the United States, is there an execution risk? Because see, they got it at very good multiples, and also it adds substantially to the EBITDA number. Could you give us some numbers on that front? How much does it add in terms of profitability, in terms of revenues as well, this Classic acquisition? Because if I look at 2025, one of the big inorganic growth that took place was from TBO Tech. So tell us more.
So if you see Classic Vacation, GTV is 1/8 of the TBO Tech current GTV, but their revenue is just 1/3 of TBO Tech revenue.
Oh.
Largely because their take rates are higher. TBO Tech take rates is around 7 to 8%, whereas the gross take rate of Classic Vacation is around 23%.
Oh.
So they cater to the ultra high luxury hotel segment.
So net this will be then accretive.
Value accretive for TBO Tech.
All right, great. All right, Shobhit, I request you to just hold on to your thought for the time being. We'll take a short break, come back, we'll continue our discussion. We'll also answer some of the queries that we have received. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha, and we are discussing the entire travel theme. So since it's that part of the year where travel is picking up pace. And we have with us Shobhit Singhal, research analyst at Anand Rathi Institutional Equities, who joins us. Well, Shobhit, you've given us a fair bit in terms of your picks with regard to the entire travel themes. But we've got a few queries that are coming there. So I request you to take a few of them. Rohan Kumar writes to us from Hyderabad. He holds around 500 shares of Interglobe. Unfortunately, he bought it at around 5,700 rupees. He wants to know what's the long-term outlook on the stock. And he also wants to know if it's the right time that he should actually consider to switch into SpiceJet. What is your take, Shobhit? You know, just as an observer, SpiceJet, you know, if it was a real competitor or really was going to seize the opportunity, the stock price would be up much more. It appeared there was that trading rally that fizzled out. But what would your advice be to the person who's writing in? He's got Interglobe at higher prices. Would you tell him that, you know, maybe buy some more of Interglobe? Or would you say you could take a punt and maybe invest some in SpiceJet?
Sure. So there is a serious supply issue going on in the airline industry, right? So pre-COVID, it used to take around 7 years to get delivery.
Okay.
Currently, it is taking around 14 years, double, right? So someone who has strategically placed the orders will get the first delivery. So we remain positive on the Interglobe, largely due to the supply issue in the industry, and company has strategically placed the orders. And the order book is like a highest in the industry now. Currently, they have order book of around 900, as compared to 500 with Air India and around 150 to 200 with the SpiceJet.
Okay. So you wouldn't, you would say, and in fact, if someone is asking you, rather buy more of IndiGlobe if you bought it at a higher price? That would make better sense?
Right.
And stay away from SpiceJet, would that be the call?
So we don't actively cover SpiceJet, but we remain bullish on Indigo.
On Indigo, got it. All right, so I hope that answers your query. We also have Shyam Krishnan, who writes to us from Chennai. He holds around 50 shares of Yatra Online. The purchase price he has is around 148 rupees. He wants to know what are the future prospects with regard to this particular name. What's your advice to Shyam? Yatra, I'm not sure whether you'll have official coverage, but that stock sometimes has been making some big moves. Your view on it?
So Yatra has pivoted from a B2C to B2B after they acquired Globe Travel in FY25. So currently their B2B, which is like a online corporate travel, now contributes around 65 to 70% of the GTV. And B2C contributes around the rest, around 30-35%, right? In B2B online corporate travel, so the customer stickiness is there. Because once you integrate into their platform, okay, so you don't have to incur any cost of acquisition, or you don't have to give any discount. So here in B2B, the margins are also higher.
You're right.
Right? It's actually double as compared to the B2C. But here the growth rate, because the market is very restrictive, right? So the growth rate will be half of what the B2C player can do, but margins are double from B2C players. And now the valuations are also very attractive. So if you see on the valuation front, Yatra is now currently trading at around 20 to 22x of FY27-28 earnings, as compared to the other players like Make My Trip, which is at around 40 to 45x, and Ixigo, it's around 55-60x.
Okay, so you believe there is some valuation comfort in there.
Right.
So, I mean, but officially you all don't have coverage on the stock, but it appears that you all are quite positive on the prospects.
Yeah, right.
Just a quick word, since you mentioned B2B and B2C, TBO Tech as of now, they're totally only into B2B?
Yeah, so they are into B2B.
Oh, into B2B.
Yeah.
All right, all right. And the other one, Ixigo, just refresh that, because I've got a query that's come with regard to Ixigo. And they are asking us just to revise what is the take rates, currently in the verticals that they are. And as you said, hotels, it's much better take rate out there. So just revise that number.
So in bus, they have the take rate of around 11 to 12%. In airlines, around 7 to 8%, and in railways, they have around 5%. Okay. And if they execute well on the hotel segment in next 3 years, so the hotels take rates are much higher, around 15 to 20%.
Got it. All right. Also, your call with regard to Safari, where you're more or less bullish. Now, VIP, they have very able promoters who have come in there. And some believe that maybe with a brand like VIP, after all, everyone has a VIP suitcase at home. Do you think that turning around the company will be a challenge? Or do you think that can happen with a kind of brand recall? I'm aware that it's no longer the market leader. I think Safari has overtaken it off late. But how do you see that panning out? And also Samsonite, I think they were increasing some capacity as well. A quick word on that with regard to supply in the market.
Okay. So VIP, so there is a strong brand recall of VIP, right? So there were some management issues in VIP. That's why they lost market share, and they got the wrong because the demand shifted from soft to hard luggage. So there was a inventory pile up of soft luggage.
Yes.
Right. So with the new promoter P multiples, right? So we believe that if they come out with the good new collections in the mid to premium range, right, and if they execute well, I think again the VIP growth and margins can come back, but it will take some time to execute.
All right, and clarity is still awaited with regard to the vision of the new promoter, I think so.
Yeah.
All right, and what about Samsonite, the capacity that they are adding? Because I think they are, in third place, around 29 to 30% of the total market.
Right. So currently their capacity is around 7 to 8 lakhs per month.
Okay, and they are adding some capacity?
No, so with this recent added capacity, so overall the capacity is around 7 to 8, but pre-COVID it was half.
Okay, all right. Well, it's been a pleasure talking to you, Shobhit. Thanks a lot for coming on Finding Alpha. And just to revise to our viewers, Shobhit believes that from the aviation space, IndiGlobe is something that you're betting on. From the hotel space, Chalet Hotels is the one that you're looking at. And from luggage, Safari is the one that you pick up. And other plays, TBO Tech and Ixigo are the stocks that you like, and fairly optimistic on the prospects of Yatra as well. Thanks a lot for joining in, Shobit. It's been a pleasure having you on the show.
Thanks a lot, Nigel.
Well, on that note, though, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching. Stay tuned.
And welcome to our special show, Outlook 2026. Today, we're taking a closer look at India's household debt story using the latest data from the Reserve Bank of India's Financial Stability Report. Now, India's household debt has climbed to 41.3% of the GDP as of end of March 2025, up from a 5-year average of about 38%. Now, this tells us Indian households are borrowing more and borrowing more consistently. Although compared to some of the peers in emerging market economies, India is still relatively better placed. What's interesting is how households are borrowing this money. Nearly 46% of household loans are now consumption loans. So things like personal loans, credit cards, and consumer durables are being bought on credit. Loans for asset creation, like housing and vehicle loans, now account for about 36%, while only 18% goes into productive purposes like education, agriculture, or small business loans. On the savings front, net household financial savings have recovered to about 7.6% of the GDP in FY25 from 5.2% in FY24, but it is still below the pre-pandemic level. Now, overlay this with RBI stress test, which shows asset quality could improve from 2.2% as of September to 1.9% by March 27 under the baseline scenario, and capital levels will remain strong, reassuring that banks, NBFCs, mutual funds, insurers, they all remain resilient even under the most severe scenario. And we have a more nuanced picture emerging here. So today, the key questions are, is India's household borrowing becoming a risk? Are banks adequately prepared if consumption-led stress emerges? And does rising debt reflect confidence or compulsion? To discuss this, I'm joined by Dinesh Khara, former chairman of State Bank of India, and Madan Sabnavis, who is the chief economist at Bank of Baroda. Gentlemen, thank you so much for your time here, and a very happy new year to the both of you. And thanks again, for joining us on this 1st of January. Mr. Khara, let me begin with you. Household debt rising to 41.3% of the GDP, and most of this is actually to just finance everyday expenses and lifestyle. From a banker's perspective, do you see this as just credit deepening, the natural flow of things, or signs of more stress build-up potentially?
First of all, thank you very much, Ritu, for having me on your show, and also my heartiest greetings to all your viewers for the new year. Well, what you talked about, the increase in the household debt, and more so when we compare it with the previous 5 years, yes, of course, it's a paradigm shift, I would say, and it is also a behavioral shift in terms of how the retail consumers are being addressed. Part of it is attributed to the convenience with which this kind of a retail loans are also available. So I would say that it's a mix of both. So I think so long as the debt is going up is not as much of a challenge. If at all it can be repaid in good time, that is something which is more important to really monitor. And if at all, what we have seen is that, of course, when it comes to bureaus and the borrowers who are there, the quality of the borrowers are certainly improving. And part of it is also attributed to an effort made by the borrowers to ensure that their credit history remains strong. So I think this is the kind of a context in which I would like to really look at this number. But yes, having said that, it is equally important that there should not be reckless lending by any of the institutions, be it NBFCs, be it bank, or be it the digital lending. So there also one need to really have a point of caution. And if at all, it can be linked up with the ability to repay the loans. That could be the best of the scenario.
Important point there, Mr. Khara. Quality of the borrower and the lending profile, both of that needs to be kept in mind for context, and we'll get to that in just a bit. Mr. Sabnavis, to just bring you in, you've been an observer of the economy for a long time. This rise in household debt, what does it tell you about the state of the Indian consumer at the moment? Is borrowing driven more by income confidence or income stress? And, can we really take comfort in the idea that India's leverage is lower than other emerging market peers?
In fact, Ritu, I have a slightly different view out here, because if you look at developed countries and if you look at their evolution, I think a lot of it has been driven by consumerism, and consumerism has been supported a lot by leverage. So I don't think it's anything odd to see retail loans actually increasing, the personal loans going up, even for consumption purposes, because we should remember that consumption is one of the links to overall GDP growth. And today, when we say that consumption is not increasing, one of the factors is that, okay, there is high inflation, incomes are not increasing. So I think what is critical is that finance, that is borrowing from banks or any other financial institution, is a means to get access to this kind of consumption, which I think is a positive thing from the point of view of the economy. This said, I think as far as banks are concerned, you need to be a bit cautious in terms of lending. You should not get reckless, because normally there's always this tendency that when there is a certain wave which is going, like we saw earlier for infrastructure, there was a tendency to overextend loans to a particular segment. So here, I think when we are seeing prudential regulation from the point of view of the RBI and intervention like what they did a couple of years back for the unsecured personal loans, I think that is something which is very important. So I would say this is a necessity to see the economy grow. As you said, if they're doing it for a home or for an automobile, there is directly a good which we're seeing there. But even if it's for a non-durable good, I think it is something which does help the economy. But important part is banks have to be cautious, and the regulator has to be alert all the time.
Absolutely, Mr. Sabnavis, an important point there. Of course, developed markets like the US, very heavily consumption credit led. But, Mr. Khara, from the FSR data RBI's release, we can again see these unsecured loans, they still form 53% of the total retail slippages. And this is after what Mr. Sabnavis was just telling us, that there are prudential steps that have been taken. The risk weights on unsecured lending were increased. And most of this is also still coming from private banks. In that context, the shift in credit mix more towards consumption, less towards productive sectors. Is that something that should sound a note of caution at all?
Now, see, the point is that what you mentioned in terms of when you look at the slippages, well, aggregated level slippages, yes, of course, that's a matter of that we need to be watchful. But having said that, we also need to really figure out that which are the entities where the maximum slippages are seen. And perhaps, if at all their underwriting models will be subject to more critical review, then perhaps, we can fathom the reasons for the kind of stress which is seen there. This is a reality. And of course, as I mentioned, that, when the banks and financial institutions are lending, their underwriting models have to really keep in mind the ability of the borrower to repay such loans also. So that is a very, very critical component. Lending on the one side will help in terms of building up the book. But yes, of course, if at all it's not a good lending, then perhaps, the kind of provisions which are required to be made. And eventually, we have seen that, in the private sector bank space, a good number of such loans have been sold out or maybe provisioned also. And also they have been sold out to ARCs also. Yeah. So I think this is the other reality which we have seen. So I think overall, when we look at the macro number, it may not really reveal the complete story. We probably need to dig down and figure out that what is the kind of a behavior which is seen by the borrowers who have been extended such loans.
Yes, we do have to look at more nuanced data. So, Mr. Sabnavis, let me also point out, from the report again, 32.5% of the consumption borrowers are below prime. That is the RBI data. That's what it's showing. At the macro level, how vulnerable does this make household balance sheets? Let's say if job conditions worsen or, interest rates are set to rise in the second half of the year. How vulnerable will they be in that scenario?
they will definitely be vulnerable. So I think this holds for any kind of a cycle which you're talking of. And if you're talking of customers who are subprime, there's always a higher element of risk which is there. Now, normally there would be a case of saying that what kind of customers are you lending the money to? I think normally there's a tendency for banks, I think vis-a-vis the NBFCs, you normally lend to customers who are already your clients, on which you really have a record of what are their income flows and what are their expenditures, what has been their overall leverage. So to that extent, you have better knowledge of the customers. But of course, if it's a new to bank customer who has come in, you necessarily have to be a bit more careful, cautious, have your credit models in place to ensure that there's no reckless lending. But I think, see, banking itself is a business in which you have to take risks. Here we're talking of retail loans. It also happened to corporate loans, which you've seen in the past, because everything is susceptible to business cycles. So if you're a company, for example, if your business cycle turns around for any particular reason, you have tariffs coming in, which was a shock. Companies could be vulnerable, and that's why we said the SMEs are. Similarly, when you're talking of individuals, if you're saying that, okay, your incomes don't increase, AI comes in, you lose your job, then what happens to your loans which you have taken? That is definitely a concern. So I think there's a lot of, the important thing is that banks have to be very cautious to have the right kind of skills when you're evaluating such customers, and you should be able to balance risk when you're lending to customers or for the personal loan segment. Because in your quest to build a large retail book, definitely you should extend and take risks. So I think that's where the expertise of the banker lies.
Well, actually, Mr. Khara, let me ask you that the banking system's health is pretty much in the best shape that we've seen in nearly a decade, and now RBI is talking about gross NPAs falling to almost 1.9% by FY27. You know, how much confidence this kind of a projection really give you? And this cycle that Mr. Satnavis is also talking about, we've seen a bulk of the growth come in, from the corporate before, then retail. Now corporate has lagged, for banks like State Bank of India as well. Do you see that driving the next cycle, or do you think retail momentum will continue for the time being?
I think the point of time when the corporate was not really picking up, certainly retail became one of the major focus area for the banks, and it became a practice across all the banks. So I think if at all, corporate book will pick up, and there are reasons for that also, because when it comes to corporate borrowing, they are not dependent upon the market borrowing. They are actually introducing, they are the issuers of various instruments, be it the bond, be it the equity. So they are actually raising money from there. And also when it comes to, they have got sufficient cash in their balance sheets also, which is also being used for funding their growth or their working capital requirements as well. So I think with the kind of growth which is expected to really take place in the economy, there will be a point of time when they will actually start borrowing from the banking system as well. So I think when they start borrowing from the banking system, then perhaps, the retail may not grow as much from the banking system, but it will grow from the NBFCs. So I think, there is a difference, when it comes to NBFC and also the banks when it comes to retail lending. NBFC being very, very strong on the ground, their ability to ensure that the asset remain of the best of the quality is significantly higher as compared to banks. So naturally, their ability to take little higher risk is also very much there as compared to banks, perhaps. Banks, on the other hand, have got a very clear visibility of the cash flow of the borrower, and that is something which gives them the confidence. So that's how they really balance out the risk and the reward. And I think if at all corporates will start borrowing from the banking system, then perhaps we'll get to see much more borrowing on the retail side happening from the NBFCs, and which eventually will be picked up by banks, maybe as a direct assignment or maybe as co-lending, etc., etc. So that's how it is going to be. But yes, of course, today is a situation where banks are probably aspiring to become 65% retail, 35% corporate. But it may not continue like this. It depends upon the opportunities. If at all corporate lending or SME lending would have an opportunity, maybe they will actually change their portfolio mix to maybe 50-50 also. So that's how much of it will depend upon how the economy unfolds and what all opportunities are available when the economy unfolds.
Sure, and with the spate of reforms from RBI, we'll have to see if that picks up. Mr. Sabnavis, finally, do you see the net financial savings improving to 7.6% as a bit of a positive? Interesting numbers, 40% of the savings are still in deposits, 23% is in equity. It's still below pre-pandemic levels, but is the saving enough to offset this rising debt?
Definitely not. I think the net savings rate has to be higher. And I think we need to have more money going into deposits, purely from the point of view of banking. I think India is a bank-oriented economy where the larger part of funding comes from this particular system. So therefore, we need to see a higher rate of savings. And I think the point which you mentioned about funds going into the equity segment is, every segment has its own advantages. But from the banking perspective, we do see that there is a lot of migration or a diversion taking place. To that extent, we are seeing the kind of liquidity stress in the banking system. So what really happens is that your savings are not increasing, deposits are not going up. There's more intervention coming from the Reserve Bank of India in the form of open market operations. Now, this is not something which is sustainable over a longer period of time. It can take place for 1 month, 2 months, maybe for one particular cycle. But at the end of the day, we need savings to go up. And at the same time, the conundrum is that we also need consumption to go up, for which we're required to have banks finance. So I think it's a very interesting situation which we have here today, where banks will be the fulcrum of not just savings, but also in terms of funding consumption and investment.
All right. Some very interesting comments coming from the both of you, but we've run out of time. So we're going to have to thank you, Mr. Khara and Mr. Sabnavis, both of you, for taking time out for us today, and wish you both again a very happy new year. On that note, we're going to slip into a short break, but up next, smoking is set to get more costlier when the next month the compensation cess period ends. We'll get you details on that and a whole lot more when we return. Welcome back, and we'll shift focus to the day's market action, where the last read ended the day flat. Nifty holding on to levels above the 26,100 mark. Broader markets relatively outperformed the blue chips. Nearly 40 Nifty stocks ended higher, but ITC's fall kept Nifty's gains in check. Now, the new year also brings with it a slew of tax changes involving both direct and indirect taxes. To start with, smoking is going to get costlier from the 1st of Feb when the compensation cess on tobacco ends, and it will be replaced by a higher excise duty. The Indian government has notified the imposition of the additional excise duty over and above the existing 40% GST rate. Timsy Jaipuriya is here with a wrap of all of the major changes and how they affect you, Timsy. Let's start with the direct taxes and income tax in particular.
Well, as we turn the calendar to 2026, here are some of the big key tax changes that you and I should get ready for. Firstly, on the income tax side, the new Income Tax Act comes into effect from April 1st, 2026. It aims to make tax laws simpler, and the idea is to reduce tax litigation, compliance burden and disputes. Then comes the tax slabs and the rates. Last budget, the new regime of income tax was made even more lucrative, and thus the income earned between April 2025 and March 2026 will be now taxed under the new regime at these revised rates and slabs. This includes no tax on income up to 12 lakh rupees per annum and 5% rate for income between 4 lakh rupees to 8 lakh rupees per annum, and the maximum rate being 30% on income above 24 lakh rupees per annum. Next, on the indirect tax side, with now close to a month left for the union budget, a major expectation is that there could be customs duty reforms, which the government could announce. A slew of changes by reducing the tariff lines were announced in the last year's budget itself. However, further rationalization and simplification is expected this year too. And last but not the least, the line on the indirect tax side, the new GST reforms and the rates which came into effect from 22nd of September last year will continue, with new rates being 5%, 18% and 40% on select demerit goods. The change which was awaited and the wait is now over, because After this, what should be the duties on tobacco products? Well, that wait has ended. So as per the notifications issued late last night, GST of 40% on tobacco products will be effective from 1st of February, and this will mean the replacement of the compensation cess duties from the earlier regime. Remember, on tobacco, earlier taxes were 28% GST plus compensation cess duties, which will continue till 31st of January. And from 1st February, the new rates will be 40% of GST on all tobacco products plus 2 new levies on 2 different types of tobacco products. To begin with, on chewing tobacco, a new capacity-based health securities and national securities cess will be levied in addition to the 40% of GST, and on cigarettes, the central excise duty has been hiked, which will replace the compensation cess difference apart from the hike in GST rate from 28% to 40%. Industry sources say that this would mean a hike in the effective MRP on cigarettes from 20% to 40% for the consumers. And as I mentioned, budget is round the corner. Expectations are more reforms, easing custom duties and reduction in compliance burden, again on both direct and indirect taxes side. That's what is expected this time. Let's see what finally Finance Minister Nirmala Sitharaman unveils when she reads out the union budget for this year. Back to you.
All right, we'll keep an eye on that. Timsy, thanks very much for joining in. So that's the key tax changes. But let's also turn our focus on the auto sector. The industry expects the demand momentum to stay intact this year, with the thrust on premiumization continuing. Sudarshan Kumar is here to take the driver's seat to tell us where the sector made a pit stop last year and where it's headed in 2026.
For auto sector, the year 2025 was the tale of two halves. If you take a look at the demand till August 2025, industry was languishing, and except SUV segment, all the other segments were under pressure. Now come to September 2025, government goes ahead, does the GST rationalization. What it does, it brings the prices of all the segments, all the cars, bikes and even commercial vehicles down. And because of that, entry-level segment demand has increased sharply. If you take a look at the data of Maruti Suzuki, which is the leader in the entry-level segment, in the month of December, the sales of entry-level segment have doubled. It has reported sales of more than 14,000 units against 7,500 units in the same period last year. Another positive thing has happened is the CV upcycle has started for both Ashok Leyland and Tata Motors commercial vehicle because of GST rate cut. So what for 2026? Industry is expecting demand to sustain going forward, and premiumization is going to be the main theme as far as demand is concerned. Two other events can impact very positively if government implements 8th pay commission, and in the budget that is going to come in the month of February, if government announces an increase in capex, that will boost the demand for commercial vehicle. But what would be the risk? Two major risks. One, rupees fall against dollar. In the year 2025, rupee was the worst Asian performing currency. It has depreciated almost 5%. Second risk is the sharp increase in the commodity prices. You take a name, copper, aluminium, steel, precious metals, prices of all these commodities have increased sharply, and because of that, input costs for all these companies have increased. Now, to mitigate the impact, all these companies are looking at price increase. Some of them have already announced the price increase, and some of them are going to do very soon. So after a very strong 2025, industry is expecting another very strong year as far as auto sector is concerned.
Okay, another strong year for the auto sector in 2026. But 2026 is also going to be a pivotal year for weight loss drugs in India. Patents are going to expire in Canada next week, followed by India and several nations by March. The medicines have already taken off in India, with sales crossing 1,000 crore rupees in just the last 6 months. Ekta Batra is here with what we can expect in 2026.
2025 marked a breakout year for GLP-1 drugs in India, with all 3 major therapies finally entering the market. Mounjaro emerged as the clear leader, clocking nearly 500 crores of sales in 7 months of its launch, making it the top-selling drug in India. Wegovy lagged with around 50 crores in terms of gross sales, though volumes rose 70% to 45,000 units in November after an almost 40% price cut. 2026 will be pivotal. Semaglutide loses patent protection across multiple markets, including Canada, India, China, Brazil, and Turkey, accounting for around 33% of the world's adult obese population. The first expiry is Canada on Jan 4, 2026, followed by the likes of India and Brazil in the month of March. Canada and Brazil are each $1 billion markets for semaglutide, with 6 to 7 generic filers. However, approvals remain uncertain. In Canada, no generic has yet received clearance, with Dr. Reddy's facing a regulatory setback, potentially pushing launches to the second half of CY26 or even later. Street estimates for Dr. Reddy's range from anywhere between $100 to $300 million in terms of semaglutide sales in FY27 to FY28, however, contingent on dynamics such as competition. In Brazil, analysts expect 60 to 70% price erosion, translating into around $40 to $50 million in terms of annual revenue per player. India will likely see the fiercest competition, with at least 10 to 15 players expected within 3 months of patent expiry. Prices are expected to halve to around 4,000 rupees per month versus 8,000 to 10,000 rupees for innovator drugs. Companies are positioning across the value chain. For India, Cipla has partnered with Eli Lilly to market Mounjaro as Urpeak, while Emcure has launched Novo Nordisk semaglutide as Pavitstra. Lupin has signed an exclusive distribution agreement with a Chinese company to commercialize a GLP-1 drug, which is taken once in 2 weeks. Ajanta Pharma will also market semaglutide across 23 emerging markets for Biocon. On the back end, OneSource has 20-plus customers, and Gland Pharma plans to expand GLP-1 capacity to 140 million units by second half of 2026. Besides continued innovation, 2026 will also be a year where accessibility, affordability increases as semaglutide goes off patent. Analysts estimate that semaglutide could account for 4 to 5% of India's pharma market, adding 1 to 2% to overall pharma growth over the next few years. And when it comes to global GLP-1 estimates, the size of the market is estimated to go from the current $64 billion in 2025 to over $170 billion by 2033.
All right, Ekta, thanks very much for that. And with that, it's also a wrap on this special broadcast. Many thanks for watching. But stay with CNBC TV 18. More news and updates will continue right here.
Ladies and gentlemen, as is very clear, we also didn't want this community to be women talking to other women. We wanted to engage with the men because at this point in time, they are the ones across different organizations in the decision-making roles. And so we're very lucky to have an ally in Hitendra Dave and HSBC, and they've been our partners, steadfast partners over the last 3 years. Dave, it's great to have you back with us here in Bengaluru. A lot of momentum over the last 3 years. You know, as you look back at the journey that we've made, but more importantly, look forward, you know, where do you believe we are and what do you believe we need to accomplish?
Well, thank you. It's great to be back here, and good evening to everyone. I wish I could say we have changed the world in the last 3 years, and that inclusion is there in reality, in letter and spirit. But I think every time we've got together on this subject, in front of the cameras and outside the cameras, I think we all recognize that this is a multi-year, if not a multi-decadal journey. I just want to be realistic about this. But hopefully with each season, each year, each conversation, you know, every time you hear these wonderful stories, I remember, I think it was in Bangalore only when Mrs. Borwankar, you know, shared her wonderful story and the kind of courage she spoke about, right? Yeah. As a police officer, as a woman police officer, and where she actually said that looking away is as much as a crime. And so, I mean, that story just comes to my mind. So, so I think in the last 3 years, hopefully, we've started the conversation. Hopefully, many companies go back, many employers go back, many leaders go back thinking, yes, I need to do this. Let me figure out the how. And each year, as we make incremental percentage-wise progress, I think HSBC will feel good about the fact that we played our small role in having these conversations.
Well, it's not a small role at all. It's a pretty big role because, as I keep saying, the tragedy is that very often these conversations tend to happen on one day, on the 8th of March, when everybody crawls out of the woodwork to talk about why women matter and why women should matter. So what we've tried to do is to mainstream this conversation, and it is our third year, and we intend to continue to do that. So it's not, as you pointed out, it's not something that can happen overnight. It needs to continue to be hammered away, and we need to keep chipping at the messaging. But as you look at what's happening around the world today, Daven, there is a retreat from the ideas of inclusion, from the idea of equity. Does that concern you? Does that worry you?
I think every decision, every action will have some background to it, right? So I think as we all, and 100% of this hall, I'm sure, and hopefully hundreds and thousands of people on the television who are watching the television, I think almost nobody in their right mind can dispute this.
Yeah.
Okay? But how to go about it is a topic of debate, and we shouldn't run away from that as well. So I think there was a period of time where if everybody agreed with me and you, then that person was
we wouldn't need to do this. Yeah.
Yeah, but what I'm trying to say is that if they agreed with it, then they were a good person. And if they said, we agree, but we don't agree with the speed or the manner in which you're going about it, and they were called a bad person. So, and I think when we, as people who are like-minded, people who want to get this done, people who want to make sure that our kids or our daughters, granddaughters, whatever it be, have a much better chance at being the next Shireen Bhan or the next business leader or the next CEO of any bank, etc. So I think it should concern us, but it should also teach us a little bit, right? That perhaps this conversation is more complex and more nuanced than some of us might have been prepared for. But eventually, I think we are headed in the right direction.
Yeah.
As with any journey, there'll be the highs and there'll be the slips. And as long as we are headed in the long term there, I'm not too concerned.
Well, that's a very important point that you make, that this is a complex issue. It's also an issue that requires a fair degree of nuance. And it's also...
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space.
Avance Financial Services raises 1,200 crore rupees from existing shareholders, work with Pincus, Kedaria Capital and Alpha Investment. This fresh capital raised will be utilized to scale education loan disbursements, improve education infrastructure and deepen institutional partnerships, it said.
Myler Play bags $1 million as part of an ongoing funding round ahead of a Series A round. Rounds saw continued backing from CDM Capital and Credit Sison, along with new participation from Growth Cap Ventures. The proceeds will be used to strengthen core payment infrastructure, expand its product stack, and deepen integrations.
Dream Sports Fan Code announces an exclusive multi-year partnership with ATP Media to expand its sports offering with the addition of tennis as part of the agreement. Fan Code will hold exclusive broadcast and streaming rights to ATP Tour's marquee tennis events in the Indian subcontinent until 2028.
Amidst a raging debate on gig workers, a stress test of the quick commerce business model points to a fragile ecosystem. Gig workers can be paid more provided certain scenarios play out, and the average order value sees a sharp rise. Those were the headlines that we're tracking for you this evening. But on the hot seat today, Magma Group is scaling fast in India's circular economy and sustainable material space. The company has just consolidated its Series A round at $8 million, with existing investors, including Bill Gates-backed Capria Ventures, doubling down alongside fresh capital from Gujarat's state-backed venture fund. Profitable since inception, Magma posted revenues of over 215 crore rupees last year, with a 500 crore rupee order book and operations now spanning 12 states. Joining us now is Neil Tucker to break down the growth story, the fundraise, and what's next on Magma's expansion roadmap. Neil, thank you so much for taking time out and being here with us on Startup Street. You know, as I just pointed out, you've closed this $8 million Series A round with existing backers like Bill Gates-backed Capria Ventures doubling down, right? What gave investors the confidence to increase their bets at this stage of Magma's journey? Take us through what Magma is solving for and, you know, the kind of offerings you have.
Thanks, Arundhati, first of all, for having me. You know, it's great to be back on the show again. You know, a lot has progressed for us since when we announced the first close of our Series A, Arundhati. So, you know, it's been a meaningful journey for us. We have solidified our advanced materials business with the launch of our private label arm, Teramag, which now has a growing portfolio across glazing chemicals, coating chemicals, metallurgical inputs, polymer compounds. So we've grown a lot in the raw material space. When I talk about the green businesses, you know, we now have an active footprint across 12 states in India, spanning paper, plastics, biomaterials, some of which even getting critical market share in certain geographies. So the green businesses have acted as a good cash cow for the company. When we look at you know, the overall contours of the round, you know, we're so excited and lucky to be having our existing shareholders double down with this additional pool of capital. And predominantly, you know, the company has you know, operationally grown by over 40% in revenue since the beginning of this fiscal year. When we look at our gross margins, you know, they've grown by over 35% since the beginning of this fiscal year. So I think in just a short span of 2 quarters, we've not only launched businesses, but we've also grown existing ones. We've grown the numbers. And, you know, with the right sort of partners at Capria Ventures, Avinya Ventures, GVFL Limited, we continue to be excited to double down on the journey with them.
Sure, and you know, how will this $8 million Series A be deployed across capacity expansion, technology, and new verticals? And what do you believe will be Magma's strongest moat as competition sort of heats up in this space?
Yeah, no, that's a great question. You know, every call that we are making is backed by a 10 to 15 year vision, right? Advanced materials, green manufacturing, industrial recycling. We believe that these are actually the answer to India's precision manufacturing story today. And when we look at investing this new pool of capital that we've raised, we're looking at engineering and MRO as the next sector. Today, you know, Magma is serving over 300 factories, and we believe that our engineering and MRO vertical will allow us to cater to the precision stack for factories. So that's going to be a vertical expansion that we're looking at. We also want to double down on investing tech and the infra around it. Earlier this year, we launched Orbit, which is our order management system, which tracks every transaction. We also want to add transaction level mapping. We want to add financial mapping. We want to add geography tracking. So our fundamental vision is that every truck that goes dispatches through Magma is tech-enabled and giving our customers an ability to monitor high-value cargo. Even on the geographic expansion, right, Arundhati, as we speak, we have a truck getting loaded in Daman and Diu, a truck getting loaded in Odisha, trucks going around in Gujarat. So the ability to build right close to the factory floor, target industrial clusters, serve their critical needs is also where we're going to be spending a lot of capital and research and development around it. And lastly, with a diversified suite of offerings and looking at the competitive landscape, where we found our space is the precision backend stack. And that's where we also want to invest in growing the right team, having senior folks, making sure that we're able to achieve majority of our order book with the right kind of talent pool, helping us as we build from Ahmedabad.
All right. And you know, Magma's revenue has grown 75% year on year to 215 crore rupees. And you've been profitable since inception in 2022, right? So what's driving the strong demand across such diverse verticals, and which segments are sort of contributing the most today, and where do you hope to end next year?
Yeah,
this year?
Yeah, absolutely. So, Arundhati, we sit at a 500 crore order book. We are confident that we will achieve at least 75% of that, invoice at least 75% of that within this fiscal year. So, about a ballpark figure can be ascertained from that percentage. When we look at, our story, I think where we see Magma's moat is being supplier first. We've very creatively designed our supply stack to be mix of asset light, yet capex heavy, where process-led control is required. So when we look at like advanced materials, Magma Green, these constitute to be our core verticals, which contribute about more than 70% of our revenue. And driving margin expansion, right? Because when you're serving the precision requirements, when you're serving and replacing their virgin requirements, it's going to translate into some sort of process-led IP and integration that we've been able to build, and we believe that's going to be an important driver for Magma's growth story. But coming back to the supplier first point, right, Arundhati, we believe that the company has structured three models. A company-owned, company-operated model, which is essentially the facilities we run on the back end, a company-owned, dealer-operated model, which is where we do some capex upgradation and leverage our existing supplier, and thirdly, a dealer-owned, dealer-operated model, which is essentially our leased out and conversion cost-linked supply units. But fundamentally, it ties into one thesis, is that we want to lock in one side of the marketplace. The benefit we get as a business is because of the underlying marketplace model. There are pools of demand and supply that we're able to very clearly see in front of us. And if you have one side of the marketplace already locked in, is something that you're already managing, it can give you a clear signal on which areas to spend time on and where to double down and press the right levers towards revenue and bottom line expansion.
Sure, and you're targeting this ARR of 1,000 crore rupees over the next 18 months, right? So what needs to sort of go right operationally and commercially for you to hit that milestone?
Yeah, I think four things. One is, in a business like ours, capital rotation is a very important element. So when we conducted our financial due diligence by Deloitte last year, they noted a 18-day working capital cycle. It's now at close to about 30 days, which is still, really great compared to the incumbents in the space. But I think capital rotation is where, personally, I as a founder, I'm spending a lot of time on making sure that we have the right customers, we have the right capital rotation, we have the right debt partners, we have the right sort of vendors where we're getting extended credit terms. I think second is, when you're transitioning from a startup to an enterprise grade solution offering, you will also need to serve enterprise customers and enter into long-term contracts. And to be able to do that, you need a very consistent supply stack. And I think Magma is now entering that mature phase where we're able to take that on and pass it down to both our vendors as well as our downstream logistics partners. So I think that's going to be the second point. And third is, in a business like ours, we emphasize a lot on corporate governance, transparency. The goal of Magma is to be a very disciplined public market company in the future, right? And for that, we're laying down the right foundation by quarterly audits, making sure that every geography we're entering, there's the right sort of SOPs we're operating. So yeah.
All right, Neil, we're completely out of time, but thank you so much for joining us on the show today, and we wish you all the best on this journey going forward.
Thank you. Such a pleasure.
All right, moving on. Fitness can dominate New Year resolutions every year, but 2026 is shaping up to be different. Over the past year, fitness in India has quietly moved from being seasonal and aspirational to becoming consistent, flexible, and deeply integrated into everyday life. Consumers are blending gyms, digital workouts, wellness, and nutrition, demanding access over ownership. To decode what this shift means for India's fitness economy, I'm joined by Akshay Verma, the co-founder of FitPass, a super membership for fitness and wellness with a 78% retention rate and a growing footprint across Tier 2 and Tier 3 India. Akshay, welcome back to Startup Street. As 2026 kicks off, fitness once again tops New Year resolutions, but are we seeing intent convert into long-term behavior?
Building healthy habits. Building healthy habits. So every time you work out or you speak to a nutritionist and get a diet plan and log those meals, you earn hard cash. So while traditionally people thought that fitness memberships was something where you donated money and you did not show up for the rest of the year, but you bought a membership. So people made money by you not showing up. We're the first company in the world that is rewarding you with hard cash every time you show up, because fitness at the end of it is about showing up and about consistency.
Absolutely, Akshay. And fitness today looks completely format agnostic, gyms, home workouts, digital classes, wellness, nutrition. Flexibility now matters more than brand loyalty or fixed memberships. So Akshay, does this disrupt the traditional gym-centric model, and how critical is an ecosystem approach in driving consistency?
I think it is highly critical. It is so we don't have to think of gyms or any of these assets as where people are loyal to. People are actually loyal to experiences. It is the same thing whether it is with Airbnb or Uber or assets are not what people become loyal to. What experience they get there, how consistent their experience is what drives their loyalty and their consistency to keep coming back. So one is that I don't think people are loyal to gyms. People are loyal to experiences. Second, ecosystem approach is the only approach, because everybody knows that physical fitness has to go hand in hand with nutrition, and both of them have to go hand in hand with all healthy habits that build the ecosystem. And you need to track it, you need to measure it. There'll be days of less motivation. You have to build these healthy habits. And that's where our campaign of Thoda Fit Bano, Thoda Rich Bano comes in, where we're rewarding you exactly for building these healthy habits with hard cash. So ecosystem is the only way to go, where everything that a customer needs to be fit, get well, stay happy is in one place, and all of that data sits together.
Sure. And participation from Tier 2 and Tier 3 cities is rising sharply, Akshay. Is this growth being driven by consumer demand, or has access and pricing finally caught up with intent? Also with AI-led coaching and nutrition at FitPass across, 573 cities, how does tech actually build consistency and not just convenience?
This is a great question. So, no, I don't think pricing and access have been responsible for this. I think there is so much consumer demand that is still unmet that we are just following where the demand is. I don't think it was not that our pricing unlocked the demand. I think the demand existed, and our solution is the only one that can serve people at such a scale. So 573 cities, millions of users is a reflection of where aspiration is. Aspiration truly lies in Bharat. Even if you look at the gym infrastructure, only 30% of India's gym infrastructure is in the top few cities, the 10, 12 cities that we count. All of the 70% is actually in Tier 2, Tier 3. So the demand already existed. How does tech help personalize and build consistency? I think there is no other way. You need people to measure, track, get nudged, reminders. There are a lot of small things and big things that tech helps in, where people are able to stay consistent. Because like I said before, fitness is not a means to an end. It's not a hack. Right? It's a habit.
Yeah.
And habits are built slowly over time.
Okay.
And that is where consistency starts rewarding. It's not about intensity. So all of that only tech can help you to understand each personal journey and then get you there and then let you stay there.
Okay.
Through your ebbs and flows.
All right. FitPass, Akshay, reports a 78% retention rate in a category known for drop-offs. What are you getting right in turning short-term motivation into long-term habit? Also, your corporate wellness platform now reaches over 17 lakh employees. Are workplaces emerging as the most underrated growth engine for fitness in India?
Well, these are very good questions. What we're getting right is, I think we're the only people who made consumer the king. Right? From an infrastructure point of view, where gyms or the supply side was very restrictive, in their pricing model, in their access model, all of that. So consumers did not feel like they had the flexibility, choice, or convenience. Suddenly, all of that power shifted to them. Now they go work out where they want, when they want, at home, at a center. They eat right. They follow up. So consumer became king. So all the friction points were broken. I think that is why people love us, and that is the 78% retention that we see, which is exactly the opposite of what the gyms actually see. Gyms see about 25% retention, means 75% of their customers drop off. We see the opposite because we made them the king. Are corporates the true growth engine? Yes and no. I think corporates that have understood that employees are assets and are forward thinkers have definitely started adopting this program at a high scale. When you say 17 lakh employees we serve, those are active. We actually serve crores of employees, out of which 17 lakh are active. So the potential of getting more people active is quite high. And now corporates who have global presence, who have global offices in the US and Europe, they have understood that fitness is not a productivity hack. It is actually something that helps them reduce costs, increase efficiency, retain talent. It's a cultural value. So those who understood are a growth driver, but there are a lot of promoter-driven Indian companies that have not yet gotten there. But yes, the trajectory is right. So is it a growth engine? 100%.
Okay. Yeah. One final question before I let you go. You're clocking, what, 173.9 crore rupees in ARR, 205% organic growth, and you claim a 54% market share. Akshay, with this kind of scale and traction, should we expect FitPass to play a leading role in consolidation, in consolidating India's fitness ecosystem through partnerships or acquisitions?
100%. I think you will hear about a lot of that. So those numbers are from last year. So these numbers, when we release them this year, will surprise you even more.
Okay.
And yes, consolidation is something that is already in the works, and that is the only way, because it is a very disaggregated ecosystem. So somebody has to bring it together, and we'll be honored to play that role and build the country's first integrated ecosystem for fitness and wellness.
Okay. All right, and we'll surely keep a track of that here on Startup Street. Akshay, many thanks for joining us today.
Thank you very much.
On that note, it is time for us to head into a short break. But coming up next, amidst a raging debate on gig workers, a stress test of the quick commerce business model points to fragile ecosystem. A CNBC TV 18 analysis on the other side. Stay tuned.
Welcome back to Startup Street. Demands for higher payouts by gig workers has been met with pushback from quick commerce companies. This has opened up a national debate on the business model and the perceived exploitation of these workers. It's a debate as old as time. Are profits being put above people? CNBC TV 18's Mangalam Malu dissects the prevailing business model to understand how it works. Take a look.
At a 600 rupee average order value, the platform actually makes a revenue of 120 rupees, fulfillment cost is 132 rupees, and they make a contribution loss of 12 rupees or a negative contribution margin of 2%. That explains why the average order value is everything in this business. At around 700 rupees, as you can see, the model finally breaks even around between 700 to 750, as you can see, and thereafter, there is contribution margin positive that comes in for these companies. Now let's talk about the quick gig worker. A quick commerce delivery partner typically earns about 40 to 50 rupees per order on quick commerce, and food delivery, which pays a little more than quick commerce per order, covers longer distances. So to that, what really matters is the earnings per hour, which could be between 70 to 20 after you account for about 20% in terms of fuel and other expenses. So for average work of around 9 to 10 hours per month and 25 to 26 days per month, we have an average monthly income of gig workers between 16,000 to about 31,000 rupees per month, which is actually slightly higher for a flexible work with earnings that are better than available alternatives. So what makes or breaks this model? The biggest revenue drivers, as we spoke, are average order value or the gross margin or take rate that these companies make. On the other hand, the biggest draggers are the rider payouts and dark store inefficiencies. Free deliveries and aggressive discounting also matter because they directly hit contribution margins. And in a competitive scenario, that's something that we will be monitoring. And here's the actual pressure point, which is the rider payouts. The business model is extremely sensitive to that. As you can see, at current costs, at 600 rupees, most of them are making contribution losses. But as you move ahead, 700 rupees of average order value, it is breaking even. But if 50 rupees moves into 60 rupees, if you look at the next plate, you would see that the average order value for you to be contribution positive or break even moves from 700 rupees to 800 rupees. And that's not all. Another hike of 10 rupees from 60 to 70 pushes it by about 1,000 rupees. So that is where the debate matters, because gig workers are not just a cost line, their earnings per hour determine efficiency, engagement, and long-term sustainability. The next time you place a quick commerce order, think about your basket size, the cost of fulfillment, and maybe ask your delivery partner how their day is going. That, in many ways, is the real anatomy of quick commerce.
All right, Mangalam, many thanks for those details. Now, after groceries, essentials and services, quick commerce has found its newest testing ground, fashion. From 30-minute party wear to same-day office outfits, speed is now reshaping how Indians shop for clothes. Shilpa Ranipeta looks at how startups and incumbents are racing to deliver fashion faster and whether this new model can actually make any money.
Fashion startups like Xylo, Knot and Zulu Club and D2C brands like New Me and Snitch are disrupting the familiar rhythm of clothes and shoe shopping in India. It's no longer about heading to the mall or store, trying on clothes and picking the ones you like. Nor is it about waiting a day or two to get delivery of online orders. The Indian consumer, well and truly hooked to quick commerce, wants that speed in fashion as well. It's not about urgency anymore.
So what behavior we have seen is a shift in how customer shops fashion. They're not doing planned shopping. They are doing fashion shopping instantly. They don't need to plan. They can buy fashion instantly. And this is the convenience and experience which is actually helping this customer to basically shift to this new way of shopping.
It's instant gratification, but that's the need of the hour.
Not just new players, Myntra was one of the first movers in the space with MNow. Reliance Retail's AGO Rush has also seen takers. Strong demand has these firms ramping up this offering.
We now have nearly 80 plus dark stores that exist across most of the metro cities in India, but we are also kind of going to the next set of cities very soon. And across this set of dark stores, we have nearly 20% of our customer bases in these cities and in these clusters have now started shopping on MNow.
There are two basic business models. One, a marketplace-led approach built around dark stores. Two, a brand-led approach using existing stores for quick fulfillment. Increasingly, even multi-brand e-marketplaces are exploring fulfillment through brand partner stores.
We did not rely on dark stores. We already have a dense enough network of stores in, tier 1 cities. For example, in Bangalore, we already have about 15, 17 stores. We are using some of those back room inventory to be able to fulfill these orders. We are trying to run our stores almost, or the back room of our stores like a warehouse to be able to, our pick pack times are within 3 minutes today.
Adding speed to a segment that has been all about trials, sizing and returns makes it trickier. Some players are betting on tech to navigate this. Some are letting customers try outfits on at home before finalizing the sale.
Look at the e-commerce platforms and the economics at which they are operating. It is far more economical to work at a try-at-home, bunched orders, all of those items across multiple brands coming in a single order. The delivery person waiting there for 30 minutes, even up to 30 minutes, and taking the returned bag. That unit economics is almost far more exciting for sustainably growing this business than just a distributed e-commerce delivery model.
Not everyone agrees.
I strongly believe try and buy is a waste of time. I don't think customers except certain cities are going to do try and buy. It's a very strong security risk where the delivery guy is standing outside your home. Try and buy itself, I feel it doesn't make any economic sense.
Investors say both approaches can work, but only at the right economics. Unlike grocery and essentials, fashion quick commerce will only work at much higher average order values. Say an order of 2,000 rupees or higher.
It's early days yet, and jury's still out on which model actually works better. But one thing is clear. Speed is fast becoming a permanent layer in fashion retail. So only platforms that can crack scale, dense demand and seamless last mile execution may survive. In Mumbai, Shilpa Ranipeta.
Well, with that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Hello and welcome to this special Outlook 2026 on CNBC TV 18. Well, we're going to decode what lies ahead for Indian markets, economy and more. Before we get started with our guests on the program, let's go across to Mangalam Malu, who's standing by with the results of the mega CNBC TV 18 market poll. Mangalam, take it away.
Well, you know, as we do at the start of every year, we poll a bunch of experts, the market makers, the decision makers, and all of them on what their outlook for 2026 is. And this time as well, we reached out to 50 experts across funds, brokerages, financial institutions, and this is what the street is really looking at. Last year was a 10% return for the frontline index. Dollar adjusted, it was mid-single digits, and a serious underperformance as compared to the world. So we started with what the street is expecting in 2026 for Nifty returns. About 55% said 10 to 20%, about a third of them said 0 to 10%, and very few expect a negative return. So the street is expecting some optimism, but expectations are fairly grounded. The second part, where should investors be positioned? Should it be large caps, mid caps, small caps, or micro caps? Remember, last year, mid caps and small caps were serious underperformers. But this time, preference for large caps is fairly high. 41% of experts say large caps still offer the best risk reward. This despite the sharp underperformance that we saw in mid and small cap indices in 2025. More than that, the street, while it is positive on mid and small cap, as we move lower down the market cap, we see the enthusiasm clearly tapering off, with literally no one vote coming in for micro caps. If you look at the sectors as well, financials have been the favorite for all the market experts we speak to on the channel, while some also speaking about tech and pharma as contra bets. But this time around, if you look at the results of the survey, nearly half of them are still pinning their hopes on the financial space, with metals and other sectors also finding some favor. Tech and pharma still, however, remain selective bets rather than broad consensus calls. What could be the driver of the market in 2026? Will it be geopolitical, India-US trade deal, earnings, or others? Well, while everyone talks about India-US trade deal as of now, earnings, that's something that will be the biggest driver of the market. Nearly 2/3 of the experts say earnings will be the single biggest determinant for markets next year. Trade deals and geopolitics, yes, they do matter, but fundamentals back at the center of the story. And speaking about trade deals, on the US-India trade deal, the start of last year, everyone was fairly optimistic. That didn't happen. This time around as well, people are fairly optimistic. Nearly 2/3 or 3/4 of them believe that the deal will happen in the next 3 months itself, with some expecting within 6 months. In fact, no one thinks it is not likely this year. So that's the one thing that we have to monitor in 2026. What about commodities? Last year was big for both gold and silver. The street believes that outperformance may perhaps not continue. They're betting on what? Copper and aluminum. Copper and aluminum, nearly 68% outperformance, 18 and 13% for gold and silver. This is a clear reflection of infrastructure, manufacturing, energy, transition themes that are taking place. What are the risks now? These are qualitative questions that we ask them, and the most used or frequently used words that came in terms of biggest risk to equities next year: geopolitical developments, the US markets, concerns around AI. Will that bubble or trade unravel? And Donald Trump's policies. That is something you can never take off the table. And clearly, the biggest swing factor when it comes to budgets, that's the one thing that we ask at the start of every year. What are the things that they will be watching out for in terms of announcement coming in? And here too, the market wants a couple of things. They don't want much tinkering with capital gains taxes. That's exactly what they're expecting. A fiscal stimulus coming in to boost consumption, higher government spending, and no removal or changes in STT, STCG, or LTCG. So those are a bunch of important, insightful data, opinions, and expert calls coming in for 2026. The big outlook, the CNBC TV18 poll, it looks like a year of steady earnings-led returns, less noise, more numbers, and a market that rewards patience over excitement.
Mangalam, thanks very much for that. Joining us now on the program, our Ikagai Asset Managers is Pankaj Tibrewal, and Demeter Advisors is Ashwini Agarwal. We're going to talk about what's ahead for the markets in 2026. So I'm going to start off with a poll of market participants on Nifty returns for 2026. Our poll showed that a majority expects 10 to 20% return this year, that is 2026. Around 32% expect returns ranging between 0 to 10%. And what we're going to do, Pankaj and Ashwini, is go over the poll quickly, and ask you whether you agree with the findings of this poll. And maybe on the second half, on the other side of this, we can discuss some of those reasons in greater detail. Pankaj, let me start with you. Do you agree?
I think I'll be more in the camp of 10 to 20%, in the sense that we expect earnings to start improving from 27 onwards, which is FY27. FY26 was a digit earnings growth for Nifty, and that should be helped by banking, autos, and some of the other sectors. And we believe that FY27, we should look at about 12 to 13% earnings growth. And in that sense, our sense is that market finally should track the earnings momentum as you move into FY27. So my bet will be on the second part between 10 to 20%.
Okay, all right. Hi, gentlemen. Good morning and good to see you all in. Well, Pankaj, I want to quiz you about a couple of sectors, and very few people were positive on metals as a counter call at the start of last year. But I recall you telling me that. And you came on the channel numerous times, you said metals, that's the counter call that we have. You're bang on. Now, the question is there more to go?
I think absolutely. We believe that the broader commodity cycle is starting to unfold itself. And it's not driven by anything on demand supply only. It's also geopolitical. Don't forget that the supply of commodities has been in very few hands. And all the incremental changes which are happening globally, whether it be AI, EV, or new tech, all require commodities which are very supply concentrated in few countries. And these countries are using commodities as a geopolitical tool for negotiations. So we believe that it will be a new cycle which will be unfolding in front of us. We have seen that in the form of gold and silver last year. It's spreading across broader commodities now, especially non-ferrous. And over a period of time, ferrous should also see some momentum coming in. So our broader call remains that metals should be one sector which should be part of the portfolio as you move ahead.
Got that? No, absolutely. Let's just go through a few more of our poll questions before I can ask you your specific ideas, etc. So let's just put up question 2, right? Which is the category to bet on in 2026? And just quick answers, and then we can discuss these. Large caps, mid caps, small caps, or micro caps. 40% said large caps, and about 32% said mid caps. 27% small caps, but large caps is top of the list. Pankaj?
So Prashant, I'll just take 2 minutes to explain.
I will come back. I want to, because there are 10 questions. I want to just quick answers, and then I'll come back to you.
Yeah, my bet will be mid and small caps combination of that.
Okay.
From bottom-up perspective.
Ashwini?
Agree with that view. I will also be in the camp of mid to small caps, bottom up.
Okay. The third question, sectors to bet on, right? And there was financials, tech, pharma, capital goods, metals, etc. 50% basically saying financials. The others are tech, pharma, capital goods, metals. Pankaj?
I'll add 2 more sectors to it, which is not the flavor of the season right now. One is consumer durables, and the second is chemicals.
Consumer durables and chemicals. Ashwini?
I agree with the view that financials will continue to do well this year. I think a lot of the underperforming sectors from last year, some names in the consumer sector, some names across the board. I wouldn't be sector specific, but I would focus on the cohort of stocks that are down 30-35% over the last 1 year and look for bottom-up opportunities there.
Okay.
Very sector agnostic.
Okay, all right. What about the key market drivers? Ashwini, you go first. What will it be? The India-US trade deal? Will it be geopolitics? Will it be earnings? What's your take?
I think nominal GDP growth, some uptick in inflation, stabilization of the US dollar versus INR. I think these would be the key to drive the market sentiment. If nominal growth picks up and the USD INR stabilizes, I think that's positive both for earnings growth and for foreign flows, and that's something I would look out for.
All right, Pankaj, what about you?
I think earnings will drive the overall momentum back into the market and FI flows returning back. I think we have seen 5 years of negative FI flows. I'm very hopeful that this year India will start seeing FI flows back.
All right, and I think, Pankaj, you pointed that out as well, that earnings are set to recover. Upgrades are more than downgrades, I think, in your newsletter as well. Ashwini, coming across to you, this is going to be a difficult one, but by when do we see a India-US trade deal? We thought we'll be first. We're still waiting by. Do you think it's in 3 months or 6 months?
Nigel, I have no idea. I would bet on 3 months. That's my hope, but it's a hope. There's no clarity on this at all.
Difficult one, Pankaj, to you, though. I'm hoping it's in the next few days. What do you think?
Beyond our pay grade.
Okay, 77% of those polled up on your screen say perhaps in the next 3 months. I mean, that's expectation. But markets are made up of all kinds of expectations. But this is the one. Like question 6, right? Top commodity asset class. Gold and silver did phenomenally well. The graphics will come up. Copper and aluminum. 68% said copper and aluminum is the commodity asset class for 2026. Pankaj?
Completely agree to that. And also will add the other bulk commodities like iron ore and coking coal, I think incrementally you will see every nation negotiating with the globe on commodities they are strong in. So I think we are entering into a cycle where geopolitical, repercussions will be very huge, and that will weigh on commodity price.
Ashwini?
Agree with that. Copper and aluminum. My sense is that real assets will see appreciation this year. A throwback to global uncertainty, which typically helps people focus more on real assets.
Okay. The one big announcement to watch is the question that we asked. That is capital gains, fiscal stimulus, something to do with STT, STCG, or is it higher government spending, and the results will come up. Pankaj, what would you say?
So if you ask me one risk which investors should be prepared for in 2026 is the global debt and deficit. I think very few will recognize that global debt has now moved to $346 trillion, and it is increasing at a pace of $660 billion every week. And that's something which is insane. In my view, at some point of time, if foreigners decide not to fund any more of US treasuries and the US yield starts to spike up, I think that's a very big risk investors are carrying into 2026.
And the budget, Pankaj? One big announcement?
Budget, I think budget, as the government has shown in the last budget also, should not be negative. I think it should be positive, and the feedback which has gone from the marketplace that please support the domestic investors. So I don't think anything negative should be coming out in the budget.
Ashwini, what about you? Budget?
I'm hoping that we'll hear more noise on privatization, which will release resources for the government to invest into infrastructure. The spending has become more consumption-oriented and less investment-oriented, which worries me. And I'm hoping that privatization will provide the resources to change some of that.
Well, time for a quick commercial break. Don't go anywhere. We're right back on Outlook 2026. Welcome back. This is Outlook 2026. You heard the mega market poll that we conducted. Lots of questions, lots of answers, but some clarity shining through. Pankaj, let me come back to you. I promised you I'll come back to you on your rationale. You always work with lots of data. And you had, on that question on mid-caps, small caps doing well, which is what your bet is for 26, right? Go on. Just explain that point briefly.
So, Prashant, if you look at last year, though the indices showed you single-digit gains, but the breadth of the market has been extremely poor. And this kind of a breadth I am seeing after almost 5-6 years. 18-19 was that kind of a year which we saw last year. And just to put two data points in perspective, though the NSE 500 is almost at a touching distance of 52-week highs, but if you look at the median drawdown, it's about 20%. And also the divergence between the indices have been very huge. So let's, for example, take the Nifty Midcap Small Cap 400, which is 250 of small cap, 150 of midcap. The indices since October 24 has given a headline returns of almost 2%. But the median return of that indices is negative 6.5%, which means a divergence of about 8%. And that is not only this index. You look at any other index, that's the similar story. And if you do an equal weighted index of NSE 500, it's negative 3% for the year, calendar year 2025. So the point is that very narrow leadership has taken the index higher. And our sense is that if earnings momentum starts to improve, which we are seeing for the last couple of quarters, we will see the broad basing of the market. And hence, you should see many mid-cap and small caps which have been delivering strong growth with balance sheet and cash. But only caveat which I would like to pick is, it won't be a runaway rally for the last 4 years which we saw post-COVID. I think it will be very bottom-up. Please don't forget the basic hygiene of balance sheet, cash flows, good promoter, good businesses. I think people should not chase too much of narratives. I think that can fall flat in 2026 because it will be a volatile and unpredictable year.
Okay, all right. Pankaj, quick fire to you then. Will India outperform in 2026?
My hope is yes, that after almost we saw the worst performance against emerging markets since 1994. We have underperformed by 28%. India is completely out of flavor. You speak to any foreigners, they will give you meetings just for relationship. But when India comes in, they have zero interest. I think that's a very, very big contrarian indicator that if something goes wrong globally in terms of AI valuations, US markets, I think India will find its flavor back among FIs.
And broader markets outperform the headline index in India?
I hope so. But I will say that it will be a bottom-up stock pickers market. You have to pick your bets very, very, carefully. It will not be a runaway rally which we saw from 2020 to 2024.
And is gold closer to the peak? And between the two, gold or silver, what do you like?
I think geopolitical, these kinds of events will make sure that gold and silver both are bidded out.
Okay.
But such a sharp outperformance, don't forget that we have seen sharp drawdowns in the past also. Okay. So investors should brace themselves for frequent, very sharp drawdowns as well. So don't, if you have an asset allocation process, just follow it. Don't get overboard on it.
And you were positive on metals, I recall, and auto ancillaries. And some of the stocks have started doing well. Would they qualify as the top themes for 2026?
I think precision engineering as a theme will be one of the biggest themes to bet in India. Globally, most of the large OEs, whether it be Airbus, Boeing, defense companies, are looking at these companies. And most of the auto companies, a few of them, are pivoting themselves from pure auto to industrials and precision engineering in these sectors. I think they can create huge value as you move into for the next 3 to 5 years. And few of the bets are part of our portfolio.
You want to name a few?
So we have been talking about, for example, Sansera. We have been talking about Happy Forging. And all these are through their capex, and incrementally the growth has started coming from aerospace, defense, industrials. And our sense is that many of them will see accelerated growth as you move ahead, because they are just pivoting them from a pure cyclical sector, which is auto, to other sectors which are more structural in nature from a growth perspective. So these are some of the names which are part of the portfolio. Don't take it as a recommendation to buy and sell, but we're just giving as a thought that precision engineering will be a great theme to play as you move ahead into the next 3 to 5 years in India.
I remember Sansera very clearly, Pankaj. I think was it about 1,100 rupees when you spoke about it, I think on the editors roundtable and maybe even earlier. So it's done well. Back to 1,900 rupees, I think almost at a new all-time high, I think, Sansera and others. So the theme is something you've been highlighting for a while. I just have one other sort of setup, and we'll just pull the graphics up in a bit. So while we do that, Ashwini, one sector, and which I think you track closely as well, is textiles. And of course, I mean, it's been bombed out because of this India-US thing. I call Gokuldas the India-US trade deal indicator, and that's back at 750, almost 750. What's your sense, Ashwini? Any hope?
So there are two issues there. One is underlying US consumer demand, where I think there is some uncertainty. It's been surprisingly strong, notwithstanding all the anecdotal evidence one is getting about job losses and about inflation being higher than what is measured in official statistics. But, if that were to turn down for some reason in the United States, that's a risk, for the sector. The second thing is what's going on, with tariffs in other parts of the world and the deals that India is signing. I think, textiles as an export opportunity for India will continue to do well. I think the companies would be well advised to look for a global customer rather than be overly dependent on the US is my take. I remain reasonably constructive from a medium-term perspective because we really have, durable competitive advantage in this area. Yeah. And my belief is that, when stocks get sold down, they should be looked into, and evaluations are appealing. One should be willing to purchase them. So in that context, if something's done poorly, that's always an opportunity to at least investigate, if not invest.
Yeah, no, absolutely. One other way, and there are so many ways in that sense to look at things, right? One, and Nimesh put this data out. He did this last year, I remember 2024, and he's done this on the editors roundtable last Friday. Simple thing. Look at the big laggards of the year gone by and see if some of them can flip on the other side of performance tables in the new year. So these are the biggest sectoral laggards of 2025. Real estate, 18% down for the year. The IT index is down 15%. And of course, there's other stuff as well. But these are the two big ones, right? 18 lower on real estate, IT down about 15%. And then stock-wise, the biggest laggards. Trent is down 40%. But of course, Trent was up very big in 2024. So it's kind of flipped on the other side in 25. TCS down 22, ITC down 17, HCL Tech down 15, Wipro, Infosys, Power Grid are some of the other big laggards. And any cues from out of this which strikes you as useful, Pankaj?
So the way we have our framework, Prashant, is that we look at that demand is very hard to predict. Just to give you a data that 7 out of the last 11 years, India Inc. top line growth has grown in single digits and lower than the nominal GDP growth. So top line growth is becoming very difficult to predict. And hence we take a call on margins. And we look at sector by sector where the margins are at an almost all-time peak or where the margins are below their averages. And in that, the margins which are at all-time peak are sectors, for example, hospitals. Clearly, that sector has got re-rated significantly over the last few years. And margins, there is a risk on margins. But when you look at some of the other sectors, for example, consumer durable we spoke about, the margins are closer or below averages this year and the last year. There's been huge competition, weather has not supported. And the second is chemicals. After almost last 4 years of non-performance, margins are very, very low. So I think when trajectory starts to improve in these sectors, you can get earnings growth plus re-rating on multiples as well. So our bet will be that have this framework of margin and top line growth. Top line growth is difficult to predict, as we have seen in the last 7-8 years. I think what we can take a call is the margins. And I think in that's consumer durables, power, metals that way, that was the reason we were contra positive at the start of the last year. And similarly on chemicals, I think that story is yet to play out. But we believe that 2026, you could see some of the events unfolding itself, which will be positive for chemicals as you move ahead.
We have to wrap up on this edition of Outlook 2026. Ashwini and Pankaj, thank you very much for staying with us. Viewers, don't go anywhere. More news and updates on the other side.
Welcome to our special show, Outlook 2026. Today, we're taking a closer look at India's household debt story using the latest data from the Reserve Bank of India's Financial Stability Report. Now, India's household debt has climbed to 41.3% of the GDP as of end of March 2025, up from a 5-year average of about 38%. Now, this tells us Indian households are borrowing more and borrowing more consistently. Although compared to some of the peers in emerging market economies, India is still relatively better placed. What's interesting is how households are borrowing this money. Nearly 46% of household loans are now consumption loans. So things like personal loans, credit cards, and consumer durables are being bought on credit. Loans for asset creation, like housing and vehicle loans, now account for about 36%, while only 18% goes into productive purposes like education, agriculture, or small business loans. On the savings front, net household financial savings have recovered to about 7.6% of the GDP in FY25 from 5.2% in FY24, but it is still below the pre-pandemic level. Now, overlay this with RBI's stress test, which shows asset quality could improve from 2.2% as of September to 1.9% by March 27 under the baseline scenario, and capital levels will remain strong, reassuring that banks, NBFCs, mutual funds, insurers, they all remain resilient even under the most severe scenario. And we have a more nuanced picture emerging here. So today, the key questions are, is India's household borrowing becoming a risk? Are banks adequately prepared if consumption-led stress emerges? And does rising debt reflect confidence or compulsion? To discuss this, I'm joined by Dinesh Khara, former chairman of State Bank of India, and Madan Sabnavis, who is the chief economist at Bank of Baroda. Gentlemen, thank you so much for your time here, and a very happy new year to the both of you. And thanks again, for joining us on this 1st of January. Mr. Khara, let me begin with you. Household debt rising to 41.3% of the GDP, and most of this is actually to just finance everyday expenses and lifestyle. From a banker's perspective, do you see this as just credit deepening, the natural flow of things, or signs of more stress build-up potentially?
First of all, thank you very much, Rito, for having me on your show, and also my heartiest greetings to all your viewers for the new year. Well, what you talked about, the increase in the household debt, and more so when we compare it with the previous 5 years, yes, of course, it's a paradigm shift, I would say, and it is also a behavioral shift in terms of how the retail consumers are being addressed. Part of it is attributed to the convenience with which this kind of a retail loans are also available. So I would say that it's a mix of both. So I think so long as the debt is going up, there is not as much of a challenge. If at all, it can be repaid in good time. That is something which is more important to really monitor. And if at all, what we have seen is that, of course, when it comes to bureaus and the borrowers who are there, the quality of the borrowers are certainly improving. And part of it is also attributed to an effort made by the borrowers to ensure that their credit history remains strong. So I think this is the kind of a context in which I would like to really look at this number. But yes, having said that, it is equally important that there should not be reckless lending by any of the institutions, be it NBFCs, be it bank, or be it the digital lending. So there also one need to really have a point of caution. And if at all, it can be linked up with the ability to repay the loans. That could be the best of the scenario.
Important point there, Mr. Khara. Quality of the borrower and the lending profile, both of that needs to be kept in mind for context, and we'll get to that in just a bit. Mr. Sabnavis, to just bring you in, you've been an observer of the economy for a long time. This rise in household debt, what does it tell you?
Supported a lot by leverage. So I don't think it's anything odd to see retail loans actually increasing, the personal loans going up, even for consumption purposes, because we should remember that consumption is one of the links to overall GDP growth. And today, when we say that consumption is not increasing, one of the factors is that, okay, there is high inflation, incomes are not increasing. So I think what is critical is that finance that is borrowing from banks or any other financial institution is a means to get access to this kind of consumption, which I think is a positive thing from the point of view of the economy. This said, I think as far as banks are concerned, you need to be a bit cautious in terms of lending. You should not get reckless, because normally there's always this tendency that when there is a certain wave which is going, like we saw earlier for infrastructure, there was a tendency to overextend loans to a particular segment. So here, I think when we are seeing prudential regulation from the point of view of the RBI and intervention like what they did a couple of years back for the unsecured personal loans, I think that is something which is very important. So I would say this is a necessity to see the economy grow. As you said, if they're doing it for a home or for an automobile, there is directly a good which we're seeing there. But even if it's for a non-durable good, I think it is something which does help the economy. But important part is banks have to be cautious and the regulator has to be alert all the time.
Absolutely, Mr. Sabnavis, an important point there. Of course, developed markets like the US, very heavily consumption credit led. But, Mr. Khara, from the FSR data RBI has released, we can again see these unsecured loans, they still form 53% of the total retail slippages. And this is after what Mr. Sabnavis was just telling us, that there are prudential steps that have been taken. The risk weights on unsecured lending were increased. And most of this is also still coming from private banks. In that context, the shift in credit mix more towards consumption, less towards productive sectors. Is that something that should sound a note of caution at all?
Now, see, the point is that what you mentioned in terms of when you look at the slippages, well, aggregated level slippages, yes, of course, that's a matter of that we need to be watchful. But having said that, we also need to really figure out that which are the entities where the maximum slippages are seen. And perhaps, if at all their underwriting models will be subject to more critical review, then perhaps, we can fathom the reasons for